That is a better lead.
Well, talking of rolling over, we started the show by talking about the relative resilience of the European equity story after the gains of yesterday and futures pointing higher. That has turned around. Futures now for Europe pointing lower by 0.2%. You're still looking at gains for the FTSE 100 pointing to upside of 25 points. Oil will play a role there with prices up 2%, closing in on $93 a barrel, about $93 a barrel right now on Brent. Interestingly, gold and silver still higher as well. So basic resources and the miners could get a lift. DAX futures, though, pointing low by 30 points, pointing low by about 0.1%. The stocks to watch, Hannah.
Yeah, let's have a look at some of these stocks to watch. We'll keep an eye on the pharmaceutical sector, the generic drug space in particular. A lot of this, President Trump now talking about a 100% tariff on some generic drugs into the United States in a couple of years. A lot of that will come from India, of course, but there are some European players in this space, so we'll keep an eye on that sector. Santander, very much in focus. We had the CFO on the programme earlier on, and he said that the company is on track to meet or even do better in some of the key performance indicators that they set out for this year, and so we'll keep an eye on the performance of that particular business as a result. And we've added JD Wetherspoons as well, because Tim Martin has said that the full-year profit is going to be below expectations, only marginally, but we would expect to see that one a little weaker at the open then, Guy.
Absolutely. Labour market costs certainly a significant factor for the pub business at the moment. OK, here we go. Let's show you some numbers, give you an idea of what is going on. We've softened up certainly significantly this morning in our expectations for the equity session. The FTSE 100 may get a boost from some of the oil market factors coming into play with the majors, BP, Shell, etc. So we'll watch out for that. There's a number of single stocks you want to keep an eye on. Santander is definitely one of them. Accidental Nobel is definitely one of them. The Airbus numbers last night, the outlook that they gave, they came out of Farnborough into London last night to update investors, and it was a really positive pitch, I have to say, having read through some of the details that came through from that. So we'll watch Airbus. FTSE is absolutely flat. Stock 600, I've got nothing really to tell you. CAC's down by 0.1%. The IBEX significantly. So it's going to be interesting to see what the market is saying about Santander this morning. Is a little off this morning, down by 0.5%. Certainly looks like a bit of an outlier. So is that a Santander story? We'll come back to that in just a moment. DAX and the SMI are not open. Tom, what have you got on sectors?
Top of the list is energy, not unexpected, of course, up 0.4%. That is the biggest gain across your sectors right now. Industrial, so some of the defence names, modestly higher. That sector is up just 0.1%. Just 4 sectors so far in positive territory. The rest seeing some downside pressure. The biggest loss is actually coming through for tech. That sector is currently down 1.4%. So tech, the biggest loser. Consumer products as well. So luxury within that space currently as a sector, that's down 0.7%. Biggest losses for tech, biggest gains for energy right now.
Yeah, yesterday tech was the best performing sector in Europe, wasn't it? So that's a bit of a turnaround for that sector, and picking up on that global narrative then. Only 4 sectors in positive territory, as you point out then, Tom. We've just got the opening price for some of those generic drugs makers, and it is a day where we're seeing markets down by 0.3%, and we see some underperformance then from Sandoz, which is down by 1.7%. So we were wondering how much of this threat from President Trump to put 100% tariffs on generic drugs, how much of that was going to be priced, and it seems as if maybe there's a bit of movement on that. So we've got that one a little bit weaker. I see Hikma in London is down by 0.8% as well. And Santander, to answer your question, Guy, down by 1.2%, despite the fact that he sounded quite buoyant on the outlook, it seemed.
Airbus is up a lot. So Airbus is the biggest points gainer this morning in terms of what we're seeing on the FTSE 100. I spoke to Guillaume Faury, CEO, a couple of days back. He was painting quite a positive picture, but last night they came into London, they had a big investor update. They talked about the fact they're going to put the engine issue that has really been a big factor for this company behind it, probably by 28. They painted some really positive pictures in terms of what they're seeing in terms of the outlook for demand. The market's really responding and re-rating that stock this morning. We're up by nearly 5% already on Airbus, biggest points gainer by some significant margin.
OK, let's widen the lens, talk to Will Hobbs, Chief Investment Officer over at Brooks Macdonald, get his view of the world this morning. Good morning to you.
Morning, Anna.
Thanks
morning,
very much for coming in. Well, we're standing on the precipice of another earnings season from big tech over in the US, and this feels important given the volatility that we inherit daily, it seems, from Asia and the technology session there, and to some degree volatility in the US tech space as well. What are you looking ahead for? What looks like good performance to you? What are the right messages for big tech to be giving?
Yeah, it's really, Anna, it's a fascinating juncture, isn't it? Because we've had this kind of hokey-cokey between those, in market terms, between those who are the recipients of this giant capex splurge and those who are splurging it. And markets have been trying to allocate how large is the pie that you will eventually win from all of this kind of thing. And so we've seen this incredibly, violent markets underneath more serene index levels. We're obviously, like everyone else, watching what happens with capex guidance. I think more broadly, though, the first thing to point out is that just looking at the banks, the major banks that reported, earlier in the season, the read on the macroeconomy in the US is pretty constructive, I would say. You saw an amazing quarter for corporate loan growth. You're seeing consumer delinquency levels quite moderate. Okay. You're seeing all that side of things. So I think looking forward, just getting back to your original question, really the biggest question now are kind of use cases, and this will dominate the rest of the year, I suspect. I saw you interviewing earlier, Santander, and asking, how are you going to monetize this? What are the returns? That's going to be the question, I'm afraid, you guys are going to be asking.
I know, and to Guy's question, if the costs and the benefits are very distributed across the P&L, it's very difficult to pin down what the return on investment is from this new technology. But you don't think we're in a bubble, and that ties into that thought. You don't think we're in a bubble in this sort of technology?
Not yet. I think, in a way, the sort of big things, I think generally we like to, overemphasize the regularity of bubbles. Bubbles are much rarer than commonly believed, I tend to think. That doesn't mean there's not areas of froth, but we saw that with the kind of leverage play on memory stocks, that there was an extreme moment, but that seems to have deflated a little bit. And actually, if you look at the Mag 7, they've been underperforming a little bit for most of the year. So I don't think there's anything that I would worry about too much. And the reality is that you're still, that's not to say that we haven't had a very intense kind of bull run this last 3 years, but you're still in the midst of this industrial revolution, in amongst an information revolution. And it's very hard to work out up or down in this period. But back to your question, the Santander question, and all of the other questions you're going to be asking corporates investing in AI, the key moment will be process change. As in prior industrial revolutions, it's not when you just buy and adopt and see some sort of changes in use case and various other bits and bobs and some efficiency gains. It's when, as in electrification, your factory managers change the processes of a factory around this new, more powerful general purpose technology that really matters. We're still undecided in terms of generative AI, the burlier brother of machine learning. But I think quite a lot of what we're seeing in productivity gains in the economy at the moment is more about machine learning. It sort of forebears a sense. So, yes.
You mentioned the hyperscalers. Does the sell-off that we've seen, the recent sell-off of hyperscalers, is that an opening? Is that an attractive opening for you?
So I think it's not. At the moment, we still focused very much on trying to look to the next stage of the kind of industrial revolution as such. So focusing on the adopters, and that's really knowledge sector players in a sense. So you're looking a lot at, in the UK, banks, legal services, and all those places where you are potentially enterprise data heavy but revenue poor. If this technology reaches its potential, then really a lot of the rewards to the stock pickers are going to be in the areas where you can get a little ahead of the game. And at the moment, we're still, in market terms, most of the excitement and the sex and violence in market terms is in the, the picks and shovels plays. This trade-off between hyperscalers and memory stocks and where are the supply shortages, and that's where the scarcity is. But as we move down the sort of next stage of this industrial revolution, technology revolution, really that's where a lot of the interest is for us, and the valuation appeal in trying to get ahead of the game a little bit.
How are you looking at European stocks through the lens of energy? At what level, Brent, are you modelling $100, 120? That's when it becomes a problem. How are you thinking about the European stock story in that context?
Yeah, so, I mean, I think what you are seeing in Europe, and again, this is something you pointed out earlier in the show, was that, you know, parts of Europe are actually picking up a little bit, and current activity indicators are looking a bit more attractive in Europe in particular. Not so much the UK at the moment, which seems to be bumbling along. Yeah, the oil price story, yeah, I don't know whether I would go for scenario analysis or just insurance in a sense. At the moment, we still feel that Europe looks to, you know, worthy of some part in portfolios, but not a dominant part. Our overweight is actually in UK equities at the moment still. That's been the case for a little bit.
Versus the US?
Versus the US. So we narrowed that 2 years ago. We had put on the overweight 2 years ago. We narrowed it 3 months ago. We're keeping with it at the moment because there's that valuation appeal. And also, I think the thing that's underestimated still about the UK economy and parts of the UK capital markets complex is that the UK is a knowledge sector superpower. This is one of the areas where the UK really has incredible comparative advantage across an array of knowledge sectors. As I say, if this technology reaches its potential...
You paint the picture of the UK as this kind of Silicon Valley. It's not. The valuations in this country are rubbish. We need to get them higher. They don't trade on the same multiples as they do in the United States. When you talk about narrowing it, what do you mean?
Narrowing it, we moved 3%.
Right, okay.
So it was a very heavy overweight, which paid off, actually. But I can't take any credit for it because that was my colleagues before I arrived.
Right.
Although, obviously, that's what we like to do, take credit unearned. But if you look at the valuations, I think it does mean, and again, valuations is a much longer-term indicator, as we know. It's not a tactical signal where you can turn around. However, on a 5-year view, if you're looking at where you want to deploy your stock-picking, fund-picking potential, I would say the UK is a very happy zone to start looking around more actively.
You talk to fund managers about the UK, though, they're really frustrated because there's a load of takeouts at the moment, and you see that happening on an almost daily basis. The companies get taken out. So what you've got to do is you've got to hold, and wait for that moment when the company gets taken out. Like, is that the strategy here in the UK?
Well, you hope that actually, I mean, as you know, markets, and you guys know this better than anyone else, markets can move in long-term kind of fads. And the UK has been out of favour for some time.
Yep.
Part of that is the sector makeup. Part of it is that the UK was just whacked to the floor by the great financial crisis in particular and has never really got off the canvas until maybe COVID. And so just investors have been under-allocated to this zone. Now, it might take something a bit more shocking in terms of earnings growth, improving return on equity, all the rest of the things to actually start getting people allocating more persistently to the region, because the US has been the story, and now it's Asia which is taking over a little bit. But I would say that that's, in a way, part of our job as investors is trying to look through the fads and try and allocate ahead of where the next fad might move. And my suspicion is that UK is underappreciated from that perspective. I get the frustration. That has been the story. But remember that, in a way, if you're looking at translating sort of, you know, what you're seeing in the universities in particular in this country, and this is underappreciated, is you are moving from, you know, knowledge to seed capital, and it's starting to move a bit faster in the various regions.
Yeah, we do seem to see more news flow in that, of that nature. But it's interesting to me, Will, that you look at a knowledge economy and you say that's set to gain from AI. Others look at a knowledge economy and say that looks vulnerable to AI. So what's the sort of the key to your view?
Yeah, I mean, I think you can look, for instance, in the part of the industry that that we operate in Brooks. You know, you can think about advisors, for instance, and how they advise clients on financial situations, tax planning, all those kind of things. One argument would just say, well, you know, tech can disintermediate those people. I would disagree with that very strongly. And again, if you look at past instances of technological change, it's more likely you get superpowers reducing your marginal cost to supply your service so you can supply more people with it. So we're seeing that already from our advisors, that a lot of the admin associated with serving an individual customer was forcing them up the scale in terms of wealth. As AI or machine learning does more of that admin cost cost for you, your ability to provide those services, legal services, all the rest of it is greater and wider. And that goes at the same time as the country and the wider world gets wealthier.
Nice to see you. Thanks for stopping by to see us. Always appreciate it. Will Hobbs, Brooks McDonald, CIO. Call 6 looks like this morning. Let's give you an idea of what we are watching here in Europe. Generally a fairly negative picture, particularly around the tech space. Certainly seen Nasdaq futures rolling over. ASML is a victim of that, down by 2.21. Schneider, to a certain extent, is off as well. But it's not limited to tech. You've got Novo off this morning. LVMH is off this morning. Rheinmetall is off this morning. Seeking some safety in Nestle and Verve this morning. OK, what else are we watching? Back to the Airbus story. I have to say, the update last night really has electrified, I think, investors around this space. The stock is up big this morning. Chloe Melly has more.
Yes, absolutely. Good morning, Guy. We are seeing Airbus firmly in the green this morning, up almost 6% after unveiling those ambitious targets last night, saying that it will have a €5 billion buyback, that it will double its profits, and also that the engine issues that had really been plaguing operations will soon start to fade. And so we are seeing that really drive the stock this morning, and we are, about almost 6% for Airbus this morning. On the other hand, we've got Wetherspoons, which is firmly in the red. We're down almost 10% after the pub operator issued its fourth profit warning this year. It's been dealing with those much higher costs. That is because of high labor costs, those high taxes, and also just cost inflation, energy prices really weighing on performance. And at the same time, it seems that there's been perhaps lower demand than expected. Maybe the World Cup boost was not as big of a boost as Spoons had hoped. And so we are seeing the shares down very strongly this morning. Moving on to the recruitment story, and we've got Randstad up more than 7% after some positive earnings in B estimates. This follows on from other recruiters posting quite positive results. We had Page Group and Hayes in the UK, and then Manpower in the US, also indicating that maybe this industry that had been in trouble for quite a while over the last few years is starting to see some of those green shoots. And so we're up about 7% this morning. Moving on to consumer goods, we have got Danone being double downgraded to a sell rating by Jefferies analysts, with those analysts saying that there's going to be a lot of competition in the US market and the Chinese market, both markets being, of course, very important for that company. And so we're seeing that weighing on the stock this morning, down more than 2%. And finally, AkzoNobel, the paint maker, is up. It's in the green, about 2%, after posting some resilient earnings. And in particular, it has some very resilient pricing, which helps it absorb cost inflation, and also volumes getting a bit better in the coatings division. So we have positive earnings story there from AkzoNobel.
Chloe Melly, thank you very much indeed, with some of the stocks on the move this Wednesday. Coming up, President Trump targets generic drug manufacturers, threatening tariffs of up to 200%. We look at the potential implications next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
2026 is the first year of this 3-year plan, and clearly we are on track, or even, on track to meet or even do better in some of the KPIs we gave for the first year of this 3-year plan. So we are starting on very, very strong footing, and we are very confident that we can deliver on the numbers we gave for the next 3 years.
Santander's CFO sounding quite positive. The numbers sounded quite positive. Anna Bosin sounded quite positive. The stock is down by 0.5%. I have to say, though, it's up quite a lot this year, which may account for the fact that it's down a little bit this morning. Tom Metcalf joins us, leading our banks team, to talk about this. It looks, these numbers look okay.
Yeah, I think context is all, as you say, the shares are up pretty strongly over the past year. So I think it's, slight dip in the shares, but probably just because they're kind of meeting those pretty elevated expectations. But as you look across the board, it's pretty strong, perhaps a bit light on the trading side, but NII was up. And perhaps that TSB restructuring charge was just a reminder, the bank has got a lot of execution to get through. And so with that, Webster, perhaps it's just a reminder, until that's all kind of cleared through, it's not necessarily going to be easy sailing.
So TSB and Webster, idiosyncratic, of course, to Santander. But is there a read across from other parts of the earnings story from Santander that we can take as we look ahead to other European bank earnings?
Yeah, I think in the core business, it looks pretty good for other Spanish banks. If that NII is up, you'd think that's just going to read across to the BBVAs of the world. And again, the other thing I always look out for is those provisions, those sort of nasty surprises or the signs of distress. Not really seeing that again. So it does seem like it's all kind of going to probably be a business as usual type quarter with a few idiosyncratic things for each bank.
And sticking with the finance beat then, Tom, since we have you here, we of course have a new Chancellor in the UK, and some of what he might or might not do with the UK economy and the banking sector might be of interest. I wonder how the finance industry has been responding to his appointment so far.
Yeah, I think broadly speaking, he's seen a sort of reliable, safe pair of hands, a common sense choice. So definitely a sort of sigh of relief in the city. But it's one of those things where literally his first day was yesterday, basically. And so there's just going to be a lot of speculation about what exactly, they ultimately come to do when, there's a lot of difficulties here with spending.
And you were asking about tax, weren't you, to the Santander CFO? That must be one of the areas. And Jamie Dimon's actually spoken about that and sort of push back in case there's an inclination to increase tax on the bank.
Yeah, it was a very well-timed release podcast he had where he was, saying similar things he said is like, look, we think the banks are overtaxed. We think it's unfair that a US bank like JP Morgan has had this sort of, kind of surcharge on us ever since the global financial crisis, which at least in their view, nothing to do with Jamie Dimon or JP Morgan. But no, quite carefully worded as well, not sort of saying, hey, I will do ABC if say, this taxes come in. But again, just a sign that there is no easy choices here. There's no sort of pot of money that, the Starmers of the world were not seeing.
When looking for the broadest shoulders,
Yeah, exactly.
just not Ed Miliband. I think, honestly, you talk about the first, all of those things don't sound like positives to me. They just sound like not Ed Miliband.
That's probably fair, I think, and that's kind of the thing. Is probably the biggest takeaway is, clearly Burnham is aware of the need to kind of reassure the bond markets, reassure the city, at least on that kind of critical point.
Tom? Thank you very much. Thanks for joining us. Bloomberg's Tom Metcalf with a look at the financial services sector, including earnings from Santander this morning. In other corporate news, President Trump says that generic drug makers have 2 years to move production to the United States or face a 100% tariff from August 2028. That levy could then double a year later to 200% in August 2029. This is, of course, if these generic drug companies don't move production to the US. Let's bring in Deirdre Hipwell, who's Bloomberg's healthcare and consumer team leader for EMEA, and joins us on set now. Deirdre, we can dissect this from a whole number of different angles, but thanks for joining us. So what kind of impact could this have on US consumers, US prices? We were talking earlier on in the program about whether this just looks as if it pushes up prices, whether you make them abroad or in the United States.
Absolutely. It could have a huge impact because about 90% of drug prescriptions in America are generic drugs, and that's everything from antibiotics, painkillers, cholesterol drugs, cancer drugs even. So potentially the effect is huge. But as ever with Trump, he makes these big announcements, but then the devil will be in the detail. So I think what we could see is what happened with the branded drug manufacturers, is we might see some carve-out or deals where generic companies try to come to agreements on pricing. So I think, we'd have to be on the lookout for that. But part of me does think he's just trying to get deals here, because giving them 2 years, I mean, if you want to get a manufacturing plant up and running, it's going to take at least 3 years. So it's not giving them much time. So they're going to have to hustle if they think that this is really going to come into effect.
Deirdre, has he had some success in arm twisting the pharma industry to build capacity, additional capacity in the US? Can you point to a win there?
Well, he's definitely arm twisting, that's for sure. Whether or not he's actually lowering prices for Americans, I think, is a question that will take some time to answer. I mean, we saw Pfizer, Astra, GSK, all the big drug companies all did deals with him, and a lot of them secured grace periods from tariffs for that time. But there is still a question whether or not this is actually lowering prices for Americans, because the drug supply chain has been built up over many years, and it's a very complicated supply chain. So I think it's not clear yet that prices are actually lower for Americans.
Who would lose out here? India looks like an obvious case, but kind of just give us a sense of who the target is, basically.
India would be probably the biggest loser. I mean, about 40% of their exports are pharmaceuticals, one of the top three, and I think it would be very, very difficult for them because they're already facing levies on steel, aluminium, autos, so they would potentially be a big loser. But also companies in Europe, like Sandoz is a huge generics manufacturer, and they have very little facilities in the US. So their CEO already warned last year that if Trump moved on generic drug manufacturers, it would lower choice for Americans, because some might just choose to withdraw from that market and focus on more lucrative markets.
And you say, though, obviously this is away from the generic drug side, but the wider trade, tariffs, drug story, a lot of the big names have done deals. And has that meant that we have a bit of certainty, Deirdre, as to what kind of tariffs they will face into the United States?
Yeah, well, as I said, quite a few of them have secured deals. They've got grace periods. Obviously, Trump RX was the direct-to-consumer platform that was launched, which discounted prices. So certainly, I mean, Trump will have some things that he can point to as wins against the pharma sector, ahead of the midterm elections later this year, because this has been a big push that he's made. He's often been very upset about the fact that he thinks people like Europeans and in other countries that patients there are getting much lower pricing than Americans. So he has a lot to point to. But, as I said, I think the wider question will be how long-term this effect will be, and is it really day-to-day lowering prices for Americans?
Okay, Deirdre, thank you very much indeed. Deirdre Hipwell, Bloomberg's healthcare and consumer team leader for EMEA. Coming up, talking of the cost of drugs and what it does to inflation. Inflation here in the UK falling. We're going to dig into the latest data with Rufaro Kiseri of RBC Wealth Management. That is coming up. This is Bloomberg.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
This is the opening trade. We are 30 minutes into the Wednesday session. Here's the picture across the benchmark then. Essentially flat. You are seeing gains here in the UK, up 0.1% on the FTSE 100. Energy and the energy sector is playing its role there. Bit of caution, though, more broadly in the markets because of Brent at $93 a barrel, because of the geopolitics, and maybe waiting on the sidelines to some extent ahead of the earnings out of the US later with Alphabet in focus. DAX pointing currently up 40 points. You're seeing relatively decent gains over in France. The CAC up 0.3%, adding 24, almost 25 points so far. Guy, you're looking at the detail.
Okay, let's get into the detail. I'm not sure the detail gives us very much, if I'm being honest, this morning. 258 up, 321 down, volumes a bit meh. Let's kind of park all that. Let's get on to some interesting stock stories where I think the action is this morning. Airbus out with a big investor update last night. They did it in London following the Farnborough Air Show, and the market is loving it. Basically, they're pushing beyond some of the kind of supply chain issues that they've been facing over at Airbus and painting a really positive picture going forward. The stock is up by 6.25%. We kind of had hints of this at Farnborough, but some numbers put on it last night by the team at Airbus and a really positive response. Randstad's out with some really solid numbers as well this morning. It's up over 6%. And Equinor in the energy space also gained. Numbers look good. The kind of the volatility in the earnings space also looks good for it. It is up by nearly 2% too. Laggards, JD Wetherspoons is certainly not having a particularly positive morning this morning, looking a little flat, down by 9%, 8.5%, 9%. The World Cup maybe wasn't quite such a big a factor, but the big cost problem for most big pub chains, certainly in the UK at the moment, is what is happening with taxation, with labour costs, with all of the kind of the taxation that goes around owning and running a pub. It is becoming more and more onerous, and you can see it really reflected in some of the numbers. ASML is down ahead of the big tech earnings we're going to be seeing later on. Santander is down 0.7%. The numbers actually, to most people's read this morning, look fairly good, but this is a stock that's done very well this year. Maybe just a little bit of caution, big price back in. Better to travel than arrive, to use the old cliche. That certainly seems to be the story when it comes to that stock this morning, Anna.
So those are the individual stock movers. Guy, let's get an update on some other news flow this morning. President Donald Trump is downplaying the prospect of immediate talks with Iran as the two sides continue to exchange strikes and Houthi militants in Yemen threaten shipping in the Red Sea. Trump vowed on Tuesday to respond if the Iran-backed group disrupted that waterway, but didn't specify how. Mediators are continuing efforts to restart negotiations, but Tehran has rejected U.S. claims it's seeking more talks. Earnings season heats up this week with Alphabet kicking off the mega cap results later today. Investors will be watching closely for evidence that the company's massive investments in artificial intelligence are paying off. Tesla is also out with results after the bell, with investors eyeing the EV maker's spending and progress on emerging product lines, including its autonomy and robotics efforts. And here in the UK, inflation fell to its lowest level in over a year on cheaper motor fuel and food. The respite for consumers may be brief, though, with higher energy bills set to complicate the short-term outlook. Tom.
OK, well, talking of inflation, that is certainly a factor for the BOJ. A redhead crossing the terminal right now. The BOJ, the Bank of Japan, of course, said to be open to raising rates faster than every 6 months. Faster than every 6 months. The yen getting a pop, currently at 162, so crossing through that 163 level, up just a little over 0.1%. You had seen a pop of about 0.2%. And the BOJ officials see recent yen weakness at levels we haven't seen since 1986 as an upside inflation risk. We heard Japanese officials from the finance minister this morning talking about bold action, but increasingly investors and traders have been looking through the jawboning, and the expectation had been that if the yen was to really have a floor under it, it would be the BOJ. And so I'm getting this redhead right now, which is interesting in the context that we've been hearing from the finance minister earlier.
I mean, the chart, it looks dramatic. It's not a big move, but it is quite a big story, isn't it? You know, a lot of people had said the government, the Ministry of Finance can intervene lots and lots, and we've seen them do that a couple of times this year, haven't we? But it's not until the BOJ steps in. A lot of our guests have told us it's not until the BOJ increases the rapidity, the pace of hikes, that we get some substantial backstop behind the yen.
How far will they go? How far do they need to go in order to stabilise this, get the yen back to levels that they feel, the government feels, are kind of appropriate? The implication of this is it's not kind of, we're not one or two more done. The implication of this is there could be many more rate hikes still to come from the BOJ.
Yeah, something we'll keep on our radar and look ahead to later on in the programme. Let's get back to the UK data out this morning. Joining us, Bloomberg Markets Today editor Sam Unstead with a look at, we started thinking about the inflation story out the UK, didn't we? So let's do that. The inflation picture then, Sam, talk us through the data. What have we learned today?
So I think you actually kind of mentioned this earlier, but the data today kind of has been a little bit overtaken by events that have happened since. So almost all of the slowdown in inflation was down to petrol prices. We started the month with oil prices hovering around $71. When I got up from my desk, they were heading towards 94. So that relief may well be very temporary. And then in addition to that, the change to the energy price cap comes in next month. So the headline data, the headline rate coming a little bit slower is good and relatively benign, you know, as far as it goes for the Bank of England. But the temporary relief is likely to be the case.
So the bank is going to look through the temporary relief and look further ahead. Is that the message you're giving me?
Well, you're now at the point where there's a lot of stuff they're going to need to look through. There's a lot of different inputs. And it probably does provide the Bank of England with a bit more time to keep watching, you know, because, you know, the core inflation and services inflation didn't come down as much as economists expected, but services still coming down. So all of these factors give them a little bit of time, a little bit of space to keep watching as you see whether you get more effects from the initial energy spike coming through from fertilizers in various parts of the supply chain, where the costs start to go from that. And now, you know, we'll have to see what happens because, as I say, oil prices are continuing to go up and hovering back above $90 a barrel again. And so that becomes another consideration beyond this initial one. So you've got kind of one spike, a bit of a cooling, and then another spike.
We've broken through 93 in this show. We've now just broken through 94 on Brent, so up 3.4% in today's session, to your point, Sam. Bloomberg's Sam Unstead. Sam, thank you. Let's get another take, a market take on what is happening in terms of inflation and central bank reaction, what it means for fixed income as well, and bring in Rufaro Caricieri, who is RBC Wealth Management Head of Fixed Income Europe. Rufaro, let's start on the UK. the markets are still traders are still pricing in about 40 basis points of hikes from the BOE. In the context of the inflation story we've seen today, in the context of what we're seeing with wages, in the context of what we're seeing from this new government, does that seem appropriate to you?
Our view is that we expect that the BOE would be on a prolonged hold for this year, and that's really predicated on what's happening in the labour market more strongly. Of course, the inflation data that's come through, and as Sam's pointed out, it is sort of showing some signs of positivity, but we actually expect inflation to track a bit higher in peak in Q4. So we're not expecting that the BOE would necessarily be reacting too much to the data that they've received today. But on the labour market front, we look at the lagged data. It's starting to show that there is weakness in employment. We are seeing that wage data is tracking lower. And then when we look at the forward-looking data, it's the surveys, the sort of decision-maker panel survey data, as well as the agent survey data. It's pointing to the fact that there is going to be lower employment and also wage inflation to stay around that 3.5% level. So labour markets are not as strong as they were back in 2022, and we think that's going to be the factor that keeps the BOE on hold. But of course, this oil story continues to be a risk to that view, and that could be the potential for maybe a hike to come through. But we think 40 is maybe overdone.
Okay, 40 may be overdone. It's really all about the labour market. Your expectation, are yields relatively capped here? Is the political premium priced in? John Healey in the Treasury as Chancellor. Where are we in terms of how you factor in and your views on gilt yields?
We think where gilts are at the moment, so we've crossed over 5% on the 10-year. We think we could certainly reach those peak levels that we reached earlier on in the year. But part of that is really going to be coming from that oil story. If we keep getting sort of escalation in what's happening in the Middle East, that's going to feed in negatively into gilts. We think the political premium is already baked in there, but we think there is still some room for gilt yields to track a bit higher from here. And, you know, as we look at sort of the political risks surrounding what's happening at the moment, the bond market will really be looking for what is going to be the sort of the fiscal message. Is it the adherence to the rules? And we know that that sort of flexibility, introduction of language was reacted, the bond market didn't like that. And so it's really going to be the case of what's going to be the policy announcements from here up until autumn, and then ultimately how does that look like for the fiscal headroom as well.
Yeah, Rafara, just sticking with the UK for a moment. I mean, what is the premium for UK debt over Europe? What is it all about? Is it reflecting underlying fears around inflation? You've mentioned the political risk. Sure, that's in there. But what could this new government, new leadership of this government do to try to bring down that spread over European debt?
I think when we look at sort of the UK fiscal picture, it certainly doesn't even have sort of the highest level of debt in sort of comparing to other G7 nations, but the cost of servicing that debt is at a much higher level in comparison to other countries. And so I think some of the aspects for the UK is that our inflation does come down a little bit slower than other countries because of these energy caps that we have. There is also that sort of lingering effect of what happened back in 2022 and that political risk premium also feeding into gilts as well. And so what the bond market would really want to see is really that fiscal prudence. It's sticking to the rules, and it's also setting out plans that are funded and, of course, having fiscal consolidation that seems realistic as well.
Yes, and actually getting some of that done, is that going to be a focus? Because we saw for the last 2 years there were attempts at fiscal consolidation, but then they were U-turned on. Is that's going to be a laser focus, is it, for debt markets?
We think ultimately, I think debt markets can accept that consolidation can happen over a longer period of time. But I think when you have a lot of announcements on reversals and also when you have instances where the fiscal headroom is diminishing quite considerably, then the bond market starts to get a little bit worried. But I think when we look at the prospect of any fiscal measures, what does that actually mean for DMO issuance? And I know we've looked at the public finances more recently where borrowing has been a little bit higher, but actually the cash requirement wasn't as excessive, so that's less of an implication on gilts. But ultimately, it's the cost of servicing that debt that continues to eat into that headroom.
How do you feel about France at the moment?
Well,
paying attention? Starting to pay attention? I just wonder at what point you think the bond market starts paying attention to next year.
I think ultimately we have seen spreads in France continue to track higher, and we have seen that, of course, as we're approaching sort of the elections for next year, the bond market is somewhat pricing that in already. But I think it will start to become more of a volatile period as we get closer and closer, and we start to hear what does some of that policy look like. But we have been underweight France for some time just because of that political uncertainty. We think there are other pockets within Europe that still are pretty interesting where you have less of a fiscal sort of risk. So we think areas such as Spain, that's particularly interesting. Areas such as Portugal, that's interesting. Italy, less so. And even with bunds, when we look at where bunds are trading at the moment, we think they can track a little bit higher. So we're comfortable being somewhat cautious of adding to bunds at the moment.
I was going to move from bunds to credit, if we can do that. How cautious should we be on credit, given the kind of record issuance we're starting to see?
I think from a valuation perspective, credit spreads are pretty tight, so credit looks pretty expensive. But when we look at it on a credit break-evens basis, credit does look pretty attractive. And I think that's been the allure for a lot of investors to go into credit. We have seen a lot of record issuance in the first half of the year. That's been taken up, and the demand has been pretty robust. We're not expecting the same pace of issuance in the second half of the year, especially coming out of the US.
Why is that?
I think because a lot of the financing has been done in that first half of the year. But of course, there could be some upside surprises. We could see some new deals coming back onto the table. But I think ultimately what we have seen is also the effect of the US tech issuance in other markets outside of the US. So we take Europe, for example, where the tech issuance is 4 times higher than the level it's been in the past sort of 4 years, especially in that sector. So we are seeing that the issuance out of the US is not just affecting the US market, but it's also filtering to other markets.
And I wonder how much, Rafaro, how much you think about the changing nature of the companies who are involved in issuing. So as you mentioned a couple of times, there's a lot of tech issuance. And that's been a real break with what we've seen in the past, where these were not businesses that maybe issued a lot of debt. And now they are doing, and they have quite good balance sheets, don't they? Still, they're not stretched. So how much does that change the metrics that we need to look at?
I think when we now look at the quality of the index, because some of these issuers are higher rated issuers, so it's actually improving the quality of the
sort
index.
Of flattering the index in a way.
In a way, but then what we're also seeing is that, say, if we look in the tech sector, the tech sector curve is actually steepened because of the issuance being skewed to some longer dated debt as well. So that is changing the makeup of the shape of the curve. But then ultimately, we think on balance, it's not every issuer is made the same. It's important to still look through at the fundamentals. As you rightly said, there's a lot of cash on their balance sheet. So when we look at their net debt levels, they're pretty good levels. But of course, as that cash flow starts to get diminished, as these investments go through, then that's going to be an area that we continue to watch out for. But we think it's an area to be selective in credit. But we still think there's some pockets of opportunity, even in tech.
Can I just take you back to the govy space? BOJ raising rates at a faster rate. Rates go higher in Japan. Does that pull money out of Europe? Do you think there's a negative effect that comes through off that?
I think when we're sort of looking at sort of the attractiveness of other markets, and so if Japanese yields are much higher, that's more attractive for domestic investors to sort of go in. And we also know with some of the policy effects to sort of make it more attractive as well.
They want the pension funds to bring money back as well.
And it starts to look a little bit more attractive for capital to flow to Japan. So we think certainly that could change the makeup of where investors are thinking about where to invest. It's certainly a yield hunting environment. We've got a lot of issuance coming into a market, so we certainly think that will make a change to investors' demand.
Rafaro, nice to see you. Thank you very much indeed for coming to see us. We really appreciate it. Rafaro Chiriseri, RBC Wealth Management, Head of Fixed Income Europe. Coming up, Alphabet kicks off the start of the reporting season for big tech a little later on today. We'll discuss what investors should be looking for in all of this. We'll do that next. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. 49 minutes into Wednesday's session, and the overall market actually dipping by 0.1%, but not perhaps in the major markets where we see a little bit of resilience. The FTSE 100 being maybe flattered by energy, but even that not doing too much to flatter it. We're pretty flat, actually, across these markets, Tom. Oil prices are not flat. They're up by 3.9% this morning.
Yes. Tech earnings, of course, in focus. Alphabet prominently, of course. Big tech names reporting this week, starting with Alphabet, kicking off the first set of mega cap results. Later today, investors will be looking for clues on how AI spending is reshaping tech. Of course, as chips, well, there was a strong rally at the start of the session in Asia. That faded. Let's get more with Bloomberg Intelligence analyst Matt Bloxham. Matt, what parts of the earnings story for Alphabet are going to be drawing your scrutiny today?
Yeah, quite a few of them, to be honest, because it's such a broad range of businesses. I mean, first and foremost is their ads business, which is still by far and away the biggest part of their cash flow, holding up in the kind of growing surge of AI. I think, so far they've kind of confounded their critics that actually search engine advertising is remaining very resilient, and they've done a good job of blending Gemini into that. Also, they're giving a lot of focus on CapEx again. They already upgraded the guidance for this year and said that next year will be even higher again. I think maybe not so much the CapEx number itself, well, that is important, but how they're generating returns against that. So a lot of scrutiny about all these big investments starting to pay off, both in terms of their own ad revenues, Gemini subscriptions, and also their ability to penetrate the enterprise market with Gemini. So a lot going on there, and there's more beyond that, but it's going to be the big focus for sure, I think.
Matt, let's get your take on a story that I think caught all our attention this morning, and that is this OpenAI story. A couple of OpenAI models meant to be in a sandbox, i.e. cut off from the internet. The AI models figure out a way to get out of the sandbox, i.e. get access to the internet, and then they go to try and answer the question that they've been posed, and they do that by basically going and hacking Hugging Face, which is another company's site. This is alarming, isn't it?
It is alarming, and it just shows you how powerful these models are. I guess in some ways, this isn't anything that new in the realm of cybersecurity. Technology advances, maybe the kind of bad actors get access to it first, and the good actors have to kind of catch up and then maybe preempt what's happening. And we saw this here. So, for example, in this case, an agentic system, as you say, with the guardrails lowered because they wanted to test its capabilities, was incredibly successful and hacked Hugging Face. And actually, Hugging Face used its own agentic AI systems to counter
but it
the
got
threat.
out of the sandbox. It wasn't meant to have access to the internet.
Yeah, it's intelligent. That's the label on it, and that's what happened with Mythos earlier this year too. They set it a particular task, it did that task, and then it just continued. And so it does provide a very clear warning that this technology potentially does have a life of its own, and there does need to be kind of quite close and careful scrutiny of how this stuff is released into to the wild, if you like. That's where we've already seen some kind of US politicians come out and say add more pressure to the need to kind of regulate and govern these things. I think it's going to be hard to kind of have effective regulation around this, but it's good to see that I think to some degree these companies are acting responsibly. They're being open and transparent about what's happened, why it happened, how it happened, and you're sharing information with companies so that they can kind of be more prepared for this going forward.
Okay, yes, and as we saw with Mythos, maybe it acts as an inadvertent sales pitch when you sort of alarm a lot of people about what your models can do. So we're looking at CapEx, we're looking at the regulatory impulse maybe around the big tech space. We're also maybe looking at the crowding out that AI is doing in other areas of tech, and this was a big theme in the IBM early release, and of course we get full numbers from them. But are you thinking about that crowding out? We're talking about AI so much. Boards are thinking about investing in AI so much. What are they not spending money on in the tech universe?
To some degree, and this may well be an incremental theme that comes up now. What other areas have we kind of missed, if you like, in terms of where spending's shifting away from? To some degree, we've seen this already in, say, some of the big IT services companies, like, for example, Accenture had kind of fairly soft numbers. Publicis that reported also has a big IT service business. They're seeing weakness still in that IT services. So it's not just a diversion of hardware budgets to specific areas. I think it's a divergence of software budgets into AI. Everything is AI, and if you're not AI related, then you're going to get deprioritized. And I think we're seeing this across every sector of the industry.
Okay. Matt, thank you very much. Matt Bloxham, Bloomberg Intelligence Senior Analyst. And everything is AI, Guy, which is part of the reason why we find it so difficult to pinpoint the return on investment in some of these P&Ls and balance sheets.
Yes. It's going to pose some challenges for the AI to figure out that return, I think probably somewhere down the road. That'll be a useful use case, maybe. Just want to quickly recap what we're seeing in terms of one of the big stories we've been developing throughout the morning, and that is this move here. We are seeing a positive picture emerging for the Japanese yen today. The reason for that, indications coming out of the Bank of Japan, the BOJ, that it is prepared to maybe up the cadence of rate hikes. We've seen a lot of jawboning, a lot of intervention. It hasn't worked from the Japanese authorities. The market's been waiting effectively for the BOJ to deliver more. Now we get hints that is about to happen. Warner Cunningham, editor at Markets Today, the newsletter, joining us now around the table. That's basically it, isn't it? We've waited for the Japanese. They tried everything else, and now they've got to do this, raise rates more aggressively.
Yeah, and they said that they will do so. They're prepared to do so, and that is by more than economists have been forecasting. So we have seen market reaction there. We've seen the yen recover after it's obviously been down at a 40-year low overnight. I think the question will be how long that lasts. It's one thing to talk about raising rates, and also just as the authorities have indicated that they would be prepared to step in to support the currency. But we actually need to see that happen, I think, for that trade to continue. Because
so the market's been convinced you actually have to get the rate rises?
I think you do, because at the moment, the other factors are still at play. I mean, oil prices are rising as we speak. There doesn't seem to be any letup in the escalation in the Middle East, and that's really what's driving those inflationary concerns in Japan because of the strengthening dollar, and we're seeing continuation of that trend this morning.
Yes, and oil prices are stronger, up by 3.6% now, Morwenna. Just briefly, this is continuing to raise questions about inflation, push yields higher.
Yes, exactly. And that's something which we're seeing around the world as well, but particularly, I think, in Japan because of that sensitivity. The dollar has been benefiting from this increased conflict, and that doesn't seem to be showing any signs of abating at the moment.
Yeah. Okay, Morwenna, thank you very much. Bloomberg's Morwenna Cunningham. On the subject of those oil prices, Iran saying that an exchange of messages is possible with the US, but currently no negotiations with the US. Those comments not moving the oil price all that much. It is still substantially higher.
It is. It's moved a lot higher this morning as well. Don't miss the conversation that we've got. Charlie Sharp's going to be on our air a little bit later on. He is the Wells Fargo CEO. Looking forward to that conversation, 2 p.m. London time. Thanks for watching. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Investors turned cautious ahead of big tech earnings from Alphabet and Tesla with concerns over massive AI spending and the chip sell-off last week. The White House plays down the prospect of immediate peace talks with Iran as Houthi militants in Yemen continue to threaten shipping in the Red Sea. And President Trump could threaten the future supply of low-cost medicines in the U.S. as he plans a 100% import duty on generic drugs to try and encourage manufacturers to move to the country. So there's a lot going on. If you look at markets, look, the main narrative is, of course, that these stocks are falling ahead of Alphabet's earnings. Traders waiting for the clearest read yet on whether the vast sums of technology hyperscalers are pouring into artificial intelligence will pay off. I'm also looking at crude prices. You can see Brent 94.22. Higher crude prices seem to be keeping a lid on sentiment after both the U.S. and Iran signaled they were in no rush to restart talks following an escalation to their conflict in the Middle East. And we go at gold 4,113 yen, 162.91. Now, if you look at Europe, a lot of them will actually be looking at earnings in the U.S. If you look at away from tech stocks, there's a couple of other things we need to watch out for, and that's, of course, some of the pharma stocks. The effect in Europe is not immediately felt, but for the moment, the CAC and the DAX, also the FTSE 100, getting some 0.3%. So for the conversations that matter and the insights you need, let's get started.
makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, more uncertainty this morning with the White House planning for tariffs on generic drug imports. There's also the threat of escalation in the Middle East. In just a moment, we'll be joined by Johanna Kirkland, Chief Investment Officer at Schroders. But first, earnings season heats up this week with Alphabet kicking off mega cap results later today. Investors, of course, cautious as recent volatility in the semiconductor market has underscored doubts around AI spending. So let's get more with our Bloomberg Intelligence analyst, Matt Bloxham. Matt, thank you for joining us. I mean, there's just a lot going on. So what are you specifically looking out for in the AI sector?
Yeah, so I think the big focus for me, at least, is going to be on the Google results because it gives you the broad spectrum of everything that's going on from the ads business, which is their core revenue and cash flow driver, which is to some degree under pressure from the AI shift, all the way through to their cloud business and what they're spending on infrastructure. So you kind of get a bit of perspective on every part of the value chain. I think actually what we're going to see is that the ads business is holding up incredibly well, probably growing more than 20% year on year, and that they're transitioning into a more AI-led internet environment than perhaps people worried they would. They've obviously already increased their CapEx guidance significantly this year, and have indicated that next year CapEx will be even higher again. I think people were looking for a little bit of an update on that, and if there's any clues about what significant increase next year means in hard dollar terms. But I think beyond that, it's also about whether they're actually starting to make any kind of return on investment in those big CapEx outlays. And so I think that's going to be a bit more of a kind of opaque set of Q&A, but I think that's where people are going to be focused.
Matt, then we have this pretty extraordinary story out today. OpenAI says its advanced artificial intelligence models basically inadvertently, hacked Hugging Face. I mean, this raises questions about, the ability to carry out cyber attacks.
Yeah, it does not. Obviously, we already had a kind of a precursor to this with the Anthropic Mythos that demonstrated incredible cyber capabilities. Seeing similar things with OpenAI's tools. I think what's interesting is that this was an agentic-led attack, and to some degree was kind of intentional. They were trying to test the capabilities of the model, but the Hugging Face responded with its own agentic AI capabilities. So you kind of got this new cyber warfare, if you're going on between agentic AI, just kind of raises the bar again in terms of what you need to be capable of doing in cyber warfare. And, it's good that OpenAI have been transparent about this. They're showing what they did, why they did it, how it worked, and they're working with the likes of Hugging Face so that they can understand the capabilities of these models, that they can boost their cyber defenses, so that hopefully we kind of end up in a similar situation where every day there's a warfare going on in the background on the cyber front between bad actors and good actors. It's no different in the AI world. It's just a lot more sophisticated.
But it also feels like a big deal, right? Because it's the first incident. So if you're a government, are you worried about regulation, and eventually will these models and systems be able to patch it?
I think you're worried about regulation, but you're probably more worried about systemic risk, really, and in many different ways. And I think probably that the risk of a major event happening now is much bigger than it was. There's always that risk, but I think that there was a good balance in cyber warfare. Now I think there are kind of unknowns, if you like, of what could happen. It could be really quite significant, both in terms of national security, financial systems, energy supply. So I think this has gone right to the top of the priority list for governments in major jurisdictions as they try to figure out the best way to contain and control this.
Matt, thank you so much, as ever, for joining us. Bloomberg Intelligence analyst Matt Bloxham. And let's get more on the AI trade with Johanna Kirkland, Chief Investment Officer at Schroders. Johanna, thank you for being here. Look, I mean, it's just a big day because we have a lot of earnings from the tech sector. Where do you see value right now? Are you going to find out this week whether actually we're going to see return on investments, or could it take longer?
I think Matt is absolutely right. The key question now is really whether we're getting that return on investment on all the expenditure. That would be the key question in the tech sector. In terms of value, I mean, I wouldn't say you can see value in the tech sector at this point. There's evidence of quite a lot of froth in the AI supply chain, which is really what's driven, I think, this sell-off in semiconductors in recent weeks. It's just too much froth in the system. We actually see better value. Obviously, value stocks, if one's looking for diversification from AI, value is a good strategy. But interestingly, quality is also looking cheap. It's quite unusual to get what I call the eclipse between quality and value. Why are those quality stocks cheap? Is in many cases they've been caught up with this AI disruption story. So that, again, it's the other side of the AI trade. But that is unusual and an opportunity, I think.
So what do you do with AI stocks or AI-adjacent stocks right now?
Well, we're looking at it. I mean, we've been advocating for a long time that you need to look at it stock by stock. We still believe in the AI story. The question is the valuation. And what we're concerned about is particularly the frothiness in the supply chain. Yeah.
So when you look at, I mean, do you have to stress test any other industries that you're looking at? Or again, is it too soon? I don't know what kind of timeline we should be looking at.
I think the challenge now with the AI story, so if you think about it, a couple of years ago, it was really a US mega cap tech story. Yeah. And really what we've seen in the last year, it's extending into Korea, Taiwan, so you don't get the same geographical diversification you used to get. And of course, it's now increasing as a percentage of the investment grade universe as well. It's prevalent also in the private asset world. So actually, when you try and do you can't diversify away from it in asset class terms. I think you really need to think through the portfolio construction on the equity side now. And it's the first time we've really been talking about that. We've been quite happy to ride a lot of these trends in recent years, but I think that now we need to start managing that risk. And so equity portfolio construction is top of mind at the moment.
So how do you do it differently?
I think we need to think about leaning back from some of the frothier areas, looking for opportunities in the quality side. As I said, exploiting this overlap between quality and value, which, as I said, is quite unusual.
I mean, there's also, of course, overlaying all of this, there's a risk of geopolitics, and that leads to higher inflation. I mean, inflation numbers haven't been too badly either here in the UK, Europe, but also the US. Is there a danger that we're lulled in a false sense of security given all of the geopolitics in the Middle East?
So geopolitical situation continues, and I think we've been advocating for a long time having allocation to commodity-related areas. We like energy for that reason, and I think you just have the hedge on, and then you try and ignore the daily volatility. We can't trade the headlines, but I think you need to have that diversifier in your portfolio. Bonds are interesting. We've generally been negative bonds really since 2023. But now we are at a point where we think that rate expectations are actually more realistic. If you think about it, we started the year with rate cuts priced in, and now markets are pricing in rate hikes. So actually, for the first time in 3 years, we're starting to see value in US government bonds. They're not diversifying. We're still in a stagflationary environment. But certainly from a trading perspective, there's potential opportunities. Of course, we're pushing up against the top end of the range at the moment. But I actually think the two things I've been worried about for the last 2 years have been the concentration in the AI theme and US 10-year, because that's the ultimate constraint on populist policy. Yeah. Right now, I'm more focused on the AI story as a risk, as opposed to the US 10-year, which I think now is better priced than it was.
Jana, what's your take on the Fed? Actually, it feels like new chair Kevin Warsh is on this push of credibility. Does that make him less likely to hike rates this year?
We think that they are likely to hike rates because even leaving aside what's happening in the Middle East, we continue to be of the opinion that the US economy is quite strong. The US labour market is quite resilient. So that would be our bias. I think there's a lot of talk about the, abandoning forward guidance. I actually think to some extent that makes sense. I think forward guidance gave a false sense of security. This idea that all the Fed government, that people knew exactly what they would be doing on rates. That is not the reality. Which is impossible. So I actually think that is probably a good shift. I mean, we managed without forward guidance for many years. It's a fairly recent phenomenon. So I think we can live with that. And I think that so far Warsh has demonstrated a need to maintain credibility. And, rate hikes are possible this year in the States.
Yeah, and the ECB is really, really pushing back against this forward, guidance. They really talk about scenario planning. I mean, the UK, it's been a big week because of the new Prime Minister. What are you expecting, and what does that mean for investing? If you look at the difference between treasuries and gilts, I don't know whether maybe it's time to think about gilts.
Well, I think there is we do need a bit of a political risk premium in gilts. Clearly, we're leaning a bit more left now. We'll have to see what they do in the next, as we head into the autumn. So that is a concern. A political risk premium, I think, is warranted. Yeah. But again, I think often when we look at the gilt market, we look at it in isolation, when really it trades in lockstep with global bond markets. Yeah. And given that we are slightly more relaxed about the US 10-year tactically, I think big picture, sell-off in the 10-year is what will ultimately end this bull market. But for now, with inflation behaving itself, more realistic rate expectations, we think we could muddle through the summer. And that means if the US 10-year is fairly stable, I think the gilt market can muddle through the summer as well.
So are you waiting for the budget, really?
Yes, I wouldn't be bottom fishing in UK gilts. No, I wouldn't. Because
anything in equities?
Equities, I mean, we're still tilting positive because the earnings momentum is there. So, we maintain that position.
I mean, there's been earning momentum across the board.
Yeah.
It feels almost in every region.
Yes.
Is that surprising, given everything that's been thrown at the economy in terms of trade, geopolitics, higher oil?
We've been positive on the market for a couple of years now, really on this idea that the cyclical outlook was positive. We've seen very low risk of recession. And, of course, all this government spending boosts nominal growth, and that hides a multitude of sins when it comes to corporate earnings. So generally, we've been positive on corporate earnings, and we think for now the evidence is it can continue, with some concern about froth in the AI side of things.
We're spending a lot of time talking about Japan. The BOJ, we understand now, is set to open the door to faster rate hikes pace. You know, the yen is something we watch closely. Again, do you look at that part of the world, especially Japan?
So we're long Japanese yen on this view that the BOJ will have to tighten policy. We're doing it against the Canadian dollar. Okay. So we're slightly, we're not going in the eye of the storm on dollar yen because, of course, there's the potential for rate hikes in the US as well. But we do like the Japanese yen against the Canadian dollar. We see opportunity there. Where do you see the biggest opportunities overall, again, given these risks and these shifting sands? I think the core position still needs to be exposed to equities. We're in an environment, a set of low recession risk with some inflationary risk. In that environment, equities are probably the workhorse in terms of generating return. You need to have some exposure to commodity-related sectors because of what's going on in the Middle East. And I think you need to think about tilting away from the more overvalued parts of the equity market, so thinking through that portfolio construction. But really, that is still the epicenter of our portfolio, is the equity risk. Emerging markets have been doing quite well. Will they continue on this trajectory? They're correlated with the AI trade. So know what you own and understand that it's not a diversifying position at this point in time if you're doing it passively. Generally, we like emerging market economies because, unlike the West, where we're throwing out the rule book on fiscal profligacy, actually, a lot of the policies pursued by emerging market economies have been a lot more credible. So structurally, we like them. We like emerging market debt. But I think if you're accessing emerging equity, if you're doing it passively, understand you are still correlated with the AI trade. Yeah. I mean, a lot of the stimulus over the last 8 months came from the U.S., right? And also a lot of the uncertainty. Does anything change after the midterms? Are you starting to think about, what that means for the U.S. politically, but therefore economically and the rest of the world? Yes, I mean, the big driver for us has been this idea that the U.S. had low risk of recession with this level of fiscal spending. And we have to see how that develops politically as we head into next year. So we're definitely late cycle here. And, I do get more worried as we head into 2027. Because valuations are expensive, because cyclically I think we might be petering out momentum-wise, because we need to watch inflation expectations. They've been very stable so far. Could they start to get unhinged? There are risks out there. But a big correction is your main worry, or just pockets of corrections that then stabilize? I think in the end, what I'm most concerned about is the point where I think we could be moving into an environment where rates are higher and we start to get a downturn in growth, which we haven't had for quite a while. So I would see that as a major shift in trend, but not something I'm worried about right now. I see that as a 2027 issue. Joanna, thank you so much for joining us today. That was Joanna Kirkland, Chief Investment Officer at Schroders. Now, coming up, President Trump threatens 100% tariffs on generic pharma imports. We'll have the details next. And this is Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
July 30th. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts July 30th, 12:30 p.m., only on Bloomberg. Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, President Trump says generic drug makers have 2 years to move production to the U.S. or face 100% tariffs from August 2028. Now, that levy could double a year later to 200% in August 2029. Let's bring in Deirdre Hipwell, Bloomberg's healthcare and consumer team leader for EMEA. Deirdre, as always, thank you for joining us. So what kind of impact could it actually have on consumers, but also on prices?
Potentially could have a really huge impact. About 90% of the drug prescriptions in America are generic. So any move to change how their supply chain works will potentially be, really quite significant. And, Americans are buying generics on everything, antibiotics, painkillers, even cancer drugs. I think the key will be to see how these tariffs actually take effect, because as we know, Trump tends to make big announcements and then try to strike deals.
So I wasn't expecting this, but I'm not in it as much as you. I mean, was the industry kind of prepared? Supply chains we know have kind of changed because of COVID. So is this just another layer, or does it really come out of the blue?
I mean, Trump has been targeting the drug industry since he came back into power. I mean, he has long expressed annoyance, concern, irritation in the way that only Trump can do about how Americans are paying a lot more for drugs than pretty much anyone else in the world, and that American innovation is subsidizing drug prices in the rest of the world. So as we know, he's already gone hard after the big branded manufacturers, and he struck deals with many of them to lower prices. He launched Trump RX, which is a big direct-to-consumer drug platform. So he has been after the drug industry for a long time, but obviously going after generics manufacturers is a very different kind of kettle of fish, because they operate on much lower margins, they have less fat cuts, so it could be interesting to see how this plays out, really.
And then, in other news, Novo Nordisk is suing Eli Lilly. So this, again, feels like a big deal, but what are they accusing the rival of?
Yeah, never a dull moment at the moment in the drug industry. So they are arguing that adverts that Lilly has been putting out since April are misleading, because what they're saying is that Lilly is using a bona fide direct head-to-head scientific study, but what they are saying is that they now have a higher dose version of Wegovy, and so if you were to include that, it's not correct to say that Zepbound is just completely beating Wegovy out of the park. So they'd already sent a cease and desist letter in April, which it seems like Lilly pretty much ignored, and now they are, they're taking legal action. So it's just more of the same as they kind of battle to try and, gain dominance, and for Novo to assert dominance that it once had but lost to Lilly, whose Zepbound sales are taking the lead from Wegovy.
I know it's a story we'll follow very closely. So, Deirdre, thank you so much for joining us. Deirdre Hipwell, Bloomberg's healthcare and consumer team leader for EMEA. Now, Equinor beat expectations in the second quarter with the Iran war driving gas prices higher in Europe. It was a boost to the company's trading business, but the chief financial officer warned us about the state of the gas market in the region ahead of winter.
When it comes to the European gas market, it is a vulnerable situation. And, we are very uncertain about, how we will enter the winter as such. And a couple of data points, global LNG markets, 20% of that is sort of inside of the Hormuz Strait, clearly limiting international flows. And in Europe, 30% of the gas has to come from LNG. So there will be an increased competition for that. And if you combine that with sort of the current storage levels in Europe, which is at 53%, which is 15% below, a normal year, it sort of tells a story about a very vulnerable situation. So we just need to be very much prepared for that. Even if sort of the Hormuz Straits open and we get back to normal, we don't think that Europe will get to the targeted storage levels before the winter. And that storage level is a very, very important data point.
Well, that was the Equinor CFO. Now, Santander has also topped expectations. The company's chief financial officer speaking to Bloomberg a little bit earlier.
And clearly, we are on track, or even, on track to meet or even do better in some of the KPIs we gave for the first year of this three-year plan. So we are starting on very, very strong footing, and we are very confident that we can deliver on the numbers we gave for the next 3 years.
You and the team have made it clear, Jose, good morning, that the UK and the US are key markets for Santander. You've made the acquisition, of course, of Webster in the US, TSB, as you mentioned, here in the UK. Are you still at the point where you're integrating those businesses, or are you looking for further acquisitions? Where are you in that story?
No, we just incorporated TSB in the second quarter. We are going to, we expect to incorporate Webster in the second half of this year. And we need to integrate these two companies, these two banks into the group for the next couple of years. So obviously we need to, we are going to focus all our resources on integrating these two companies in the next couple of years. So no significant M&A on the table at the moment, no.
Okay, does that allow you to think about maybe returning more cash to shareholders above and beyond the announced amounts?
At Investor Day, when we outlined our next three-year plan, we made a few changes to our distribution policy. We increased the cash from 2027 onwards, from 25% of profits to 35% of profits. And we also said that if capital stays above, or when capital goes above 13%, which is the upper end of our operating range, which is 12 to 13%, so the excess capital above 13% will be distributed to shareholders.
Now let's get more from our Bloomberg Managing Editor for EMEA Finance, Tom Metcalf. Tom, so what stands out, first of all, in these Santander results?
Well, I think, pretty decent set of results. For me, probably the most specific thing would be, they did sort of really beat those estimates on net interest income. And I think that has a good read across to other Spanish lenders at least, right? Like if they're doing well there, you'd expect in their, one of their home markets, BBVA would also do pretty well, for instance. So, yeah, for me, that was the biggest takeaway. Obviously, shares not really responding, but that's all in the context of, Santander shares being up something like 60+% over the last 12 months.
What did they sound for? I mean, it's difficult to have, concrete forward guidance given everything that's happening with the oil and the Middle East.
Yeah, but it's pretty confident. It was basically saying we expect to meet or even potentially exceed any kind of those targets we set out for the next year. So that all looks pretty positive. And again, that's kind of probably the big takeaway is, no nasty surprises in the set of results. Obviously, they've got to integrate Webster. TSB is now sort of, officially part of the group as well. But yeah, the big thing is, can they continue to execute on those two sort of idiosyncratic absorptions, but also just generally on the strategy? But it seems to be pointing in the right direction.
Tom, thank you so much, as ever, for joining us on the bank's Tom Metcalf. They're, of course, in charge of finance in EMEA. Now, coming up, shipping disruptions in the Middle East intensifying as the U.S.-Iran war grinds on. Of course, we'll discuss the outlook for commodities with Michael Haig from SocGen Corporate and Investment Banking. I'm looking at the price of oil in general, actually. If you look at some of the things that the markets are worrying about, they're definitely focused more on earnings ahead of Alphabet. Traders waiting for the clearest read yet on whether some of these vast sums of money that they've really spent on technology hyperscalers are, will pay off. So that's the one question, but there's also quite a lot of questions on the Middle East. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Investors turn cautious ahead of big tech earnings from Alphabet and Tesla, with concerns over massive AI spending and the chip sell-off last week. President Trump could threaten the future supply of low-cost medicines in the U.S. as he plans a 100% import duty on generic drugs to try and encourage manufacturers to move to the country. And the White House plays down the prospect of immediate peace talks with Iran as Houthi militants in Yemen continue to threaten shipping in the Red Sea. Now let's get more on the Iran war, where mediators are continuing efforts to restart negotiations, but Tehran has rejected U.S. claims that the Middle East countries are seeking more talks.
Iran has been reaching out to the United States, both directly and indirectly, to engage in talks about settling the differences with regards to what's happening in that part of the world. Unfortunately, so far, even though we have reached agreements, they have not kept their commitments. And as the president stated earlier today, I guess, today Washington time, yesterday our time here now, the problem we're having right now is that they're not serious about talks.
Well, let's get more from Bloomberg's Paul Wallace, managing editor for the Middle East and Africa. Paul, attention, of course, now on both the Hormuz and the Red Sea. So is there any prospect of de-escalation?
Hi, Francine. It doesn't look like it right now. We've just heard Marco Rubio essentially saying, well, the U.S. isn't ready for talks with Iran because it doesn't believe Iran is serious. For what it's worth, the Iranians are saying that, talks are a possibility at some stage, but they're certainly sort of dismissing any idea that they're desperate for a new round of negotiations. They continue to counterstrike against U.S. attacks by hitting Kuwait and Bahrain and Jordan. Those three countries in particular are being bombed on a daily basis with missiles and drones, and they continue to hit ships in the Strait of Hormuz. So at the moment, neither side looks like it's ready to back down, and of course, as you mentioned, we have the possibility of a new front in this war opening in the southern Red Sea with the Iran-backed Houthis warning ships not to go to dock at Saudi Arabian ports. They announced this about 2-3 days ago. They haven't actually attacked any ships yet, but if they do, that would be a major development and would likely push up oil and energy prices even further. And some shippers are very wary of these threats, and we're already seeing quite a few oil tankers turn away from the southern Red Sea to avoid going close to Houthi-controlled territory in Yemen.
And Paul, the Wall Street Journal is also reporting that the Trump administration has basically approved a landmark nuclear deal with Saudi Arabia. What do we know about it?
So we're still waiting for the U.S. to confirm this. It's possible that they make some announcement today, but if the U.S. does agree, does let Saudi Arabia enrich uranium on Saudi soil, and also say that U.S. companies will help Saudi Arabia build up a nuclear power industry, that would be very significant. And this is something that Crown Prince Mohammed bin Salman has wanted for years. It was under discussion with the Biden administration. The U.S. has long been wary of the idea of Saudi Arabia enriching uranium. Israel too. Israel has in fact already come out, or some politicians have come out and spoken against the idea in reaction to the Wall Street Journal story. They sort of feel it could open the floodgates and lead to other countries in the Middle East insisting on being able to enrich uranium too. And of course, this is all going on at a time when the U.S. is trying to curb Iran's nuclear program. So it could send, in the eyes of some critics in the U.S., it could send a wrong signal to Iran, at the same time that the U.S. is saying Iran must not enrich uranium. If it turns around to the Saudis and says, well, they can, that might not be the best message in the eyes of critics. So it's something that won't happen overnight, and there will certainly be a lot of pushback from a wide variety of politicians in the U.S., but it would be significant if Trump essentially says he thinks it can go ahead.
Paul, thank you so much as ever. Paul Wallace, Bloomberg's managing editor for the Middle East and Africa. Now, we're now joined by Michael Haig, commodities research head at SocGen Corporate and Investment Banking. Thank you, Michael, for joining us. I mean, the concern is that when you look at oil, a lot of the predictions that we've done before haven't really played out.
Right.
But now there's 2 or 3 scenarios that could really get us in trouble for winter.
Exactly. No, so you're exactly right. I think most people who are trying to forecast the price of oil were relying on the traditional kind of inventory price relationship, which kind of broke because we're in an unprecedented time. So our forecasts were looking at ridiculously high prices when we started to see this conflict, given what could happen with inventories. We don't really rely on that so much anymore. We look at sort of what the options market is pointing at. So to give you an example, over the last week, and especially since the Houthis have got involved, and you look at the build-up in put options versus call options, there's about 4 times as much open interest build-up in puts rather than calls, which would lead you to believe, oh, the market's quite bearish. But it actually isn't that, because the put option build-up is really about strikes around the $70 to $80 level over the next month, whereas the call option build-up is much more spread out over the course of the year, around 120, 130. So I kind of rely on that a little bit more these days rather than inventory models, because it seems to be a little bit more sort of grounded.
But were we also underestimating at the start of this Middle Eastern war how China has diversified, or some of the other energy places of China? And does that change just the energy, how you look at the energy complex?
No, for sure. I mean, nobody would have expected Chinese imports to drop 5 million barrels a day, right? I mean, that's just a massive number. That's like playing like OPEC would play. But part of that has got to do with their policies restricting product exports, so the incentive for refineries to bring in crude oil at a very elevated price, but not being able to export to the product markets where the cracks are really high, has meant that refinery run rates have dropped in China, call it 2 million barrels a day. You have no more strategic petroleum reserve build-up in China. You have demand destruction. I mean, EV sales are up 4% in China, as they are around the rest of the world. So it has done an amazing job of depleting its imports, which has helped cap where prices have gone over the last couple of months.
So what happens now?
So, I mean, basically, we've had to readjust our probabilities on these scenarios. So the probability of a stalemate between Iran and the US is probably just as equal as a narrow deal. And then there's two other scenarios, which is more elevated fighting, which I would put around 20%. So the first two are around 35 each. Elevated fighting, more than what we see right now, around 20%. And unfortunately, a full resolution is really tiny at this point.
I mean, so what happens to the price of oil? Again, I don't know, we were talking at the beginning of the summer about jet fuel, running out of jet fuel. I mean, now we're talking more about the winter months just not having, or taking more time to replenish. But,
exactly.
But what's the worst case scenario?
Well, the product cracks are already, I mean, gasoline, heating oil, they're already like $30, $50 above the price of crude, and that can only get higher because the inventory levels are really, really low. So as each passing day goes by, and bear in mind, between 3 and 4 tankers are now going through the Strait of Hormuz compared to 2025 a month ago. So as each month goes by, it becomes more and more vulnerable. And I said that 3 months ago, obviously, and things didn't pan out the way they were. But it's for me, the asymmetry is very, very much to the upside now.
What happens in the U.S.? Because, again, and we go back to this idea that there are the midterms, that President Trump at some point will get scared and really back down because of the price of fuel. But then the U.S. is quite insular also to what's happening in the Middle East, or certainly less than, they're less dependent on it than Europe is. Yeah, I
mean, they're less dependent on the volume because they're self-sufficient. They're a net exporter, as we know. Trump hasn't imposed any kind of export restrictions that we were worried about. But gasoline's above $4 a barrel again on average. So that's a bit problematic, and we're about 2 months away from the midterms. So, I mean, we were saying that we would see a resolution by the midterms, but it's not too far away now. But the US consumer isn't really feeling it as much as you would think they were, even though gasoline's at $4. I'll give you an example. Back in 2008, oil was $147 a barrel. When you take into account inflation and wage increases, if you're lucky enough to have had a wage increase, and the intensity of use of oil has decreased, even in the US, people aren't driving as bigger cars anymore, they're more efficient. Oil would have to go to around $250 a barrel to feel like 147 did back in 2008. I'm not saying people don't hurt by this, but it's not as significant as you think.
Talk to me a lot about some of the other commodities. I mean, what is gold? Because gold has, for me, changed in the last 8 months, right? We thought it was a reaction function of kind of a bit of anti-American sentiment, hedge event inflation that it's always been. And now it just feels to be behaving differently.
Yeah, it certainly does. I think that's part of the inflation backdrop, obviously, because it doesn't yield anything, as we know. I would stay away from gold for the short term. We are long-term, medium-term bullish on gold, but I wouldn't advise doing anything yet. I mean, even though using sort of high-frequency vault data movements and export activity of gold out of the UK, it looks like central banks in the last recorded month have started picking up buying again. Maybe bottom fishing on the lower oil prices, but gold prices, sorry. But I would stay away for now. I think once this resolution in the Middle East sort of takes hold, if we get that, inflation becomes less of a concern, I'd get back into gold.
Is there anything else that you would stay away from and then wait for some kind of resolution, or at least, I mean, is it resolution or progress, or is it too dangerous to to get back in for progress, because it could go back?
Well, the progress would mean ebb and flow
like a real
of traffic. You know, one week you'd have 4 tankers going through, the next you'd have 10. That would be progress. Resolution would be back to the average of 23 tankers traversing from west to east, like going out the strait. So that looks less and less likely.
Yeah.
Now, in terms of staying away from things, there's a few things that I would actually not want to stay away from, which is European gas. I think it's very vulnerable. I think copper looks really great, especially with military expenditures expecting to increase. So there's more I would go into rather than stay away from.
I mean, copper, and we've seen it really play out also as we're trying to build out the AI and the infrastructure.
Yeah.
I mean, what's the limit for copper? Price limit? Is there a price limit?
Well, there is a precedent. I mean, the way I would look at it is go, okay, when was the high in 2008 when we had the commodity super cycle? Copper was at 9,000, the marginal cost was at 4.5, so it was double. So the marginal cost of copper right now for the 90th percentile producer is more like 10,000, and we're at 13,000. Now, I'm not saying it would double to 20,000, but there's a lot of forces that are in favor of copper. There's military expenditure, there's stockpiling, there's AI, as you talked about, there's obviously the green stuff. That used to be the big narrative. The only thing I would say about copper is we still don't have a resolution yet on the tariff uncertainty in the US, and stocks of copper in the US are at 600,000 tons, which is massive compared to the 90,000 you had before Liberation Day. So if there was some sort of clarity on that, and that copper found its way into the market, copper would sell off. But I would see that as a buying opportunity. Yeah,
and gas prices in Europe, I mean, that's partly LNG coming, of course, from Qatar and other Middle Eastern, but it's also a Ukraine story with Russia.
It's the fact, and because of those features, that means that European inventory levels are at historic lows, 5-year lows, so looks very vulnerable. 60 euros a megawatt hour looks really cheap right now, given the risks that we have going into the winter, October, really, the heating season, I should say.
Thank you so much for great analysis, Michael Haig, Commodities Research Head and SocGen Corporate and Investment Banking. Now, Ukrainian President Volodymyr Zelensky has dismissed the Commander-in-Chief of the Armed Forces after nationwide protests. Let's get more with our Chief Europe correspondent, Oliver Crook. Good morning, Ollie. So what's the wider significance of actually this change of personnel? Does it show Zelensky's weakness that he's bowing to pressure from protesters?
So listen, this isn't the first time that Zelensky has had to bow and do things that he effectively did not want to do because of public pressure within Ukraine. You had a similar scenario last year where he wanted to take more control of the prosecutors' offices and basically gain effectively more control over the anti-corruption probes that were happening in Ukraine. This is something that is independent of the presidential office. There were massive protests in the streets of Ukraine, and as a consequence, Zelensky had to capitulate. You have a similar situation now unfolding in Ukraine at the very top of the military complex within the government, where you had basically a feud between the former defense minister who resigned as a consequence of pressure from Zelensky, and a feud he had with the top military official, the commander, General Syrskyi. So these two men are very different in terms of their approach to warfare. The younger of the two, the former defense minister, was sort of seen as pioneering the drone warfare that's really been the lifeline for the Ukrainian military, but of course the Ukrainian nation. And then the commander of the armed forces, who is seen as sort of more old style, using much more Russian style tactics, really throwing a lot of people at the front line and sort of willing to endure a lot more casualties. As a consequence, you had these massive protests. Zelensky has now capitulated with the resignation of the top general of the military. Now, that takes us a few things. For one thing, it tells us that Zelensky is obviously under pressure from the population, that he is also still reactive to this population and has to basically acquiesce some of their demands, despite the fact that there has been a freezing of many of the democratic institutions in Ukraine, obviously because they're at war. But of course, this is still a population that is very engaged, not just in the war, how the war is being waged, and again, who is going to be waging it. So this is a really big shakeup. It's the biggest shakeup to the military within Ukraine in the last 2 years. So again, we've also got more promises from Zelensky saying he's going to look at the configuration of the military. So we'll probably hear more about that in the coming weeks.
Ali, the Kremlin, we also report, has hardened its demand on occupied land in Ukraine because Putin just no longer has faith in what he thought was agreed with Trump in Alaska. So where does that leave hopes for a way out of the war?
Well, I think that Putin, rather than this being on Putin's initiative, I think it's more of a reaction from what he's seeing from the White House and President Donald Trump, in a view that basically Trump sees things differently than he did when he met with Putin in Alaska last year, and that the scenario has changed pretty radically on the ground. I mean, that Alaska meeting came pretty freshly after that meeting with Zelensky, in which Trump kept telling him he didn't have any cards, and the dynamic has really fundamentally changed, both on the battlefield, also in terms of the financing position, but also, of course, in terms of the military operations that the Ukrainians are able to commit within Russia. So now it seems that Putin effectively sees the deal that was sort of struck between Trump and Putin. This was never really fully a deal, of course, because no one had actually agreed to anything, but a broad outline in which there would be sort of land swaps. Putin basically saying potentially not really open to that land swap anymore, but it leaves Putin in the same position. He still has not taken the Donbass. He still needs to take all of Donetsk and Luhansk. He's been unable to do so, so it leaves him in the position of trying to figure out how to do that. There are apparently people close to him who thinks he can do it within the next year. There's a lot of skepticism about that, but for the Russians and for Vladimir Putin, coming under quite a bit more pressure, not just on the military front, the strikes within Russia, and of course the economy buckling.
Ollie, thanks so much. Terrific briefing from Oliver Crook there in Brussels. Now, coming up, it's the second full day at work for the new UK Chancellor. We'll find out what the City of London is expecting from the Treasury. That's coming up next, and this is Bloomberg.
Asia at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deal. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Welcome back, everyone. Some encouraging news for the new British Prime Minister Andy Burnham, as UK inflation fell to its lowest level in over a year on cheaper motor fuel and cheaper food. Now, the respite for consumers may be brief, with higher energy bills set to complicate the short-term outlook. Now, let's get more with Rosa Prince, Bloomberg opinion columnist. Rosa, thank you so much for joining us. We kind of spent the week together trying to figure out exactly what we can read the tea leaves of this new cabinet. What kind of prime minister, or what kind of cabinet is the prime minister trying to convey the image of?
Well, today he's set out his second measure to alleviate the cost of living, and he actually said that his cabinet would be a cost of living cabinet. So today it's a measure to cap bus fares. How he's paying for all this is interesting. A little bit of jiggery-pokery. He's taken some money away from some climate financing overseas, rather. But I think it's also dropped some hints about his sort of bigger picture. He had hoped, I think, to raise the tax threshold. He had said that that was something that came up for him on the doorstep when he was out campaigning to get back to Parliament. And he also kind of left open the possibility that he would raise the higher level to 50 pence. Both of those things have been quashed overnight. They are now briefing that all savings will have to come from within departmental budgets. So I think they're still kind of figuring this one out. I think he wants to be someone who splashes the cash around, but he is aware that he needs not to frighten the markets and to stay within those tight fiscal rules that were signed up to at the last general election.
Rosa, really quickly, I mean, there seems to be also the willingness from the UK Prime Minister to provide strategic support to the US on Iran. That seems like a shift.
Yeah, that was a big question, whether he would be a little less in America's pocket than Keir Starmer was, certainly for most of his time in government. But we have heard that he is willing to approve the use of those bases to support Iran. Yeah. I think he felt with a slightly controversial new foreign secretary, he didn't want to rock the boat. Last thing he needs is Donald Trump's ire at this moment when he's just setting out.
Rosa, thank you so much. Bloomberg opinion columnist Rosa Prince. Now, to discuss what the city wants to see from the new government and the Chancellor, John Healey, we're joined by Chris Hayward, Policy Chairman at the City of London Corporation. A joy to have you as we try and figure out exactly what this new government wants. So what are the City of London's thoughts, first of all, on the new Chancellor? I mean, he's a known quantity and he seems to be well regarded. Do they worry about taxes?
We always worry about taxes, I think. Look, we want the Prime Minister and the new Chancellor to be pro-business. Prime Minister has said he is, and actually, when you look at his track record of what he did in Manchester, he worked with business to actually create that prosperity in Manchester. So for us in the City of London, what we don't need is more taxation. What we need is economic growth. And so my offer to the government is to partner with the government on initiatives which will actually move the dial on economic growth. The reality is, in the past 2 years, there has been no economic growth. It hasn't moved the dial one iota. And actually, if we can start to get businesses being more successful, I mean, the sector I speak for, financial services, 2.5 million people in that. We contribute 12% of the government's tax take, and those are actually all over the country. 2/3 of them are outside of London.
But is there a danger that this takes time, that the government doesn't have time because they just need spending money?
Well, the government has to invest the time to make the right decisions. It's not for me to prioritise what the government spend their money on, but I do think, and I understand, this need to get cost of living down. But what the Prime Minister and the Chancellor, I think, need to focus on is how do we get greater tax receipts? Well, we get greater tax receipts not by greater taxation, but by greater success. Taxes will go up. People will pay more if their businesses are making more money. And what we want are pro-business initiatives in the City of London, which really drive that economic growth. Because if we can get 1 or 2% on economic growth in the next 2 or 3 years, that really will transform our economy.
Is continuity feasible? Because chief executives don't like chop and change. And what I'm hearing this week is actually we just have to wait for the budget come the autumn.
Well, look, I think the fiscal event in the autumn is always important. And business does want stability, right? We want constancy. Business likes to know the direction we're going in and that we're staying with it. And that fiscal budget will be very important in terms of where the Chancellor and the Prime Minister see their priorities and how they want to finance them. But I do think at the moment what we've got to see is more money coming in to the Treasury, and that will come if we get business driving the agenda. And that's what the city's all about. We've got deep pools of capital, and what we want to do is invest them across every postcode, as the Prime Minister would say, in the country. We've got an Invest Connect policy, which is about how do we get the nations and regions actually invested in, and we're really working hard to partner with government on that.
And that's very clear, and it's kind of like, again, this idea that you want growth and that the City of London will support it. Is there anything that you're worried about that actually the City of London is really fretting? Is it stamp on, shares, stamp duty on shares? Is it bank taxes? We heard Jamie Dimon talk about this earlier this week.
Look, I don't think we want any more taxes on banks. Our banks are already taxed higher than any other competitor banks in Europe. So that I don't think is the way forward. I think from the city's point of view, what we really want to see is, the Chancellor and the Prime Minister recognising the source of wealth and the source of capital that the city can be, and our ability to distribute that for inclusive growth across the United Kingdom. So that's my message to government. It's, work with us, don't work against us. If our businesses succeed in the city, it will transform that capital out into the regions. And that's where, under devolution, that's where the Prime Minister and the Chancellor want to focus their efforts.
I mean, a lot of the, City of London workers are also movable, right? You can kind of work from anywhere in the world. If Andy Burnham were to introduce a 50% top tax, do you think workers and employees will ask their bosses to move them elsewhere?
Well, look, one thing I don't want to see is a brain drain to any other country. There is a global battle for skills. We need the very best people here in the City of London. So anything that drives them to think about wanting to work elsewhere is not good. So I would say, don't put up the taxes. What we need are incentives. How do we incentivize innovation, enterprise? These are the ways forward, actually. If we focus on those rather than actually increasing taxes, then I think that's the right way forward.
But would it be unfair to say that the last government also tried? Was it because they were distracted, or it wasn't the right framework?
They were very distracted. I think we have to be clear that over the past 2 years, we've had some of the most geopolitical explosions in the world, and that's really impacted on this on this government, not just this government, but other Western governments. But if they can get inflation down and they can get capital up and capital investment up, I think they stand a real strong chance of actually turning the dial.
Yeah, great points. Chris Hayward, thank you so much for joining us. That was the policy chairman at the City of London Corporation. We'll see exactly what happens, and then we'll also see what the business secretary and the city minister have to say. Now, this is the picture across the board for a lot of these equity markets. Look, stocks are falling behind as they're waiting for Alphabet's earnings. Traders waiting for the clearest read yet on whether the vast sums that technology hyperscalers are pouring into AI will actually pay off. I'm also looking at high crude prices, so you can see Brent a little touch higher, and they're keeping a lid on sentiment after both the U.S. but also Iran signaled they are in no mood for the moment to restart talks. Up next, it's Bloomberg Brief, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
On AI, some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers, and it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Racing for big tech results, investors turn a little cautious ahead of Alphabet earnings. President Trump targets generics, the president telling drug makers to move production to the United States or face a 100% import tax. And oil rallies as both the US and Iran play down the prospect of talks. All right, it's been a big day around the world, nowhere more so than Asia. We have yen news and lots more. Let's get straight there now to Winnie Su for the latest.
Yeah, good morning, Bonnie. Well, the yen now has passed that 163 level against the dollar, which is now at its weakest level in about 4 decades. It has remained around those levels for most of today, but actually we did see a sharp spike about an hour ago when we've learned that the Bank of Japan is open to raising rates faster than consensus expectation. However, those gains really didn't hold on for long, as the report also indicates that there is no preset course in mind, and it seems like investors right now need more than just talks, but actions. Now, flip the board, we take a look at the broader Asia market. We have the MSCI Asia also pretty much erasing all gains that it has seen today, and that is driven by these caution ahead of the earnings from Alphabet, and also as oil continues to extend gains. We did see South Korea's Kospi index erasing gains of as much as 6% earlier today. Now, that is also coming after the exchange triggered an 8th sidecar in a row, and it really goes to show how volatile this market has become. Also leading losses today, we see tech stocks in Hong Kong driven by those gaming shares, as there are concerns rising around Tencent's business. Back to you, Bonnie.
Winnie, quite the roundup there. Thank you so much. That's Winnie Su there in Hong Kong. Now I want to take you through some of what's happening in Europe. We'll begin with Brent because that is really setting the tone for today's session. Up to more than $94 a barrel now, up more than 3.5%. It continues to rise. There was some headlines out of Mayor in the last few minutes suggesting that Iran says no exchange of messages is possible with the United States, but those headlines continue to go back and forth. European gas futures, this is a phenomenal statistic. We're at close to 62 euros per megawatt hour now, up another 3.5%. We're up more than 25% in the last few sessions. And just to put it into context, that would be more than $115 a barrel in terms of crude oil if you were to switch it into crude. So that is a huge premium for Europeans to be paying, and they are feeling it. Mind you, not in the UK inflation data. We saw core inflation actually come in a little bit stronger than expected, although the headline number was softer, and certainly that is reassuring for the moment, but inflation is coming back down the pike, and as you can see, there seems to be a floor under yields. We're very close to our highs of the year on UK yields, and of course we are at our highs of the year in the rest of Europe. The 2-year UK yield at 4.38. If we look at other asset classes, you can see the Stocks Europe 600 is now firmly higher, up more than 0.5%. It started off on a very fragile footing. The FTSE 100, though, then just took off. It's up more than 1%. And as you can imagine, oil, basic resources, all of those companies are doing pretty well. Also, earnings have been phenomenal in Europe. The euro continues to strengthen. We're above 114 now. And I just wanted to point to gold as well. This is a little bit of reflection of the macro trade, back well above $4,100 an ounce. Let's get to the United States, where the picture is not quite as rosy. A little bit of trepidation before big tech earnings start, but also that mammoth session yesterday, right, where the Philly Stocks Index had another wonderful day. You're seeing that come off the boil just a little bit with NASDAQ 100 futures, but we'll see if this holds, given the picture across Asia and now across Europe. Let's take a look at yields here in the US as well, because we are seeing them hold at highs of the year too. Not fully at the high of the year, but the 2-year yield is firmly at 4.25, and it's not budging. And that 2-10 spread now, very narrow. We're at 37 basis points, so a flattening curve. You'll notice too that the 30-year yield at 5.13 and change today. All right, let's get to some individual pre-market movers now. Over to London and Chloe Melling.
Good morning, Bonnie. We have Supermicro soaring this morning after raising its gross margin outlook and also saying that the backlog was at a record, which is, of course, very reassuring for investors in this AI trade, as it confirms this strong, solid demand for AI servers. So we're up almost 16% there. Moving on to Pegasystems, which is seeing a huge drop this morning after earnings missed estimates. And so this is an IT company. There's delays in terms of the decisions made by clients, which is echoing what also IBM said at the beginning of the earnings season. And so this doesn't bode too well for the IT sector. And finally, we can move on to Sandoz over in Switzerland, which is a generics drug manufacturer, which has been one of those companies impacted by Trump's threat of imposing 100% tariffs in a couple of years on those companies. This, of course, would push up those costs much higher for those companies, which are already operating on very thin margins. And then for consumers, this would mean, of course, higher prices and potential shortages of those generics drugs. So we are seeing a bit of weakness there for Sandoz on the back of this as we await more detail on this potential tariff threat.
And as we see European indices move higher, Chloe, thank you so much. Chloe Melly will be back later in the hour. Also coming up this hour, investor sentiment ahead of tech earnings with Christian Müller-Glissman of Goldman Sachs. Three big tech names reporting earnings after the market closed today: Alphabet, Tesla, and IBM. Matt Bloxham of Bloomberg Intelligence joins us now. We'll set IBM to the side for a second. Matt, what are we going to want to hear from Alphabet in particular when it comes to the AI build-out, spending and returns, essentially?
Yeah, I mean, I think I'd put it into two buckets. There's the resilience of their search advertising business, which is where they make by far the majority of their cash flow. And then also the returns, if they're getting any yet, on their AI investments and how those two things kind of weave together. You know, they've done a good job of defending that anchor business in search advertising and evolve it towards AI. And also they've been kind of gaining traction in the enterprise AI market, obviously building a big cloud business. It's how all those things fit together and whether they're going to look to increase their investments again. They've already made a massive increase in their capital spending this year. They've indicated that it's going to go up again next year significantly. So I think there may be some questions about whether they're able to give any more precise guidance about what significantly means next year, because that has a lot of implications for the rest of the supply chain in terms of NVIDIA chips, data center build out, all those kind of things. So I think Alphabet continues to be a bellwether for the full kind of AI value chain.
You have to wonder if investors are going to be happy no matter what we hear, Matt. Will the stock sell off anyway? I mean, that's what we've been seeing, whether earnings are good or bad, although I should mention Supermicro as an exception.
Yeah, I mean, actually, the Supermicro is interesting because actually their revenue guide wasn't particularly good versus expectations. It was the margin that pushed things up. So I think investor reactions to results at the moment are a little bit unpredictable. So it's kind of hard to gauge how they're going to react to the Google numbers. I think expectations are pretty robust for Google. So I think it would be quite hard for them to deliver something that's going to really give a significant incremental positive versus where market expectations are already.
All right, well, the tension is building. Matt, thank you so much. That is Matt Bloxham of Bloomberg Intelligence. President Trump targeting generic drug makers now. He's telling manufacturers they have 2 years to move production to the United States or face a 100% import duty by 2028. Let's bring in Deirdre Hipwell, who leads Bloomberg's healthcare and consumer coverage for EMEA. Deirdre, just give us an idea of how many generic drug makers are out there and who Donald Trump is actually speaking to.
Well, there are a number of generic manufacturers in the US, in Europe. The biggest country that would be affected by this is India. India is a huge base for generic manufacturing, so they could be potentially one of the big losers from this move by Trump. But as ever with Trump, he often makes big shots across the bow and then is potentially working towards a more negotiated settlement. So I think in the next 2 years, we'd be potentially on the lookout for generic drug makers striking deals with Trump over pricing.
What essentially would have to happen? There is a whole global supply chain that involves many of these generics being made, as you say, in India, in other countries, Ireland, various countries in Europe and so on. If they were to promise to move their production to the US, I mean, would that be efficient? Would that be cost effective for them? Or would they just stop producing for this market?
It would be very difficult. Obviously, generic manufacturers are working with much lower margins than branded manufacturers. Over the years, the supply chain has completely shifted to places like India and China. So it would be extremely difficult. If we look at Sandoz, a big generic manufacturer in Europe, less than 20% of their business is coming from the US now, and they have very little, if any, manufacturing facilities there. Plus the timeline that he's given, 2 years or 3 years for the even larger tariff. If you were to try and get a plant up in action from scratch, it would take more than 3 years potentially. So it would be extremely difficult. But I think with Trump, he'll get something, maybe not what he's asking for today. I think it might be more about just lowering prices in general, which has been a big push that he's been making since he came back into power, so to speak.
Right, exactly. It was one of the pillars of his candidacy that he was going to make healthcare and drugs essentially affordable. I mean, this will be targeting a major portion of his base, right? We all depend on generics in order to be able to afford the drugs that we need.
Absolutely, particularly in the US, Americans, about 90% of the prescriptions that are issued are generic drugs, and it's everything from antibiotics, painkillers, to cholesterol drugs, and even cancer drugs. So potentially it's hugely impactful for the American consumer.
All right, we'll see what the response from the generic drug makers will be. Deirdre, thank you so much. Bloomberg's Deirdre Hipwell. Oil extending gains after both the US and Iran played down the prospect of talks. Joining us now from Dubai is Bloomberg managing editor, owner, and it's getting a lot more serious now, owner. What can you tell us about the latest and the prospects for essentially any continued mediation or peace talks or whatever you might call it at this point?
Yeah, well, it is getting more serious. We have seen a wider US attack overnight into Wednesday on Iran, with strikes reaching as far north as Tabriz in Iran's northern peninsula, as well as some other areas in the west of the country. And Iran, expectedly and very much in line with the pattern we have seen over the past 2 weeks, has retaliated with attacks on Kuwait, Bahrain, and Jordan. We don't see an immediate or imminent resumption of negotiations, just based on what we've been hearing over the past 12 hours. As you mentioned already, President Trump has already played down the prospects for new talks, and we've just seen over the past hour messaging coming out of Tehran suggesting that Tehran doesn't really see itself in a position that should do the reach out to the U.S., so to speak, and sees the ball to be in the U.S.'s court. They think that it was the U.S. that violated the interim agreement signed between the two countries last month, and therefore it's the U.S. that should take the first step to de-escalate. So as things stand now, with wide attacks by the U.S. on Iran and Iran's retaliation, and the unwillingness of both sides to come to the negotiating table or to be the first one to do so, suggests that the chances or the prospects for an imminent resumption of serious negotiations look quite slim.
And I just want to point out, owner, I'm sure you're aware of this, but just in the last few minutes, the EU naval forces have told US, Saudi and Israel-linked ships to avoid the Red Sea, which is an escalation there in terms of advice to shippers to avoid the Red Sea. Owner, what can you tell us about this Saudi nuclear deal and what it means essentially if Trump is going into Iran to purportedly stop Iran from having a nuclear weapon, but then allowing Saudi Arabia, or helping Saudi Arabia even, have a nuclear program?
Well, this has been in the works for quite a few years now, and we've extensively reported on it. So it's not exactly a surprise, but I think what will be the determining factor in terms of how the U.S. Congress or U.S. lawmakers might react to it is going to be the possible constraints that might be imposed on Saudi Arabia in terms of domestic enrichment, which is a key Saudi demand going into these negotiations or going into this new agreement, because the implications for the region would be quite significant. As you can imagine, countries from Saudi Arabia to Turkey in the Middle East have expressed willingness, for lack of a better word, to basically chase possible nuclear armament if Iran one day announces that it has nuclear capabilities or nuclear weapons. So this is quite dangerous and sort of a delicate balance that the U.S. will be looking at striking when it finalizes these agreements with Saudi Arabia in terms of the constraints on, if any, on domestic nuclear enrichment and mining in Saudi Arabia. Bonnie.
Owner, thank you so much. That is Bloomberg's owner Ant in Dubai. Now to other top stories trending on the terminal this morning. UK inflation fell to its lowest in over a year on cheaper fuel and food. Consumer prices rose 2.6% in the 12 months to June, down from 2.8% the previous month. The reprieve may be short-lived, though, as the return of hostilities in the Middle East weighs on energy prices. BMW won't be in this year's Paris car show. It's part of the new CEO's push to cut costs. BMW says it remains committed to a selective presence at auto shows in the future. The World Cup final broke U.S. viewership records in the U.S. The match between Spain and Argentina drew 62 million TV viewers. Almost 39 million tuned into Fox's English language broadcast. Telemundo scored almost 24 million viewers. Coming up, the BOJ talking about taking action. More on how officials plan to fight a weaker yen. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Sources telling Bloomberg that the yen's continued weakness has Bank of Japan officials open to raising rates at a faster pace than they typically do every 6 months. Bloomberg, Morwenna Conium joins us now. So Morwenna, we had verbal intervention earlier. That didn't work. The yen was at a 4-decade low again, well above 163. And then this line that the Bank of Japan is maybe considering upping rates a little more often than it's used to. Explain to us why that would be important.
Well, yes, and the reaction has been that we've seen the yen stabilise, actually entering positive territory. The idea is that inflation is starting to become something that Japan are having to look at quite seriously. The situation in Iran and the Middle East doesn't seem to be calming at all, which is helping the dollar, but that is weighing significantly on the yen, which then, of course, adds to inflationary pressures. We've sort of got used to a pace of once every 6 months from the Bank of Japan raising rates, and they have indicated that they will be prepared to do more than that. So that is potentially going to weigh on shorter dated gilts, but potentially support Japanese bonds, and that's going to potentially support the yen. But I think we'd be waiting to see when that action occurs, because it wouldn't be expected to be at the next meeting. So whether it's enough to sort of stem the decline in the yen in the short term, I think we need to still wait to see.
Yeah, and I have to say there was a big strengthening when those lines came out, but we're back roughly around 163 again, just fractionally below it, Morwenna. I mean, would the Bank of Japan consider doing something a little more drastic, perhaps a double move or an emergency inter-meeting hike, anything like that?
I mean, we have certainly heard from Japanese officials earlier that they would be considering sort of intervening in the yen. So I think there's the potential that we see both sort of monetary policy and government action at the same time, potentially. And as you said, it doesn't appear that just the rhetoric around it has actually had much impact for very long, and that's a pattern that we keep seeing.
Yeah, I mean, let's just do a little bit of a recap, because we've seen a lot of actions out of Japan, not just the monetary authorities, but the fiscal authorities too, plus lots of verbal intervention. We had the channel checks from the US, talk from Korea of coordinated intervention. We had actual intervention. None of this has worked in stemming the tide for the yen. So why won't the Bank of Japan just step in?
I mean, that's a good question, and probably one for my more Japanese monetary policy focused colleagues. But I think what we have seen is that none of this does seem to be having a long-term effect, and it comes down to partly inflation is actually starting to look like it might reach the target that the Bank of Japan set over 13 years ago. So this is quite a sort of relatively unprecedented in modern times situation. So I think there's going to be a certain degree of caution there.
Yeah, absolutely. And of course, the re-escalation of hostilities definitely providing headaches for central banks around the world once again. Morwenna, fantastic stuff. Thank you so much. That's Bloomberg's Morwenna Conium. Coming up, the cost of the Iran war. A look at what's making headlines in your front page news. This is Bloomberg.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, the Wall Street Journal reporting President Trump formally approved a landmark nuclear agreement with Saudi Arabia. The deal will provide the kingdom with a civilian nuclear program and potentially open the door to uranium enrichment. The Journal says the 30-year accord is expected to be submitted to Congress for review. Next up on the New York Times, Defense Secretary Pete Hegseth requesting as much as $70 billion in emergency military spending after nearly 5 months of war with Iran. Hegseth told the Senate Appropriations Committee Tuesday the latest estimate of the cost of the war is $37.5 billion. And finally, the Financial Times reporting Samsung is in talks to invest in French AI company Mistral. The FT says Samsung is discussing an investment of potentially €1 billion as part of a broader fundraising round that could value Mistral at €20 billion. The partnership would bolster Mistral's efforts to become a leading alternative to US tech groups. All right, we're going to talk about this market next with, as you can see, it is pointed lower. We have futures lower, but they are off their lows. We'll be speaking with Goldman Sachs's Christian Müller-Glissman next.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open, and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Bracing for big tech results, investors turn cautious ahead of Alphabet's earnings. President Trump targets generics, the president telling drug makers to move production to the U.S. or face a 100% import tax. And oil continues to rally as both the U.S. and Iran play down the prospect of talks. And we'll start right there with Brent crude up more than 4% now, trading almost at $95 a barrel. And that's setting the tone for this market. That, of course, and big tech earnings. Tech stocks might be in for a tougher day, certainly tougher than yesterday. Yesterday, of course, the index rebounded more than 5%. Korea, by the way, overnight started to climb. It was up more than 6% on the Kospi intraday, but then gave up all of those gains. So it looks like there is some investor trepidation. Although it should be said, SK Hynix came out with relatively mediocre earnings and had a 15% after-hours pop, so we will see what happens. As you can see, futures are off their lows. Let's look at yields because they're close to their highs of the year. The 2-year yield at 4.25 and change, and that 30-year yield above 5.13 right now, 5.13 on the 30-year yield. The 2-10 spread, though, at 37 basis points. Let's get to some individual market movers now, and Chloe Melee in London.
Good morning, Vonnie. We've got Supermicro up almost 17% this morning after raising its margin outlook and saying that the backlog was at a record. This, of course, indicates very strong, solid demand for those AI servers and should be reassuring to those investors in the AI trade ahead of those big tech earnings that we have got coming this week and the next. On the flip side, we've got another story, which is the IT story and the IT sector being in a bit of trouble as companies shift their spending from IT towards more AI, towards more chips. This is something that IBM has warned of at the beginning of the earnings season, and now we're seeing an echo of that today with Pegasystems also missing earnings estimates on the back of the very similar dynamics, and we're seeing that really weigh on the shares this morning, down more than 16%. And finally, let's go over to Switzerland with a drug maker, Sandoz, which is one of those that might be affected by Trump's tariffs, threat of tariffs on generics. Those potential tariffs could really push up costs for those companies and squeeze margins further, even though they are already operating on quite thin margins. And so this potential threat, this potential import tax, that is really weighing on that stock this morning. And we're seeing the shares down more than 4% in Switzerland.
All right, and this even, of course, as European stocks are higher in terms of indices. That's Chloe Melee there in London. Investors bracing for big tech earnings. Christian Müller-Glissman of Goldman Sachs weighing in, writing, the outlook for profitability among the hyperscalers is becoming more challenging. They're becoming increasingly asset-heavy businesses. He's head of asset allocation research at Goldman Sachs and joins us now. Let's start right there, Christian. What is wrong with perhaps being a newly asset-heavy business?
Listen, I think actually a lot of investors do like asset-heavy business right now, as long as they're not kind of disrupted and as long as they're not spending a lot of money. And the big concern, of course, is how to get that money back. And I think like the big challenge is we've been in this investment phase linked to AI for so long. We all know that technology booms usually have a bit of a J-curve. And the question is if there's a bit of a loss of patience from investors with regards to the hyperscalers recouping some of the spent money. But just to be clear, we're not leaning to the negative side too much. We're just worrying that investors at some point might lose patience.
Yeah, I'd point out that you do think the overall structural trend around AI is intact. Tech, though, generally has been so sensitive to momentum, Christian, and it's hurt at least the immediate and intermediate term investor. Perhaps we don't have to worry so much about the longer term investor. But what will be the catalyst that changes that trade from a momentum trade into something a bit more tangible?
Yeah, I mean, the big challenge you have right now is that it's been a very narrow group of companies, the AI CapEx beneficiaries, the semiconductors that have been leading kind of, you could say, the AI ecosystem and the whole equity market. And you have these different phases in every tech boom. You have like the investment phase, the application phase, and the adoption phase. And especially the adoption comes back to the J-curve, can take a quite long time. So right now, the big investor focus has been on the investment phase. There's some very tangible drivers. Earnings growth has been incredibly strong for the semiconductors. And that has led to an enormous amount of positioning and leverage, investor leverage, towards this area. So to answer your question, how can that space stabilize? If you get some of that positioning down, if you kind of get a bit less of this extreme investor leverage in that space, that's already helpful. The most important driver will be the earnings. As long as the earnings come through, I think those stocks should be able to make progress, but the positioning needs to normalize a bit.
So for the last couple of weeks, as this was happening and as Korea was impacting, frankly, our markets, and just the whole idea of concentration and leverage was really impacting markets, we did see some dispersion, right? So we saw some of the other areas of the economy do better, some of the other types of companies and so on. Does that reverse if we see a pickup again in tech optimism?
Well, you had a record kind of high dispersion within the equity market, and it's very much linked to what I mentioned, like a very narrow group of companies leading the market higher, and then in the reversal leading the market to some extent lower, or at least having a significant correction that drives the dispersion. Like, there's another reason though. I think usually volatility and dispersion are kind of driven also by the macro backdrop. And what you had in the last few weeks with the ceasefire is that inflation expectations globally have collapsed. So that created a bit like a Goldilocks-ish type backdrop where inflation momentum is negative, but the growth picture has been actually very good. So that means you kind of have more micro driving the market. Macro is actually very stable. The big concern right now is not just that you get broadening within AI and maybe less narrow leadership in the market, but the concern is also that the macro backdrop is getting a bit less friendly as we speak because of the Middle East war, but also the tariffs. I think like this whole normalization of inflation, this whole kind of negative inflation momentum, the market has priced very quickly. So if you look at two-year break-even inflation, they've been hovering below 2%. So the market puts very little risk with regards to inflation for the next 2 years into the pricing. So my worry would be that dispersion could actually come down and macro could become much more important if the Middle East conflict continues and you have more signs of another wave of inflation risk.
Yes, and we are seeing really obvious signs of fragility with the yen today, for example, and global yields rising quite substantially. Christian, I want to point out what you think might be an attractive hedge in this market. So puts on the Russell 2000, US consumer discretionary, US banks, China equity. They, to you, look attractive to hedge any kind of growth shock, and you say their implied vol remains below that of single stock volatility. So I'm curious, do you still think that that's a valid hedge?
Yeah, I mean, I would say the big challenge is that a lot of cross-asset hedges, they don't work currently in the portfolio because of this tension from the inflation side. So if you do have a significant setback in equities due to the tech sector, due to innovation, the bond market might not give you the same buffer right now because you're dealing with a different type of inflation risk. So what we've recently looked at a lot is style diversification, as you were mentioning. There obviously were several parts of the market that in this rotation severely underperformed, low volatility stocks, high dividend yields, some of the defensive stocks. And they can create now a quite nice balance potentially for the tech exposure that we all invariably have in our portfolio just because tech has gotten bigger and bigger in the market. And what's really interesting is that those type of stocks in tech-led equity drawdowns can actually deliver positive returns. I give you an example. During the tech bubble, the S&P was down 45%, NASDAQ was down close to 60%, the tech sector was down 80%, and low volatility stocks and high dividend yield stocks, they were actually up. They were up like 10 to 15%. So that's currently what we discuss a lot with clients to create a bit more balance within equities in the portfolio.
Yeah, it's really fascinating, Christian. I mean, you have to ask yourself, what kind of purpose do bonds serve in a portfolio these days? Most of what you are talking about is diversification using equities, right? And you're overweight equities, but you're neutral bonds, you're underweight credit. And I'm curious, why?
Yeah, I just find that different roles for different assets. I think the kind of role of bonds in the past has always been to diversify equities. The 60-40 portfolio has been a very successful strategy for this generation of investors. But going forward, we think the role of bonds is changing, where it's much more about generating yield and to some extent less protecting the portfolio. And we just don't think that the yields that you currently get in the sovereign wealth space, sovereign bond space, is that attractive. And the same is true for credit, even more so, because credit spreads are incredibly tight. So you could say that sovereign bond yields in the medium term have to find an equilibrium that's higher, but it's even more true for credit spreads, because I think we have certain late cycle tendencies. There's releveraging that's linked to the AI ecosystem. There's restructuring, M&A. All of that tends to lead to worsening credit quality, but credit spreads are ultra tight right now. So we just don't see the fixed income complex currently as very attractive. There are like multiple headwinds from the macro side, from inflation, from monetary policy, and then also the risk premia you're getting are not very attractive in our view.
Christian, we are at this year's highs and maybe potentially even longer. So I'm just curious, how many more basis points would you need on yields just generally? Are we talking 10, 20, 30 before they would start to look attractive again?
Yeah, I mean, it's not just the level of yield, it's also the kind of macro backdrop. I think for bonds to be attractive, in our view, in a significant way, something needs to go wrong in the economy or with the equity market. But even then, the type of buffer you might be getting, as I said, won't be that large. So I think levels above 5% on the US 10-year are things that we've highlighted in the past, create a certain feedback from the bond market to the equity. So the closer you get to 5 and the higher above 5 you get, the more likely it is actually that equities struggle with that. There's a lot of other drivers. It depends why they go above 5, depends how fast they go above 5. But I think if we get closer to 5, there is probably that kind of equity reaction that justifies a bit more balance between equity and fixed income. But that's as of now. There's lots we can learn in the coming months, like during the tech bubble, 10-year yields went above 6%. And the equity market was fine because there was so much long-term growth optimism. And as a result of that, I think like it's a moving target. We need to see how the market reacts as well.
Just a wonderful conversation. Christian, thank you so much for joining us this morning. Christian Müller-Gisman of Goldman Sachs. Now, to other top stories trending on the terminal this morning. Sources telling Bloomberg the yen's continued weakness as BOJ officials open to raising rates at a faster pace than the economist consensus. BOJ watchers expect it to move once every 6 months, usually. The BOJ's next meeting is July 31st. New UK Prime Minister Andy Burnham walks back a proposal to raise the UK's cap on tax-free earnings, coming as the new Prime Minister tries to signal fiscal discipline to sceptical bond markets. And Blackstone is finalising a group of banks to underwrite a $3 billion loan to build AirTrunk's new data centre in Australia. Some of the lenders include Credit Agricole, Deutsche Bank and HSBC. Coming up, President Trump's latest tariff announcement puts pressure on drug makers. Details next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump says generic drug makers have 2 years to move production to the U.S. or face a 100% tariff in 2028. Kate Ackley of Bloomberg Government joins us from Washington. Another threat, Kate, but in cases like this where you actually have to think about moving manufacturing, these drug makers have to take this seriously, right?
And that takes time. I mean, tariffs have been a core of President Donald Trump's agenda since he came on the scene. I mean, that's a signature part of Donald Trump's economic policy. So this isn't a huge surprise, but it comes as, Secretary of State Marco Rubio is meeting in Manila with his counterpart from India, and India is a country where there is just a lot of this generic drug production, and so they're talking, about how to finalize a trade deal between the two countries that would maybe ease some of those tariffs. Meanwhile, the whole prescription drug price issue is all about affordability. That is a very key issue as we're all starting to focus on the midterm campaigns, the congressional elections coming in November.
Exactly, and that was potentially a flashpoint. Rubio apparently didn't talk pharmaceuticals with India today, this coming from the news conference that you just see playing on your screens, which is happening in real time. I mean, it's embarrassing, right? It's you, on the one hand, you're trying to use diplomacy to make good with, a friendly country, and on the other hand, imposing potential tariffs on an industry that's very important to India. What about his voter base? Because if this actually goes ahead, it's going to make generics very, very much more expensive if they're even available in the U.S.
Well, and that's the thing. I mean, we've seen a lot of these tariff, for the past 18 months, we've seen tariffs be imposed, and then things, there are exceptions, or the threat of tariffs is used then to make a trade deal happen, or, give a favorable sort of starting point on negotiations. So it remains to be seen, but it does put in, new uncertainty into one of the big affordability conversations over healthcare prescription drug prices. That is a real dominant theme on the campaign trail and here in Washington.
Yeah, well, speaking of the campaign trail, we have to talk about Arizona. So Trump's ally also secured a win. It seems to be that President Trump's candidates, or the ones he endorses, are doing pretty well.
That has been the case, and this is an example. We've had a number of members of Congress who have run for governor and have lost their nomination in several different states. This is one where a member of Congress has won his party's nomination. So we have Andy Biggs, who will take on incumbent governor there, Katie Hobbs. It's, considered a battleground state. It will be closely watched. There are some key congressional races, of course, in Arizona as well. So we'll be, all eyes on Arizona come November.
Congress, or at least the House, passed the stopgap bill to avert a shutdown before the midterm election. Is that now absolutely for sure the government is not going to be at threat of shutdown for the foreseeable future?
I don't know that you can say anything is absolutely for sure with Congress, but there is there's a deal underway to try to get that patch of funding so that there isn't a government shutdown, right before the midterm elections, and people would be focused on that. The Senate is likely to take this up as well before they go out on their August recess. So, where a week ago there were a lot of people saying, I don't see how we avoid a shutdown. Now there's a clear path to avoid a shutdown, but a lot of uncertainty, and there's still many weeks to go.
Yeah, this legislation would at least bring us through December 4th, if indeed it does all just go through smoothly. Kate, thank you so much. Kate Ackley of Bloomberg Government. 3 big tech names are on deck to report after the bell today: Alphabet, Tesla and IBM. Bloomberg's Neil Campling joins us now. We'll be interested in all 3 for very, very different reasons. We have to start with Alphabet. What does Alphabet need to say? If you were advising the company, and of course you would never do that, but what would you tell them the investor wants to hear?
Yeah, very well put, Vonnie. I think the first thing I would suggest is to say to them that to justify the massive AI capex spend, they need to deliver a similar kind of message they did last quarter, which is to show in earnings that their cloud growth is accelerating. So consensus has 65% year on year for cloud growth in those numbers tonight. That's key to make sure they can come in with the accelerating growth profile, especially because everyone is focused on the AI capex spend. And for next year, consensus has that growing at 3x what that number was last year. So you've got to justify those kind of returns. That's the first thing I think on Alphabet. Then if we look at IBM, now the question for IBM, because they're pre-announced to the downside, there's going to be a question whether the June quarter revenue destruction, whether that can recover in the second half of the year, or whether that goes away, because they mentioned, of course, that because clients were spending more on AI, they are seeing deferments of spending in other parts of their servers and software systems. So there's going to be a key sort of risk, if you like, around the wider narrative that they're talking about tonight. And then if we look at Tesla, I suggest that perhaps we'll be looking at where the capex spend is going, but also it's Elon Musk, so we don't really know exactly what Mr. Musk is going to say. Will there be any kind of hint about kind of collaborations or closer ties between Tesla and the SpaceX business? Because there's been lots of reports recently about what will happen longer term, whether the 2 companies might, merge entities longer term. So that'll be a focus as well. But of course, all 3 are critical to different parts of the tech narrative, as you mentioned.
You can only imagine, as the first of the hyperscalers to report, that the other hyperscalers will be as, minutely focused on today's results and conference call as anything else that they're focused on right now, Neil. It does appear that the stakes are getting higher every quarter for these companies, these AI-related companies. A guest earlier said that these names are becoming asset-heavy names. Is that necessarily a problem?
I think if you look at the kind of spending they're doing, then the asset heavy is a concern if they become kind of industrial tech companies, which probably longer term warrants a lower type of valuation multiple. The only way you can really balance that risk is by producing supernormal growth rates and returns. The likes of Alphabet have done that. So that's key. You've got to have the high growth to justify the investments, to suggest that you are going to see better returns on the invested capital. Otherwise, there's a risk for sure that valuations could continue to shrink over the longer term. That's a key aspect to watch, as you say.
Neil, wonderful stuff. As always, Neil Campling, thank you so much. Coming up, we'll get you set up for your trading day. This is Bloomberg.
week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Now a look at what's ahead today. As if you didn't know it already, two of the world's largest companies, Alphabet and Tesla, are reporting after market close. We're also getting results from AT&T. IBM will be a big one, even though they pre-announced to some extent Texas Instruments and Southwest Airlines. And tune in for an interview with Wells Fargo Chairman and CEO Wells Fargo, Charlie Scharf, before the market open at 9 a.m. Eastern. Supermicro is gaining a lot. It raised its fourth quarter gross margin outlook. It said its backlog was at a record. Otherwise, the results were pretty mediocre, up 17% this morning. Pegasus Systems dropping after an earnings miss, and comments about delayed purchasing decisions from clients, and analysts are saying it seems to echo IBM. And Alphabet awaiting its big day, up 0.6%, up about 10% year to date. This is your macro picture going into your Wednesday. Nasdaq futures coming off the boil after yesterday's gain. Brent crude above 95 and the yen back above 163.
Point in your tennis career did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
What we have seen is a much higher baseline level of volatility for technology stocks.
Some of these moves have been absolutely parabolic.
It's becoming a little bit more consensus, at least, to lean a little bit more into the hyperscalers.
You got the hyperscalers. They're spending like drunken sailors.
Can the build of AI get done as fast as the market expects?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, struggling to hold on to gains, heading into the beginning of quarterly earnings from big tech as oil hits 6-week highs following the 11th day of strikes on Iran, leaving Japan facing more pressure to stem the rout in the yen. The yen bouncing off a 4-decade low.
You know, we keep talking about, Julian Emanuel has said this is very much a market of stocks and specific stories, not a stock market or other types of markets. And the Japanese yen is a perfect example of this, given the fact that ultimately we've asked how long can they keep burning cash to support their currency. It turns out at a certain point the Bank of Japan has to get in on it because, yes, they're talking about potentially having some intervention coming from the finance ministry. At the same time, that isn't enough. So you do have some speculation that Japanese monetary policymakers may hike rates more frequently than once every 6 months. Maybe that'll give a boost. Does this jawboning work if there isn't action behind it?
Stay on that chart. Dollar yen at 163. That's an intraday move. Look at the size of the move this morning. They're throwing everything at it. Talk is cheap. The Japanese finance minister talking about taking appropriate and bold action at any time should the need arise. I'm guessing the need has arisen because we got reporting here at Bloomberg that now the BOJ is considering going faster than a 6-month hiking pace. And even with that reporting, you've got a 0.1% move off a 4-decade low on dollar yen.
They have a credibility problem right now with just using talk, just using verbal intervention, and that is ultimately what that chart is showing and what you're highlighting right now, which is they've talked a big game, but they haven't followed through. And even with respect to the consecutive interventions that we've seen from the finance ministry, it hasn't staved off the declines that are structural given where the monetary policy is being pushed, which is to be easy to allow growth.
They're getting bullied right now by the price of crude. It's a time to trade shock for them and many others as well. Check out the price of crude this morning. WTI and Brent, we have breached 95 for the first time in 6 weeks on Brent crude. We've added $20 in the last few weeks.
And the rhetoric at the moment is not getting better, at least if you would like to see the Brent price go lower. 11 straight day of attacks last night. It's the first time in almost 6 weeks that you're seeing this Brent crude price, and that is because not only do we not have the attacks continue, but you have the Iranians coming out and saying, we're not negotiating, we're just exchanging messages. The president saying he will respond if the Houthis get involved, and so much that there is a concern that the European naval force is actually telling some European vessels, don't use the Red Sea anymore. Just the threat alone is having people to react.
Investing is an emotional game in many ways. Oftentimes, and this right now is one of those times. 95, I don't want to see that. I don't want to think about it. I don't want to internalize it. It's not happening. 88, whatever WTI is this morning, don't want to think about it, don't want to internalize it. It's not happening. Then yields start to creep higher. And all of a sudden, the yield on 2s, 10s, and 30s starts to look just a little bit different. You're starting to push towards 430 on 2s, on 10s. You're still around 460 on 30s, comfortably above 5%. And the more you see these kind of moves, the longer it continues, the more of a problem it becomes to take risk.
Over to you to the ECB, which will come out tomorrow and have to deal with this boiling the frog type of environment, at least for market participants. From the market's perspective, there have been so many cross currents of stories, in particular tech, which will take the oxygen out of the air later today, with tech earnings that people are going to try to ignore what's going on in the Middle East. But you cannot ignore when real yields on 10-year treasuries reach the highest levels going back to late 2023, when you start to talk about what the potential is for there to be overly easy policy if the Fed does not respond to this. And ultimately, does the ECB muck it up again with potentially growth expectations declining on both fronts when it comes to Europe?
Look out for that in the next 24 hours or so. We've had a close to 30 basis point move on the German front end of the curve. 2-year in just the last few weeks alone so far this month. Equity futures on the S&P 500 down by about 0.2%. Coming up this hour, we'll catch up with Max Kettner of HSBC, warning of risk ahead. General Karen Gibson of Academy as President Trump dismisses hopes for Iran peace talks, and Angelo Zeno of CFRA on the high bar for big tech earnings. We begin this hour with stocks pulling back after snapping a 3-day slide. Max Kettner of HSBC suggesting warning signs are building. He writes the following: it may well be time to reduce risk in portfolios after the peak earnings season in 2 weeks' time. Max joins us now for more. Max, welcome to the program, buddy. This one surprised me.
Hello.
I get your research every week. I was going through the note, and I'm always looking for it. When is Max turning less bullish? This note came really, really close, Max. What's changed?
I think there's a couple of things that changed. Now, when we look at the price action just the last 6-7 weeks, of course, that's been largely the semi unwind. So let's be honest, if you had told me semis are going to go down into actually a bear market and the overall S&P is actually flat, I would have taken it any day. So that still looks pretty good. But we've got to face it that actually outside of that, the rest of the S&P isn't yet participating so much. So I would say now with peak earnings season coming in the next sort of 2 weeks, there's two possibilities. Either the earnings season propels us even higher, particularly from a broad-based perspective. So the equal weight S&P really performing well. That means things like breadth measures, like things like members of the S&P above 50 or 200-day moving averages, that really going to the highest from where we were in 2023 and 2024, that then would say, hey, you know what else is there to buy? There's no more marginal stuff that is actually lagging that I can buy. And that's one possibility. The other possibility is we don't see actually that even broad-based earnings surprises propel the market higher, both of which would be pretty bad. The other thing that's clearly changed is sentiment and positioning. When we look at our measure of particularly sentiment among long-only investors, that's now starting to push towards where we were during the reopening trade, that sort of peak bullishness in 2021. And that surely from a positioning, from a sentiment perspective, when everyone's getting so bulled up, is not a positive going forward.
Max, I just want to highlight something you're saying here. I think it's important. What I'm hearing from you is don't look for the earnings, look for how the market responds to the earnings. That's going to be far more important to you over the next 2 weeks.
Yeah, absolutely. I think absolutely, particularly when you compare Q2 versus Q1. Let's face it that when you compare and look at year-over-year earnings expectations, of course, everyone says, oh my God, the bar is so much higher. That's not true. It's just the year-over-year that is higher, and that is largely a result of the really, really good earnings season that we had in Q1. Let's remember that in Q1, we had the highest earnings beat rate in the S&P 500, really, since the second quarter of 2021. And we had the highest average earnings surprise, right, across the S&P 500 companies since Q1 2021. Really, since that reopening trade, we had an average earnings surprise of almost 20%. Well, of course, the year-over-year rate expectations are going to be high then, but the sequential ones, the quarter-over-quarter ones, when you strip out energy and materials, you end up with net income expectations from consensus at about -3.5%. So I do think we can get pretty broad-based earnings surprises again. I wouldn't be surprised if we get similar magnitude of earnings surprises in the broad-based sense, median earnings growth, comparable to what we had in Q1. And then it really depends what the market is doing. Are we going to go and get a broad-based rally? Then you want to take some risk off because probably positioning and sentiment goes even closer to a sell signal. If we don't see that coming, then I'm afraid to say it's like, well, what's going to propel us even higher here? We're flat even, or we continue to be flat even with broad-based earnings surprises. In both cases, I think then into September, October, you want to take a bit of risk off the table.
Max, you're in an uncomfortable situation. Waiting is not something that seems like traders enjoy when they're looking at markets and saying, we don't know exactly how this is going to play out. What are you doing in the next 2 weeks? Are you just sitting on your hands, biting your nails and watching the earnings?
I mean, I'm hopefully not biting my nails, but I'm waiting and I'm still max overweight stocks. So we are, leaning really still into that broadening of the market. We're still overweight the equal weight S&P. We're still overweight Europe. So we've already been rotating out out of emerging market equities in the last couple of weeks, out of Asia, more into the likes of the Mag 7, where, again, the earnings bar, the bar to beat, both in terms of the numbers, but also in terms of the narrative, is so low. It's leaning into the equal weighted S&P, leaning into value more, so Dow Jones. So a little bit still away from momentum, and that also means Europe. It means European banks. It also means the dip that we've seen in Japan, particularly things like Japanese banks. That really doesn't make sense. So those are the sorts of things that in our asset allocation we're still really, really heavily overweight in the next few weeks.
Max, John was doing a great job of laying out the boiling the frog scenario that's happening in the oil markets and how that's bleeding into yields and just valuation expectations going forward. When you look at something like the 10-year U.S. real yield at the highest level going back to October of 2023, what do you do with that? At what point does that start to offer its own pressure to the bullish narrative, separate to potentially earnings and the reaction in markets?
Yeah, I think you said it, right, Lisa? I think the first step is really going to be earnings. So we are what we call that danger zone. I've been talking about it in this program quite a lot in the last 6 months as well. We are actually in the middle of that danger zone. But as long as you've got these really, really low sequential earnings growth expectations, for the next 2-3 weeks, it doesn't matter. Then I think if real rates really continue to push a little bit higher, then that's going to be an issue. But for now, it's really the earnings expectations, the earnings season. What I would also say, however, on the real rate side, I'd be actually more concerned if real rates were still lower, because in reality, that means the market has now already turned hawkish. It has already priced in those rate hikes. It has reacted to better data, to consensus now really starting to believe in that U.S. exceptionalism picture. What I would say, when you look at something like Fed sentiment on Fed minutes or things like Fed speeches sentiment, that's already pushing towards really the most hawkish since 2022. So I do wonder, going forward now into the next 4 or 5 months, that actually, aren't we all believing a little bit too much into that U.S. exceptional picture? Are we not extrapolating a little bit too much the strength in H1, this fiscal impulse strength, that the almost 20% higher tax refunds that we had in H1? Are we not extrapolating that too much into H2? And isn't there then a bit of a downside surprise potential? Nothing recessionary, but just the U.S. not being as exceptional, just great, but not as exceptional. And that, of course, actually from a real rate and then from a risk asset valuation standpoint, perhaps after the midterms would be really good in a classic sort of bad news is good news regime, because we could price out the threat of rate hikes then.
Hey, Max, it sounds like you're on the edge of buying Europe at the end there.
Yeah, absolutely. I mean, it is, I think, now a picture of, okay, maybe into the midterms, with a little bit of too bullish positioning behind the earnings season behind, maybe, and obviously seasonality, right? September, October, maybe you'll take a bit of risk off. But I think after that, that sets us up then for a really nice renewed rally again.
Interesting, Max. It's good to see you, buddy. Thank you. Max Kettner of HSBC. Nice cover story on Max this week from Bloomberg, right? See the pictures?
I didn't see the pictures.
It's like a runway shoot, wasn't it? Like a fashion shoot.
Vogue. That's what I said.
For Max Kettner. Let's talk about this market then. So rates have repriced. Crude has repriced. Earlier on this year, we had the comfort blanking of a massive positive earnings surprise to insulate us from what was happening with rates and the volatility in energy. Can you repeat the act twice? With earnings, not once, but twice, and that's what Max is focused on in the coming weeks.
The positioning and how much people have already overweighted these upside surprises, and if they cannot be pleased by what they see, which is something that we saw from Samsung, for example, does that signal that we're reaching peak positioning, which gives perhaps a bit of shade to his bullishness?
Just off 95 on Brent. No one wants to talk about it, do they? Every time we cover this story, you can just feel the anxiety. We talked about it just the other day. You bring up the story with crude, you bring up the price and you say 95 on Brent, WTI 88, and you just feel like people are frying their breakfast at the TV screen.
Well, we heard from Francisco Blanche yesterday, and he was saying that potentially if we go above 100, if the escalation continues. Goldman Sachs is saying if we continue in the phase we're in right now, we're looking at 120 towards the end of the year. These are incredibly high numbers, and right now when you look at the rhetoric coming out of both these countries, it looks like we're going to continuously be in this messy situation.
We've got a 4% move on crude so far this morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, good morning. The U.S. is widening its airstrikes on Iran in an 11th straight night of attacks. Tehran responding with strikes on U.S. facilities in Kuwait and Jordan. President Donald Trump saying he's not worried about Iran-backed Houthi militants threatening to impose a maritime blockade on Saudi Arabia in the Red Sea. President Donald Trump also preparing to impose 100% tariffs on generic drugs. The new levy will go into effect in 2028 and will increase to 200% the following year. In a Truth Social post, the president writing, this is done in order to reshore generic pharmaceutical producing into the United States. The yen back above 163 and close to its 4-decade low. The currency strengthened for a brief spell earlier after we reported Bank of Japan officials are open to raising rates at a faster pace than the expected 6-month tenor. This as continuing weakness in the currency is adding to upside inflation risks. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, blowing off talks with Iran.
We are doing very well. We are degrading them at levels that nobody thought was possible. They want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest.
Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning.
Trading day is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your Opening Trade.
Only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the Opening Trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Futures decline. We're down by 1/3 on the S&P, and the Nasdaq we're down by 0.7. Yesterday on the S&P, the best day of the month so far, a gain of 0.9. Chips helped out big time. 5% rally on semis. This morning we take some of it back, declining across the board. The Y in the bond market, yields still elevated, 2s, 10s and 30s, 2s around 425. In commodities, crude very much elevated, taking out 6-week highs a little bit earlier, $95 a barrel on Brent crude, 94.50 as things stand, higher by close to 4%. Under surveillance this morning, blowing off talks with Iran.
We are doing very well. We are degrading them at levels that nobody thought was possible. They want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest. We'll be hitting that area pretty soon, and very heavily.
So here's the latest this morning. The US striking Iran for the 11th straight day. The Trump administration downplaying chances for talks between the two sides. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, despite mediators' efforts to prevent further escalation, tensions appear to be pointed there as the U.S. expands its scope of targets. Yesterday, President Trump said that the military will soon heavily hit what's known as Pickaxe Mountain, which the U.S. and Israel suspect to be a nuclear site. Now, President Trump says that behind closed doors, Iran wants to make a deal, but as you heard, he says the U.S. doesn't want to come to the negotiating table unless Iran does in what he called a meaningful way. But publicly, we've gotten very little indication Iran is willing to let up its leverage when it comes to disrupting global energy supplies. And it's not just in the Strait of Hormuz. Yesterday, new tracking data shows that at least 2 tankers filled with Saudi oil made U-turns as they approached the Red Sea. Amid that threat from the Iranian-backed proxy group, the Houthis now risking the nearly 4.5 million barrels per day that Saudi Arabia exports via the Red Sea. And John, the longer the strikes go on and the U.S. maintains its own naval blockade, that is raising questions here in Washington about U.S. resources and stockpiles. Yesterday, we saw Pentagon officials on Capitol Hill asking lawmakers for nearly $67 billion in supplemental funding, as the U.S. Defense Secretary Pete Hegseth says that the war has so far cost Americans $37.5 billion so far.
And climbing. Tyler, thank you. Tyler Kendall with the latest in Washington. Let's build on this. General Karen Gibson of Academy writing, the current cycle of violence is about who will determine the rules governing one of the world's most strategically important waterways. Expect continued U.S. strikes and Iranian retaliation. General Gibson joins us now for more. General Gibson, welcome to the program. I wanted to unpack this headline that crossed about 20 minutes ago. It came from Secretary of State Marco Rubio. He said the United States is targeting places launching attacks on ships. I want to unpack that because I think it's important. The strait is small, but the coastline is massive. Can you flesh out just how difficult it is to achieve what the military is trying to achieve right now?
Yes, it is a tremendous advantage that Iran has, Jonathan. We are doing, as has been highlighted by the administration, U.S. Central Command is having a tremendous effect in degrading the ability of Iran to conduct these attacks. They have destroyed many launchers, command and control sites, coastal radars, but there's a big difference between degrading it and totally eliminating it. It's a small area that we're trying to protect, but the geography from which Iran can launch these attacks is vast. There are many tunnels, there are inlets, it's a tremendous coastline, and some of their weapons, like the one-way attack drones, are relatively easy to produce, relatively cheap, easy to hide, and there are limited signatures associated with their employment until they're actually launched. So to eliminate this capability is an incredibly high bar, and frankly, one that I'd say is impossible to actually achieve.
Yeah, well, how would it be possible when they use asymmetric warfare like fast attack speedboats? Is the administration going after those kind of tools?
Yes, they are, certainly, I think, and we have destroyed most of the Iranian Navy, but as you can see, even with the destruction of the Navy, they still have an ability to impact shipping. When I look at what an adversary can or might do, I actually look at 2 components. One, what is their will or intent? What do they hope to achieve? And the other is, what is their capability? Now, these strikes have largely been impacting and degrading the capability, but I think they haven't really made a dent in Iran's will and intent to control what's happening in the Straits of Hormuz. They seem intransigent on their insistence that they will control the traffic that goes through. I think one of the core roots of this issue is the MOU that we both signed said that Iran would provide for the safe passage of vessels, but that it would conduct dialogue with Oman on the how this would be administered, and it would do so in accordance with international law. Now, we both signed that. We're clearly interpreting it differently. And these strikes, while they degrade the ability, have not moved the needle on Iran's intent to control the traffic themselves.
After the Interior Minister of Iran's visit to Pakistan, his spokesperson came out and says currently there are no negotiations. It's only possible for there to be an exchange of messages. So what is happening right now in terms of the negotiating table if there's just an exchange of messages? And when you're dealing with Tehran, what's the difference?
Yeah, so I think right now a key challenge is that both sides believe that if they apply additional pressure, they will compel the other to make concessions. And so we are in a period of heightened exchange of strikes and counterstrikes, and I anticipate that's going to continue for some time, perhaps punctuated by periods of pause for diplomatic talks of some kind or exchanges of messages through mediators. But I think that we should be prepared for a period of instability in the region for the foreseeable future.
General, how short are the U.S. ammunition stockpiles right now after the attacks earlier this year, given what the U.S. has sent over to Ukraine and given the ongoing strikes?
Well, certainly there's been an impact on the global supply rate. And I think this is not just a result of this war. Even when I was still in uniform, if we used a lot of munitions in the fight against ISIS in Iraq and Syria, it had impacts on the supply rate across the U.S. military globally. This will be a priority, and I think some of the impact will be lesser munitions for other theaters where we are not actively engaged, to include potentially Ukraine, until the U.S. industrial base is ramped up sufficiently to restock those munitions.
Karen, it's good to catch up with you. This is a major challenge for the American military. General Karen Gibson at Academy Securities. American military superiority is well understood. We can talk about it across a number of dimensions, but the scale of this challenge is particularly unique. You talked about the asymmetric nature of it. These drones they're using, the one-way attack drones, they're cheap to make, they are easy to replace. Then you've got to talk about the environment. This is something that the General was doing just moments ago. The strait at its narrowest point is what, 21 miles, 20 miles, something like that. The coastline is 1,000 miles plus for Iran. So to find and identify the launch sites across Iran, tremendously difficult to do, particularly when you are replenishing your stock continuously in the way the Iranians have done over the last 5 months.
Yeah, and highlighting that is just the fact that Iran has fired ballistic missiles, and supposedly the U.S. had gotten rid of the ballistic missiles. So not only the low-tech drones that they can cheaply produce, but also some of the higher-tech missile ammunition that has not been destroyed. This all highlights how Iran is using the asymmetry to its advantage. They're saying, you have much better technology than us. We'll fight a low-tech war that is much harder for you to defend against. How much is this the road of travel going forward for the likes of Iran, for the likes of Russia in warfare?
And we've got a real-time market measure of how difficult it is to get control. Brent crude right now just off 95, back down to about 94, and higher on the session by 3%, 87 on WTI, and a very quick change. We've added $20 to a barrel of crude in some 3 weeks. Up next, we'll talk about tech. Angelo Zeno of CFRA on the high bar for big tech earnings. Live from New York City, you're watching Bloomberg TV.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Mag 7 earnings begins. A little bit later on today, you'll hear from Tesla and Alphabet. A week today, you'll hear from Microsoft, Meta. A week tomorrow, you'll hear from Apple and Amazon. And in between, you'll hear from Kevin Walsh, the Fed chair. That's quite a week coming up for this market. Let's start with the equity market. Equity futures this morning on the S&P, the Nasdaq, the Russell declining by a few tenths of 1%, down 0.2 on the S&P. On the Nasdaq this morning, down by 0.5. Not major losses, but struggling to hold on to the gains of yesterday. Chips had a fantastic session, bouncing back some 5%. Adding to Monday's gain and erasing part of that 10% slide on semis through last week. Switch on the board again to the bond market. It gets harder and harder to ignore. 2s, 10s, and 30s this morning. Lisa, 2s resetting at 425, 10s at 462.
There is a certain point at which this Federal Reserve cannot ignore the broad-based inflation pressures, even if they are coming from supposedly one-time effects like oil prices. You could see that impatience from the likes of Beth Hammack, but you can also feel that there is something going on in markets. At what point is that just fueled by what's going on in Japan, given the fact that ultimately there is a pressure for the Bank of Japan to take more action? At what point is this a global market where the Bank of Japan has as much effect on the U.S. markets as anything else?
And oil is setting the tone for the Bank of Japan right now. Crude, Brent and WTI, we're elevated. We're pushing higher by 3%, 94 on Brent, WTI around 87. It's a terms of trade shock for the Japanese, putting lots of pressure on policymakers around the world. But with dollar yen near 4-decade lows, with dollar yen at 163, talk is cheap. It ain't working anymore. We need to see some action from the Japanese authorities, and that's what the market is beginning to call out.
Yeah, and that's the reason why maybe you're seeing a little bit of a reaction to this news that the Bank of Japan may potentially move faster than every 6 months. Of course, they're coming up against a policy coming from the Prime Minister that is against that, right? The idea of run the economy hot, get the economy far, far away from the 90s, that era of repression, and how much can you get towards some sort of warp speed? Right now, they're really playing a difficult dance. FX very much in focus.
Dollar yen at 163. We're getting some numbers from AT&T. We'll get to those figures in just a moment. In the meantime, let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We are seeing shares of Super Micro soaring 16.5% in the pre-market after the company gave us a preliminary look at its results, and they were excellent, reporting a record backlog of more than $60 billion and that stronger than expected margins. It's also being taken as a sign that customers are looking past recent controversies because the company is still being investigated by U.S. and Taiwan authorities over allegedly shipping AI servers to China containing restricted NVIDIA chips. Staying on that AI theme, we are seeing shares of nuclear stocks, Oklo and X Energy, extending yesterday's gains, rising on our reporting that they will be part of a Trump administration to speed up the development of nuclear reactors used in AI data centers. The program, which also involves the likes of Microsoft and NVIDIA, is the latest reminder of the enormous amount of power needed for AI and that all power sources will be needed. And in the latest sign of trouble for software, we are seeing Pegasystems plunging 15.6% in the pre-market. Its quarterly results missed estimates and highlighted a bigger issue that customers are delaying software purchases because of the rapid change of AI. It echoes what analysts say, that it echoes what IBM told us last week, that companies are putting off software decisions in order to pour more of their budgets into AI infrastructure. John?
Yahara, thank you. Thanks for the update. Let's get back to those numbers. The earnings from AT&T just crossing. It's a beat. The stock is higher by close to 5%. Bramo, look at those phone additions, net additions for the 3 months ending June 30.
Yeah, 432,000 versus the estimate of 325,000. So a significant upside beat. This also affecting the share price. The fact that the shares are lower by more than 10% so far this year. They said that they see their full year free cash flow at least $18 billion, and they're accelerating their share repurchases to $10 billion from $8 billion. Given the fact that they also have about $8 billion of dividends, that's the entirety of the free cash flow getting redistributed to shareholders. So potentially that also adding to the boost in shares this
Unlike
morning.
what we're seeing from major tech players who increasingly are doing other things with
Correct,
that money.
exactly. We're not investing in some sort of long-term project. We've already invested in that. Here you go. Here's your money.
John Stankey coming up a little bit later. The AT&T CEO joining this program later this morning at 8 a.m. Eastern Time. Do not miss that conversation. A beat from AT&T. The stock is rallying in the pre-market by some 4%. That's our top stock story. Let's get to our top stories in our radar this morning. The Trump administration downplaying the prospect of talks with Iran.
Iran has been reaching out to the United States, both directly and indirectly, to engage in talks about settling the differences. Even though we have reached agreements, they have not kept their commitments. The problem we're having right now is that they're not serious about talks.
U.S. forces attacking Iran for an 11th consecutive day. Tehran telling semi-official media that an exchange of messages is possible, but there are no negotiations underway. Elsewhere, the president threatening a 100% tariff on generic drugs. The president posting on social media that drug makers will have 2 years to move production to the U.S. before the duty takes effect. Levies will rise to 200% a year later. And finally, OpenAI, check this story out, admitting its most advanced models hacked another tech company, the maker of ChatGPT, saying systems for Hugging Face were breached in an unprecedented incident. Hugging Face, which hosts AI models and data sets, reported an intrusion just last week.
And this comes with the latest OpenAI model that they said hadn't had the sufficient guardrails, but they wanted it to really experiment to see what it could do. Again, it just highlights the potential risk here as new models come to the fore. We know that Anthropic worked with the government to try to corral and maybe take offline their Fable and Mythos offerings before you could get some sort of protections. Again, though, this is a huge concern for the financial markets. Yes, this is for particularly an AI company that hosts AI models and data sets. What happens if this really gets into a massive system and shuts it down?
Because it's supposed to be operating in a safe sandbox environment, but the system itself found a vulnerability in that sandbox and escaped to the internet. Now we have Sam Altman, according to the company, going to the White House next week. He's supposed to be going there for meetings. I imagine this is going to be the #1 concern, and potentially the government gets involved the same way we've seen them get involved in Anthropic.
They've got some issues that they need to address. I think an important development in the last 24 hours for that company. 2 additions to the board to OpenAI, both from financial services, one a friend of this program, Robin Vince of BNY. And I think you can think of a bunch of reasons for why this would be happening. I can think of 2. 1, you need financial services know-how to navigate the financial system, not just over the next 12 months for an IPO, but particularly the amount of money that this company is going to need. 1. 2, also PR. When I hear Robin talk about AI and the use case, I hear a quite positive, constructive message about the future, capacity creation, that kind of thing. That's the kind of help I think Sam Altman really needs right now at OpenAI.
He also needs credibility that he can keep control over this until it's ready, and he can keep control over any new models and roll them out in a responsible way. Again, to the point that Robin Vince could potentially create some of the know-how behind this, but with financial systems in particular, clear sensitivity, given what we've seen with Mythos.
That's the latest on OpenAI this morning. Let's get to Alphabet, kicking off big tech earnings after the closing bell. Investors looking for details on spending plans and returns on AI investments. Angelo Zeno of CFRA writing, all eyes will be on which companies will be able to win the confidence of investors towards demonstrating successful AI monetization. Angelo joins us now for more. Angelo, welcome. How high is that bar for Alphabet later on this afternoon?
Yeah, I would say, John, Alphabet's probably got the highest bar among the hyperscalers that are out there. The biggest reason is just the fact that, you know, this is a company that's probably been the best, it has been the best performer among the hyperscalers here over the last year. I'd also say when you kind of look at the magnitude of the increases that we've seen across their businesses, whether it be on their ad-related businesses within search or whether it be on the cloud side specifically, those numbers have gone up significantly. You'd have to see, a cloud number north of 70% here to really get the street probably excited. And clearly expectations are for top line growth of north of 20%. So the bar is high here. You kind of look at the multiple here for the shares as well, looking at about 23, 24 times our calendar 26, 27 estimate relative to others that have actually seen their multiples come in significantly. High expectations going into the print.
Angelo, as you know, a focus also on one number, CapEx and CapEx intentions. Help me navigate that. One, are you expecting that number to be bigger? And if it is bigger, is that because they found more things they want to buy, or just that the things they want to buy have got more expensive?
Yeah, I mean, I think the expectation going into this is probably a bias to the upside in terms of boosting that CapEx number. I mean, you're looking, let's say, close to about 190 billion here this year. Whether or not they boost the number here for the second half of this year, I think is less relevant versus what they're going to do into 2027 and in 27. I think, at this point in time, you should expect something at least 300 billion or north of that, just based on kind of what we've seen them do in terms of raising equity. Also, when you kind of think about what they've seen here over the last couple of months in terms of that cloud growth, you need to continue to invest aggressively. And I think as long as you can kind of show that the magnitude of the backlog growth that we've seen here over the last couple of months, they've essentially doubled the backlog growth last quarter. We'll see what they do here this quarter. As long as they show that growth trajectory, and they are going to start ramping up the hardware-related revenue here in the second half of this year, I think the street will be okay with the higher CapEx numbers, but in kind of moderate levels here.
Wait, hold on a second, Angelo. I want to make sure I'm understanding what you're saying. You think that it's enough for them to show the backlog of business, the demand for services that they're building out and they're investing in, and that will be enough, even though they continue to come out and say, demand outstrips supply dramatically again and again. We have seen some fading credibility that markets say, okay, maybe, but that's not enough for us. You're saying it still will be enough.
I think these companies are going to be looked at on a case-by-case basis. And when you think about Alphabet, or if you kind of look at how the market has kind of reacted to Alphabet here over the last couple of quarters, I think they trust Alphabet a lot more than I'd say some of the other hyperscalers out there in terms of being able to monetize and take share, at least on the cloud side of things. So I think when we kind of look at the pipeline here from Alphabet, and I also think when you kind of look at what they've also done on the ad side of things in terms of accelerating that growth, again, we've got to see what the numbers look like and what kind of clarity they provide here into the second half of this year. But I think it'll be enough in terms of if we continue to get that momentum on the booking side of things.
Angelo, will Google's gain be everybody else's pain? And I'm talking about cloud computing and winning share. We've seen that in the past. A question of whether Google Cloud wins at the expense of AWS and Azure. Do you expect to see that type of dynamic, or do you think that a rising tide can still lift all boats?
I think you're at a point where you can see the rising tide lift all boats. I just don't think it'll be kind of at the same trajectory, across these companies. So for Alphabet, I'd say that tide is much greater. Just kind of based on what they've done here, I'd say it's a lot less. The visibility is a lot less there when you think about Microsoft, and clearly the multiples show you that in the stocks between the two companies. And then of course, when you start looking at some of these tier two players, right? You think about what Oracle is having to go through right now. I think that's really the problem child in this market. But and then you kind of throw all that into what Meta's doing at this point in time, and I think that's really fascinating in the sense that they're kind of ramping up this compute offering. We'll see if they announce anything in terms of a potential kind of bookings or growth trajectory in terms of that AI compute business, because I think that's really important in terms of some of the tier two players that are out there, and that potentially impacting the backlog growth you'll see from those companies in the coming quarters.
We also have Tesla on deck. Does the earnings take on increased importance since the SpaceX IPO and all this speculation that potentially there could be a tie-up between the two?
Yeah, I mean, I think you'll definitely get asked that on the call as far as Tesla is concerned. I think there's an expectation or growing expectation by many out there that there is going to be a combination from the two. But yeah, I think it's going to be an item up for debate here on the call. I don't think Musk will directly answer that one, but I think there's going to be, especially after the call, there'll probably be more speculation around it from the investment community.
Angelo, thank you, buddy. Appreciate it. Angelo Zeno of CFRA will be talking about Tesla a little bit later on this morning. It will be the only question, be the first question for so many people. Just when? When's it going to happen?
Yeah.
When are you going to see this tie between them and SpaceX?
Yeah, and what's the market kind of forecasting here? I mean, in other words, if they don't get some sort of announcement, then does that disappoint shares and does it send a blower, or is everybody going to keep out hope that maybe it'll be next quarter?
Nasdaq futures this morning down by 0.6%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump approving an agreement with Saudi Arabia to develop a civilian nuclear program. The Wall Street Journal reporting the deal could pave the way for uranium enrichment inside the kingdom. The 30-year agreement is estimated to be worth tens of billions of dollars. AT&T shares rising in the pre-market. The company reporting second quarter earnings that beat analyst estimates. AT&T also seeing its quarterly revenue take up as more customers sign up for its postpaid phone and internet services. And coming up at 8 a.m., AT&T CEO John Stankey joins Surveillance. The World Cup final scoring a record U.S. TV audience of more than 62 million viewers. The tournament's viewership more than doubling compared with 4 years ago. And the official FIFA TikTok account receiving more than 24 billion views throughout the tournament. That's your Bloomberg brief. John.
Bonnie, thank you. It's a great time for good news because guess what? The bidding process will start soon for the next round of the World Cup and the round after that. And there is talk, the number I've seen, of something like $4 billion for the US rights. It's a multiple of what Fox and Telemundo have paid for the previous World Cup bidding auction. And we could see other names like Netflix, YouTube, Disney maybe get in the mix to pursue this.
Increasingly, it's not a revenue driver when it comes to a lot of these different streaming platforms and cable networks, just because the costs are so high. The goal is just to attract viewers, because ultimately that is what you're paying a premium for, but the costs are high enough to offset all the other potential revenue gains.
Get more content though, Bramo. Just make it a 100-team series, you know? Just have 100 nations in it. We'll do this the whole summer, 3 months.
And you know what? They could be split with Paramount, Netflix. You could have to go to each one to see the different teams go, because that's what they're doing currently with sports.
Look, I'm joking, because right now I've got withdrawal. I miss Portugal, Uzbekistan. Like, I miss those games. I want to go home and it's not there.
There's nothing really good on right now. I don't think I have to watch the Yankees.
You're not being serious.
I am deadly serious.
You know, you're already thinking about
that. Premier League's a few weeks away.
Exactly. Carry on.
August 21st?
A few weeks away. Okay. Up next on the program, inflation fears driving higher.
When we look at the drivers of inflation, they all suggest upside risks to inflation pressures. Inflation is not going to move back down to the Fed's target without additional policy tightening. The bar for hikes is relatively low.
Up next, we'll catch up with Subhadra Rajappa of SocGen, live from New York City. You're watching Bloomberg Surveillance.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years when I first became a congressman. It takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half
is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
We're down 0.2% on the S&P. We're down 0.5 on the Nasdaq 100. Some outperformance on the Russell relative to the Nasdaq in a down market. We're down by only 0.25% so far on the small caps. Into the bond market we go, where yields are really elevated. Look at this: 425 on twos, 462 on tens, a 30-year around 513, the upper end of the recent range, very close to the very upper end of the recent range on yields across the curve. The move in crude's not helping. WTI and Brent, another move this morning of 3 to 4%. Here we are this morning, just off 95. 95 earlier, down to 94 on Brent. WTI at 87, a week out from the Fed's next meeting. Under surveillance this morning, inflation fears driving inflation much higher.
When we look at the drivers of inflation, they all suggest upside risks to inflation pressures. Inflation is not going to move back down to the Fed's target without additional policy tightening. The bar for hikes is relatively low. We think the first hike is going to be in September, and you'll have a sequence of 3 rate hikes in the back part of this year.
So here's the latest this morning. Rising oil prices renewing inflation fears, with the Federal Reserve's July interest rate decision only 1 week away. Treasury yields hovering near highs of the year, putting last week's call inflation prints very much in the rearview mirror. So Subhadra Chapter of SocGen writing, while we continue to expect the Fed to keep policy on hold, persistent market pricing reinforces the possibility of a hike by the end of the year, likely after the midterm. Subhadra joins us now for more. Subhadra, good morning.
Good morning.
Let's start with the base case. Base case for you is a hold. So let's start with why. Why a hold?
Only because of the fact that we thought that so far the data has not sent a clear signal that the Fed should hike immediately. And then you have the dynamics with the midterms and Kevin Warsh taking his job. Just a month ago, he probably doesn't want to come in and raise rates as soon as he's been appointed as chair. So those were kind of some of the motivations. And then you got the two softer, the CPI prints, the PPI prints. Core PCE is probably going to be, also somewhat on the softer side. We're expecting 0.18 for, month over month. So that brings core PCE at 3.3%. So there's not an urgency for the Fed to hike, but the market is fully pricing in a hike by the end of the year. So at some point, the market's going to dictate to the Fed what the Fed should do. If the market is fully priced for a hike and the Fed doesn't deliver, then the Fed's going to be inducing volatility. So that's kind of the spot that we're trying to navigate here.
Can you unpack the move in yields in the U.S.? How much is oil? How much is the Bank of Japan? How much is just deficit concerns as we keep hearing about the mounting bills from the conflict in the Middle East?
So when we wrote our mid-year outlook, I thought maybe the conflict was almost over. The Iran war is fully back on. You have higher oil prices. You're looking at the impact of higher oil prices kind of feeding through to all of the other economies in the world. Europe and Japan are extremely impacted by that. So you're starting to see those economies start to, markets I should say, start to price in more hikes and higher yields. And then you're seeing the rout in the yen. Inflation expectations in the U.S. have been somewhat contained, but I am concerned about the trajectory for debt and deficits. The Trump administration's asked for $87 billion extra in supplemental funding for the war, as well as for the Farm Bill. And you're looking at refunds from IEPA also contributing to higher deficits in the month of June. So all of that put together, you have a dynamic where you have not only higher inflation, but investors are starting to get a little bit concerned about the trajectory for debt and deficits.
And the best evidence for this is real yields, because you're seeing that right now yields are not climbing higher as a result of inflation expectations. They're actually relatively muted. But you are seeing real yields on U.S. 10-year treasuries reaching the highest levels since 2023, 2.34%. How high do you see that getting if the Fed does not hike rates, if the Fed remains on hold despite what the market seems to be suggesting?
So, I mean, we are near the highs. Is it possible for real yields to push higher? Yes. You're starting to see some of the correlations that you typically see between gold and real yields start to come back and play. That inverse relationship is starting to come back into the front. Typically, investors start to buy or enter into the bond market when real yields look attractive and move away from gold. But I don't know if you're going to see that backstop bid in an environment where the concern is for debt and deficits. And debt and deficits is not just a U.S. problem. You're seeing this in Europe as well as in Japan. And that's really where I think the global bond market dynamic starts to come into play and push yields higher.
What's the window the Fed has to act when the market actually continues to believe them and it's not just empty threats, given the fact that the market's pricing in hikes and officials continuously talk about how they're concerned about higher inflation?
So historically, if it's like 70–80% priced into the market, the Fed typically tends to deliver. We saw a lot of volatility in the July meeting pricing, right? I mean, we went from almost being fully priced in early last week to not being priced in to now yesterday, we started to see that come back into play. That's one of the reasons why I highlighted that maybe the Fed might have to act by the end of the year, because it's more than fully priced in for the end of the year. It's a question of whether they deliver before the midterms or after the midterms.
Do we need to rethink that when we say things like typically, they usually? Is this a different Fed where typically and usually doesn't really apply anymore?
100%, and that's what makes it all the more confusing, because there's no forward guidance. I mean, this is not, business as usual for the Fed. And it's hard to know if kind of the market's going to dictate to the Fed, and the Fed is going to ignore the market's pricing. But, as I pointed out earlier, I think that typically tends to lead to volatility when the Fed doesn't follow through on market expectations. So the Fed has to decide if they want to comply or be the inducer of volatility in the market.
Subhadra, it's good to see you. Appreciate your time, as always. Subhadra Japa there of SocGen. We'll catch up with Mike McKee later to try and get confirmation as to whether we'll get a news conference or not a week today from this Federal Reserve. Up next, we'll catch up with Mira Pandit of JP Morgan Asset Management, Libby Cantrell of PIMCO, Susan Bell of Rystad Energy, and Simona Mokuta of State Street. The second hour of Bloomberg Surveillance just around the corner.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the Treasury market. You can get that from a bank. You can get that from high yield right now, is pretty good. High yield has very little exposure to software. And then you can get it from private credit, where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
The U.S. economy continues to chug along.
It's all fun and games until the Fed has to pump the brakes.
Hawkishness at the Fed is reaching a type of critical mass.
I'm hard-pressed to see Fed tightening. We have a labor market that's stable.
I think the Fed is going to be on hold through the rest of the year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this, declining following yesterday's bounce. On the S&P, we're down by 0.2. On the Nasdaq, down by 0.6. In the bond market, new levels again to talk about. 426 on 2s, 463 on 10s. Responsible for this, somewhat, what's happening with the crude market right now. Brent earlier topping $95 a barrel for the first time in 6 weeks. This morning, as things stand, higher by close to 4% at 94.35.
Yeah, and this is a global story, and we've been talking about it all morning, how higher oil prices don't necessarily translate to higher inflation in the U.S., and certainly you're not seeing that in inflation expectations. That said, around the world, it is pressuring a lot of nations, whether it's in Europe, when we get the ECB rate decision tomorrow, whether it's in Japan, where you're seeing some real pressure on the currency. Given that, you start to wonder at what point the bond market diverges from some of the past principles and rates keep rising, despite the fact that people still want to use the T word when it comes to some of these inflationary inputs.
And I know when Jonathan says the market just wants, or investors just want to ignore where Brent is this morning at $95. You can't. Even if you decide to ignore the rhetoric coming out of Tehran and Washington, you can't ignore what's actually happening. 11-day, another straight day of strikes, finishing last night. We're getting messages now that the Iranians are talking about what they've been targeting, U.S. air bases in Jordan, desalination plants in Kuwait. All of this continues, and at the same time, the Houthis are just threatening to get involved, and already that is diverting some ships.
This is up there with tariffs, two of the most hated stories in financial markets. It really is. Tariffs and this in the Middle East. And why? Because they didn't matter to the market. That the market kept rallying up and to the right, up and to the right. We saw through the issues with tariffs, everyone got worried about it, wasn't a problem. We saw through the issues in the Middle East, everyone got worried about it, wasn't a problem. That's what makes this moment so dangerous in the Middle East, because people have been scarred and conditioned by their experience over the last few months, not to be too preoccupied by all of this, to focus on what's happening elsewhere. And yet the risk continues to build, and the cushion that's insulated us all is getting smaller and smaller. And that's where the worry comes this time around.
The inventories have been drawn down significantly, and it's not just on Brent crude and WTI, it's also on refined assets, the distillates, which have also gotten to near record lows. And you're seeing that in terms of the spread for heating gas and gasoline and just natural gas even over in Europe rise to really high levels relative to where the base commodity is. And that's leading to a lot of people to wonder how much this is going to bleed into consumer activity. It's also, we cannot predict this story. It is out of our control. And the stories that you can predict are becoming less predictable. And that is the tech story. So all of the pillars that are keeping up this market kind of facing their own questions right now.
The comfort blanket, the earnings, of course. The earnings have been absolutely fantastic, tremendous. And later on, we get more earnings. We will hear from Tesla. You will hear from Google, Alphabet, of course. And you will hear from IBM. This morning, we heard from AT&T. And again, a different company, another sector, really good earnings from that company this morning.
Yeah, adding a much higher number of subscribers than people had expected, but competing on price and actually offering discounts to lure people in, emphasizing that they want more subscribers rather than getting the best bang for your buck with every single one of them. So how much is this strategy of hoovering up enough of the pie ahead of broader AI adoption, broader connectivity? Does this give a read that is secular, structural? I mean, what can we read into this to extrapolate a larger narrative?
John Stankey, the CEO, joining the program 60 minutes from now. Coming up this hour, we'll catch up with Mira Pandit at JP Morgan, ahead of a key week for big tech earnings. Libby Cantrell at PIMCO, with President Trump threatening a 100% tariff on generic drug imports. And Susan Bell of Rystad Energy as crude spikes following an 11th straight day of attacks against Iran. We begin this hour with stocks failing to maintain momentum, heading into a massive stretch for earnings. Mira Pandit of JP Morgan Asset Management writing, the AI narrative is one of stagnation and rotation. Earnings growth may not be the decisive differentiator. Joining us now, Mira Pandit. Mira, it's good to see you.
Good to see you too.
Let's get to this bar. We've talked about it so many times. It's really, really high. We were shocked by a positive earnings surprise through the first quarter. How difficult is it to repeat the act in Q2?
We are no longer talking about whether AI is a bubble or not. It's very much become this volatile trade around stagnation in areas like the Mag 7 and the hyperscalers. Mag 7 are barely up this year, up slightly. Hyperscalers slightly down, to this rotation into semis. And what we're also seeing is this rotation back and forth. People want a little safety, they go to the hyperscalers. People want a little growth, they go to the semis. And so this trade-off has been persistent over the last couple of weeks. But then you think about these spectacular earnings and the earnings growth that we're seeing out of these companies, nothing has changed from that perspective. Still incredibly impressive. But the challenge is the Mag 7 years ago had set such a high bar of trumping themselves each and every time and every quarter that your reward for that upside in earnings was only taken away from the fact that your upside in CapEx kept increasing. And you're even seeing that now with the semis, where some really explosive earnings globally in different semi stocks have not necessarily impressed the market. So that bar, again, has become so much more challenging for rewards here.
Are there areas of the market that make you a little bit more constructive when you think about the prospect of being rewarded, these earnings coming through strong and being rewarded in the equity market?
I would say probably financials, although I know that there is an AI stripe to that when you think about the fundraising there and the IPOs, capital markets activity. That was clearly a big driver when we think about earnings this past quarter. But underneath that, you still are seeing very strong consumer fundamentals when you think about delinquencies and charge-offs. You're still seeing loan growth there. So it's not masking any weakness there. There's still some underlying strength, and that has been a laggard for most of the year until recent weeks where you've seen that start to pick up. But the big challenge we're facing as investors is when you go to those traditional spots for diversification, when you go to value, when you go to small cap, those are very AI-centric still. I mean, you look at where we are year to date, and it's been so shocking to see how much value has outperformed growth persistently throughout the year. It's not really an energy story. A lot of energy gains have been given up since the pre-war time frame, but it's really 51% of that return coming from just 10 stocks that are all semis, hardware, equipment. And 7 of those stocks will not actually exist in the value indice after the rebalance. You see the same thing with small cap. It's a bit of a confluence of low quality rally, of reversion to the mean, but also that AI trade where if you looked at the second quarter, 22 of the 25 top performers were also AI related, about 30% of the return. You look internationally, you see earnings growth, 60% of that being driven in Japan by AI, 80% in emerging markets. So it's so hard to go to some of those typical spots, which is why it's so important to say, let's look at the company by company fundamentals here to find some diversification.
Max Kettner was on earlier from HSBC, and he has been max bullish. And as John was saying, we all look for, I still remain bullish even after all of his negativity. This time he was a little bit different. He's saying this will be a true test, the way that the market responds to tech earnings that we get later this week and into next. Do you agree? Do you think that if stocks sell off, even in the face of good earnings, that that's a broader sell signal to get bearish on U.S. equities?
it's just been so touch and go around the tech story that it's hard to get truly bearish around it, because then investors find another place where there's opportunity and potential growth. Again, as this trade continues to rotate into new favorites and then back to old favorites, I think the bigger risk here is more around investor fatigue and more of, again, that stagnation risk, that things don't necessarily crater, but instead investors just say a lot of this is in the price, given what we've seen over the last couple of years.
How high do yields have to go for bonds to be a competitive pressure with respect to AI versus income?
As you mentioned earlier, that real yields are showing some of their best levels in years. So I think it is a competitive pressure in that it gives you another source of diversification. You have to be a little bit mindful in that within the IG space, there's a lot of tech there. But I think for it to become a threat to equities itself, you'd have to see more of an acceleration in yields as opposed to what the absolute level is. If things grind a little bit higher, I think we're still okay. And it's not necessarily grinding higher all for bad reasons. Yes, oil is a component and inflation pressures are a component here, but the economy is still fundamentally in a good place. And I think what the Fed is arguing is there is this geopolitical and inflation-prone economy that we are mindful of, but there's also a resiliency to the economy where we just may not have rates that are restrictive enough to an otherwise pretty solid backdrop.
You don't think the Fed moves until after the midterm elections, but does that match the rhetoric you're hearing from Fed officials?
It doesn't necessarily match the rhetoric, and we've seen a big pivot here. I mean, it's so surprising to think about when Kevin Warsh was first nominated, we were telling clients, we don't think he'll cut rates in a massive way, and now instead it's, we don't think we'll have massive hikes. The rest of the committee's composition hasn't fundamentally changed much. And if you look at the dots in the dot plot, for example, you still had 8 people on hold this year. Again, we don't know who's a voting member and who's not necessarily, but if you look at that trajectory of the dot plot, it almost looks like a little bit of a hike and then a cut. So to me, that suggests a hold because you probably won't just see one rate hike. And I think if we think about the July meeting, probably a little bit premature, even though the rhetoric has been strong. September, typically you see movement before the election only if there's already been a chain of movement, cut or hike. So perhaps the first live meeting, again, is likely December, but even then we do see broader disinflationary pressures in shelter when you look at rental vacancies, in wage growth, helping services potentially. So there are a number of different areas, even tariffs, although they're resurfacing, probably a lower rate than what we were at last year. So we could very well see that timeline pushed out further into 2027.
Let's try not to talk about tariffs, Mira. We're really trying to bury that story. We'll talk about it in a moment. It's hike versus hold. There are some out there that believe we'll get cuts. Citi's still holding on to that call. This came from Andrew Hollenhorst just moments ago. Andrew and the team over at Citi. The yields are basically following energy prices higher, but, and it's a big but for them, we think markets are underappreciating the extent to which softer CPI will raise the bar for Fed hikes.
Yeah, and this idea that we did get those softer CPI and PPI levels, given that Andrew Hollenhorst and the team thinks that there is greater weakness in the underlying economy and that will actually pressure people to still cut. I think they removed the easing bias and we left because we already had seen such hawkish rhetoric. I think Citi is pretty idiosyncratic in their call.
Unique.
Unique, thank you. That's the word I was looking for.
Unique, for sure.
Yes,
for
exactly.
Sure. Mira, let's finish on this. How high is the bar? Is the bar higher for hikes or higher for cuts for the year ahead, as far as you and the team are concerned?
Right now, the bar does seem higher for cuts, given the shift of the rhetoric and given the fact that just the totality of history over the last couple of years where we have seen inflation overshoot, and now that the markets have priced in those hikes, it feels like getting back to an environment of cuts is going to be a little bit more challenging. But again, it's very possible from an inflationary perspective where we start to see things come down more than perhaps expected next year, irrespective of energy, again, pointing to some of the things I had just mentioned around wages and I won't say the word again, starts with a T.
I'll do it in a minute, don't worry.
So there are certainly some balanced risks around inflation in 2027, but at the moment where the market narrative lies, it seems like the bar to cut it is pretty high.
Mira, thank you. Mira Pandit of JP Morgan Asset Management. It's tariffs on the Strait of Hormuz, and people are just like, no, I can't hear you.
Tariffs, transitory, right. Other T words that just, honestly, people just, how do you price that?
With difficulty.
Which is the
and even when you price it in the crude market, you still try and ignore it because of how things have played out in the last 5 months. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump minimizing the prospect of immediate talks with Iran as the two sides exchanged strikes for an 11th straight day.
I will tell you, they want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest in even.
Iran confirming mediators reached out with proposals to ease hostilities. Intel confirming a new round of job cuts to reduce costs as part of its turnaround effort. The layoffs will target the company's data center business, which has been helping drive a recovery in revenue amid strong demand for AI infrastructure. Intel reports earnings after the close tomorrow. Apple is partnering with shopping and payments platform Klarna to launch a new leasing program. Sources telling us here at Bloomberg, the service will work like a subscription model, allowing customers to pay monthly for iPhones, Macs, iPads, and Apple Watches. And that is your Bloomberg Brief, John.
Hey, Vonnie, thank you. Appreciate the update. More from Vonnie in 30 minutes' time. Up next on the program, putting tariffs back on the agenda.
We have a very big plan on pharmaceuticals. We want to bring a lot of the pharmaceuticals back to America where they should be. We're going to want to be making a lot of them ourselves, all of them in a sense.
Libby Cantrell in the green room. I'm not sure even Libby wants to talk about tariffs, but we'll attempt to get Libby to talk about tariffs in just a moment. Libby Cantrell at PIMCO, up next.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Equity softer, down by a third this morning on the S&P. Bouncing back yesterday, raising some of that gain this morning on the Nasdaq 100, down by 0.7. We managed to squeeze out decent days of gains for the S&P and the Nasdaq, even with the repricing across the yield curve yesterday. 2s, 10s, and 30s. Yields up throughout the last 24 hours across the curve. 2s around 426, 10s around 463. Supporting that move, this move in crude, higher by 3 to 4% so far this morning. Crude at 94.40. WTI 87.30. Under surveillance this morning, we've got to talk about it. Putting tariffs back on the agenda.
We'll be announcing on pharmaceuticals sometime in the very near future. We have a very big plan on pharmaceuticals. We want to bring a lot of the pharmaceuticals back to America where they should be. We're going to want to be making a lot of them ourselves, all of them in a sense.
So here's the latest this morning. The president saying generic drug makers will face a 100% tariff if they do not move production to the US. The president posting on social media the duties will take effect in 2 years' time. Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, as you're saying, President Trump says that this is part of the administration's effort to onshore manufacturing, but it is raising questions on the potential impact it will have on the cost consumers pay for generics, which make up nearly 90% of U.S. prescriptions. If this sounds familiar, you'd be right, because back in April, the U.S. Commerce Department announced the results of that Section 232 investigation looking into the national security implications of making pharmaceuticals abroad, and at the time announced that the U.S. would levy brand name pharmaceuticals at a 100% tariff, actually by the end of this month. But this is the first time that we've gotten an update when it comes to generics. Now, publicly, the administration has billed this as part of its affordability push, launching alongside it a direct-to-consumer discount drug sales platform. But the planned tariffs are expected to raise costs on manufacturers that are already operating on thin margins, risking higher prices. Now, John, our own analysts at Bloomberg Economics say we'll have to wait to see exactly how big an impact this will have, in part because the administration has granted carve-outs to some of the biggest companies like Eli Lilly and Merck, who have committed to building factories in the U.S. Plus, keep in mind, levies on exports from some countries that have struck trade deals with the U.S. could face lower rates.
Tyler Kendall with the latest in Washington. Unfortunately, we've got to build on this. If you don't like this story, I haven't got good news for you. Later this week, on Friday, we've got a deadline approaching for President Donald Trump's global tariffs. Sources telling us here at Bloomberg, the administration is planning fresh levies in the coming days to keep those levels intact. Libby Cantrell of PIMCO writing, while some speculated that Trump might soften his stance, we're likely to see him once again double down on higher tariffs. Libby joins us now for more. Libby, good morning. Thanks for doing this.
I also don't want to be talking about tariffs, by the way, but I'm happy to be talking with you.
Why is Friday so important?
So just as a reminder, about half of the tariffs that the president had put on were ruled illegal under this SCOTUS ruling in February. That was under IEEPA, the International Emergency Economic Powers Act. The president then replaced those tariffs with this sort of temporary stopgap law, Section 122, at 10% across the board. Those expire, though, on Friday. So our expectation is that he would, even before the reporting, is that he would then move forward with more tariffs under these more durable tariff tools, Section 301, Section 232, now Section 338 is in the mix. That comes from a 1930 tariff law that has actually never been used before to impose tariffs. So I think that the point here is that even though I think there was maybe some hope among some folks that he would use this opportunity to sort of pivot away from tariffs to maybe take some of these concerns to heart in terms of affordability and concerns of voters going into the midterms. He's not. And our expectation was that he would not. He believes in tariffs. He thinks tariffs work. And importantly, from a revenue perspective, tariffs are a tax. They do raise revenue. And so what this administration is trying to do, I think to also maybe quell the bond market a little bit, is to reconstitute that tariff rate to get back to that sort of $170 billion amount that we were raising under tariffs under IEEPA and the other provisions.
But as you mentioned, some of these legal authorities have never been used before. So what are the chances we're back at the Supreme Court?
Well, so Section 301 is more durable. That is, there's a lot, as you know, a lot of process that's required there. There's an investigation, there's public comment. I would be surprised if these new tariffs that are likely to be announced on Friday under Section 301 would be contested by the courts. We'll see. The Section 338, much more novel use, again, has never been used under the 1930 Tariff Act. We'll see. It's the way that they're imposing them. It is very targeted on those products that Canada discriminated against or allegedly discriminated against, things like alcohol, and they're more targeted. So we'll see that they might be actually more legally durable. But I think the bottom line here for markets is that even though we wanted this sort of this tariff trade policy risk to be in the rearview mirror, it once again continues to be, I think, front and center, honestly, for this president. He believes this. He believes this is unfinished business from his first administration. He's going to continue to focus on it.
What about this latest threat when it comes to generic drugs? If you talk to analysts, 100%, 200% tariff on generic drugs actually doesn't even mean it's going to be cheaper to produce in the United States. You'd rather take the hit on the tariff and still produce in India or in China. Is this just a midterm election message?
I mean, it definitely, I think it's one of those talking points the president likes to lean into in terms of decreasing, drug prices. I mean, look, it's the time frame is not until August of 2028. That, of course, is right before presidential election. It all of us feels. I mean, I think we should believe it when we see it. But I think the broader point here is that while this might be the news of the day, the bigger, broader headline is that the president is going to continue to move forward with these other tariffs, and again, in order to rebuild, to get to that kind of 13% effective tariff rate that we were at in the January before the SCOTUS ruling in February.
Why do we hate talking about this so much? Is it just that we think that this is all going to get overturned or that it's not going to go into effect? So any analysis that you do of it's just going to be wasted breath?
Well, a little bit, and I think what we have seen is that the economy has been able to absorb tariffs much better than I think we were all expecting. I mean, one was that the other countries really didn't retaliate against the United States. I think that was actually something that I think we all sort of assumed, and that did not necessarily materialize. And then obviously the president has also backed off from sort of the apex of the Liberation Day tariff. So we have not, we sort of touched the hot stove, and he retreated.
You said something, though, fascinating, which is the bond market is watching the deficit climb, and they're watching the fact that there aren't the revenues coming from the tariffs that were overturned by the Supreme Court, and they're watching what's happening with the conflict in the Middle East, and they're watching what's happened with Doge and some of the people who've been added back, and they're wondering, how is this going to add up? At what point is that the big market takeaway that needs to be the focus?
Yeah, and then, you obviously have this sort of supplemental request for an additional, $90 billion or so, in addition to what was outside of the appropriations process, obviously just meaning the deficits are going to be higher here. So the bond market, has been relatively sanguine about the government's finances. I think there's a lot of dynamics there. One is just the fact that the yields have been attractive, so that's attracted maybe some more economic buyers, some more foreign investors that have replaced some of those central bank reserve managers who used to buy treasuries quite a bit. But I think there's also sort of this expectation that yields will be higher, that the yield curve will be steeper, and you've obviously sort of seen that play out. So our view here is that deficits continue to be high. They continue to be the kind of the biggest loser in terms of the political situation in Washington. Both parties have a spending problem. Both parties don't really want to raise taxes. And so, there will likely be a reckoning. Is that a bond market reckoning? Or, and I think even more likely, is that a policy inflection point? One thing just to, we've nerded out about this before, but the Social Security Trust Fund is going to go bankrupt in 2031. That means it starts paying out less than it brings in. Why is that important? That is politically untenable for members of Congress to absorb. So there's going to have to be something. I think this might become an issue in the 2028 general election. So anyway, I think that the music, as long as the music is playing, members of Congress will keep dancing, the bond market will keep dancing, but it does feel like there will be some sort of reckoning. Again, whether that's a bond market reckoning, that seems sort of less likely, just given sort of the dynamics. It could be a policy inflection reckoning.
Libby, you're the best. Appreciate it. Thank you.
Guys.
You were great. Libby Kentrell of PIMCO, thank you very much. That's the situation right now with the Treasury. The problem that we all have with politicians is they're not really known for preemptive solutions. You need a crisis before you get a solution. 420, 460, 5% across the yield curve. It ain't it. It is not it.
It might be when people start to get less from Social Security than they pay out. That might be the reckoning that they need.
Futures this morning, down by a third. Up next, we'll talk about energy with Susan Baum of Rystad Energy.
world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Stocks down following the biggest one-day rally of the month so far in yesterday's session. Equities down by a third on the S&P. Yesterday, the rebound driven by chips. Chips entering day two of a rally following a 20% plus decline from the highs of June and a 10% slide through last week alone. Chips doing a bit better. We're taking some of it back this morning in the equity market. In the bond market, the picture looks like this. 2s, 10s, and 30s. Two-year yields basically back to where they were before CPI came out softer than expected, closing in on 430 at the front end of the curve and taking it all back almost on 2s following softer CPI and PPI. Going into the Fed's next meeting a week today, the setup yields close to the high of the year. In the bond market, yields are higher. Crude in the energy market higher as well by 3 to 4%. WTI this morning close to 87.40. Brent crude briefly earlier this morning topping 95 for the first time in 6 weeks.
And these stories are related. The softer than expected CPI and PPI was really due to oil prices coming down as people expected some sort of resolution or at least a truce to hold. Now, as that unwinds, people are saying that's backward looking. This could potentially increase the inputs to a lot of PPI and CPI. It's also being driven by other places, though, as well. But either way, it's a boiling the frog type of moment. Just one day after another, the story doesn't go away, and that's the reason why you're seeing just markets slowly adjusting.
Even if you want to ignore it,
you
can't. You know, blink and you missed it. 2-3 weeks ago, we were in the low 70s on Brent, in the 60s on WTI. We've added $20 to the price of crude just like that. I get it in Wall Street. You're dealing with some of the most impatient people on the planet. I get it. I don't hate it. I love you all. And they don't want to waste time. And they've wasted their time on this story for 2-3 months, and it wasn't material. So who should you listen to now when so many people got it wrong? I think Barclays. I think of Ajay Rajadaksha, Vinu Krishna, who got the rally right, ignored the initial stress in energy, and then came out a little bit later on following that massive run-up in chip stocks and said, now we're starting to get a bit more concerned. Because it's not that we didn't think it mattered in the Middle East, we just didn't think it mattered yet, because we had a massive cushion of inventories. But that cushion is getting thinner and thinner, and these problems keep persisting.
That was the sort of break point that people were talking about when you hit tank bottoms. Are we getting that much closer? Yes. Are we going to get there? That's ultimately the question. And it's not just tank bottoms when it comes to crude and WTI. It is tank bottoms when it comes to natural gas. It is crude bottoms when it comes to other distillates like heating oil. You're seeing those also go down, and that might be harder to replace.
And that's what we've heard from Jeff Curry. That's what we heard from Francisco Blanche yesterday of Bank of America. Don't even bother with Brent WTI. You need to look at actual product. And it's not just the conflict, and we spoke about this. Yeah, so China's been a little bit softer on crude imports, but they are hoarding products, diesel, gasoline. What is going on right now in Russia? They have an export ban on diesel because they have a crisis internally in their country. There are a lot of issues right now in the world when it comes to product, and that's why you're seeing gasoline in the United States continuously above $4 a gallon.
Love Francisco, love what he did. Do you see what he did? Came over to the US, pretended he'd got meetings, he went to the Spain game. Watch the final on Sunday.
Epic.
Can we all have his life? That's fantastic. He admitted that to you?
Yeah.
Oh, we talked about it. Bragging rights
Sure, he
for
squeezed in some
4
meetings
years.
as well.
Bragging rights for 4 years. Can you imagine?
Brian, what do you think about that?
Yeah, it's worth the money if you can brag for 4 years.
He said it was pre-scheduled, just for the record.
And just for the record, the Bank of America did sponsor the whole event, so there is that.
Well, no, he extended his trip.
That's right.
So he planned the meetings. Actually, he did this very well.
Before we get Francisco in trouble,
Yeah.
please clarify.
Yes, he was a scheduled trip before the World Cup.
Okay.
Spain made it, and then he extended, and then he joined our program. So it was a win-win.
It's well worth the extension just to join this program, of course. Count you down to the opening bout. 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Well, we start with Intel here, giving back some of yesterday's gains as the broader chip sector takes a breather. Those shares down 3% in the pre-market, but it rallied some 8% yesterday after the company confirmed another round of job cuts in its data center business. This all part of CEO Lip-Bu Tan's turnaround plan, which has involved job cuts and cost-cutting measures. And investors will get a better look tomorrow at whether that strategy is paying off when this name reports earnings after the bell. Let's get to the earnings that we've gotten this morning, and we start with GE Vernova. Shares are down 5.5%, even after it raised its full-year outlook as the company continues to benefit from the AI power build-out. But investors are focusing on margins that came in just a touch lighter than expected. Plus, the bar was incredibly high for this name, which is up about 60% year to date. And we end on AT&T. Shares are rising nearly 4% in the pre-market after it added 432,000 monthly wireless subscribers. That is more than 100,000 than the street was expecting. The results are helping to ease concerns that have been hanging over the stock, which is down 10% year to date. It's navigating an increasingly competitive environment, not just because of the likes of Verizon and T-Mobile, but also amid growing speculation that SpaceX might get into the wireless business as well. That is something to ask John Stankey, the CEO, when he joins you all at 8 a.m. Eastern today. John?
No doubt, Yahara, it will be part of the conversation in 30 minutes' time. Bramo, it's a big piece of the conversation. Do you see Starlink as a competitor in the future, a partner? Maybe, I don't know. What does that relationship look like in years to come?
Yeah, and how does the competitive landscape change as you've got satellite increasingly getting into the otherwise wireless and fiber universe, a changing environment for a lot of different businesses?
John Stankey coming up from AT&T, 8 a.m. Eastern Time. On our radar this morning, the Trump administration reportedly preparing to launch new tariffs on products from dozens of countries. Sources telling Bloomberg the levies would hit 60 nations, with rates starting at 10% starting this Friday. Elsewhere, the Trump administration continuing to downplay talks with Iran.
We remain open to diplomacy. We remain open to working it out in a negotiated way. But right now, they don't seem to be serious about that. And so we're going to continue to protect shipping. At the same time, we are going to, when the opportunity presents itself, degrade their ability to target global shipping.
Iran insisting it should maintain control of the Strait of Hormuz and calling on its Houthi allies in Yemen to disrupt shipping traffic through the Red Sea. And finally, Bank of Japan officials open to raising interest rates at a faster pace than expected. Sources telling us here at Bloomberg that policymakers are growing increasingly wary as the yen faces levels near multi-decade lows.
Their current policy rate, I believe, is 1%. So they're talking about raising it incrementally from there, and it's expected every 6 months. Now people are saying, well, could they make a move sooner than that? The fact that the market isn't responding more gives you a sense of just how much credence people are putting in this idea that right now the Prime Minister of Japan, Takaichi, has not really talked about the idea of a tightening policy. She's talked about a loose policy, has been much more kind of liberal with respect to spending. So to have some sort of policy shift on the banking side of things, the monetary policy side of things, highlights a quagmire that a lot of central banks are going to find themselves where they're moving in an opposite direction from an administration.
The Federal Reserve at the moment is going through its own communication exercise. It'll say things enabling them to maybe anchor inflation expectations, but there's only so long you can do that for. And I think Japan's a fantastic example of that. Threatening to act, threatening to act, threatening to act. Now it's just a show me market. Coming out from the finance ministry and dropping the odd headline here and there. And I would say even the story, our reporting from BOJ sources suggesting they're willing to go further. It's pretty obvious why that story's come out this morning and why those sources were incentivized to get that out there in the news flow. Look what it's done to dollar yen. Dollar yen this morning has had a move of 0.1%, with the central bank threatening to hike more than markets expect. This is a show me market. Stories here and there, not moving the dial.
Yeah, we're still close to the weakest levels going back 40 years for the Japanese yen versus the dollar. And this is even with intervention from the finance ministry. So that gives you a sense that the finance ministry can't necessarily keep burning cash. It has to come from somewhere else, and it's got to be more than just words.
The move in crude is not helping. Brent crude spiking to a 6-week high this morning as the US and Iran downplay the prospects of negotiations. Susan Bell of Rystad Energy writing, I expect oil prices to continue to escalate. If flows out of the Strait of Hormuz cannot be re-established, demand destruction and high prices can be quite damaging to the global economy. Susan joins us now for more. Susan, welcome. We're often said when we hear from people like you, Susan, energy experts, not to focus on crude, but to look at crude product. Can we talk about refining capacity? How much spare capacity is in this system to address a much needed issue right now where we're getting a real squeeze in product?
The challenge is that the spare capacity exists in the regions that can't get access to crude oil. And so there really is very little spare capacity. I mean, when you look at what's happening in the U.S. is running their refineries harder than ever to try to backfill the lost supply into the Atlantic Basin that would typically come from the likes of Russia, the Middle East, and Europe is also running very, very high. Where there would be spare capacity is, of course, in the Middle East, but they have an egress issue. They can't get products out of the Strait of Hormuz. And then there's also spare capacity in China, of course. But China has chosen a strategy of minimizing crude runs to only supply domestic demand, helping the markets out, certainly, by reducing the amount of crude oil that they're importing by close to 5 million barrels a day. But not helping the markets out from a product supply perspective.
Do you think at some point China's going to have to reverse that policy when it comes to their imports?
I mean, if they have been drawing down their crude oil stockpiles in the order of about 1 million barrels a day since this crisis began. I'm pretty sure that they're loath to do that because those stockpiles are what is giving them a sense of energy security. So for them to reduce their strategy here and decide to increase crude throughput in their domestic refineries would be, they would have to also at the same time open up export licenses for those products to supply their neighbors and supply into North America primarily, into the western coast of North America. And then they would have to certainly start buying more crude oil, which compounds the problem.
We already know that when it comes to the Strait of Hormuz, vessels are not really going through anymore, and it's been really a halt in movement. But when it comes to the Red Sea, given the threat that we have now from the Houthis, have you seen a little bit less vessels go through?
We have seen a slowdown in loadings, yes. I'm not sure that it's necessarily turning into a slowdown of transits out of the south end of the Red Sea, but certainly that's to come. The Houthi threat has, yesterday it was reported that the Houthi threat has encouraged several vessels to turn around and not even enter the Red Sea for loading of crude oil. And the Houthis are specifically targeting vessels that are stopping at Saudi Arabia's ports. And Saudi Arabia is the one region that is the one country that is able to get crude oil supply out of the south end of the Red Sea and back to Asia. That they've been very critical in ensuring the flow continues to Asia to the tune of about 4 million barrels a day.
What's your sort of break point when we hit tank bottoms from your perspective, both for crude and crude products?
Well, I think, first of all, the issue is much more critical with regards to refined products. We started this crisis with about 4.4 billion barrels of crude oil stockpiles between commercial and strategic reserves. But we only started this crisis with about 1.4 billion barrels of key products, gasoline, diesel, and jet fuel. Products have drawn in the order of 200 million barrels. Crude oil has drawn in the order of 200 million barrels, but products just had a lot less to start with. So the crisis is intensifying on product stocks. And you're seeing that certainly in crack spreads. At the start of this crisis, gasoline crack spreads were very lackluster. In the US, they were maybe $8 a barrel net of the renewable volume obligation cost. Europe, the crack spreads were a bit stronger, but we're now seeing gasoline crack spreads in the order of $40 to $50 a barrel, and distillate crack spreads have also surged with the surge in the conflict. With crude oil, there still is room to draw down SPRs and commercial stockpiles, but the tank bottoms are a lot greater in crude oil just because the infrastructure to move the volumes around the globe is much more significant than product infrastructure. So we don't have, it's not like we've got 4 billion barrels of crude oil sitting there for us to use. Upwards of 50% of that volume could be truly tank bottoms that are inaccessible.
Some politicians wish we did, that's for sure. Susan, thank you. Susan Bell there of Rystad Energy, thank you very much. There is a heightened sensitivity to the headlines on the tape this morning, and you can just see that in the last few minutes or so. Sirens sounding in, say, Bahrain, alerts in Saudi Arabia. As those headlines cross, crude just ticking a little bit higher again, Brent back through 95. As you get that move through 95 on Brent, equities pulling back. Not major moves, just a tenth here and there. You see that on futures this morning, with crude up by more than 4%. Futures just pushing a little bit lower on equities too.
Absolutely, and when you're talking about alarms going on, one of them was issued in Saudi Arabia in Dammam to warn of danger. Well, that's where a lot of their refining is. That's where the Aramco headquarters is. This is the concern right now in the region because the escalation of the actual kinetic attacks is continuing 11 straight days. At the same time, no vessels are moving through. So even if you're concerned about where the rhetoric is going, just look at the actions of what's actually going on the ground, and you can see the heightened volatility.
Equities down by 0.4 on the S&P with an update on stories worldwide this morning with your Bloomberg Brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. OpenAI is saying its advanced AI model accidentally hacked Hugging Face. The ChatGPT maker is saying the model broke into the AI model and database host during a cyber capability evaluation. The accidental hack prompting calls for more oversight and regulations on the technology. GE Vernova shares are falling in the pre-market, the energy giant raising its full-year forecast following strong quarterly revenue that beat expectations. Investors, though, uneasy over its miss on core profit estimates, alongside warnings of continued revenue declines in its wind division. New Jersey Governor Mikey Sherrill says about 6,600 people who identified themselves as non-citizens were registered to vote in 2023 and 2024. Sherrill saying it was due to a software error in the state's motor vehicle system. That is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. Up next on the program, inflation anxiety on the rise.
Inflation has been above target for quite some time.
It's all fun and games until the Fed has to pump the brakes.
He needs to do something, and we think 3 rate hikes is the way to start.
Up next, Simona Makuta of State Street, live from New York City. You're watching Bloomberg TV.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Oil in the driving seat. Brent crude topping 95 moments ago. Once again, this morning, 94.40. We started July with a 71 handle, with hopes that we could break into the 60s. We're ending July with a 94 handle, with fears that we could break back into triple digits. The strikes continue, 11 consecutive days. What's becoming more and more important, what is being hit, what might be hit, and what isn't being hit.
So Iran, apparently, according to Tasnim, is saying that Lark Island was targeted by a U.S. missile attack. We are getting more details today about what actually is being hit. You see the United States actually extending and expanding what they are striking. It hasn't just been what's going on in terms of drone facilities and a lot of installations Iran has to target vessels, but also goes to going after some things that are dual use, like civilian infrastructure, like bridges. And the hostilities continue once again, and Iran, as you see, is retaliating.
Setting the tone for financial markets cross-asset. Equities sliding. Bramo yields higher, up another basis point. 10's now 464, near the highs of the year.
Over to you, ECB. And ultimately, the issue with the ECB is that they're facing both a similar type of move in yields and an even bigger move in some of their distillates and their natural gas, which have risen to near the highest levels going back to 2022. So that connection between yields and some of the commodity sector really has to be tied starting this week and then next with the Federal Reserve.
22 is not a good year.
That's not a good year.
For the Europeans or for many others for that matter.
And that was later in the year in terms of the comp, but still we're talking about the same kind of Ukrainian war disruption levels that we saw back then.
Let's talk about the backdrop for inflation and for these central banks. Under surveillance this morning, inflation anxiety on the rise.
Inflation has been above target for quite some time.
The inflation situation is extremely complicated.
It's all fun and games until the Fed has to pump the brakes.
Kevin Walsh has said this. Interest rates may just be too low for the level of inflation that we have.
He needs to do something, and we think 3 rate hikes is the way to start.
So here's the latest this morning. Headlines from the Middle East sending crude prices higher once again. Brent briefly touching 95 a barrel, reminding Wall Street the fight against inflation is far from over. Simona Makuta of State Street writing, our house view is that the Fed remains on hold through year end, but Fed speak clearly points to a rate hike as the risk scenario. Simona joins us now for more. Simona, welcome to the program. What is going to keep this Fed on hold?
Well, I think it's a combination of things. You know, to be fair, the case for a rate hike and for some tightening from the Fed is very easy to make precisely on the basis of what was discussed on the program already. You're not where you need to be on inflation. We understand that, we acknowledge that, right? But you have to ask yourself, are rate hikes going to be effective in fighting the type of inflation and the sources of inflation that we are dealing with today? And I think our view is the answer is no. And if you do hike, are you resolving the problem that you're trying to resolve, or are you potentially accentuating issues that you want to not come to the surface. You know, we happen to see the labor market perhaps in a little more vulnerable state than the prevailing narrative makes it sound. I don't think it's all a bed of roses in the labor market, and I am concerned that if you have policy tightening, you might, that would be detrimental to the labor market. And then everything from there has a bit of a snowballing effect. You look at consumer delinquencies, those are very high across a number of dimensions, and they are very high in an economy that supposedly is at full employment. What happens when we are no longer at full employment? So it's, we want to do something. You have the urgency and the sense that you should be doing something, but what should we be doing? And perhaps the best thing to do is not do anything.
Can this Federal Reserve afford to do that if you have the market suggesting that they are moving and not suggesting it, but telling them that they are moving and pricing it in already?
Yeah, I think it's still a bit of a, circle there. There is, obviously Chair Warsh is telling the market, you look at the data, you make your own decision, don't wait for us to signal. But I think there is still a bit of a back and forth going on there. And again, the risk scenario truly is for a hike. We talked about oil prices today where we end July. A week and 2 weeks is a very long time in this world. And the difficulty for the Fed is that they are dealing with the oscillating shock. You could almost describe it, right? Things are deteriorating, things are improving. Like, at what point do you choose to act? And that's very, very difficult because you may act, and by the time your hike actually feeds through the system, the underlying situation may have resolved. And the other point to make is how many hikes, right? The market's pricing, about one, a little bit more than one. Do 25 basis points really alter the trajectory here for inflation in the bigger, understanding of that, or specifically as it is feeding through from energy? Again, it does not seem particularly effective, and as you think over the horizon, a year from now or 6 months from now, what are the underlying dynamics in the economy? It's very complicated. So I don't think the case for a hike is clear-cut. I think, Chair Warsh mentioned that the stance of policy is nuanced, and it's very true. This is a K-shaped economy to the max. It's not just in the consumer space, it's in the investment space. I mean, look at housing, look at residential investment versus AI. Again, would 25, 50 basis points worth of hikes stop the AI enthusiasm? Probably not.
Simona, it's good to catch up with you. I appreciate the reaction. Simona Makuta there of State Street Investment Management on the outlook for the Federal Reserve. Got Jim Zelter on my shoulder from Apollo just saying,
take a walk.
Take a walk. Touch grass, right? Calm down. 6 months from now, we won't be talking about this.
And I think a lot of people are saying the same thing. What's one rate hike going to do
Brings me a lot of comfort, that does. Thank you, Jim. Equity futures this morning, down by about 1/3 of 1% on the S&P. Up next, we'll catch up with the AT&T CEO, John Stankey, following fantastic results from them. James Picariello of BNP looking ahead to earnings from Tesla, plus Wendy Stewart of Bank of America, Mona Mahajan of Edward Jones.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years, and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
What we have seen is a much higher baseline level of volatility for technology stocks.
Some of these moves have been absolutely parabolic.
It's becoming a little bit more consensus, at least, to lean a little bit more into the hyperscalers.
You got the hyperscalers. They're spending like drunken sailors.
Can the build of AI get done as fast as the market expects?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity slide following yesterday's bounce, snapping a three-day losing streak. We're losing again on the Nasdaq. We're down by 0.8%, taking back some of the gain in the last 24 hours. In the bond market, yields elevated, up a single basis point at the long end of the curve. 10s back to 464, 2s closing in on 430. Off the back of this, crude for sentiment this morning in the driver's seat, at least for now. Brent crossing 95, not once but twice, earlier on this morning, up by close to 4%. WTI close to 88.
And it's breaking through some thresholds when you look at the actual crude-related products. And that's what a lot of people keep mentioning, the fact that, yes, crude prices have risen significantly, but not as much as things like natural gas over in Europe or potentially even heating oil here in the United States. And you start looking at levels that we haven't seen since 2022, you start to say this is going to pressure people and people cannot ignore. And that is the reason why you are seeing a bit more of a reaction, even if the Fed might look through it.
I'm glad you mentioned Europe because they have serious problems right now. The Equinor CFO was talking about the fact that it's incredibly difficult right now for Europe to make sure they're getting those storage levels they normally have in the summer for the winter months. It's really been a double whammy when it comes to Russia's invasion of Ukraine. They had to outsource their LNG supply to Qatar, and now Qatar cannot get vessels out when it comes to LNG because what's going on in the Strait of Hormuz. And then you just continuously see the hostility and the volatility in the Gulf continue. Now we have Iran reporting that Iran's Lark Island was targeted by U.S. missile attacks. Yesterday, another night, 11th straight days of hits that the U.S. is targeting the Iranian regime.
These moves have got a firm grip, a hold over market sentiment so far this morning. I say so far, I say for now, because later on we'll get some earnings. Alphabet and Tesla in the mix after the closing bell. That's going to dominate the focus of this market, particularly stateside. Later on, following fantastic numbers from AT&T. And we've seen this from company after company across sectors in this country, corporate America executing against a really good backdrop.
Yeah, even though there is incredible competitive pressure, the idea that AT&T could come out and add more than 100,000 subscribers than people previously had expected gives you a sense of where the outperformance could come into play. Also, the bar was a little bit lower because the shares had not performed as well year to date, down about 10%. So how much is that really leading to the boom that you're seeing this morning?
Coming up, we'll catch up with the man himself, the AT&T CEO, John Stankey, on the company's strong second quarter. Bank of America, President of Commercial Banking, Wendy Stewart, on the state of the nation's mid-sized companies, and Mona Mahajan of Edward Jones on how tech could reclaim market leadership. We begin this hour with stocks inching lower as earnings season enters full swing. AT&T shares gaining after crushing estimates on mobile subscriber gains. Joining us now to discuss, the man himself, the boss, the AT&T CEO, John Stankey. John, welcome to the program, sir. I want to talk about execution. There's so many issues to talk about with your company, but just execution. These numbers this morning, John, the street's looking for like 325,000, and you deliver 432,000 monthly wireless phone subscribers in 2Q. What went right, John? What was the strategy behind a gain that big?
Well, I think going into the break, Jonathan, you referred to the results as fantastic, and I would agree with you, and I think the team did an excellent job executing, as you said, and it's not just in our wireless business. It was nearly 370,000 fiber net adds. That's a record for us in this quarter. Look, what went right is what we told people was going to happen this year as we gave guidance for the next 3 years. We said because of the investments we've been making in this business over the last 5 years at a sustained and targeted level, and the M&A work that we had done, acquiring more spectrum and picking up some additional footprint from Lumen, that you should see a step up in growth as a result of those things. The team had the asset base it needed to execute and drive growth at a faster level, and you saw the manifestation of that starting to happen here in this quarter. And it's showing up in accelerated service revenue growth. It's showing up in accelerated EBITDA growth. I would even go into our business segment and point out that we had growth in our strategic services for business for the first time in a very, very long time. And as a result of that, we expect that that's going to sustain itself through 28. So we're executing well. We're hitting on all the cylinders in the engine. And when that happens, the business can deliver the kind of results you're seeing. And I'm pretty confident we can keep that moving going forward.
John, there's a number that jumped off the page for me this morning as well. It's 42.5. 42.5% of households that purchase the broadband service from you also buy mobile phone service too. How important has that convergent model been just behind the success you're having, and how important will it be for the remainder of the year?
It's extremely important. It's actually, that number's 45% if you were to normalize it for the Lumen footprint that we just recently brought in that's diluting the number a little bit. And as you know, you see in our report, that's been ticking up steadily. And it's important because, one, those customers are more lucrative customers when they buy multiple products and services from us. Two, churn goes down, and that's one reason why you're starting to see our churn numbers improve this quarter, because we're starting to get that benefit of that base that is buying both together from us. And three, brand affinity. The customer's happiness with AT&T and their impression of the brand is much higher as a result of that because the products are better together. So it's really important we continue down that path, and it's frankly one of the most important things as you think about our competitive positioning moving forward, because we can provide world-class networks in both wireless and fixed that tackle 98% of what a customer needs to do on the internet. Occasionally they walk off one of our networks, and as you look at our partnerships that we're working with the satellite industry, by this time next year, we'll be able to solve that problem. And so we're the natural place for people to come and meet their needs on the internet and do it easily on one bill with one set of services and one support infrastructure. We think we're in a great position as a result of that.
And John, this is a reason why there has been really a price war between different providers, simply because everybody wants that package, right? They want to get everybody. How has the competitive landscape changed, though, over the past couple of years with the introduction of satellite services, of what we're seeing with Starlink, of what we're seeing elsewhere?
You know, I don't characterize it as a price war. I think there's been a stratification of pricing for customers depending on what kind of services they want to buy. There's the segment of the market that needs high-performing, symmetrical gigabit services, very robust wireless plans. That segment of the market is willing to pay for that, and they pay a premium as a result of that exceptional value that they get back. We've played very, very well in that space, given our asset base, but there's also a segment of the market that's more value-oriented. And I would say choices have come into the market because of good regulatory posture that have allowed investment that weren't there before. And those choices are putting more value-oriented products and services at more attractive price points, but the product and service maybe isn't as robust. And at AT&T, we've played really well up market, but not as well down in the value space. And we've been working hard to get our product portfolio so that it matches up across the entire continuum of the market. You saw that in the results this quarter because our account additions, new accounts to AT&T, hit like a 3-year high. And that's because we're doing a lot better job down market. And there's nothing wrong with having a more affordable product that's tuned to certain parts of the market. I don't consider that a price war. I consider that meeting market needs. As long as you're doing the things that you can do up market, which we've done very well. And I think when you see margins the way they are at AT&T, this is like a record for us. That's a good sign that we're getting that balance correct.
Over the next 5 to 10 years, John, how do you see the breakdown of the mix of broadband and fiber on one hand, the wireless or the more budget-sensitive areas, and then satellite from the likes that you're seeing from Starlink?
Look, my point of view is they have a fantastic product. There's great innovation that's moving in that space, and it fits a part of the market that hasn't been well served, especially in less densely populated areas. And the interesting part about that is our investment has largely been in urban and densely populated suburban. We haven't pushed real hard in the rural and less densely populated areas. That tends to be more the stronghold of cable companies. I think they'll do pretty well in that space, bringing an alternative and competition in there. I think it's going to be very hard to come into the more densely urban populated areas to compete with that bundle that I just talked about earlier of fiber that is the best product in the market, best performing. It's the lowest marginal cost, our great wireless density that far outstrips what you can do from direct-to-device and satellite. Years of investment in the hard-to-reach places like stadiums. Everybody who went to a World Cup game knows how important being able to connect in a stadium is to experience what goes on socially and actually in the arena so that you can see a few replays that they're not showing there. We've been doing that for a long, long time, and it's going to be very, very hard to catch up on that infrastructure, and I think we're going to do really, really well competing in metro and suburban areas, which is where our investments have been.
And John, you've talked a lot about how fiber puts you in a really good position in the AI era and how an increasing number of businesses really do need that kind of connectivity and the latency that's so important to improve. And I'm just wondering, aside from the demand side, from your actual corporate side, if you've been able to calculate any of the return on investment of your own uses of artificial intelligence. I know you've been really vocal about how it has improved in efficiency dramatically. Has there been any ROI? Have there been any structural changes that you're able to disclose?
Yeah, we've been really disciplined about this, and I'm satisfied that where we've been investing in places like in our software development organization, what we've been doing in our customer service channels, our applications into engineering, some of the things that we've been doing and building the right algorithms for pricing support, that we've gotten very strong returns. And as a result of that, I would almost argue people inside of our company maybe think we've been a little too judicious about how we've managed investment. We're trying to find that right balance of innovation and allowing things to run and the discipline of ensuring that what we're doing drives return. I would also say that I'm very well aware that a lot of this investment is a competitive necessity. When we improve operations like customer service and call centers, I don't know that that's necessarily sustainable. I think those are ultimately efficiencies that get competed away in the market. They go to the customer in the form of lower prices or better service. There are the things that we do that really give us strategic advantage, like maybe writing software for capabilities that we didn't have before that make us better at pricing or better at driving yields on the network or more efficient. Those are the ones that maybe we get to keep some of the benefit on. And if I were to say that we need to do something better moving forward, We need more of the ones that drive strategic advantage to balance out some of the ones that we know are just the table stakes that we need to compete in the market and drive the great margin performance that you're seeing right now in the quarterly results we just published.
John, I'd love to finish by talking about the stock as well. Just listening to you speak about the degree of investment you've put into the business to serve these areas, densely populated urban areas across this country. And when I think about other companies right now spending a fortune, raising loads of capital and going through this massive CapEx cycle, I'm thinking of tech and what's happening there. You're in a different position. You've done some work already. Then I see this headline, you're accelerating the pace of planned share repurchases. Can you walk us through just the characteristic of what's on offer now, your stock, and how well understood you think it is with investors at the moment?
Well, you know, look, I think the markets eventually get things right. It doesn't mean that they get it right every month or that there isn't momentary dislocations and readjustments. And in my point of view, obviously, I'm probably speaking my book, I think we're in a little bit of a dislocation right now, and there's certainly a desire to raise capital to move to new opportunities in the AI space, and you know, I think there's been some rotation out of our stock as a result of that. But here's what I know, we've built this business for the future. To your point, we're building symmetrical networks that have as much upstream bandwidth as they have downstream bandwidth, and we think that's going to be critical in the AI world, just like memory's critical, just like chips are critical, just like data center infrastructure is critical. And I do believe that the market will eventually understand that what we have built is indispensable for the kind of workloads we're going to see in this AI environment working forward, and that AT&T is uniquely positioned in the investments we've made over the last 5 years to serve more of those workloads more effectively than anybody else. And eventually the market will figure that out, and when the cash shows up, valuation will ultimately correct itself, and I have the confidence that that's the case. Our job as a management team is to continue to execute and stay focused on the plan that we've laid out, and I believe this quarter is a testament that this management team is in fact doing that.
Message received in the stock market this morning, the stock kind of the pre-market by 4%. John, we appreciate your time, sir. Thank you. John Stankey there, the AT&T CEO. Great report, decent numbers, accelerating the share repurchases as well. Music to the ears of investors this morning.
Yeah, and frankly, AT&T is putting their money where their mouth is with respect to increasing their share buybacks that they plan for the rest of this year. Also seeing, exactly as John was saying, something of a dislocation. Interesting to see the dissonance between that and the likes of GE Vernova that came out and outperformed with their earnings, but are being punished in the market. Just sort of an interesting sort of a contrast between expectations and what gets delivered.
That stock is up this morning in the pre-market. Equity futures down about 1/3 of 1% on the S&P, with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump minimizing the prospect of immediate talks with Iran as the two sides exchange strikes for an 11th straight day.
I will tell you, they want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest in even finishing.
Iran confirming mediators reached out with proposals to ease hostilities. OpenAI appointing 2 financial services executives to its board of directors. The CEOs of BNY and Nubank joining the company's for-profit and non-profit boards. The ChatGPT maker is said to be considering an initial public offering as soon as 2027. New York City Mayor Mamdani withdrawing his pledge to arrest Israeli Prime Minister Benjamin Netanyahu during the Prime Minister's visit to the city in September. Mamdani citing a lack of legal authority. The mayor calling on the federal government to join the International Criminal Court and execute the arrest warrants. And that is your Bloomberg brief. John.
Bonnie, thank you. Appreciate the update. Up next, the Morning Calls Plus, James Picariello of BNP Paribas looking ahead to earnings from Tesla.
is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your Opening Trade.
Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the Opening Trade.
It's Bloomberg Money.
This is The Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
I do think we can get pretty broad-based earnings surprises again. I wouldn't be surprised if we get similar magnitude of earnings surprises in the broad-based sense, comparable to what we had in Q1, and then it really depends what the market is doing. If we don't see that coming, then I'm afraid to say, it's like, well, what's going to propel us even higher here? I think then into September, October, you want to take a bit of risk off the table.
Max Kettner of HSBC on the edge of bearish, almost there, just on the edge of bearish. Equity futures this morning negative by 0.4 on the S&P 500. That right there is your price action. Here are your morning calls. First up, Barclays raising its price target on Supermicro, citing improving margin forecasts. Your second call from Goldman, raising its price target on GM, seeing healthy dealer inventory and a new pickup truck cycle ahead. And your third and final call from Wells Fargo, raising its price target on SanDisk, citing a tactically positive setup leading into fourth quarter earnings. Elsewhere, big tech earnings in full swing. Alphabet, Tesla, IBM results all due after the closing bell, with companies facing a very high bar on Wall Street. Ed Ludlow has more. Good morning, Ed.
Good morning, John. Spending is the overriding theme, right? But each of those three companies' relationship to the spending story is very different. In the short term, Alphabet going beyond capex expectations of $190 billion at the high end would move the needle. But it's really about returns. 20% top line growth, where 65% cloud growth is the minimum. You're completely right that particularly on the buy side, expectations are really high. They want to see something in return for the patience of letting Alphabet and other hyperscalers spend to that level. Tesla is a very different story. The street is calling out for Tesla to put its money where its mouth is. $25 billion of capital expenditures this year is unprecedented for Tesla, but they want to see on a quarterly basis them spending at or above that level to get going on those future businesses, robotaxi, humanoid robots. The stock right now is priced in those businesses. The street wants them to act on it and make them real. And then IBM, the question is AI spending leaving everything else that's not AI to one side? You know, they had to pre-limb release their earnings where there was a lot of evidence that that was the case.
You've got a big day coming up. I'm looking forward to the show. Bloomberg Tech.
Thank you.
A little bit later, a few hours away with Bloomberg's Ed Ludlow. Looking ahead to those results that Ed was talking about from Tesla, James Piccirillo of BNP Paribas with an underperform rating, 280 price target on the stock. He writes the following: we fear the company will face daunting key performance indicators at its robotaxi and Optimus business over the next 2 years, bringing downside risk to core operations before any SpaceX merger could realistically materialize. James joins us now for more. James, good morning.
Good morning.
I mean, the last line is the most important line for many people, is how soon before it's realistic that these two companies get together?
Yeah, that's what everyone wants to talk about. I think a merger is going to take time, right? I mean, there's been some rhetoric that a merger can get fast-tracked during, within the current Trump administration. And
what do you think needs to happen?
Well, you certainly need China and Europe regulatory approval. You have defense contracts involved when we think about SpaceX. It's going to be a slog, I think, right? So there's going to be time for Tesla on its own to have to deliver on certain KPIs, right, around robotaxis and Optimus. And yeah, I think the bar has been set quite high in the valuation, and there's downside risk.
Well, let's talk about the robotaxi rollout. Where are we?
So they were in 4 cities as of the first quarter. They had targeted to expand to another 5 cities by the first half. They missed that target, but just this week they announced that they're in Tampa and Orlando. So they're expanding their robotaxi fleet in terms of the city coverage. But if you look at the availability of that robotaxi fleet, there's no great explanation on this. It's come down quite significantly. So the fleet size is in place, but the availability of that fleet has come down over the last 3 months. And it speaks to the difficulty in managing a robotaxi operation.
Tesla used to be kind of a public wrapper for Elon Musk. It was essentially you're buying Elon Musk with the wrapper of Tesla. It wasn't a car company. It wasn't exactly something else that you could put your finger on. What is it now when there's another wrapper for Elon Musk that's out there?
Yeah, I mean, certainly with SpaceX, Elon is going to have to share his time between SpaceX and Tesla, right? It's not just Tesla. So that complicates things a bit. I mean, for Tesla, it's about robotaxis and Optimus, and there's a high bar. People, there are bullish expectations for Optimus to achieve 1,000 units per week once they hit commercialized production by October. I mean, we're getting close.
What's the obstacle? Is it the supply of actual equipment, of actual cars that are outfitted with the right technology, or is it a permitting issue and a question of the regulatory oversight that would enable a broader adoption?
Well, it's the permitting for sure, but to get to this full future picture of what's envisioned for Tesla, there's a lot of CapEx investment, right? Tesla needs to make this conversion as a true AI company, right? That's been the thesis for many years now. We're talking about at $25 billion in CapEx guided this year, right? That leads to close to $10 billion in cash burn for this year. Over the next 3 years, I have almost $20 billion of cash burn, and that's with strength in the auto and energy storage businesses to help mitigate that cash burn. That's the real dynamic that the expansion of these AI-led businesses requires substantial CapEx investment, and that interplay, the timing needs to be pretty precise.
Which is why you're at 280 and the stock's at 375 this morning. It's funny, years ago, if we had a Tesla conversation, we'd be still talking about one thing, and that's the car. Auto sales, deliveries, those kind of things. You can have a 5-minute conversation, 10-minute conversation on Tesla now and not even talk about deliveries.
And arguably you shouldn't have back 5 years ago either, because it wasn't about that either. The cheaper it gets, the cheaper it'll be for SpaceX to eventually take it over. So there is that potentially could be a saving grace.
James, good to see you, buddy. Thank you. James Piccirillo there of BNP Paribas. Up next, we'll catch up with Wendy Stewart of Bank of America on how mid-sized companies are navigating headwinds in this economy.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The opening bell's about 60 minutes away. Yesterday was a better tape, a better story. Chip stocks picked up on Monday, picked up big time on Tuesday, 5% rally. This morning we take some of it back on the NASDAQ. The NASDAQ is lower by about 1 full percentage point. On the S&P, we're lower by 0.4. The Russell also down by 0.4%. Small caps, of course, have had a wonderful year, fantastic year to date up until now. In the bond market, 2s, 10s and 30s, just that repricing of rates coming through this market again this morning by a basis point, just grinding higher. Before you know it, you're at 430, 427. This time a week ago felt so different. You just had softer CPI. A week ago, you just had softer PPI, and you were talking about removing the urgency to hike interest rates. Beth Hammack into the weekend? I don't think so. I think we might have to hike interest rates, was essentially the message coming from the Cleveland Fed president. Then you get this move in crude, adding to it again, and you just wonder what is the hawkish risk into the Fed's meeting a week away, with crude early this morning briefly breaking 95 this morning, back to about 93.90.
It used to be that the Fed was a central bank to the world. Right now, I would argue that there is an eye toward the rest of the world as well, because it's not just the Fed that has to grapple with where oil prices are. It's also the ECB, which comes out tomorrow. It's also the Bank of Japan with questions over whether it might be incentivized to hike rates more quickly. And that starts to raise a question, even if people say it's transitory here in the United States. If you get a CPI and PPI that reignite in terms of the heat under there as a result of what we're seeing in the move from oil, does that lead to a different calculus at the Fed than some people might have expected in the past, that it would just be looked through?
Isabel Schnabel, Executive Board Member, ECB. First week of July 6th, if I remember correctly, she comes out and she says, this is no longer a shock you can just look through. Since the start of this month, you've had a 30 basis point move on 2s in Germany. Compare that to 2s in America. I think we're higher by mid to high single digits. Let's call it 8 basis points higher on 2s so far month to date. It's in a much bigger move in Europe. And you often say single mandate central bank, one issue. And it's harder and harder to look through that one issue.
If you see that natural gas prices are near the highest in Europe going back near to 2022, you start to think if they're looking at that one input, it is not going in the right direction, and they have to preserve the validity of the euro at the same time that you're looking at other drivers of dollar dominance. This is the reason why you start to think maybe it could be a live meeting.
This time tomorrow, an ECB meeting coming right up, a news conference too. As we count you down to that and to the opening bell some 60 minutes away. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start with the latest trouble in the software sector. We are seeing shares of Pegasystems down nearly 18% in the pre-market after the company came out with results, and they came in lower than expected because it is saying that its customers are delaying orders as they pour more resources into the AI build-out. It echoes what we heard from IBM last week, warning us about its results, which are out after the bell today. Turning to Reddit, those shares also falling in the pre-market, down nearly 6% as the Wall Street Journal reports that the company is reconsidering its AI partnership with Google. Under the deal, Google pays Reddit some $60 million a year for access to its posts and conversations in order to train its AI models, but Reddit is reportedly questioning
that now, because the search tools are increasingly keeping users on Google instead of them going onto Reddit. And Supermicro, that name is surging in the pre-market, up nearly 13% now after it came out with preliminary results reporting a record backlog of about $60 billion and better than expected margins. This is also being taken as a sign that that customers are looking past some of its recent controversies because it is being investigated by authorities here in the U.S. and Taiwan over allegedly sending AI servers to China with restricted NVIDIA chips. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Speaking of chips, this just dropped from the Journal just moments ago. AMD and Anthropic, I'm going to read the story verbatim for you, have just signed a deal for tens of billions of dollars worth of artificial intelligence servers, strengthening AMD's competitive position against the industry leader NVIDIA and supplying Anthropic with much-needed computing power. The Journal story goes on to read, under the terms of the agreement, Anthropic will purchase up to 2 gigawatts of AMD's latest generation chips. AMD will also invest up to $5 billion in Anthropic, its first check into the firm, as certain deployment milestones are met. AMD this morning down about 3%.
Yeah, Anthropic is working already with a lot of Google's TPUs as well as Amazon's Trainium chips. You've seen them also, of course, deeply intertwined with NVIDIA. So they're trying to gain partnerships with all these different chip makers. And you can see the incentive for AMD to say, we want to be part of your ecosystem. Again, though, this is going to go to the questions of circular financing, of how much some of the chip producers are investing money in the likes of Anthropic or OpenAI to then have that money be spent on their particular chips, et cetera. This is what people were worried about earlier this year. And again, I'm sure it'll come to the fore now.
We'll keep asking those questions. AMD this morning at the pre-market down some 3%. 1 week away from a massive, massive week of earnings and a Federal Reserve decision sandwiched in between. The July interest rate decision just a week away, a week on Wednesday. Into that, crude climbing to 6-week highs as inflationary pressures continue to build across the economy. Mike McKee has the latest. Good morning, Mike.
Good morning, John. Well, you're talking about the Fed a week away, and it reminds me of a line that Donald Trump uses often. Many people are saying, you're starting to hear people say, maybe a rate increase is going to be on the table. They might not do it because they're only a few days away this time, but we've already almost priced in a September move, and we have priced in an October move. More on that in just a second, because it looks like inflation is coming back. Now, we have seen crude oil rise. That's pushing up gasoline prices. As of yesterday, $4.06 a gallon, well over that $4 mark. Gas Buddy's forecast as we go in the next week to $4.15. The June average, though, was $4.07. July so far, only $3.89. So when we get to the CPI, you may not see an impact in July because they look at the average changes in a sort of rough sense between month over month. And you go back to May, the high was $4.58. So we may not see it in the CPI yet, but it is coming if this all continues. And one of the worries out there that you hear people in the oil markets talking about is inventories. 10:30 this morning, we get the latest inventory numbers. Now, these are last week numbers. This is the days of supply out there right now at about 23. When you get to 20, that's called the flashing yellow light that we're starting to get short of oil. If it dips below 20 days supply, we're going to have some shortages somewhere, and then that'll send prices much higher. So that's something to keep an eye on when we get those inventory reports. And then the Fed out there has some other things to worry about, the Houthis and the Red Sea. Does that send oil prices higher rapidly? By the end of the week, more tariffs coming. Well, they're already coming because the president put some on Canada. And then AI inflation is the new worry that we saw in the minutes. They're getting concerned about that in the short run. You see the Anthropic news with AMD today could push prices higher. So a lot for the Fed to think about. Now, the big question is, when would you raise rates if you think you need to raise rates? October is 4 days before the midterm elections. They're not going to want to do it then because then they'd be accused of influencing the elections. September looks good at this point, but if you really want to get out and ahead of the game, why not do it next week? 2-year note has already priced in a Fed move. So something to keep in mind as we get closer and closer to that Fed meeting.
Mike McKee, appreciate the update. Mike, buddy, thank you. Looking ahead to that meeting next week, let's talk about the backdrop in this economy right now. Bank of America, with a front row seat to mid-sized businesses in the United States, Wendy Stewart, the president of Global Commercial Banking, has an optimistic outlook, writing the following. Our first half results demonstrate that middle market companies continue to invest for growth, even in a complex operating environment. Wendy joins us now for more. Wendy, welcome to the program. The business at Bank of America, as you know well, serves 1 out of every 5 middle market companies in this country, in this economy. So Wendy, you've got a fantastic read into the broader economy at the moment. What is confidence like in the C-suite at the moment? We've been talking about risk all morning across several dimensions. What's confidence like at the moment?
Well, good morning, and thank you for having me. It's nice to see you. So you're right. We do work with a lot of middle market companies. We cover U.S. and Canadian-based companies and their international subsidiaries around the world. So we do have a pretty good view as to what's happening. And I would say confidence is cautious, but also investing in growth. Our clients are very resilient, and they are looking to grow this year, and we've seen that in a variety of ways. They are investing in their companies. They're digitizing, and they're leveraging strategic advice to navigate the geopolitical and the economic environment that has been quite uncertain for them this year.
Do you think it's defensive, Wendy, or is it opportunistic? When you think about things like mergers and acquisitions, the potential to expand, is the opportunity right now because they see great gains in the future? Are they on the back foot? How do you read things?
So it's both defensive and it's offensive. And so, you know, we just announced earnings last week, and we had a strong second quarter, and part of the driver was investment banking and M&A. And in our space, covering the middle market companies, we were up 50% year over year, and M&A was a big driver for that. And, you know, we work with a lot of privately held companies, and they are looking for growth, so you might call that more offensive. They're also managing risk, so you might think of that as defensive. And then they're also managing succession planning. And in fact, we worked with a company recently who did not have a succession plan, and so they decided to sell the company to an investment management firm because they wanted to make sure that the company was prepared for long-term growth. They also wanted to make sure that their employees had a future with the company, and then they were also looking at preserving the family's wealth, and we were able to work with them and accomplish all three. It's been a big area for us. We just announced that we are hiring 10 new regional investment bankers who are joining us later this year so that we can continue to help our clients with all of their strategic needs.
Do you think that we're at the beginning or the middle or near to the end of this M&A cycle in the middle markets?
I would say that we are somewhere in the middle. It feels like it's been strong for the last 18 months, and we still have a strong pipeline ahead. So I don't see that we're anywhere near the end. And, you know, we do feel like we're well positioned to continue to help our clients. And, you know, they are looking at growth in a variety of ways, not only in the United States. They are also growing outside the U.S. They want that opportunity to grow into other regions. They've got to manage supply chain. They've got to manage other risks. And doing business outside the United States is actually providing them an opportunity to do that.
How open does the market need to be for some of these players for them to continue with their expansion plans? In other words, is this pipeline potentially at risk if rates rise to a certain degree, or say if there is some sort of drawdown following the earnings season in big tech over the next week?
So, I mean, our clients are not as interest rate sensitive as you might think. And in fact, when we talk with them about that, you know, they'll say a 25 basis point move here or 25 basis point move there really doesn't impact their long-term objectives and how they execute on those. Because again, a lot of these are privately held companies, so they don't necessarily think in quarters the way that publicly traded companies do. And so, you know, we feel like they're well positioned, and that the interest rate environment, you know, even if rates move a little bit, isn't going to impact the strategic decisions they're making for the long term.
It's interesting you say that they continue to make these decisions for international growth and new markets at a time when this White House is involved in a conflict in the Middle East and there's continued threat of tariffs. How have these companies been able to weather all that?
Well, they are very well diversified, and they're continuing to look at the geopolitical environment and how these macroeconomic trends are impacting them. And, you know, again, they're making decisions for the long term. So they might make a decision because they're looking out not just, you know, a year or 2 years from now, but they're looking 10 years from now and trying to identify where those opportunities are for the long-term growth. And so they might make bets and grow in areas that are a little bit unexpected. But again, they have the ability to do that over the long term because they are thinking 5, 10, 15 years out.
Wendy, we've got to ask you, you're in Atlanta. How many World Cup games did you watch in the last 6 weeks?
Oh gosh, the World Cup dominated our company and my life over the last month. It was a fantastic experience. I went to many matches. I had the opportunity to host clients around the country, and it was a terrific experience, I think, for us as a company. We had 3 objectives we wanted to accomplish. The economic impact of the World Cup is very real. We're expecting a $20 billion impact, and we were really excited to be a part of that. It's great to be a part of the community impact and the legacy that a lot of the World Cup will leave. We've been partnering with cities around the United States to leave fields, soccer fields, so kids have access to soccer long after the World Cup. And then our clients had a terrific experience, and we were delighted to host clients at all 104 matches.
Amazing. Love that. Wendy, thank you. Appreciate it. Thank you very much. Wendy Stewart there of Bank of America. Was kind of jealous of the team over at Bank of America over the last 6 weeks.
I was just thinking, is she hiring? Because it sounds like a really nice.
Can we come next time?
Yeah, exactly.
Except some took advantage of it. It sounds like Wendy did it right. Brian Moynihan went to one
Brian
match,
went to
or
one
2,
game.
because went to the final.
Well, he went to the final too, yeah. Wendy was clearly very busy.
Yeah, good
over
for
the last
Wendy.
6 weeks. On a more serious point, the serious point that I took from that, there were many, but this one, how rate insensitive some of her clients are right now. They're 25 basis points here and there. It's not going to move the dial or change their plans.
And they have longer-term plans that they're trying to come to that are coming to fruition at this point. And the other calculus, which is AI adoption, they have to ultimately defend their market share and expand at a time where these are costs just to stay competitive. Just think about what John Stankey was saying. A lot of the AI efficiencies are just the cost of doing business. They're not going to come to their bottom line. They're going to have to translate into, frankly, lower prices for customers.
If her clients and the businesses she deals with are rate insensitive, who are the clients and companies that are calling the Cleveland Fed president?
I thought the same thing.
Who's calling Beth Hammack and saying, I need help, you have to do something with inflation? Because it's not these middle-sized companies. I'm curious, what are the characteristics?
There are some companies right now under serious price pressure, clearly. And you see it in the surveys, in the ISMs. The prices paid component of things, access to goods, the price of goods, just comes up continuously in the surveys.
Yeah, and you see that with respect to, for example, the airline costs and what you're seeing with some of the fuel bills, but the other input costs. And you're seeing this clearly communicated from a number of different places. Question is just, you know, what's 25 basis points going to do? And that's what we keep asking.
Stocks this morning down by about 1/3 of 1% on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. AT&T shares and rising in the pre-market. The company reporting second quarter earnings that beat analyst estimates.
We're executing well. We're hitting on all the cylinders in the engine. And when that happens, the business can deliver the kind of results you're seeing. And I'm pretty confident we can keep that moving going forward.
John Stankey on surveillance earlier. AT&T announcing plans to accelerate buybacks this year. OpenAI saying its advanced AI model accidentally hacked Hugging Face. The ChatGPT maker saying the model broke into the AI model and database host during a cyber capability evaluation. The accidental hack prompting calls for more oversight and regulations on the technology. AMD and Anthropic signing a major chip and investment deal. The Wall Street Journal just reporting AMD will invest up to $5 billion in Anthropic, and Anthropic will purchase up to 2 gigawatts of AMD's latest generation chips. And that is your Bloomberg Brief. John.
Vonnie, thank you. This is part of the program where Bramo gets bored and she's stepping aside.
No, that is not the case. I have an assignment. Absolutely not.
Just to clear that up.
Do not sully my engagement with...
Is 8:46 the new 8:56, Elisa? Okay. One day away from the program, it's like, oh, I don't know.
Yeah, I slept in yesterday, and here we are.
I used to do that when I used to wank in the market open show.
Yeah,
you know
I saw that. Yeah, no, I remember.
It's like 8:40 sometimes.
Exactly.
Sometimes like 8:20.
Glass houses, honey.
I know. Lisa's going to step away. She'll be back tomorrow. Up next on the program, we'll set you up for the day ahead. Plus, Manu Marjan of Edward Jones on how tech could storm back to lead this market.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's very much become this volatile trade around stagnation in areas like the Mag 7 and the hyperscalers. The challenge is the Mag 7 years ago had set such a high bar of trumping themselves. That bar, again, has become so much more challenging for rewards here.
That was Mira Pandit at JP Morgan Asset Management weighing in on the high bar for earnings season. Into that high bar, equities declining by 0.4 on the S&P, on the Nasdaq 100 down by 1 full percentage point. Heading into this, ahead of the opening bell, your trading diary shaping up as follows. After the close, you'll hear from Alphabet, Tesla and IBM reporting earnings. Into tomorrow, results from Intel and American Airlines, plus an ECB rate decision and another round of claims. And into Friday, just before the weekend, we get some extra PMI data. Into all of that, stocks edging lower ahead of a massive slate of tech earnings. Mona Mahajan of Edward Jones writing, if earnings season delivers on lofty forecasts and the outlooks remain robust, we may see tech resume its leadership, especially in parts of the market that have lagged the most. Mona joins us now for more. Mona, good morning.
Good morning.
When you say that, and I don't want to put words into your mouth so you can tell me what you meant by it, do you mean Mag 7? Do you mean the hyperscalers? Maybe some software names too?
Yeah, look, I think we generally are in a good setup heading into earnings in that parts of the market, so semiconductors had almost gone through a bear market. They were down 20% or so. Now we will hear from them, and we've already heard from the Asian semiconductor names, which blew earnings out of the water. Mag 7 this year has lagged the entire year, down, or actually up 1 to 2%, but S&P up 9 to 10%. So if they can show, if these hyperscalers can show, not only that they're spending more, but of course what we're watching for is there any return on this spending? What does cloud revenue look like? Maybe they'll make commentary on where they're seeing potential return on this investment. We think if they can deliver on those two variables, we can see a little bit of resumption, and markets are looking for a little bit of leadership here, so maybe it comes from that space.
Go through 6 of those 7 names that were up on the screen just moments ago. Let's bring that back and just go through them individually. I know you can't do single names, but can you describe out of these 6 names the kind of businesses that you're looking to get exposure to? And Alphabet is very different to an Apple, a Meta is very different to a Microsoft.
Sure.
Where do you want to be, where don't you want to be?
Sure. Broadly, I'd say the hyperscalers are looking more and more interesting if we can start to see the return on that investment. So in Alphabet, as we hear from them tonight, they will set the tone for earnings season, we think. So everything else has been great. The banks have reported well. We really haven't entered earnings season until we hear from Alphabet tonight. And we're not only watching the cloud business, we want to hear what they're thinking about from an investment perspective here. And everyone, all eyeballs will be on what are they thinking in terms of when and where this return will come from. So we know what's coming. we hope that they know what's coming and can deliver on that.
We spoke to Max Kantner of HSBC a little bit earlier. I'm not sure if you're familiar with Max's work or not, but Max has been overweight, Max bullish for a number of years now, for the majority of those years.
Expansion side across sectors, really, but the earnings story has underpinned this market. Fed has been on the sidelines, and we think July 29th, they will continue to remain on sidelines. We're hoping we get a little bit more color on what data points they're watching to make their decision. But
good luck, Mona.
Yeah.
Yeah, I don't think Kevin Walsh is interested in providing it.
Yeah.
Mona, it's good to see you.
Good to see you.
Thank you. Mona Marjan there of Edward Jones. Looking ahead to a week full of earnings. It starts after the closing bell with Alphabet. That gets the Mag 7 rolling. Picks up next week. Fed decision in the mix. And this move in crude isn't going to help. Just on the margin, we'll just encourage that more hawkish conversation a week today. Crude this morning on Brent around 94. WTI around 87 this morning.
It's going to make that family fight a lot harder next week when the Federal Reserve meets. But for this week, as Mona was saying, this is the catalyst this evening when Alphabet kicks off. And the bar is so high, especially given how much we've already seen this company spend when it comes to the AI build-out.
Crude higher, yields up as well. Futures just a little bit lower on the S&P. We're down by a few tenths of 1%. Coming up tomorrow, we'll break down those results. We'll catch up with Ross Kostrick of BlackRock, Gil Luria of D.A. Davidson, Jim Caron of Morgan Stanley, Austin Quant of Wells Fargo, and I'm told, I promised, Bradmo's going to be back as well. From New York, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open, and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
And
And so it begins. Big tech earnings kick off today as we decline in the future session. 30 minutes to go until the start of your cash equity trade. I'm Danny Berger.
And I'm Isabel Lee. Bloomberg Open Interest starts right now.
Coming up, Alphabet, Tesla, and IBM kick off big tech earnings with AI spending under scrutiny.
Meanwhile, Iran tensions simmer as President Trump presses ahead with tariffs on generic drugs.
And Wells Fargo CEO Charlie Scharf will be joining the program for an exclusive conversation in just a few moments.
We're looking at some stocks, Danny, but Wednesday is going to be a busy day. I think big tech is going to kick off in earnest, but our stocks to watch surprisingly isn't big tech because we're looking at, I guess, mobile carriers. So when you chat with your friends, this is the companies behind them responsible. We have AT&T beating subscriber growth estimates by more than 100,000 in the second quarter. The company has rolled out aggressive perks and incentives over in the past year, and that's amid a price war with their peers. Their shares climbing as a result, AT&T up by 4%, Verizon and T-Mobile up just ever so slightly.
I'm sorry, we can't get too far away from big tech because that's who I'm watching before the market open, as you might have suspected. Listen, we're going to hear from 3 tech players and the heavyweights, and the main one is going to be Alphabet. And to learn about what their CapEx spending plans look like, whether they've had any tangible return on investment from those AI efforts, we'll also hear from Tesla and IBM. Not too much action. Tesla down about 1%, so that's the biggest mover among them pre-market as well.
And for more on tech earnings, we have Bloomberg's tech Ed Ludlow joining us from San Francisco. Ed, it's such a busy day today. I mean, big tech is going to be reporting earnings. Is there anything you're looking at? We have investors becoming even more demanding. Even beats are being punished. I mean, what do you think investors are going to be on the lookout for?
Well, I'd also point out that buy-side expectations have just been very high for a really long time. But the common theme across all of the companies, which are very different, is spending. They all have a different relationship to the spending story. You know, like in Alphabet's case, the CapEx guide for this year is $190 billion at the top end. And if they were to move the needle on that, you know, the great expectation is that in the short term, that would be significant for markets. But, you know, in Alphabet's case, more so, it's what are the returns now? You know, overall top line growth of 20%. The catalyst being the 65% growth in Google Cloud as the main vehicle for how they get AI specifically across to a broadest base of customers while it still sort of adds to the search business. You know, Tesla, comparing across, so different. You know, the world is desperate for Tesla to start spending some money, more money than they've ever spent before. And so maybe that's the next part of the story.
Ed, elsewhere, I mean, the circular financing continues, and this time AMD investing $5 billion in Anthropic, according to the Journal, to help give Anthropic a wider access to its chips. It feels like a lot's going on here. I mean, we also learned yesterday from TSMC that it was going to get more expensive for the TSMCs and the NVIDIAs of the world. Just how much of a crunch is there for these types of companies to get their hands on chips from AMD and NVIDIA, and thus we continue to see these deals?
Yeah, I mean, it's not unprecedented. When AMD did its sort of big compute deal with OpenAI, there was also a financial transaction involved, which basically, you know, gave AMD a seat at the table. You know, at the time we asked Lisa Su, why is it that you and NVIDIA need to take equity stakes? And this was also, remember, that it's also through the mechanism of warrants, but in the companies that you're providing compute to, and you know, the answer they always give is supporting the ecosystem. You know, basically greasing the wheels, letting all of this stuff happen. But you know, the other thing to remember is that all of those frontier labs and the next layer down, everyone that's working on AI is compute constrained. And one way that they've tried to combat that is just through a diversity of computing sources. On Anthropic's side, they're very big on TPU with Google, but they rely heavily on NVIDIA, the latest NVIDIA systems, and AMD too. And having those different options in part offsets the overall lack in supply.
Ed, appreciate it. Looking forward to Bloomberg Tech in about 2 hours' time. Ed Ludlow, host of Bloomberg Tech. Elsewhere, AT&T added far more wireless subscribers than expected last quarter. They beat Wall Street estimates by roughly 100,000 customers. CEO John Stankey discussed the company's growth on Bloomberg Surveillance.
We can provide world-class networks in both wireless and fixed that tackle 98% of what a customer needs to do on the internet Occasionally, they walk off one of our networks, and as you look at our partnerships that we're working with the satellite industry, by this time next year, we'll be able to solve that problem. And so we're the natural place for people to come and meet their needs on the internet and do it easily on one bill with one set of services and one support infrastructure. We think we're in a great position as a result of that.
Let's get more context from Bloomberg Markets correspondent Nora Melinda. Nora, this is an incredibly saturated market. Is the only way that the AT&Ts of the world are winning and having results like this just being really aggressive on pricing?
Well, competition is very stiff. You're seeing a lot of the major carriers. If you think about T-Mobile, you think about AT&T and Verizon, they're all offering any sort of incentive to get on new customers and also intrigue their customers to stay. We've been seeing these companies really branching out into different ventures. We've been seeing them going into fixed wireless access, which is essentially like home internet, but it uses some of the cell towers for that. We've also been seeing them branch out into fiber, which we see to be a really competitive space when you think about Wi-Fi access at home and it being stronger than the traditional broadband that we're used to. They're trying to figure out how they can get any sort of leg up in this environment, given the fact that competition is still really stiff.
And the company is leaning hard into bundling all of these, just like we talked about yesterday, even streaming companies, that you just bundle everything and it's like we're back to my mother's era where,
right.
I mean, is this their biggest competitive advantage then?
We've been seeing a lot of analysts talk about this idea of convergence. We see AT&T in this report calling out the fact that about 42.5% of their customers that are actually there for the mobile phone service are also there for broadband internet. So you do see these discounts. I can attest to this, just talking to T-Mobile just last week about the fact that I was interested in maybe getting some home internet, and they're offering discounts for people who are doing that, and essentially for analysts and investors, they think that these are the type of customers that will stay.
It's fine. At some point, SpaceX is going to be providing everything. We'll be getting our internet from the stars.
You know, my friends in Manila, they do use SpaceX Starlink. They love it.
Good Starlink.
It's super fast.
Yeah, there were reports that they were going to do something with, I think, Charter, maybe?
Right, exactly.
Yeah, so could be definitely not your mother's broadband.
In New York, you just go with whatever the building tells you to.
Exactly.
That's why I just follow orders. But thank you so much, Bloomberg's Nora Melinda, for all things AT&T. Now, President Trump making new threats to Iran, posting on Truth Social moments ago, from this point forward, anytime the Islamic Republic of Iran shoots at a ship in the Strait of Hormuz, whether it is by missile, rocket, drone, or any other device or weapon, the United States will bomb and destroy one bridge or power plant, including those located next to or in the capital city of Tehran. Joining us now from Washington is Bloomberg's Tyler Skendel. Tyler, that is quite the statement from President Trump. What do we know more about that? And do we know if the threat or the intention is serious?
Right. I mean, Isabel, at this point, despite efforts by mediators to try to prevent further escalation, the tensions appear to be pointed there. Just to reiterate, this new threat from President Trump saying that if Iran continues to target commercial vessels in the Strait of Hormuz, we could see the U.S. in turn targeting a bridge or power plant in Iran, giving us a little bit more insight into how the U.S. may be going about its strategy in terms of targeting Iranian infrastructure. And it comes as the U.S. continues to expand the scope of its targets. Just overnight, we saw the 11th consecutive night of attacks, which included bombing in some areas that hadn't previously been, as President Trump yesterday said that the U.S. would soon heavily hit what's known as Pickaxe Mountain, a site believed to be a nuclear site by the U.S. and Israel. President Trump has repeatedly said that he thinks Iran wants to make a deal, but now that the U.S. doesn't want to come to the negotiating table unless Iran does, in what he said would be a meaningful way. But so far, we've gotten very little indication that the country is willing to let up its leverage when it comes to the Strait of Hormuz and disrupting global energy supplies, even beyond just that waterway. Because Danny and Isabel knew overnight, we got in the satellite imagery, which shows that at least 2 tankers loaded up with Saudi oil made U-turns as they headed toward the Red Sea amid that heightened threat from the Iranian proxy group, the Houthis, to institute a maritime blockade there.
Tyler, elsewhere, this feels like a common theme from this morning, talking both about physical wars and trade wars. We are back in this environment with the president saying he will impose an 100% tariff on generic drug makers. How will this work? Because the time frame is this gets implemented in 2 years, when it will be the twilight of Trump's presidency.
That's a really good point, Danny. The administration has billed this as essentially trying to give some more time to these drug makers to onshore their manufacturing, saying that a 100% levy will go into effect next August and then double in its rate by the following August. It is raising questions both about the timeline for these drug makers to actually build up these facilities and whether or not it's going to be worth the costs if it ends up getting passed down to consumers, keeping in mind that the generic drug market makes up about 90% of prescriptions in this country. If this all sounds familiar, it should, because back in April, the U.S. Commerce Department announced the results of that Section 232 investigation into the national security implications of making pharmaceuticals abroad. And at the time, that's when we got that 100% levy on brand name pharmaceuticals that are actually expected to go into effect at the end of this month. But this was the first time that it happened, that we got an update related to generics. But Danny, we're going to have to watch to see how this actually plays out, because many companies have gotten carve-outs when it comes to pharmaceuticals.
And I'm sure this is not the last of announcements on tariffs, given Section 122 expires on Friday. Tyler, looking forward to speaking with you throughout the week. Bloomberg's Tyler Kendall in Washington, D.C. Let's get a check on your equity markets. 20 minutes to go until your trading day. Things could look very different in this market, both by the end of the session and post-market session, because we're still awaiting Alphabet earnings. That feels less like just any sort of say on how Alphabet is doing, but more just on the entire CapEx ecosystem. Tech declining this morning. 10-year yields up 1 basis point. Isabel, we've seen a huge surge in yields over the past 24 hours, given that oil is doing that, up to $94 a barrel.
Tesla also reports today, and I think investors are going to ask, why isn't it spending more on AI? I think it's a reverse question for Tesla, but honestly, I'm just excited to hear what the CEO say. We have Max Kettner earlier today saying that it's not the earnings he will look out for, but the reactions to the earnings.
I think that's important, because even if you could be given a crystal ball or do weird insider trading, seems to be in vogue right now, even if you knew exactly what the numbers were, you might not know what the direction of the stock is.
I want the crystal ball here. In the middle of us.
I think we would be doing something different if we had that. Coming up, an exclusive conversation with the Wells Fargo chairman and CEO, Charlie Sharp. That's coming up next. This is Bloomberg Open Interest.
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg. Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
Good Wednesday morning. Let's head over to Bloomberg's Romaine Bostick, who is sitting down for an exclusive interview with the Wells Fargo CEO. Romaine.
Thank you, Danny, and thank you to our audiences across all of our Bloomberg platforms, television, radio, and YouTube. I'm here in our New York studio with the CEO of Wells Fargo, Charlie Scharf. Of course, the fourth largest U.S. bank out there, a bank that is now actually growing after roughly, 6 years or so of regulatory constraints. You've been there for more than 6 years, navigating through those constraints. I think a lot of people have seen the fix that you've done over that time, and now the big question is, what do the next 6 years look like? Is that a growth story?
It certainly is for us. I mean, we're incredibly proud of the progress that we've made. We're a very different company than we were when I got to the company. I guess it'll be 7 years in November. And what you've seen since the asset cap has come off is that we're able to compete on a level playing field with everyone. And we're growing our consumer bank, we're growing our commercial bank, we're growing the wealth business, we're growing our core investment bank. And we're doing it in a way with very, very highly focused on sustainable growth and higher returns. And we think we got a huge opportunity in front of us.
When you say sustainable growth, some investors want to see aggressive growth.
Yeah.
Can you be aggressive and be disciplined and sustainable?
I think, listen, in this business, you got to be very, very careful about what aggressive means. And we also have to be very, very careful about distinguishing between what the markets are adding to our performance or any other financial services provider's performance and what we're doing. We're not looking for quick wins. We're not looking to take outsized risks in the short term to drive stronger results. We're looking at building the underlying franchise, building customer relationships, building flow of things that will go up and down based upon how the markets are doing. But that's what I mean when I say sustainable over a period of time.
Well, talk about this transition then, because over the past few years, I mean, people will look at what you've done over the last few years and call that a turnaround story. Although we should point out, Wells was in relatively good shape even when that asset cap was placed back in 2018. Was that a turnaround story, or was that just kind of regulatory rehab?
Well, I wouldn't call it. I think you're right. It's not a turnaround story. The company was always very strong. We always had a great franchise, but we had to fix things that needed to get fixed inside the company. But from our customer standpoint, we were serving them every day. We were making loans. We were taking deposits. We were constrained on growth, but we were there providing what we did day in and day out. And financially, we were still doing okay. And when we looked at what we were able to deliver, we're not able to grow our balance sheet. We've been focused a lot on efficiency inside the company. We've been focused a lot on growing our fees inside the business. So our corporate investment bank has grown very nicely. Our credit card business and credit card spend is growing very, very nicely. Focused on building treasury services, and now we can grow the balance sheet so we can more holistically serve customers. And that's what you see when you look at the results of this past quarter, with earnings per share up 25%, revenue growth double digits, growth across every one of our businesses in terms of revenue. We're certainly in a different place, and our goal is to be viewed as the best financial services provider in these businesses in the country.
How much of that is because of Charlie Scharf and the executive team, and how much of that is because of market conditions and economic conditions?
Well, I think it's predominantly because of the quality of the franchise and the broad group of people that work at the company. Listen, what I and the new management team have been able to do is get people focused, create a different set of priorities, but a lot of people execute day in and day out. And the fact is, the markets do help. So there's no question that, I mean, these times are really good for banks. And so if you're not doing really well as a bank today, there's something not quite right with either how you're executing or what your strategy is. And that's not lost on us. But again, we look at the underlying metrics of each business. We're growing our consumer checking accounts. We're growing commercial banking customers. We're growing the kinds of loans that we want to grow. We're taking the risks that we want to take that we think will provide strong returns over cycles and not get over our skis and not pretend that it's all us. Some of it is the markets for sure.
You just reported earnings, and the number that I think jumped out for a lot of folks was the growth in the investment banking business. You've been on a hiring spree there. Does that continue, that build out?
Yeah, so we've been on, I would call it a disciplined path to growth in our corporate investment bank. We're a huge lender to corporates of all sizes in this country, large corporates down to middle market companies. We provide treasury services, and what we're doing is building on those relationships with a stronger set of products and services, coverage groups, M&A, underwriting capabilities. And so we've been very disciplined about adding resources in a sequential way, seeing that they're paying off, and we're seeing the results. And so, yeah, we would expect that to continue as we move towards our ambition of being top 5.
As well, the ambition of being top 5, I am curious. You and your executive team are based here in New York, obviously the bank headquartered in San Francisco, your largest employee base down in North Carolina, in Charlotte, I believe. As you build out an investment banking business, can you do that in Charlotte, San Francisco, or is that a New York story?
It's a combination of all the above. I mean, we do have more resources in New York than we used to have, for sure. But as you point out, we have more people in North Carolina and in Charlotte than any other specific location, and that goes back to the merger of Wachovia and Wells Fargo. Half of our corporate investment bank is down in Charlotte. The other half is here. We also, I should say, we do have offices around the country and other parts of the world. And so, we would expect to see growth in both locations and closer to serving customers across the country.
How committed is Wells Fargo to its footprint here in New York City?
Listen, we have, I think we have about between 4,000 and 5,000 in New York. That number at this point will probably, in total, stay roughly what it is. And the question for us is going to be, where's the best talent? Where do they want to live? Where do they find the most attractive place for them to want to live and do business? It's very hard for us to get people to move from North Carolina to New York, even when we try. Sometimes it's hard to get people to move people from New York down there. There are people that self-select. And over a period of time, how New York does and how North Carolina does and how California does matter to where people want to live, and that'll be an important driver.
I am curious about that, though. I mean, at your bank, and basically with all the different business lines, you have a very keen insight into the economy across all the geographies here. When you look at sort of the rebound that we've seen post-pandemic, whether it's in New York or even some of the down south and some of those markets here, I mean, what are you actually hearing from your clients, the people that you're talking to, about where they're doing business, and more importantly, are they comfortable right now being able to do business?
So I would say what you hear from them and what they're doing aren't the same things. People are nervous. They read the newspapers, they watch TV, they see what's going on in other parts of the world. They're concerned about AI. And so those are things that are very much on their mind. But when you look at what they're doing, when you look at consumers, they're spending more year over year. Their delinquencies are down. They're saving more. They're doing really, really well. When you talk to smaller companies across the country, again, they're nervous. They're concerned about how they should be planning for the future, but they're in really great financial condition.
Are you surprised by that? I mean, given how persistent inflation has been, and just over the last 3 weeks, you've seen oil prices spike back up 30%, gasoline prices $4 a gallon, mortgage rates 6.5%. So does it surprise you to see that economic resiliency?
Yes and no. I think, if you would have laid those things out, you would have said, well, would you have as strong an environment today? You'd say probably not. But the fact is, employment is still strong. Wages, at least for our clients, are growing faster than inflation. And that's going to be the most important driver of how the consumer performs. Now, that's not to say that that's going to last forever, but we do continue to see that. And so that's what's going to drive the results.
Well, as you sort of continue this growth story for Wells Fargo, do you feel like the economic conditions will be supportive as they have been over the last couple of years?
So I'd separate into what I know versus, what we would guess. What we know is that the strength continues. When we look at the stats day in and day out, the strength of the consumer, the strengths of businesses hasn't changed from what we reported just a couple of weeks ago. Are we nervous about what the future holds? Sure. The fact is things are really, really good. Markets are really strong. Things are, there's certainly volatility, but things are priced quite well in the credit markets and in the equity markets. There's a huge amount of liquidity out there. There's a huge amount of financing take place. And at some point, then that doesn't go on forever. So we're trying to be very thoughtful about recognizing that good times don't last forever, but things don't look like they're breaking quite yet.
Is your expansion or the growth in this business going to be primarily in the U.S.? There's been talk that you may be looking to expand some of your investment banking business over in Europe.
So, but predominant, so we're 95% of our revenues come from the U.S. We're thrilled about that. So goes the U.S., so goes us, and we're big time bullish on the U.S. And so we're going to continue to invest in all of our business here in the U.S. and believe that there's significant opportunities for us to grow with the economy and to take share. The business that you mentioned, the investment bank, does have to grow outside the U.S. For us to serve large companies and middle market companies as they want to expand outside the U.S. properly, we need to have a presence. We need to have distribution capabilities. We need to have advisory capabilities. But it's there primarily to serve the customers that we do business with here in the U.S.
With regards to the private markets and your role at Wells Fargo, you've obviously been involved in some deals. I believe you're an advisor on Apollo's deal for that Broadcom AI Center and a couple others here. You don't see any real credit concerns in terms of credit quality concerns in that space?
Well, in the private markets, we always say this, private markets are a very, very broad group of people. There's some that do it really, really well, that have the experience, that have been through cycles, that have the analytics, that have the rigor. Those are the ones that we try and do business with, and those are the ones that we focus our attention on, and we feel really good about the credit support that we're providing for them. There are others out there that people potentially should be more concerned about, but we don't have broad exposure to that. But when we see certain transactions, there are that are willing to take a lot more risk than others, that do seem to have different levels of discipline and different levels of analytics. So if credit does turn down, it's just like in the banking universe. Some do it really well, others do it less well. Some will do quite well. We believe those are the ones that we bank, others not as well, and that'll be shown up away from us.
With the structure of some of these AI data center financing deals, is Wells Fargo still interested in doing more?
We are. Listen, I mean, the fact is, this is it's a necessary bill that needs to take place to support what AI can do. But here too, just like we talked about private credit, not every transaction is the same, not every piece of risk is the same. Who you finance, who the guarantor is, who's got the revenue model to support it really does matter. And so we very much are in active dialogue, not just with the things that we've done in the past, but the things that we want to do in the future. But you've got to be selective about who you're financing and what the structures are.
Your board recently reorganized your compensation to effectively structure it so keep you around for another 6 years, basically through 2031. There's been a lot of talk as to whether you will be there through 2031 or whether you would have ambitions maybe to take the seat of another CEO job.
I have no ambition to do anything other than stay at Wells Fargo, build Wells Fargo, and retire from Wells Fargo. That's what I intend to do, and that's what I'm going to do. By the way, I think it's the great seat. I mean, when you look at, if someone could give you the opportunity to run a company like Wells Fargo with the quality of the business that's been so constrained for so long, has picked and chosen the businesses to be in, we have amazing opportunities to continue to do a better job for our clients, to grow and increase returns. And I think we can make a difference in this country, and that's incredibly appealing.
Do you ever look at your old employers and get envious? BNY, JP Morgan, the others?
No, I don't get envious. I look at them and listen, you can learn a lot from people. A lot of companies out there do really, really well. They've done really well. And hopefully over time they'll look at us and feel the same way.
Do you ever talk to Jamie Dimon?
I talk to Jamie. I talk to all the other leaders in the business. There are things we've got common interests on, and we talk about those things, but we compete hard day in and day out.
I do have to ask you about the Wall Street Journal story from the other day that allege that the head of the IRS and the Social Security Administration, who used to work at JP Morgan, allegedly spied on some of his rivals within the organization, including you when you were running the commercial business there at JP Morgan. Is there any truth to that? Were you aware of anything potentially going on?
I have no idea. You know, Frank and I have known each other for, I think it's maybe 30, 35 years. Spoke to him the other night. He says it's not true. By the way, I don't know what I would have that anyone would have any interest in. And so I honestly don't think about it that much.
All right, Charlie, a final question here, and this is really about the next 6 years. I mean, when that next 6 years is wrapped up, whether you're there past 2031 or beyond, what exactly do you want to make sure gets done over the next 6 years?
I think we've got the opportunity not just to have Wells be a better performing company, but be back to what we should be, which is the best performing financial institution in this country, which means real sustainable growth with the highest returns adjusted for our business mix. And ultimately, that should drive us to be the most respected bank in this country. And we compete with great people out there, so it's not going to be easy to do, but that's our goal.
All right, Charlie, really appreciate you
Thanks
joining
for
us. All right, thank you. Danny, back to you in New York.
Romaine, thank you so much for that fantastic conversation. That was Bloomberg's Romaine Bostic with the Wells Fargo CEO, Charlie Scharf. And we are just here entering your opening bell. Let's get this trading day started. We're starting on the back foot this morning, down nearly 0.25%. NASDAQ underperforms. We are awaiting Alphabet earnings. The opening bells, it's nice to see faces you maybe usually aren't used to on Bloomberg. Down at the New York Stock Exchange, celebrating a 30-year partnership with CNBC. You got Sarah Eisen, Jim Cramer, some other executives and friends of CNBC, I suppose. I don't know, kind of cool, very meta to currently see them on Bloomberg TV. Down at the NASDAQ, you have Churchill Capital Corp. It's a SPAC, Michael Klein SPAC, who you can see there up front and center. They're about to complete a merger with Agility, which is a robotics company. So SPACs are back. Nothing to see here or be worried about, Isabel.
We are looking at some of the biggest movers today, and of course, they are the carriers and the broadband. I should stop saying they're carriers because I just know them as the carrier on my phone, but they also provide broadband services, among others. So we have AT&T beating subscriber growth estimates by more than 100,000 in the second quarter. AT&T has rolled out aggressive perks and incentives over the past year, and that's amid a price war with its peers, who are all climbing. On the result, AT&T popping their 3%, Verizon and T-Mobile up by just more than 1%, Danny.
Isabel, I'm looking at some of the tech heavyweights that we're going to be hearing from after the bell about their AI spending plans, namely Alphabet, to see whether there's any tangible return on investments from AI. IBM will also be interesting, has been incredibly volatile at one point, falling more than 20% on a negative pre-announcement. And Tesla, we're also going to hear from them as well. Joining us now is UBS Global Wealth Head of Global Equity Strategy, Nadia Lavelle. Nadia, great to see you this morning. And it's like the time to take a deep breath before all of these earnings start. With Alphabet specifically, I wonder how much you're looking at this company and saying this is less of a referendum on Google and Alphabet as a company versus the entirety of the AI CapEx cycle.
You know, I think it's an important thing to watch for today. You're seeing a bit of positioning ahead of that and sort of event-driven positioning. But I think that even if when you look under the surface, we've had this positioning going on for a couple of weeks with the pullback in semis. When I think about looking forward to what Alphabet will report, I would kind of put it not entirely of all about the AI trade. Remember, last quarter, the experience around Alphabet was quite different, where they saw cloud revenue growth of over 60%. They rallied after that. They increased CapEx. Their peers did not get the same benefit of the doubt. So I think what the market really wants to see is that you are seeing a path to monetization. So cloud revenues will be watched very closely. Search and so forth will be watched very closely, because the market is less focused on, is CapEx going to increase? We know that the AI spending is well supported. We've seen capital raises, whether it's in a debt market or the equity market. But now, what is that return on invested capital, as you talked about? And you know, are we seeing it in products? Are we seeing it in cloud and other areas of the entire ecosystem?
And you don't expect CapEx cuts, but investors are increasingly looking for whether or when they will see the return on investments. At what point do you think monetization will become like a thing that they will really be holding on to and will become the market's main focus?
Yeah, and I think we're starting to see that, you know, in terms of how some of these stocks are traded. The market will reward, if you increase CapEx, but you're also seeing monetization, the market will reward that. But if you're just increasing CapEx and you're pointing to that you're spending just to spend because your peers are spending and there isn't a clear path to monetization, investors want to see that line of sight, then you are going to be punished. And I think that what you're going to be watching very closely is really the cloud revenues, because that is the best indication right now. And know, you've seen it coming through in terms of better traction around advertising, better traction around search, or any sort of other product launches that are AI related and a path to monetization.
It's not just tech, it is earnings writ large that expectations are so high. I was reading through some of the data or looking through some of it, if you'll stick with me. So the ratio of companies upgrading their outlook versus cutting or keeping it is the highest since Bloomberg's data going back to 2011, the team reporting that. Profits are expected to rise 26% in the second quarter, something that has never happened outside of a recessionary period. And at the same time, earnings in the first half of this year are expected to reach 28%, the most since 2004, if you exclude the rebounds, excluding the rebounds from the pandemic and the GFC. I mean, what? That's crazy.
No,
Is that a bar that we can meet and beat?
Yes, you know, I mean, our expectations for the second quarter, just the second quarter alone, is actually 28%. And that might even prove to be conservative. And I think it's not just the AI story. We know that semiconductors are contributing a big portion of that, about 40% or so of that. But you're also seeing a broadening out. I mean, you talked about the AT&T's awards that you're seeing rally in, that you're seeing a broadening out of that profit because the economy itself is doing well. You're seeing a pickup in manufacturing activity. Look what the banks also put up last week in terms of loan growth. And so that is a healthier scenario for the markets. You don't want a market that continues to be overly concentrated in the AI or in semis. You want a market where you're seeing a broadening out. And we have seen that in financials, industrials. We've seen that in healthcare in recent weeks. And we think that's important for the durability of this overall bull market. And the earnings are coming through. We're looking for sort of a medium company outside of that to be about 12% earnings growth for this second quarter.
So you talk about the broadening of the market, but what if the Magnificent Seven in the next 2 weeks disappoints? Can the market carry themselves higher in the next few weeks? The S&P, will it reach new highs?
And you have seen the last few weeks, you know, the churn under the hood. So the index level has been quite resilient because these other areas of the market has been able to deliver the earnings growth and has been holding up. Now, do you need participation from the Mag 7? Reality is, when you look at the Mag 7 performance year to date, it's not all that rosy compared to the other parts. I think the question is more, do you need the AI ecosystem to deliver? Absolutely, you do, just because mathematically the overall weight, you know, do you need semis to continue to perform and Mag 7? Because if you don't have semis performing and Mag 7 is still lagging, that has broader implications for just the index because the S&P 500 is a market cap weighted index. But I do think that the rest of the market also seems to be, the laggers also seems to be catching a bid recently.
I just wonder, one of the things that I'm trying to understand about the AI trade that we're seeing right now is this divergence that's happened, or this negative correlation that's presented itself. It seems like every day that you have the hyperscalers rallying, the chip stocks are doing poorly. When the chip stocks are doing well, the hyperscalers are doing poorly. We've been describing it as the check writers versus the check takers. I wonder if you expect that relationship to continue, that inverse relationship.
Look, we think that they both can work, not necessarily always at the same time and for the same reasons. We know what is driving the semiconductor trade. It's really that demand for compute. We know that the hyperscalers, you know, the bias is to continue to spend, and so the beneficiaries are benefiting from that. You know, at the same time, what needs to happen for the hyperscalers? They need to show that monetization, that return on investment, that needs to come through. And if we start to see more indications of that in this earnings season or even the next earnings season, you can start to see a re-rating again of the hyperscalers. Reality, we already know that investors' concerns around hyperscale spending has somewhat been priced in. You know, they lagged earlier this year. They're starting to get a bid again. And so our view is that maybe from the risk reward standpoint, the hyperscalers could look a little bit better near term. You know, we have actually closed our underweight exposure in our transformation innovation opportunity AI portfolio to the hyperscalers because of that. So we're now neutral on the hyperscalers. But we don't think that this is a zero-sum game. We think over the longer term, as long as you see AI adoption continue to accelerate, then you can see both perform well. But in the short term, you could see some rotation between the two.
You are a bit more selective now, I think, on your notes when it comes to semiconductor. Is that a valuation call, or are you worried that the AI enthusiasm has run ahead of fundamentals?
Not a valuation calls because the earnings are growing. I mean, when you look at semiconductors for this year in S&P, they're expected to, EPS growth is expected to be over 100%. And again, that could surprise to the upside. I think it's more that they've had a very strong rally. So tactically, we've taken some off of the table, but we're still overweight in our portfolios to semiconductors. We think that the spending it has legs. And what we've heard from, some of the Asian suppliers, there's visibility out for a couple of years. And so that just gives you some comfort in the ability for the earnings to continue to grow, into 2027. I think the question mark becomes more around 2028 and what happened to CapEx. We expect CapEx to grow 70% this year, next year probably 25, 30% or so. But then what happens in 2028? Do you see a pause? And we need that monetization to come through to continue to encourage your spending.
Nadia, it's such a pleasure to have you on. Thank you so much for joining. That's UBS Global Wealth's Nadia Lovell. Let's get a check on your equity markets about 10 minutes into your trading day. And again, it was an up day yesterday, turns into a downturn today, but are we just treading water ahead of the earnings we'll get after the bell, which include Alphabet and Tesla? The biggest gainers so far in this morning's session, Philip Morris reporting earnings. They actually trimmed their outlook because of the currency hit and things like the war in Iran. But within that, they say the consumer is really resilient. We're really positive on our Zyn product since the FDA says we can market that as healthier than cigarettes. Thus, you get a rally of nearly 5%. Dell is doing well. HPE is also rallying. I'm trying to see if I see it on this board. I don't. Supermicro reported earnings. They are AI servers. Prelim earnings, I should say, and Dell rallying in sympathy. AT&T, also very strong earnings. So earnings helping the top pile at the moment. To the downside, you have Microsoft. That's down 1.3%. A lot of the hyperscalers having a bad day today. Amazon, Meta, that falling. GE Vernova also reporting earnings, which disappointed. So you can see those shares sinking 6.6%. Let's get a look at your sectors this morning on your GRR screen. Only 3 are declining, but that just shows you how important tech is in this index. To the point that Isabel was asking, if the Mag 7 disappoints, can everything else hold us up today? The answer is no. Infotech falling 0.7%. Materials, energies, utilities, those doing well. Energy specifically doing well as there continues to be disruptions, not just in the Strait of Hormuz, but the Red Sea as well, that sent the price of oil higher. Isabel.
Danny, that's such a great point. We have options markets signaling hyperscaler earnings matter more than the Fed, and it really is a signal of just how important this week is. Coming up, a trio of big tech earnings as we just talked about. After the bell today, we take a closer look next. This is Bloomberg Open Interest.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
Key
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Time now for our top calls. Some of the analyst action in focus this morning. First up, JP Morgan raising its price target to Capital One to $246, highlighting the company's strong credit and sales growth. You see the stock there down by nearly 2.5%. And next up, Barclays cutting its price target on Alaska Air to $65, citing a weaker third quarter outlook compared with competitors Delta and United. That's why you see the stock there down by nearly 5%. And finally, Baird initiating coverage of IBM with a neutral rating, pointing to growth and durability concerns following the week's preliminary earnings released last week. You see the stock there just up by around 0.3%. Then.
Staying with tech, because IBM is going to be joining Alphabet and Tesla in reporting earnings today after the bell. Joining us now is Mandeep Singh, Bloomberg Intelligence Head of Global Tech Coverage. I gotta say, I love when the sell side comes around like maybe a week or two late after like IBM has already seen this like huge blockbuster catalyst event sell off. Anyway, earnings today, I'm guessing it's just really Alphabet and their CapEx numbers. How much are you looking at this? I was talking to Nadia Lovell about this earlier. Are you looking at it and saying, okay, this is a referendum on Alphabet versus the entirety of the CapEx cycle?
I mean, in my mind, the cloud segment has to show a big sequential acceleration, partly because of what has transpired in the quarter, which includes trends like token maxing and, you know, everyone really running out of their credits to run these LLMs. So who does it benefit? It's your cloud providers. And Alphabet cloud segment has been the fastest growing out of all the hyperscalers. In fact, they were already growing 63% last quarter. So you want to see a big sequential acceleration, and that'll be the justification to raise the CapEx, because they already did an equity raise, and now we are talking about, you know, I mean, our numbers are $300 billion in CapEx for 2027. It's much higher than consensus, but I think you will see a big beat on the cloud side today from Alphabet.
What about in Tesla? It seems like it's the opposite story because investors actually want to see AI spending. Anything you're going to be on the lookout for when it comes to maybe the AI roadmap or capital spending?
I mean, with Tesla now, things have become murky with what will go to SpaceX versus what Tesla will end up spending on their CapEx. But look, when it comes to SpaceX, we already know how big of a benefit they are getting from, you know, the data centers that they have set up already and how it's translating into real revenue. So to my mind, I think Elon Musk does believe in AI in a big way, and I wouldn't be surprised if he plans to raise CapEx even for Tesla.
When are these two companies going to merge, right? It's inevitable that Tesla and SpaceX become one, right?
I mean, there are so many regulatory aspects to this that it's hard to.
I thought regulators were super chill with everything right now, though, Mandeep.
Well, I mean, even with the LLMs, we are finding things are changing, you know, with how much open source has caught up and what kind of adoption we are going to see at the enterprise level. I bet you at some point there will be more regulatory.
Can I just quickly ask a question there? Because we've talked a lot about Chinese open source models and they're catching up. What's the state of U.S. open source LLMs? Are those finding success? And might you even see Anthropic offer their own, or one of the foundational LLMs offer their own open source because they realize they need it to compete? Like, how likely is it that a US open source ecosystem is just as robust?
I mean, you do have Gemini offering their model with an open source option and OpenAI as well. The problem is there's a big gap between the Kimi 3 open source versus what Gemini and OpenAI offer right now, and that's where enterprises are worried about token costs. So, you know, at the end of the day, it's your total cost of ownership that determines which model you're going to adopt, and you care about the future. You don't want that model to be banned, 2 months from now. So that's the commitment you're looking at in terms of, is it something that I can build my application on top of? And I think there are a lot of considerations at play here.
What about Google? Is the key question now is whether AI spending will finally translate into faster cloud growth? Is that what investors will be looking out for?
Yes, and look, search will always be dominant on a Google earnings call. So that's
even with ChatGPT now, because I've gone to search less. I go to ChatGPT sometimes.
But look at how fast Google has been growing. Last quarter, they grew 19%. Even this quarter, consensus is around 16%. So the problem with these LLMs is right now they're still consumption or subscription-based models. They don't have ads. So until and unless ChatGPT starts showing ads and they're able to monetize that freemium model, Google search continues to be dominant. But I would agree with your question that from a volume perspective, volume for Google searches probably has taken a hit, and it will be interesting to see how it impacts the search revenue.
Wasn't that like one of Anthropic's big advertising campaigns? That's like, yeah, you go to ChatGPT and you're getting ads and we won't have it. Like, wasn't that one of their big selling points?
It was, but look, at the end of the day, we know ads is a very dominant model for all of the internet players. And I would be very surprised that if that changes, with LLMs, even though they're very expensive to deploy right now, which is why these companies don't have a choice but to use a consumption model. But over time, all these platforms have an ads component, and I expect that to be the case with Anthropic and OpenAI.
I'm cheap, Danny. I sit through the ads. I'm just like hypnotized by the ads.
Oh no, I will pay up.
You will. That's where we are different.
Convenience is what I pay for.
Thank you, Mandeep. We love that we can ask you anything tech. Mandeep Singh of Bloomberg Intelligence. Coming up, AT&T subscription growth accelerates much faster than anticipated as perks lure customers. That's next. This is Bloomberg Open Interest.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television. Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
I do believe that the market will eventually understand that what we have built is indispensable for the kind of workloads we're going to see in this AI environment working forward, and that AT&T is uniquely positioned in the investments we've made over the last 5 years to serve more of those workloads more effectively than anybody else. And eventually the market will figure that out, and when the cash shows up, valuation will ultimately correct itself.
That's AT&T CEO John Stankey after reporting huge subscriber growth in the second quarter. Bloomberg's Kelsey Griffith joins us for the sector coverage now. Thank you so much, Kelsey, for joining us. What have we learned for AT&T? It's such a competitive landscape, but they seem to be beating their peers.
That's right. AT&T had a little bit of a rough go in the first quarter. They came up short on some estimates, and they were hoping to sort of turn things around this quarter, and that's exactly what we've seen. We've seen some pretty early analyst reports saying basically AT&T beat on everything that matters to investors this quarter. Their subscribers were up for mobile services. They did really well on adding these fiber customers, and we've generally just seen that the company is doing a really good job of pulling share when they combine those mobile customers with home internet customers.
How much is that competition just going to get even worse, Kelsey, with news or at least reporting around SpaceX joining forces with other providers getting into this business? Is the price war about to just accelerate?
That's something that John Stankey was asked about on the investor call that just wrapped up a few minutes ago. He was very measured in what he is saying about satellite. He is mostly saying right now that, look, satellite is a complement to our network. We are looking at satellite as a way to fill in gaps and to maybe retire some expensive infrastructure and to cut cost savings there. On the customer side, he has been kind of at the helm of introducing some new pricing plans that are giving customers a bit more choice in how those plans look. AT&T has also introduced some price increases in the last quarter, so we might be seeing that show up in the results a little bit. You know, it's sort of hard to say right now whether that's going to hurt customers or whether that's going to help AT&T's revenue, but so far it was a pretty good quarter.
And Kelsey, around 45 seconds here, the company is also leaning hard into bundling broadband and wireless. Is this becoming the biggest competitive advantage in the industry right now?
That's what AT&T thinks. They have leaned into this convergence strategy for a really long time, and at least in this quarter, they've said that has paid off. They've seen somewhere around 42% of customers who take AT&T home internet also take AT&T wireless service. So that's a model that they're really invested in.
Hey, Kelsey, we really appreciate your coverage this morning. Those AT&T shares up nearly 4% with the rest of the industry rallying too. That's Bloomberg's Kelsey Griffiths on the latest earnings. Coming up in hour 2 of Bloomberg Open Interest, we'll speak with JP Morgan's Jordan Jackson and how Wall Street will react to AI CapEx changes. As a reminder, in case you haven't heard it enough, we will get Alphabet earnings after the bell. Then we'll speak with Mark Rosen of Catalyst Brands on the state of retail. They own companies like JCPenney's and Brooks Brothers, but not a lot of the IPO. That belongs to Authentic Brands. And we'll speak with Itay McKelly from TD Cowen. Will join us ahead of Tesla earnings. What will they bring? All of that happening in just a few minutes after this commercial break. You're watching Bloomberg Open Interest.
Being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you? I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
ABC News. I'm Sherry Preston. President Trump saying on social media this morning that for every ship shot at in the Strait of Hormuz, the U.S. will destroy one Iranian bridge or power plant. The warning coming after another wave of strikes overnight and after alerts were issued in Bahrain and Saudi Arabia. Today, the president attends the dignified transfer of remains at Dover Air Force Base for the 4 most recent soldiers killed in the war.
The wife of 30-year-old Sergeant Michael Swinton of North Carolina telling ABC News he was an amazing husband and father to his 2 young children. The father of 25-year-old First Lieutenant Tyler Feehan tells ABC, "Our hearts are shattered," calling his son and the others who were killed our heroes.
ABC's Martha Raddatz in Amman, Jordan. This hour, the family of Nolan Wells is releasing the results of an independent autopsy conducted on the 18-year-old who died after attending a 4th of July boat excursion on one of Mississippi's barrier islands with friends. Family attorney Benjamin Crump.
Somebody saw something. Somebody knows something. There were almost 300, 400 people. Somebody knows something.
Police say Wells drowned. The autopsy by the family says the cause and manner of death are undetermined. Tropical storm Bertha taking aim at Louisiana's Gulf Coast. ABC's Victor Okendo in New Orleans.
We met residents preparing to secure their homes, loading up on sandbags. They have been through their share of storms in New Orleans. They tell us they'd rather be prepared than caught off guard. As Bertha approaches, some of those gusts could top 35 miles an hour. The heaviest of the rain will be south of us. Some areas could see 6 inches, and that could lead to flooding. We'll likely see some thunderstorms as well. 1 to 4 feet of storm surge is possible.
New data from the CDC shows a confirmed 4,173 lab-confirmed cases of cyclosporiasis. This is ABC News. E-bike sales are surging, but so are e-bike injuries.
One estimate puts the number of people hurt in e-bike accidents at 20,000 per year.
It's really disheartening.
Orthopedic trauma surgeon Hassan Mir sees it firsthand.
I'll spend a day operating on kids injured from e-bikes, and then on my way home from work, see more kids on e-bikes.
Riders aged 10 to 14 make up the largest percentage of e-bike injuries. When Dr. Mir sees those riders,
I wonder if that kid's going to be my next patient.
Jim Ryan, ABC News.
New Jersey says it has corrected a voter registration error that automatically registered thousands of non-citizens to vote. The announcement from Governor Mikey Sherrill drawing quick reaction from the White House. President Trump using it to further push his voting bill. ABC's Mary Bruce is at the White House with more on what the governor said.
She says officials became aware of this issue last week and that all 6,600 people are now being scrubbed from their voter rolls. And she is vowing that this will not happen again, saying when they find problems, they will fix them. All of this is coming as President Trump is amping up his unproven claims of widespread election fraud. The president quick to react to this news out of New Jersey, saying the episode underscores the need to pass his Save America Act, which of course is his bill requiring voter ID and proof of citizenship.
The Ebola outbreak in the Congo, the fastest spreading in history, has now killed 999 people, more than 730 other patients currently in isolation in hospitals. I'm Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live in HD. We're doing it on Bloomberg.com. We're doing it on YouTube. I think we're everywhere.
I didn't realize we're HD. Are we like 4K HD?
I think we're at 4K HD. If there's a 5K, we're there as well. We go. That's how we roll.
I'm just
here.
at 2K.
John's in a 2K world, but we're all in the 4K, 5K world. This is Bloomberg Intelligence Program. Scarlett Fu and Paul Sweeney. Coming up here, we're going to take a look at these markets. We got red and green on the screen here today. We're going to talk with Anurag Rana. He covers all the technology stuff for Bloomberg Intelligence. We got some tech numbers after the close with Google. We're going to get IBM as well. They had their big pre-announcement, which rocked that stock last week. Frances Newton, CIO of Tuttle Wealth Partners, get her thoughts on the markets. And Gautam Mukunda, lecturer at Yale School of Management, and he's a Bloomberg Opinion contributor. He's got a column out here. He's saying, regulate AI like we do the airline industry. I'm not sure where we're going to go with that. So a lot coming up here. We'll get there with the markets, the stocks, and the bonds, and all that kind of good stuff. We're going to kick it off with John Tucker and a Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest in your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Major stock averages mixed to a little change ahead of the earnings results later today from, yes, Google parent Alphabet. Those shares right now up 0.9%. That's all going to be about a return on investment in AI. Energy also in focus as oil continues to push higher. Brent up 3%, 93.86 a barrel. Yes, 426 at the Wawa. Going up. Materials and energy.
How much at the Wawa?
What?
How much at the Wawa?
It was 426.
Really?
425 and 9/10, so I round up. Energy in focus again. Materials and energy best performing major industry groups in the S&P 500. Best performing stock. Now, Carmen's going to break this down in detail in a little bit, but Super Microcomputer, those shares up close to 23%. Meantime, Laura Cooper at Nuveen says the rise in oil prices does bring Fed interest rate policy back into focus for everybody.
We could start to see more of those hawkish bets being placed that could, drive interest rates higher in the near term, tighten financial conditions, and ultimately potentially weigh on the earnings backdrop as well, which has really been propping up these markets.
S&P 500 up 4 points, 75.13. Dow Jones Industrial Average up 247 points, 52,468. And the NASDAQ The NASDAQ Composite Index, 64 points lower. That's down 0.25%. In addition to Google, Tesla also reports after the close of regular trading. And the Cybertruck in focus today may be on its way.
Why?
Because it's so ugly. No, it's on its way to being viewed as the greatest automotive flop of all time.
Better than the Edsel?
Worse than the Edsel.
Oh, okay.
The Edsel, if you don't know, Edsel was named after one of the Ford sons.
I think so.
Edsel Ford, and they
It had that weird grill, right?
They made a car. It was like an oval shape. This is 1957 Carmen, which is you weren't even a thought. So, and that until now was the worst performing.
Okay. All right.
But it has been.
The Cybertruck is like a Minecraft vehicle.
Yes, that's a good way to.
It's just.
And I have to. Every time one goes by, I look at the window and say, "Who's driving this thing?" And it's all over the place. You get.
And the sales they do have recorded, a lot of Musk's own companies have purchased it, for themselves.
So Musk employees are driving them around? Maybe.
I don't know, by choice. Anyway, we check the markets and other stuff right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and at Bloomberg.com here. We got red and green on the screen, as John was just reporting here. Let's take a look at some of the stocks on the move today. We can do that with Carmen Reinecke, Deputy Team Leader for U.S. Equities, joining us here in studio. Carmen, what are you looking at?
Yeah, well, let's start with the best performer on the S&P 500, as John mentioned. This is Super Micro, ticker SMCI. Shares are up 23% right now. This is the best intraday move since May, and it also brought the stock into the green on a year-to-date basis. As of yesterday, it was down about 13%. Now it's in the positive territory for the year. So shares are moving today because the server maker issued preliminary results that said its backlog hit a record on new orders in the quarter. So they're expecting more than 60 billion. Really positive note there. It's also lifting shares of HPE and Dell, so some other server makers getting a little bit of a lift there as well.
All right, it's from hardware to software. You're looking at a company called Pegasystems.
Yes, so let's look at Pegasystems. This is ticker PEGA. Shares are down 14% right now, worst intraday move since February. And this is interesting. We were talking about we get IBM results after the close. So this company's stock is down after it reported second quarter earnings that missed estimates. And a lot of the analyst comments said that it was very similar to IBM's remarks earlier in the month. So remember, I think a few weeks ago, if not last week, we got this news from IBM that its customers were spending in different ways than it expected, right? So they weren't spending as much on mainframes. So Pegasystems reports sort of reflected a similar sentiment where they said that clients delayed purchasing decisions and that the trend may continue to adversely affect their annual contract value growth rate going forward.
I remember when this AI stuff started 4 years ago, whenever it was. I remember asking tech analysts, how much of this is incremental spend versus just taking it from different buckets?
Right.
And I think initially a lot of it was incremental, but now it seems like it's kind of taken
reallocating.
Reallocating, yeah, that's kind of what we're seeing there. And so that'll be interesting to see what IBM says after the close today. All right, one more, GE, and there's some other name after the GE. I don't know what that's all about.
So GE Vernova, ticker GEV. So shares are down about 5.5% right now. This is the second worst performer in the S&P 500 today. It reported a higher full-year revenue outlook, but investors are still selling off the shares here. It was up 65% this year through yesterday's close. So maybe just a little bit of a chance to make profits. So this is the electric
power company, right?
Exactly.
GE.
And there is still some weakness in the wind unit.
All right. I mean, they split into two companies, GE and GE Vernova, right?
Yes.
Okay.
Yes.
All right. So I don't know. Carmen, good stuff. Thanks. Appreciate it. As always, we're hearing about some stock movers here. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen here. I think we've got an issue with generic drugs.
Yes, because President Trump is now talking about increasing tariffs, 100% tariffs starting in August 2028 if these drug manufacturers don't move production to the U.S. I mean, reshoring is one of his big agenda items.
All right, so we'll see. I mean, I think a lot of people benefit big time from generics.
Yeah, it feels a little bit at odds with his stated goal of reducing drug prices for Americans as well. So which is the more important to him, reshoring or keeping drug prices low for Americans? That's the question.
Naomi Kresge, she's going to join us in Bloomberg News. She knows what's going on here. Naomi, talk to us about what's going on out there. What is the president proposing?
So he said in a Truth Social post last night that he intends to push through a 100% tariff on generic drugs effective August 1st, 2028, if companies don't return manufacturing to the U.S. And this tariff would then be boosted to 200% a year later in 2029.
Okay, 100% to 200%, but unusually for this president, this would not start until August 2028. So that makes me think that this is all about drawing some lines in the sand and, kind of setting up a negotiation, a long-term negotiation.
I mean, the timing is interesting. Some analysts have noted that by the time the 200% tariff would, in theory, be coming through, his administration will not be in power anymore at that point, and so it would really be up to the next administration. We have seen some commentators suggesting that this would be rolled back potentially by another administration. It is, there are many challenges associated with this for the generic drug industry, partly just because, unlike makers of branded drugs, generic drug makers actually don't produce very much in the U.S., and that's because the U.S. is such a low-cost market for generic drugs. And it really depends on a supply chain in lower-cost places for manufacturing.
Where are most generic drugs manufactured?
So the majority would be in India. It's a big place for manufacturing. Yeah.
Okay. And what I didn't know, which I found out from your reporting, generic treatments account for more than 90% of U.S. prescriptions. That is huge. Has it always been that level?
Oh, that's a good question if it's always been that level. That I don't know, but it is at that level now. It's, 90% of prescriptions, but I think something like 12% of costs. And so you can see that that disconnect. The U.S. is an expensive market for branded drugs, as we have all discussed, so many times. But it's actually cheaper to buy generic medicines in the U.S. than it is in a lot of other wealthy markets.
Naomi, I thought it was interesting that you said that most of the generic drugs that we get in the U.S. are made in India. So you wonder whether this is a broadside at India overall, an attempt to just tariff imports from India. But you point out in your reporting that there's a trade pact between the U.S. and India that was struck in February, which makes a certain stipulation about generic drugs. Can you just explain what happened in February and how this threat affects that or doesn't?
So, I mean, first of all, we should say that we'll have to see how all of this plays out.
Of course.
We're discussing Truth Social posts right now, not official, policy that has gone through, lots of review and thought and discussion. So just setting that as a first point. I think this has unsettled Indian drug makers. They're very surprised by this. I guess that they're potentially, whether there would be a carve out for Indian drug makers, not sure. We'll have to see. Indian drug makers have said that for them, it's not practical to move operations to the U.S. And that to do that, they would probably have to raise prices. And at any rate, 2 years is a very short time window for building factories in the U.S.
All right, Naomi, thank you so much. Naomi Kresge is our healthcare reporter. She is based in Berlin. And of course, we'll be following this story. There's a lot to it here because there was that trade pact that said India would receive negotiated outcomes with respect to generic pharmaceuticals and ingredients. So it sounds like those two things kind of run head to head against each other. But I mean, these are all Truth Social posts. So,
but it's news.
TBD on everything. All right, this is Bloomberg Intelligence on Bloomberg Radio. We have a mixed trade in equities. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. High-stakes mega-cap earnings after the close of regular trading today. You're going to start off with Google, parent Alphabet. Tesla also opening their books to investors. Traders are looking for results to demonstrate a clear return on all this AI investment from Google. Brent oil earlier spiking above $95 a barrel. The international benchmark, 94.12 right now, so that's up close to 3.5%. And again, that's leading to all these concerns about inflationary pressures that could lead to higher interest rates from the Fed. The 2-year, which is more policy reactive, up 3 basis points right now at 4.3%, I'll call it. And Supermicro Computer issuing preliminary results saying the backlog there hit a record on orders in the quarter, of more than $60 billion. So that's the best performing stock right now in the S&P 500. Supermicro up close to 25% in today's trading. AT&T adding more monthly wireless phone subscribers than the analysts expected in the second quarter, and shares of AT&T, they're up 2.5%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Scarlett.
All right. Thank you so much, Sean. And as you put it, we've got some big earnings this afternoon after the market closes. Alphabet, Tesla among them. So two of the Mag 7. If you still believe in that cohort of stocks called the Mag 7.
Bloomberg has an index, so it is still a thing.
It is still a thing. People talk about the Mangoes group as well. I mean, there's a whole bunch of different names.
Okay.
Yeah. Right. So anyway, however you'd like to put it, the AI trade is definitely in focus with earnings season upon us. Francis Newton is economic strategist and chief investment officer at Tuttle Wealth Partners.
Let's go to Anurag first. No.
Oh, that's right. That's right.
Technology.
You're right. Let's talk to Anurag first. Thank you. I got ahead of myself.
He's waiting out there in Chicago, which is a burgeoning tech hub that people don't know.
Is it really?
Oh, sure.
Anurag from the burgeoning tech hub of Chicago. Thank you so much for standing by as I got all confused. So Anurag, talk to us about what you are anticipating when we start looking at earnings. I mentioned Alphabet, I mentioned Tesla, but there's also IBM, and IBM gave a pre-announcement that really got people worried.
Yeah, and again, it's, one of the things that we have been seeing, and, three of us been talking about it almost 2 years, is the shift of enterprise IT spending from your traditional tech spending to more of the AI spend. So people are, putting more money in models. People are looking to fix their data and all that stuff. But meanwhile, the consulting growth in your traditional software has been slow. But we never saw this big of a miss, which IBM talked about, a few days ago. And the big line item over there was that their clients, the big companies in the US and global for Fortune 2000, are right now accelerating buying their own internal servers because there is a fear that the prices are going to go up next quarter because of higher memory prices. So because of that shift, they took money out of one bucket. They actually, they basically, the thing that actually lagged for IBM and, is the software part of it. And that is the theme we anticipate over the next 2 weeks when we see, Pegasystems just reported today. They said the same thing. It's down 17%. ServiceNow is going to report today. SAP is going to report tomorrow. So we expect all of them to say a similar thing, that, they are looking at budgets being shifted and deals not being closed.
So what can IBM say today that can, reset the narrative here? Because, boy, that stock fell more than it ever did. And we're talking IBM here. They've been around the block once or twice. I mean, that was a major reset for expectations. What can they say today?
So there are two things to it. I think they will say that the software revenue that they lost will come back. But I can't tell you whether that comes back in 3Q or 4Q, but it has to come back because that software is tied to the mainframe, and you're not going to run the mainframe without the software. So it has to happen. That's not it. The thing why, one of the things we think why IBM fell 25%, because it was trading at 25, 26 times earnings. Frankly, that's well over Microsoft, frankly. If you look at ServiceNow, if you look at Salesforce, if you look at Workday, they're all growing faster than IBM, and yet they're all trading at 12, 13 times earnings. ServiceNow is a little bit higher than that. So I think there was a little bit of a valuation correction there, because a lot of, I would say, retail investors got excited about IBM as a quantum play or, the next generation technology, which is, again, great for IBM, but it's not what a growth driver for them at this point.
Okay, so we come back to the idea of what's going to be the catalyst for growth for a company like IBM and other software companies. What is it going to be? What's the realistic option that they have?
So for IBM itself, they are a company that's going to grow top line between 5 to 7%. And I don't see that changing this year or next year. So let's make that the first and the most important thing, just because the size of the company and what they sell. When you look at some of the other vendors, somebody like a ServiceNow that does automation software, that's a company that grows 17, 18%. And you're going to be in that range between 15 and 18 for next year also, just because of the way that workflow portfolio works and people are looking to automate their internal processes. So each company has a different growth rate, but we're not going to see accelerating growth rate from anybody. But each one, whatever they are growing at, they're going to be some sequential decline on that.
All right, Anurag, I can't wait to hear what IBM has to say, because, again, IBM dropping 25% in one day, you never saw it before, and that was just historical, I think, for a lot of the market about where some of this AI spending is coming from. Anurag Rana, Senior Tech Analyst for Bloomberg Intelligence out there in Chicago. It's not just meatpacking, they do tech now, so there you go. Let's talk about these markets here. Frances Newton joins us here, CIO of Tuttle Wealth Partners. She's based in Tampa, but we got her up here in the big city here today. Frances, what's the conversation you're having with clients these days? Are they worried that we're maybe in a bubble, that we're too far over our skis? Is there fear of missing out? What's the conversation you're having?
The conversation I'm having is we definitely have to participate in the AI trade because that's the new Mag 7, to your point earlier about whether or not that's obsolete. But it's the new Mag 7, and so you're going to have a drag on performance if you don't participate. But the responsible way of participating is in the infrastructure play. Power, water, all of the things and resources, voters, what's going on in that, all of the things that are responsible for feeding AI that are not going to be disrupted by AI is what we're focusing on for the long term. So, we have the forever portfolio, and that's where we kind of put people's wealth. And then we at Tuttle Wealth Partners have the benefit of having Tuttle Capital Management. We've now issued about 70 ETFs where we have a trading desk, we have active traders internally in those ETFs, but our clients don't see all of that buying and selling in their portfolios.
So what do you do with your exposure to the actual nuts and bolts of the AI trade, the chip makers and whatnot? I mean, is that part of the forever portfolio? Do you not add to it even when you get the opportunity to because there's some drawdowns?
Yeah, so we layer it on top of the forever portfolio, but we are actively trading it so that they don't get, so hopefully we, remove some of the drawdowns, by being able to actively trade it. We're focused on the bottlenecks, right? We've got memory. The new bottleneck that just came out was tungsten. We're looking at, the developments around Kimi 3, which could actually, make models cheaper, but they could have broader usage because of that. So we're watching all of these things change in real time. And the nice thing is that sitting on the trading desk, not me, they're watching the Trump tweets, they're watching all of the news, they're watching the charts all the time. The thing that we have to be careful of, which most, wealth advisors don't really know about, is like an undercut rally. So we're watching those technicals, what's happening in real time. One of the things we've been focusing on is heavy asset, low obsolescence. Now, investing has changed in the sense that sometimes stocks can be undervalued, not because they're cheap, but because they are going away. So if you're paid to think, AI is going to disrupt you. But like, with the infrastructure play, they're not going to get rid of the railways and the tracks, right? Even if railroads adopt AI, they might get more efficient with some of their processes, but they're not going to get rid of the actual infrastructure that makes that service possible.
So one of the questions that a lot of people are asking is, and they've probably been asking it since the beginning of this AI trade 4 years ago, is it a bubble? How do you respond to that?
Yeah, so as a global macro person, we have a record amount of liquidity in the system. And so the record amount of liquidity in the system is going to try to find places to go until we don't have that liquidity in the system. The valuations are supported by that liquidity. And until that liquidity is changed, inflation changes it, the Fed changes it, I still see AI being, the thing to go into. It's just going to be a bit of a rotation around these various components as new bottlenecks are discovered.
What about on the fixed income side? Because you've got the 30-year bond now trading above 5% for the longest stretch since the beginning of the financial crisis, and that gets your attention. We know the structural problems that the U.S. faces, the growing debt pile, potentially sticky inflation that's not going to come down. How do you think about where you want to be on the curve?
Yeah, so basically Matt is like very iconoclastic when it comes to bonds because they're no longer a hedge. You looked at the correlations change in 22, Liberation Day, the war with Iran. And so when we look at the fixed income component of our portfolios, we're looking at property and casualty stocks. Why? They're totally bonds, but there's an underwriter, there's an equity play. They're not totally correlated with the S&P 500. And if you just, look at one of those property and casualty ETFs against the TLT, you will see quite a divergence in the chart. And we're also looking at pre-merger SPACs. Of course, before they deploy that capital, you're sitting in bonds, right? So that's another bond play. And just looking at things like preferred shares, where your yield is a little bit more certain and less volatile, because the volatility in the bond market is probably not going away. And bonds are not a hedge when rates are moving higher because of inflation, and that's what's happening right now.
We kind of came into the year, and most folks were pretty bearish on the U.S. dollar, thought the dollar would be soft, and it was until we started a shooting war in Iran, and then money came flowing back into the U.S. dollar here, and we got the DXY index well over 101 here. How do you guys think about that?
I mean, it's just, it's a function of tightening, and it really goes into, the administration's negotiations with trade, basically, is the long-term effect of having this really strong dollar, and that's what's very interesting. Obviously, we're going to return to the trade conversation. Of course, we have the midterm elections coming up. Yep. So, I expect the Fed to remain on hold for the July meeting. I don't know if they're going to hike before the election, but the funny thing is that yields are pricing things in ahead of the Fed. And I think that's what Warsh's challenge is with these task forces. It's, how does the Fed communicate when the bond market is pricing things in faster than he can move? And how does he kind of contain that data and, kind of direct monetary policy with that in mind?
So with all that in mind, very quickly, do you anticipate anything big to come out of the whole task force discussions that Kevin Warsh is holding, where we're going to get some kind of resolution by the end of the year?
The most interesting task force for me is dealing with the liquidity mechanics, the reserve requirements, things like that. And the reason that's most important to me is because obviously Dalio has been out for a while kind of warning that we are going to need to consistently have extreme demand in the bond markets in order to be able to service the debt and still have a significant velocity of money in circulation to, provide growth. And in any way, if we get anemic demand in the bond market, we're going to have a real problem. And we know yields are Trump's Achilles heel because we've obviously seen that. Yep. And as a country, we're just very over-levered, both in the public and private sectors. You've got 60% of the populace living paycheck to paycheck, totally dependent on credit. And so that's the Achilles heel. And so I think that the task force, which I think it's the number 2, that looks at those liquidity mechanics is the most interesting to me.
All right, Frances, thank you so much. We appreciate it. Frances Newton, Economic Strategist and Chief Investment Officer for Tuttle Wealth Partners, based down there in Tampa, but up here in the big town today. S&P is down 10 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, the mega cap tech earnings beginning later with Google parent Alphabet kicking things off. Christy Mueller-Glisman at Goldman Sachs says, you know what, investors still want to know when spending on all that AI stuff is going to pay off.
We all know that technology booms usually have a bit of a J-curve. And the question is if there's a bit of a loss of patience from investors with regards to the hyperscalers recouping some of the spent money. But just to be clear, we're not leaning to the negative side too much. We're just worrying that investors at some point might lose patience.
Tesla, IBM also due to report later today. And you have shares right now of Google parent Alphabet up 0.4%. Tesla shares down 0.4%. And then also IBM, those shares down 0.2%. Overall, the S&P 500 down 11 points right now, 74.97 on the index. The Dow up 67 points. The Nasdaq Composite Index down 117 points. That's a decline of just about 0.5%. The Japanese yen hit a record low. Why do I care, you ask, John? Because of the carry trade, of course.
Okay.
Because Japan, low interest rates, low yen means you can borrow in Japan, convert your yen into dollars, and then put that to work in other markets. So it carries a lot of the risk. So if the Bank of Japan were to intervene to try to prop up the weak Japanese yen, bye-bye carry trade. Wouldn't make much sense anymore.
That would be a sea change in the markets.
Yeah, it would really. That's a lot of money that goes into overseas markets because of the carry trade, and
But my son is finishing up his semester abroad in Tokyo, so he's enjoying the strong dollar.
Is he speaking Japanese?
He's trying to.
Really?
He's eating a lot of Japanese food. He's traveling a lot.
Japanese, traveling a lot.
Spending his strong dollar.
Mm-hmm. My strong dollar.
Correction.
Thanks, Dad. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Scarlett Paul.
All right. Thank you so much, John Tucker, with our Bloomberg Business Flash. AI very much on our minds right now. And, we look ahead to some of the bigger picture issues that we need to resolve. And regulation is and has been coming up quite a bit. Our next guest suggests that perhaps we think about regulating AI the way that we regulate the airline industry. Gautam Mukunda is lecturer at Yale School of Management and a Bloomberg Opinion contributor, and this is exactly what he's written about. Gautam, just walk us through your thesis here about regulating AI using an FAA kind of approach.
Right. So let's think about this from, what the industry itself says is that this is a technology that will have not just gigantic economic implications, but gigantic security implications, right? That they're already finding evidence. This is technology that can help you do cybersecurity attacks, that can help maybe even with development of sort of chemical or biological weapons. That sounds like something that the government needs to step in, right? There needs to be some regulation of that when you talk about those kinds of risks. So that if you look at the industries and the areas where that risk has been successfully managed, the aviation just stands out. It's just head and shoulders above everyone else. I would say that if you could, you could tell people 100 years ago that you could go from anywhere in the world to anywhere in the world in 24 hours in safety so complete that it is safer to be on the airplane than driving to and from the airport. And the worst thing that would happen to you is you would complain about the quality of the pretzels. They would say that's a miracle. That is an astonishing achievement. And you cannot separate out that level of success and that level of innovation from the success of the FAA, the American regulatory agency, which has just led the world in regulatory safety. So if we've done so well with such an important industry, I think we can learn from that.
Is an argument to be made, Gautam, that we as society, it might be too late to regulate AI? Maybe it's already kind of out there?
So it is out there, but it's not. But the question is, it might be too late to eliminate all of the potential harms. But if we're looking at the curve and the curve keeps getting steeper and moving faster, it's not too late to obviate the worst ones, right? So the really big risks aren't there yet. You hear people talking about AI's use in biological weapons. That's a place where I've published articles, and we're still quite a few years away from that, right? So working with biological systems still involves a lot of handwork, involves people, it involves a lot of sort of tacit skills. that's there. But it is going away. So we want to have these regulatory barriers in place before we lose the safety that we sort of inherited.
So Chinese company Moonshot released Kimi K3, and we talked about this AI model and how potentially disruptive it could be. Do we think that China is going to move faster than the U.S. on regulating AI?
So this is a fascinating question, and there's clearly a lot of debate in China, and the Chinese regulatory state is quite advanced, and they have a deference to sort of technical expertise that we don't, that might allow them to do that. But when we think about these open weights models that are coming out of China, however impressive they are also very clearly sort of behind what the United States has. And in quite a few cases, they seem to be heavily based on American models, so much so that if you take Kimi and you ask it, what is your name? Its answer will be, my name is Claude by Anthropic, which is kind of a flag as to where they might have gotten that data from, right? And so what I would say is in this duality, what we've learned is aviation is an incredibly cooperative space, right? It's both competitive and cooperative. Everyone wants to have the world's leading airplane makers. It wants to have the world's leading airlines, but they also understand that we've all got to work together in order to make those safe. And what the FAA was able to do was to create international norms of cooperation by being the best regulatory agency in the world. So everyone in the world sort of looked at the FAA and took their lead from the FAA. That again is the same model we can do here, where we can get the Chinese and us to agree on a regulatory harmonization that might make it safe for everybody, because we know they can, because we've done it before.
What has China said on this matter, if anything, and as it relates to just broadly regulating or controlling AI?
Yeah, there have been some really interesting discussions, but it hasn't come out yet, right? So it's pretty clear that they have some concerns about the AI systems and their willingness to sort of talk about issues like Tiananmen Square. They've cracked down on that and made it much more difficult for these systems for their systems to do that. There are a bunch of other areas where they've talked about it, but so far it's been almost a surprisingly light touch. I think at least in part because the Chinese attitude towards these systems is very different from ours, right? The Chinese AI community is not consumed with the possibility of super intelligence or ending the world. They're sort of like, we're building these things and then we'll be able to apply them in factories and make our factories more efficient. That is a lot less likely to generate fear and, might actually be more likely to generate short-term economic returns too.
Okay, Europe is not exactly the leading edge of AI innovation, but Europe is very good on regulation. They spend a lot of time on that. Has Europe said or done anything that kind of creates a bit of a template?
So I would say not yet, and I want to sort of push that on when you say they're very good at regulation. What they often are is they have a heavier hand in regulation.
Yeah, maybe that's a better way to put it.
Yeah. But I think the American regulatory state that we established, up until pretty recently with agencies like the FDA was incredibly successful. We managed to get both high levels of safety and high levels of innovation at the same time. Those weren't in conflict, they were together. The reason that the aviation industry was able to progress so quickly was because people trusted that the American government would keep it safe. And so this is sort of a point that people in the industry who sort of keep it weakening supporting the weakening of the federal government or things like that, they are fundamentally misunderstanding the situation, and they should be really careful. They might get what they want for, what they're asking for. Because if they get a U.S. government that is too weak to regulate AI, what they will get is also an American public that rejects AI entirely and an industry that will die on the vine here.
30 seconds left. What has the Trump administration said on this matter, if anything?
They've started to talk about banning Chinese open weights models, and that's probably going to be my next column, because I'm not sure what I think about that, but that seems to me that is walking down a very slippery slope, because those open weights models are a big threat to the economics of our frontier labs, but they're pretty great for everyone else, so you're making a pretty striking trade there.
All right, Gautam, thank you so much. We appreciate it. As always, Gautam Mukunda. He is a lecturer at the Yale School of Management, and he is a Bloomberg Opinion contributor and joining us from Sweden via Zoom. What's he doing over in Sweden? Nice place to be. Good time of year to be over there. S&P off 12 points. The Dow up 60 points. The NASDAQ down 130 points. You see where I'm going here. There's no real direction in this market here, so that's kind of what we're calling out here. But we're going to get some earnings. After the close, Carol Massar, Tim Stenovic, they'll be bringing you IBM, Google, they're going to be important
Tesla
numbers.
too?
Tesla, yep.
Although, Tesla, what kind of company is it right now?
Yeah, I don't know. Is it just a call option on getting into SpaceX? I don't know. But we'll see how that plays out. But we get some earnings after the close. That'll give the market some direction, presumably.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. We got Tesla reporting numbers after the close. And quite frankly, as Scarlett was just asking earlier, I'm not sure how important these earnings are, you know, like deliverables of cars and that kind of thing.
Because people are not valuing Tesla on the fact that it's an EV maker, right?
Yep.
It's all about the promise of the future, autonomous driving, robotics, all of that.
So you'd like to hear Elon and what his vision is for Tesla going forward. Kara Carlson, she's going to pay attention. She's an EV reporter for Bloomberg News. She is based down there in Austin, Texas. Kara, what do you think folks are going to be looking for, listening for when Tesla reports earnings after the close today?
Yeah, so Tesla really lately especially has been very future-looking, very forward-looking. A lot of people are looking to some of these product lines that aren't really making revenue yet more than the auto business, which is making up the majority of their revenue. So they're looking to robo-taxis, they're looking to humanoid robots, and some of these future product lines, they're looking for key updates.
Looking for key updates there, are there any like magic numbers or certain benchmarks that people are anticipating that you will be listening for?
You know, we'll be looking for kind of their roadmap and more details on the robotaxi network, especially. We don't know a lot that Tesla has personally disclosed on, you know, number of vehicles, usage, the key details like that really get into whether they can stand up this robotaxi business. On the autonomy note, also things like full self-driving, software adoption, you know, these key autonomy drivers for them.
What is kind of the timetable that the company's laying out for some of these, you know, kind of EVs and autonomous driving and some of these futuristic businesses? What kind of timelines have they put out there?
You know, so far we've mostly gotten a few cities that were supposed to launch in the first half of the year. They've met most of these, but it's very unclear how many vehicles they're running in those areas. So I know investors are watching very closely for more details on that. And also, you know, what does the next half of the year look like? What does the next few years look like as far as launching these business lines? Cybercab, which is their purpose-built robotaxi, is a big area that people are watching for. That's supposed to be ramping production this year. So I think people will be looking for more detail on what that timeline really looks like as far as launching and integrating into the robotaxi network.
In terms of CapEx, does Tesla's CapEx guidance move the stock the way that it, you know, that kind of line item moves other stocks in the AI play?
Yeah, CapEx will also be a very big focus tonight. You know, Tesla has announced twice now 2 different numbers, the most recent being $25 billion that they plan to spend this year. And it's really even a number that traditionally Tesla is not a big spending all this money, spending all this investment in projects the last few years. So it's a number that makes people maybe have a bit of a pause, and they would love more details. I think in general, when I talk to analysts, I talk to investors about where's all this money going, outlining specific areas, and any color that Tesla does give tonight will be heavily watched.
What's the feeling out there among Tesla investors, I guess, as it relates to SpaceX? Is the expectation that at some point Elon Musk will just kind of roll Tesla up into SpaceX if for no other reason than to just make it easier to have everything under one roof? What's the thinking there?
I would say the majority of investors these days are thinking it's at some point. There's a lot of speculation on timelines. You know, we shouldn't necessarily expect Tesla to comment on that tonight. They've been pretty careful to avoid it, but it's definitely, you know, when that happens is a big area. A lot of people who do believe this is headed for a merger are really watching for. I mean, some people think it could be as far as 5 or 10 years away still.
Yeah, I know it's off in the distance, but we talk about it a lot. And in some kind of combination, Kara, do you think this would be a SpaceX acquiring Tesla or a Tesla acquiring SpaceX, a merger of equals, or will it be some super complicated transaction where you're not, there's a swap of equity and you're not sure who has the upper hand?
You know, those are details we really don't have a lot of color on. You ask, you know, 2 separate analysts, they'll give you 2 separate answers on that. I think
fair enough.
There's definitely a camp that would love to see a merger of equals, but we're really waiting for details on what anything could look like these days.
Is Elon, is he always on the call here for Tesla?
He typically is. He's been on all but one, to my knowledge, the last few years since I've started covering Tesla. And that's really also his tone, his kind of commentary that generally isn't in the investor material that they put out ahead of the call is really an area people watch very closely for details he might mention or things he's excited about.
All right, Kara, thanks so much. Appreciate it as always. Kara Carlson, EV reporter for Bloomberg News. She's down there in Austin, Texas. That's kind of where Elon's setting up shop. He likes Texas. He's all in on Texas.
Well, he's anti-California.
Anti-California. And there's a lot of people that are anti-California,
Yes.
and for good reason. They seem to be taxing the heck out of those folks out there.
Right, and they're fleeing to California, they're fleeing to Texas, they're fleeing to Florida, just getting out of California. Even though that wealth tax that has been under discussion hasn't actually gone anywhere. And Gavin Newsom, the governor of California, has made clear he is not for it.
Right. And I tell you, if you ever driven through Silicon Valley, some of those towns there are just absolutely spectacular, and the homes are spectacular. It's a beautiful part of the world. That weather's perfect. Close to Stanford, close to San Francisco, close to.
And then you have computer engineers who make six figures who are homeless.
Yes, they can.
And living out of their car.
It's been the whole housing issue out there is just extraordinary. It's a big issue, and you got to drive everywhere. There's no.
Yeah, and pay your $6 a gallon gas at that.
Exactly right. So there's always been a trade-off for those folks out there. Looking at the S&P, down 4 points. The Dow's up 59, and the NASDAQ is down 90 here. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global digital audio network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Brokers Studio in Midtown Manhattan. This is Bloomberg Intelligence. We're streaming live on YouTube. Paul Sweeney, Scarlett Fu, and John Tucker with you for the second hour of the program. We've got a very heavy tech and telecom earnings day, so we're going to dig right into AT&T's results with Kelsey Griffiths. We're also going to check in with Woo Jin Ho, our senior hardware networking analyst, on Supermicro's results, and of course, this on a day when Alphabet and Tesla will be reporting earnings after the close. Philip Morris also reported results, so Ken Shea, our senior consumer products analyst, is on deck to give us his recap of those results. And of course, looking ahead to those big results tonight with Mandeep Singh, our global head of tech research here at Bloomberg Intelligence. First, though, let's get you to John Tucker for a setup and our Bloomberg Business Flash.
Yeah, kind of on hold for investors today. Major averages, not much change. S&P 500 down just 3 points, 75.05 on the index. The Dow up 56 points, 52,276. And the Nasdaq Composite Index right now is 78 points lower. It's down 0.3%. So the pressure building for companies to justify all those AI expenditures, and that's certainly going to be on full display at the close of regular trading when we hear from Google parent Alphabet. Philip Morris, they did report a boost in demand for smoke-free products, even as they trim their profit forecast. So right now you have Philip Morris shares. They are 2% higher. I should mention Google shares ahead of the earnings results after the close of regular trading, up 0.4%. In the S&P 500, utilities and energy best performing industry groups in the S&P 500 as oil continues to move higher. Brent crude, the international benchmark, $94 a barrel right now. That is up 3.3%. Meantime, Aaron Kennan at Clear Harbor Asset Management says a lot is riding on these earnings.
I think the bar is high right now for earnings season, but we just may meet the bar. But the fear of missing out is also something that we've been seeing over the last several weeks, particularly as it pertains to semiconductors.
And mentioning semiconductors, the SOX, the Philadelphia Stock Exchange Semiconductor Index, today it's up at just about 0.5%. Here's something to chew on. So far this year, the long bond, the U.S. 30-year, has traded beyond 5% for 27 days. This is actually the longest stretch since the dawn of the financial crisis back in 2007, 2008. So it reflects investor concerns about increasing sovereign debt loads as well as sticky inflation. Can you say bond vigilante, maybe? The 30-year right now up, it's at I'll call it 5.14%.
Yep.
And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, John Tucker. The 20-year yield, if anyone ever tracks that, but it's not as actively traded, is even higher, 5.159%.
Oh, interesting. Okay.
But the liquidity in that is kind of thin.
Yep.
All right, let's get back to equities and check in with Avalon Purnell. She has our stocks on the move this morning. Lots of earnings to get through. Avalon, what are you keeping your eye on?
Yeah, we can start off with GE Vernova. That is ticker GEV. It's currently falling about 6.1%, and that's after the power equipment manufacturer's modest guidance boost disappointed the street. Jefferies writing that the robust cash and backlog visibility should outweigh the near-term margin pressure that analysts were definitely pointing out, and they do see a strong buying opportunity. Still, a lot of analysts noted that expectations were very elevated, especially as the wind business continues to remain under pressure, and that's making GE Vernova the biggest lagger on the S&P 500 this morning.
How about, I don't know, let's go Reddit?
Yes, Reddit. A big mover today, that's ticker RDDT, currently sliding about 9.4% most intraday since March. And that's after the Wall Street Journal reports that the social forum company has weighed blocking Google from accessing its content for AI use. RBC highlighting in a note that the reconsidering of this renewal would be a significant step backwards, especially as investor confidence only recently continued to build. And the report also revives the question of what exactly is content worth as the web continues to consolidate given this AI proliferation. So definitely an interesting one there.
All right. I am using Reddit more now.
Are you?
I
Really?
started using, but I find that I'm using Google to learn something. I'm using Reddit for like gossip on a topic.
Deep dives into something.
No, more just kind of gossip about
Gossip
something
on
I'm
what?
It's just something what are people saying about something I'm interested in as opposed to learning something.
Okay.
Is that how you use it?
I understand that. For like the New York City influencers, there is definitely a Reddit forum that you can find a lot of random gossip on, and it's just kind of funny to read every now and
I'm
again.
just wondering if I'm using it correctly. I don't think I am.
No,
I'm not getting the full usage of it.
I mean, I think gossip is a pretty good motivator for using Reddit. I can go with that.
That or like tech advice. You never know.
Tech advice.
One more, please.
Yeah, Supermicro, that's ticker SMCI, currently the best performer on the S&P 500 this morning. It's jumping 25%, most intraday since May, or now actually December 2024. And that's after the company provided a preliminary fourth quarter business update that noted while revenue is tracking toward the lower end of guidance, gross margins are much better than expected. KeyBank writing that this is a very positive update, noting that meaningfully better profitability and also $60 billion in orders are likely to drive confidence that Supermicro can continue to regain market share without having to put that margins on the wayside. So definitely some interesting news there.
All right. Thank you so much. Avalon Purnell is our Bloomberg News equities reporter. For more conversations like this, be sure to subscribe to our Stock Movers Reports, where we offer 5-minute audio reports on the biggest winners and losers in the stock market. You can find Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, staying with earnings, AT&T adding more wireless subscribers than forecast by roughly 100,000 customers. The CEO, John Stankey, joined Bloomberg Surveillance to discuss the rise in subscribers. Take a listen.
We can provide world-class networks in both wireless and fixed that tackle 98% of what a customer needs to do on the internet. Occasionally, they walk off one of our networks, and as you look at our partnerships that we're working with the satellite industry, by this time next year, we'll be able to solve that problem. And so we're the natural place for people to come and meet their needs on the internet and do it easily on one bill with one set of services and one support infrastructure. We think we're in a great position as a result of that.
Kelsey Griffiths is the Bloomberg Telecoms reporter. She has been tracking the earnings today, and she joins us right now from Washington. Kelsey, the mobile phone industry is extremely competitive. We are bombarded by ads constantly from AT&T, Verizon, and T-Mobile trying to undercut each other and offer better terms, better deals. How is AT&T able to add more monthly wireless subscribers than expected in this kind of environment?
This is a strategy AT&T has put into place since about last quarter. So back in March, they debuted this new plan that is kind of like an all-in approach. They were modeling it after Peloton or Netflix or one of these sort of like tech lifestyle subscriptions where you pay one price and you have access to everything that you hope to get out of it. So AT&T's version of that is one price, you get home internet, you get mobile service, and you get a few connected devices like iPads or Apple Watches thrown in. So that seems like it's been pretty successful. They have introduced some price increases on, I believe, with some of the more legacy plans. That was about $10 to $20 per line. But even with those increases, it seems like customers are responding to some of these newer offers.
Kelsey, talk to us about their return of capital plans going forward, because I know that's a big part of the investment story.
Right. AT&T has said for a while that they are heavily invested in returning back to their shareholders. And today they announced that they're pulling that forward a little bit. I think they said they're going to buy back $10 billion instead of just $8 billion in shares this year. So that's a modest uptick that kind of contributes to that optimism that they're expressing in their long-term strategy and growth.
I want to just go back to the competitive market landscape for AT&T and the other mobile operators for a moment here, because there's been talk that SpaceX might enter this space. So what's already hyper competitive will get even more so. What is the latest on that front?
That's right. We've seen all three of the big telecom carriers stocks take a pretty substantial hit over the last several weeks as speculation about what SpaceX might be up to has sort of taken off. The telecom carriers have all so far made it pretty clear that they don't want to do any deals that would offer SpaceX access to the market as a peer, but at least T-Mobile is working with SpaceX to fill in some of the gaps in T-Mobile's terrestrial network. That was kind of what John Stankey suggested today. He didn't say specifically that he wants to do a deal with SpaceX, but he did say that he sees satellite generally as being very complementary to the ground-based network that AT&T has, and it could actually potentially help them make their revenue better because they can fill some gaps in their network with satellite and potentially retire some parts of the network that are very expensive to maintain.
CapEx, Kelsey, it's a capital-intensive business, this telecom business. Did the company mention kind of what they're thinking in terms of CapEx going forward?
Well, I can tell you that John Stankey is very bullish on, or at least very aware of how agentic AI is changing the network traffic patterns. And so I think he said he expects to see 9 times enterprise growth in agentic AI by 2035 and 7 times the volume of agentic AI on the consumer side. So those massive increases in essentially AI-driven traffic are things that he's planning for, and they do have a strategy right now, and they're not adjusting that strategy necessarily to account for in their
CapEx. Got it. All right, Kelsey, thanks so much. Appreciate it. Kelsey Griffiths, telecom reporter for Bloomberg News. She's down there in D.C. I'll tell you what, on the beach and the weekends, cannot get a cell signal because there's too many people there clogging up the system. So they could put up another tower.
Do they have Wi-Fi? This is a dumb question, but maybe someone at the beach.
No, you can steal somebody whose house is across the street, but
No, at our clubhouse.
Of course.
You got to type in the password.
Yeah. Out in the rough and tumble Jersey Shore, no. But on the weekdays, it's fine. But notice.
Do you have the option for satellite service if you wanted to?
I don't know. I don't know.
I have T-Mobile, and then it'll say SOS, and then you
what
can
is
try to
SOS?
get.
Is that the
well,
satellite?
that's for emergencies only,
Okay.
and I'm not sure how that works because I haven't actually used that part.
Okay.
But I think I can get satellite service if I'm willing to be outside and scan my phone around to try to get the satellite service. It hasn't worked.
It's tough. I'm just telling AT&T, put up another tower or something. Let's stay on the earnings front. Supermicro jumps after early results show rising backlog. The stock is up 24% today. Just extraordinary. So let's talk to the analyst who covers Supermicro. That'd be Woo Jin Ho. He's in our Princeton office. Woo, talk to us about Supermicro. What did they say with the results, and why is the stock up so much today?
Yeah, hey, Paul. So essentially, it was that stunning backlog figure that they posted, right? So if we think about a month ago when they did an equity raise, they announced that they had $39 billion in backlog at the start of June. That increased to about $60 billion as part of the pre-announcement. So what happens now is that the setup for fiscal 2027 guidance is going to be really, really good. Consensus prior to the backlog guidance was at $53 billion for 27. I'd be shocked if they don't exceed that.
So if Supermicro sees this kind of backlog, what does it mean for its peers, for its competitors? Are they getting a similar lift?
Well, I mean, that's a great question, Scarlett. Dell is the market leader in AI servers. I suspect that Dell is going to see similar demand patterns as well, right? Because typically these type of mega deals, AI server deals, are dual source. So if Supermicro is benefiting, Dell is benefiting as well.
And Dell stock is up 10% today in sympathy, so that probably tells the story there. Wooj, how does the memory shortage, the chip shortage, and all that kind of stuff, how does that impact the Supermicros of the world? Because it doesn't seem to be much of an issue.
No, so we did some analysis on that. From the AI server front, it's clear that given the demand for AI servers and the demand for compute, the neo clouds are more than willing to absorb those costs. Now, what's happening on the traditional servers, right, the stuff that powers our own enterprise data centers, customers are desperate for compute because the rising memory costs. They want to avoid the inflation of the server inflation. So they're actually, I don't know if they're pre-purchasing or pre-buying, but they are buying. It hasn't affected the server business at all. If anything, the vendors have benefited.
Okay, as we mentioned, Supermicro shares up about 24% today, so getting a big lift, but still, well below the highs that we saw in early June. So, Woojin, this was a preliminary result. The company will actually formally report its quarterly results in mid-August. Have we seen all the upside here, or is there something that the company might withhold until the actual results that could give this stock another kick?
Yeah, so the thing that we're waiting for right now is the gross margin guidance for 27, Scarlett. Look, they gave they expect phenomenal gross margin, 15 to 17% for the fiscal fourth quarter, and they guided to previously 8.2 to 8.4%. Look, I think it was one mega deal that helped them raise that guidance. I do expect gross margins to come down in 27. But I suspect that there is an uptick in gross margin overall from the 8% that they delivered in 26 to around 9 to 10%. If that's going to be the case, given that the leverage of the model, you could start seeing a substantial uptick in earnings in 27, even with the dilution from the equity raise.
30 seconds left, Wooj. What is the revenue visibility for a Supermicro? Seems pretty solid.
I mean, from a quarter-to-quarter basis,
yeah.
I mean, Paul, they've missed their guidance for the past 3 to 5 quarters. So their execution has been choppy. But from a full-year basis, it's actually been up and to the right, given how these data centers have been sprouting up, and they've been really wanting to get the NVIDIA chips in their buildings as quickly as possible.
All right, Wooj, thanks so much. Appreciate that. Woo Jin Ho, Senior Technology Analyst for Bloomberg Intelligence. He's down there in our Princeton office. You can't get those guys out of the Princeton office. Great breakfast, even better lunch. Awesome.
So 2 meals are taken care of.
Done, dusted, because there's nowhere to go down there.
As opposed to, buying a $20 salad here in Midtown Manhattan, a sad salad at that.
Yes, exactly. And I guess when EV started, we had 2 EV charging stations now. Now I think they got like 200 down there in Princeton. Yeah, and they've got the solar panels out in the field behind the building too.
Sounds like Nirvana.
It is. They know what they're doing down there. So and you can't get those goods. Hey, Wooj, why don't you come up to New York? And
No, thank you.
Not happening.
But you can entice them with a steak dinner.
Yeah, I do that time to time. So whenever you do see a Princeton person up here in New York, it's because somebody's buying them a meal. That's kind of how it works. S&P up 5 points, the Dow up 75 points, the NASDAQ down 25 points, zero direction in this market here today, but that's all right. Oil is
We're waiting for
higher.
earnings. That's how it goes.
Wait for earnings. We'll do that. That's coming up after the close. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. All right, so the mega cap earnings season kicking off. Alphabet reports after the close of regular trading. Everybody's looking for Alphabet's results to demonstrate some sort of clear return on all those massive investments. You're also going to get after the close Tesla and IBM. Brent oil briefly spiking above $95 a barrel. It's paired some of the earlier gains, but still up 3%, 93.88, because of the war with Iran. That's also lifting bond yields on inflation concerns. The 2-year 4 basis points higher. That is at 4.30% right now. Overall, the S&P 500 6 points higher, 75.15 right now. The Dow Jones Industrial Average up 120 points, 52,342. The Nasdaq Composite Index 20 points lower right now. That is down just a 1/10%. Apple, we're getting a lot of Apple news lately. They are preparing an overhaul of the Mac line. They're going to have new versions of every Mac they sell. They have recently gained a following among people who run computing-intensive AI agents. In fact, it's kind of the backbone for a solo entrepreneur. Is you just get like 3 old MacBooks, link them together with things like OpenClaw, and you can pretty much.
That sounds complicated.
Well, you can do all the stuff you don't want to do, like you can get the marketing, do the books, all that good stuff, and frees you up to have coffee and lean back in your chair. We check the market's view all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right. Thank you so much, John Tucker, with our Bloomberg Business Flash. We are awaiting a whole slew of earnings this afternoon. IBM will be reporting, Alphabet will be reporting, Tesla will be reporting. It's very much all about the tech trade, the AI trade more specifically. Anna Rothbone is joining us right now. She's CEO of Grenadilla Advisory, joining us from Cleveland, Ohio. And yes, we'll get to the AI story momentarily, Anna, but I do want to start off with tariffs because it's very much on the front page, the virtual front page these days, but I'm not sure it's having much of an impact on the markets or if investors care about it. The president has threatened tariffs on Canada. Now he's threatening to impose tariffs on generic drugs, generic drug makers if they don't move manufacturing to the U.S. How are you thinking about tariffs and the return of tariffs as a market theme?
Yeah, we kind of knew this was coming because when IEEPA was struck down, we sort of had a temporary measure of 10% tariffs across the board, which the president could do, but it expires, right? So now we're coming up against expiration, and what we're seeing is President Trump going at different sectors and different commodities and putting tariffs on them. And that is something that is within the power of the executive branch. I'm not sure the markets care, to be honest, because we were expecting it. And, if we've learned anything since Liberation Day, these tariffs are actually temporary. It's used to bring people to the table and have negotiations. So, if you're a company trying to project and plan for 6 months, a year, 5 years, it may not matter to you that much.
So, Anna, given that backdrop here, maybe the market can focus a little bit more on earnings, which have been very, very good coming out of the S&P 500, particularly in their first quarter, and the second quarter seems to be in a pretty good starting spot. What are your expectations?
Well, I think the expectation going into this quarter was around 22%. It saw 25% year-over-year earnings growth. That's a pretty high bar. And I think a lot of that beat is expected to come from tech companies. And we do expect it. It's just that, how are the prices going to react? And, Alphabet earnings this afternoon is going to set the tone for the rest of the tech companies or AI-related companies. And as everyone knows, the focus is on ROI. I'm not holding my breath. Just to let you know, I'd rather be surprised on the upside of having an ROI that I don't expect. But frankly, I really think it's going to take a long time for these hyperscalers to actually achieve ROI that investors would be happy with.
Right, and I guess that raises the next question. How patient will investors be with that ROI coming through? I mean, what can Alphabet show for the second quarter of 2026 in its results this afternoon that would make people feel okay with whatever CapEx number it does give us?
CapEx number has just been growing. So, we shouldn't be surprised if that number grows again. I would love to see cloud earnings growth, right? And that has been growing, and we've seen that over the last several quarters. But I think there's a little bit of a misunderstanding of what kind of return we're expecting from these companies. Google, Microsoft, Amazon, Amazon has been in the web services, but they're kind of turning into an asset-heavy AI infrastructure services company, right? So, and when you build these things, even if the demand is really high, backlog is high, backlog doesn't mean revenue right now, right? So I think there's a little bit of a mismatch of timing in our expectations. It's one of the reasons that I'm not expecting too much. I don't think there's anything Google can do. They just have to keep building it and continue to rent it out, right? So I think it's really more on us to set where we set our expectations.
Anna, what's screening well for you these days? What's the conversation you want to have with your clients these days, whether it's stocks, bonds, commodities, wherever?
You know, leverage has been increasing, and that's something I'm watching very, very closely, especially with these hyperscalers. I'm leaning toward quality, certainly quality of balance sheet, free cash flow, operating margins, et cetera. But quality looks different today than it did like 3 years ago. We had gotten pretty comfortable leaning on some of these hyperscalers as quality names, but it's not that they're not quality, but we do have to take a second look because of all the leverage that's going up. So these are the conversations we're having. There's the stuff that we used to be able to depend on may not be as dependable, and it may mean something as small as, you know, just changing the weights a little bit and looking for other opportunities.
Okay. Then what are the new utilities in 2026?
Well, the new utilities seem to be these hyperscalers. I mean, even if you think about SpaceX, inside of it, the AI company is really turning into an infrastructure company too. I mean, recently there was news about, I can't remember, is it AMD? It was a company that actually is partnering with SpaceX to make data centers. So, you know, infrastructure is changing, utilities is changing. It's not just about energy. Energy certainly is one of them, but I do think that data centers and all of these web services are going to be so important in our lives, they end up becoming like utilities.
All right, Anna, thanks so much. Appreciate it. As always, Anna Rothman, Chief Executive Officer, Grenadilla Advisory, based out there in Cleveland, Ohio. Cleveland's like the great music school out there.
Oh, yeah?
Yeah, I forget the name.
Cleveland is home to Case Western, right?
Yeah, but Anna's a trained professional singer.
That's
she's,
different.
Yeah, big time. And that's Cleveland's got a great Philharmonic out there. So I'm told from the folks who know this stuff. More earnings here today. Philip Morris thinks cigarettes. PM is the ticker. Some numbers out today. Stock's up about 1.65%. Stock's at a 52-week high, up 19% year to date. Plus, you get a 3% dividend yield. So Philip Morris shareholders have been quite happy. Let's bring Ken Shea. He's been following this company since the beginning of time for Bloomberg Intelligence. He's seen all the iterations of Philip Morris and Altria and all that kind of stuff. So, Ken, talk to us about what we saw from Philip Morris today.
Yeah, hi, Paul. Yeah, Philip Morris's numbers today were really good. The headline numbers, top line 10%, beat 5% expectations. EPS up 15%. Expectations were for 7%. You know, initially, despite those strong numbers, initially the stock in the pre-market was down, and I was scratching my head. And I guess it was because they lowered their guidance on a after currency basis. In other words, this company is very international, hence the name. And they said, look, you know, currencies are not going to be quite as favorable as we saw last quarter, but our adjusted currency numbers, we're still looking for high single-digit EPS growth. I think when investors digested that, they got bullish again.
Right. Philip Morris is basically the international business, right? I mean, Altria is the domestic business, and Philip Morris, I believe, sells Marlboro cigarettes outside the U.S.?
That's right, Scarlett. In the late 90s, I should say 2008, I believe it was, this company split. Philip Morris International basically took the Marlboro name and the franchise outside the U.S. Now, Altria, a holding company, owns PM USA, which owns the Marlboro name in the U.S. Since that time, though, the two companies have agreed to allow PMI to sell non-cigarette tobacco products in the U.S. And that's why you're seeing them sell Zyn, you know, the nicotine products, and soon they're going to launch their heat-not-burn vapor product in the U.S., a big potential growth market.
What is Zyn? It's all over social media. Can you explain this to me?
Zyn is an oral nicotine product, Paul. It comes in those little round cans, maybe plastic containers. But in it, you have 20 pouches that you can get your nicotine buzz. It's a non-tobacco product, tobacco-free, and you get your nicotine buzz without the ire of your neighbor at work or on the subway or whatever, getting annoyed that you're smoking or vaping next to them. So it's a very discreet way of getting your nicotine, and it's doing really well. A lot of smokers are switching over.
Interesting. All right.
Is it like nicotine gum? Is it meant to kind of get you off of smoking, or is it just a flat-out replacement? I mean, is the idea like a smoking cessation device?
It's mostly that, yes. Yes, Scarlett. And that's what the intent is. And that's why the FDA has granted it recently the authorization to promote it as a less harmful source of nicotine as opposed to cigarettes. It's the inhalation of carbons that causes the harm. The FDA acknowledges that if you get your nicotine, through your mouth or whatever, it's bypassing that harm. Not to say nicotine is completely safe, but it's a much less harmful, form of nicotine ingestion.
All right, Ken, thanks so much. Appreciate it. Ken Shea, Bloomberg Intelligence on Philip Morris. Here's my Philip Morris story. Senior at the University of Richmond, Philip Morris, based in Richmond, go to an interview. I had heard the stories that they smoke in the interview to see if that bothers you.
Oh, interesting.
So what I did is I came in with a photograph of me when I was like 2 years old, sitting on my mother's lap. She had a drink in one hand and a cigarette hanging out of her mouth. And I'm like, dude,
that explains a lot.
You can't exactly.
Did you get a job offer out
I
of
did
that?
not, unfortunately.
But it got a good laugh.
You can't intimidate me, dudes. I grew up in a house where my mother's smoking with a kid on her lap, so that's how we roll. So, but anyway, there's still a huge presence down in Richmond, Virginia. So that's cool to see. Altria Group is still based in Richmond,
Are there things
Virginia.
named like Philip Morris in Richmond, Virginia?
Yes. Yep, absolutely.
I would imagine.
And they have the old tobacco warehouses downtown, which have all been converted into
Lofts?
stores and restaurants. Yes, and lofts and all that kind of stuff. So they've done a good job there. Chaco Slip is what it's called down there. All right, so let's look at these markets. S&P's up 6, the Dow's up 140, the Nasdaq's down 30. I mean, just no direction. Waiting for 4 o'clock to see some of these tech names, see whether you get on the bandwagon or off it. I'll tell you where there's movement is in oil prices. WTI crude oil up 2.8% here today. That's $86.70. We were at 88 and 60 cents earlier today, so coming back a little bit, but still higher on those tensions. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Kind of something of a holding pattern right now ahead of Alphabet's results. They come after the close of regular trading. Utilities and energy among the best performing major industry groups in the S&P 500 right now, as oil pushes higher with the little prospect of any resolution right now to the war with Iran. We have oil up over 2%, 93.41 on Brent. WTI is up $2 a barrel, 86.32 right now. Supermicrocomputer, best performing stock in the S&P 500, up over 24%. This is the server maker. They issued preliminary results saying the backlog there hit a record on new orders. And then on the other side of the ledger, GE Vernova among the worst performers in the S&P 500. That's down over 6%. The power equipment manufacturer raising the full-year revenue outlook, but investors wanted more. In the meantime, Phil Orlando at Federated Global feeling positive about company earnings.
First quarter revenues up about 12%, earnings up, I don't know, maybe 28% or so. We're looking for comparable numbers in the second quarter. Profit margins were record high in the first quarter. We're looking for comparable numbers in the second quarter. So there's nothing wrong with revenues and earnings.
Right now, the S&P 500 up 8 points, 75.17. The Dow up 149. The Nasdaq Composite Index 22 points lower right now. CVS expanding into pet health.
Sure.
They're now filling prescriptions for Fido and Raffi, that was my cat, at its pharmacies nationwide. Pet prescriptions eligible for a lot of the same pharmacy services as their owners.
But it's not covered by insurance.
You get pet insurance, though.
I know, but do they cover pet prescriptions to the same extent that human insurance covers prescriptions?
I don't know. Anyway,
Is there PBM for pet insurers?
I hope not.
Well, maybe we can start a new business.
There you go.
Last year, pet owners spent more than $40 billion on vet care and related. $40 billion.
There are a lot of anxious dogs out there. John Tucker. Yes, during the pandemic, they got very accustomed to having their human at home.
You do, right?
Yeah, I have a dog, and she is anxious, but she doesn't take medication.
Oh, okay. Well, maybe,
but there are dogs that take medication.
Maybe she
for
should.
their anxiety.
We check the markets for you all day long, right here on Bloomberg Radio. I'm coming home. Scooty, Raffi, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg business.
Owner of how many pets?
No, I don't have any more. Those were the pets.
Oh, okay.
I should have given more prescriptions. Maybe they'd still be here.
All right, John Tucker, thank you so much. We appreciate that. Scarlet Fu, Paul Sweeney. We're here in the Bloomberg Interactive Broker Studio, streaming live on YouTube. Back in the day, when I was at First Boston, I was part of the group that took Google public. You can blame me and some of my padres for revenue X TAC and all that silliness.
Right, X traffic acquisition cost. That's the number you always have to look at.
Yeah, we came up with that one. But
Clever.
I couldn't do it now. I have no idea. I mean, Mandeep's talking about monthly tokens processed reached 3.2 quadrillion in May,
What
up
does that
7
mean?
times year over year from 440. What is this company anymore? Mandeep Singh joins us, global tech research lead, Bloomberg Intelligence. Is Alphabet even a search company anymore? What's going on there with my Google, which we had a great name until you guys screwed it up?
I mean, Google is still a search company. It's just search, the way it used to be done was algorithmically. Now there is a new way to do search, which is the LLM way. Use a lot of compute to search for information. And that is why it's a big opportunity for them, as well as in the long term, a challenge for their core business, the cash cow, search box that we have accustomed to. But clearly, they've benefited on the one hand with the cloud side of the business, and that's been on a tear. They see a lot of growth, huge backlog, $460 billion in backlog. But it's the core search ads business where I still have my worries. It's just they haven't showed up yet. And at some point, I think will start to worry about that ads business.
We'll start to worry. What's going to be the first sign that we need to worry?
When your Anthropics and OpenAIs of the world double down on ads. I mean, right now, this is a model that is driven by consumption and subscriptions. There is no freemium aspect to Anthropics models because it's so, expensive to run the compute. You can't offer it on a freemium basis and then hope to monetize it through ads. And that's why these companies have strictly adhered to a consumption-based model where you pay for token usage. But once they launch ads, which OpenAI has dabbled into ads, it's just they haven't really been successful and they haven't scaled it. That's when it could be a problem for someone like Google.
All right. I don't know if I'm representative of anybody out there. I type into my Google search bar, blah, blah, blah. I just take the Gemini thing that comes up. I'm done.
You don't click on anything else.
I don't click on anything.
That's a problem for
That's
all
a
the
problem,
other companies.
Right? Am I the typical user out there?
Well, a typical user right now is also using ChatGPT for a lot of their searches and Anthropic.
But for Google, I can't believe I'm as profitable or as valuable a user to their advertisers as I was before. Because I'm not clicking. I'm not scrolling down and.
Well, they're still showing you ads in Google AI overviews and AI mode. So even though you're not clicking, Google still gets paid for the sponsored ads that they are showing in that search page. And you're right about the click-through. So the click-through rate certainly has gone down. But where else can advertisers show up their ads? Google still has the traffic along with Meta. So from that perspective, it hasn't hit their ads yet, but I agree with you. At some point, it will.
But it'll hit their partnerships, right? Because Reddit is down today on a report that it may cut Google's access because people like Paul are not clicking on the link to go into Reddit. He's just looking at the, the Gemini summary. If Reddit does cut off Google's access and other websites, other companies follow suit and do the same, how damaging could that be?
I mean, in the near term, I think it's going to hurt Reddit more than it hurts Google.
Right. And we're seeing that in the share price.
Yeah, and look, I think Google has the advantage that it will give you the information through their own LLMs, Gemini, through other publishers. So even if Reddit cut off the native access to Google, I think, Reddit results won't show up in that top 10 links. But in the end, I think Google will still give the users the experience they want in terms of helping them find information. And look, it's a bigger debate. At the end of the day, these LLMs are more truth-seeking than the prior search era where Google had an algorithm to surface the top 10 links. And if you met their algorithm criteria, your results would show up in the top 10.
Right, you're golden.
But now with LLMs, it's like, they really have a different way of finding information, using a lot of compute. There is no algorithm. So I feel search as a whole is changing. And that's why Google is still a search company, but they get a lot more revenue by serving the compute layer now through their chips and their cloud infrastructure than through the search algorithm where they generated all of their free cash flow.
I love how he brought that back to where you started.
Yes. And I don't know. I made my money on the IPO. I'm happy. So, I kind of look at the search business. I'm like, fundamentally, that has to be at risk. Now, that's okay if my cloud AI business within Alphabet can offset.
Yeah, it's still a $400 billion company growing 20%.
Yes.
What more can you ask for?
Well, if it's going to spend billions of dollars on CapEx, then we want more.
I think they have the right to spend because they are growing 20% at their scale. So, and they generate around $125 billion in free cash flow. So that's where they get that right to spend. But clearly, there are a lot of moving parts. And you could say Waymo could be a big growth driver down the line. We aren't even accounting for that. So that's the beauty of Google's business is they've got a lot of, different businesses within that Alphabet family. And even though search is under pressure, you've got YouTube, you've got Waymo, you've got cloud infrastructure. And that's why I think people are still positive on the whole.
Stock's up 11% this year. It's up 80% over the trailing 12 months. I tell you, I would have shorted this thing. The first thing I totally wrong yet again, which is why I do this and not trade other people's money. So Mandeep, thanks so much. Appreciate it. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence. It's Alphabet. I don't even recognize you from 2004.
Well, yeah, it's called Alphabet. That's the other thing.
Yes.
You pointedly refuse to call it Alphabet.
Exactly.
You call it Google. You call Meta Facebook.
And we took the company public 22 years ago. So there you go. I guess some things change, even especially in the world of technology. All right, let's switch gears here. Let's get to the banking sector. Wells Fargo CEO Charlie Scharf spoke exclusively to Bloomberg's Romain Bostic on Bloomberg Open Interest. He told Romain, quote, "These times are really good for banks," end quote. He also says that the firm is being very disciplined about adding investment banking resources and that they're big time bullish on the U.S. Let's take a listen.
It's not a turnaround story. The company was always very strong. We always had a great franchise, but we had to fix things that needed to get fixed inside the company. But from our customer standpoint, we were serving them every day. We were making loans. We were taking deposits. We were constrained on growth, but we were there providing what we did day in and day out. And financially, we were still doing okay. And when we looked at what we were able to deliver, we're not able to grow our balance sheet. We've been focused a lot on efficiency inside the company. We've been focused a lot on growing our fees inside the business. So our corporate investment bank has grown very nicely. Our credit card business and credit card spend is growing very, very nicely. Focused on building treasury services, and now we can grow the balance sheet so we can more holistically serve customers. And that's what you see when you look at the results of this past quarter, with earnings per share up 25%, revenue growth double digits, growth across every one of our businesses in terms of revenue. We're certainly in a different place, and our goal is to be viewed as the best financial services provider in these businesses in the country.
How much of that is because of Charlie Scharf and the executive team, and how much of that is because of market conditions and economic conditions?
Well, I think it's predominantly because of the quality of the franchise and the broad group of people that work at the company. Listen, what I and the new management team have been able to do is get people focused, create a different set of priorities, but a lot of people execute day in and day out. And the fact is, the markets do help. So there's no question that, I mean, these times are really good for banks. And so if you're not doing really well as a bank today, there's something not quite right with either how you're executing or what your strategy is. And that's not lost on us. But again, we look at the underlying metrics of each business. We're growing our consumer checking accounts. We're growing commercial banking customers. We're growing the kinds of loans that we want to grow. We're taking the risks that we want to take that we think will provide strong returns over cycles and not get over our skis and not pretend that it's all us. Some of it is the markets for sure.
You just reported earnings, and the number that I think jumped out for a lot of folks was the growth in the investment banking business. You've been on a hiring spree there. Does that continue, that build out?
Yeah, so we've been on, I would call it a disciplined path to growth in our corporate investment bank. We're a huge lender to corporates of all sizes in this country, large corporates down to middle market companies. We provide treasury services, and what we're doing is building on those relationships with a stronger set of products and services, coverage groups, M&A, underwriting capabilities. And so we've been very disciplined about adding resources in a sequential way, seeing that they're paying off, and we're seeing the results. And so, yeah, we would expect that to continue as we move towards our ambition of being top 5.
All right, that was Wells Fargo CEO Charlie Scharf speaking with Bloomberg's Romain Bostic on Wells Fargo, putting up some solid numbers for sure. Still a hard pivot here. We can do that at 11:53 in the morning. Let's talk about the EV business. Why? Well, Tesla's going to be reporting numbers after the close, so that'll certainly be top of mind for this market. One of the key issues for the EV business globally has been batteries and kind of the quality of the batteries, the cost of the batteries, the life of the batteries, and all that kind of stuff. Evelina Stoico joins us here. She is head of battery technologies and supply chains at BNEF. Evelina, talk to us about where we are in just batteries globally, because it seems like there's the U.S. and then there's everybody else out there that are really making inroads. Where is the battery storage market these days?
Yeah, so batteries play an increasingly important role when it comes to EVs and stationary storage because they make up a very big part of the cost. So there's a lot of technological know-how, and their cost is a big part of it as well. So a lot of companies have been focusing on making them better and making them cheaper in order to make EVs and stationary storage more affordable. And as you said, I think a big issue is whether the world can compete with China. So far, China has the lead when it comes to both technology and especially cost due to massive economies of scale. So it's a big question whether other regions are going to be able to catch up.
So why? So China, is there battery business? Is there EV business? Is it subsidized by the government?
To some degree, China has been building its battery industry for a very long time, and the government has played a very big role in supporting it. And now they're able to basically reap a lot of the benefits from scale.
What percentage of the world's batteries come from China these days?
It's quite a big percent. If we look at manufacturing capacity, I think they have over 60 to 70% of the global manufacturing capacity. So most of the batteries come from China, so both domestically and imports.
It just feels like, you know, outside of the U.S., companies like BYD, the Chinese auto manufacturer, EV manufacturer, it seems like they're going to take over the world. I mean, what's the feeling about China just as an EV competitor globally? I mean, it seems like they can, in fact, take dominant market share everywhere, except the U.S., of course.
In a lot of markets, they do play a very dominant role, but what we're seeing is that a lot of the local players and local governments taking measures to support their industry. And a lot of the legacy automakers outside of China, they also do have a lot of important know-how and a very established business in many regions, including US and in Europe and other markets. So we're starting to see them picking up, introducing new EV models, and basically trying to compete.
I know some governments have imposed tariffs on Chinese batteries. Are they making any impact?
Yeah, the most important market is the U.S. So the U.S. imposed very hefty tariffs on China, so that does make a difference. However, we don't see similar tariffs in other parts of the world, so it's mostly focused in the U.S.
So are we going to have, I mean, President Trump and others would like to reshore and friendshore a lot of manufacturing. Does that include EV batteries? And are we, in fact, making inroads here in the U.S. to build more batteries?
Yeah, that's another great question. We do see that, especially a lot of Korean and Japanese battery manufacturers. They have long-form partnerships with EV makers, and we're also seeing companies trying to bring ESS cell production as well. So outside of EVs, trying to onshore that because of favorable tax credits and the opportunity to create something that is cost competitive to China.
How about the rest of the world? I mean, is every country making batteries or just a select few? Because it seems like in Europe in particular, the adoption rates for EVs are so much higher than they are, say, in the U.S., and therefore I would think the battery infrastructure is much better outside the U.S. than it is here. How are they doing it?
Yeah, in Europe, we've also seen policy supporting it. In many cases, it's been in the form of targets, not funding, so it hasn't been as direct and as effective, if we can call it, compared to the US. And in Europe, we're also seeing a lot of Chinese battery manufacturers setting up facilities there, which is not the case in the US. So the view is slightly different there.
What's Tesla doing with their batteries? Where did they get their batteries? Did they make their own?
Yeah, so Tesla has a long partnership with Panasonic, which has been very successful, especially in the U.S. They were able to produce batteries themselves, being one of the first, if not the first. And as a result, they were able to get that know-how and make it cheaper, making it an advantage for their EVs.
Withdrawing the subsidies, the credits for buying an EV in the U.S., that really, or let me ask it this way, did that set back the industry?
It did, as if and any policy change and any movement is going to have an effect on adoption if an incentive is being taken away. However, we're at a point with EV adoption and technology where economics are driving a lot of the adoption, so we're entering that phase when it comes to EVs and batteries.
All right, we'll stay on it. Just again, there's the U.S. going at a roughly slower rate in EV adoption versus the rest of the world. That is becoming seemingly more pronounced over the last couple of years. Evelina Stoico, thank you so much. We appreciate that. She's head of battery technologies and supply chains at BNAF, joining us here in our New York studio. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121, access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. Looking at the markets here as we close out the morning session. S&P's up 12 points. The Dow's up 170 points. That's about 0.3%. And the NASDAQ is unchanged so far here. The VIX for Tom, just below 17 here, so nothing moving there. 10-year Treasury yields up a couple of ticks here, 4.64%, but it's about oil up $1.70, $86 a barrel. We'll have more coming up. This is Bloomberg.
From ABC News, I'm Michelle Franzen. In Delaware, President Trump and Pentagon officials, along with families, attended the dignified transfer at Dover Air Base for all 4 U.S. service members killed in Iranian attacks last weekend. First Lieutenant Tyler James Feehan of Hawaii, Sergeant Angel Rampersad of New York, and Private Isabella Gonzalez of Texas, all killed in Iranian strikes at a U.S. base in Jordan. Sergeant Michael Swinton of North Carolina was killed in Iraq during a controlled detonation of a downed Iranian drone. President Trump, before attending the solemn military ritual, telling reporters what he would say to families.
All I'm going to say is we love you, we love your child, and that's what they are to them. They're their children. There's no games, no nothing. That's their child.
18 U.S. service members have died since the war with Iran began February 28th. The U.S. military continues strikes against Iran now for an 11th straight day of renewed hostilities. Secretary of State Marco Rubio at the Asian Summit in Manila defending the ongoing war and says Iran wants to talk.
Iran has been reaching out to the United States, both directly and indirectly, to engage in talks about settling the differences with regards to what's happening in that part of the world. Unfortunately, so far, even though we have reached agreements, they have not kept their commitments.
In Mississippi, the family of Nolan Wells released findings from an independent autopsy. The teen died following a boat trip with friends July 4th weekend to Horn Island. His body found days later. Authorities say their preliminary investigation suggested Wells drowned. Wells' family attorney Benjamin Crump reading the preliminary autopsy report at a briefing today.
Cause of death undetermined, pending investigation.
Crump says the report also stated that Wells's body was missing the throat organ, which is a standard practice in autopsies, but could be needed here to investigate the cause of death. Tropical storm Bertha churning toward Gulf states. The storm expected to make landfall later today in southern Louisiana. You're listening to OpenAI confirms 2 of its advanced artificial intelligence models went rogue and attacked a digital library. ABC's Hannah Battah has more.
OpenAI says this happened during testing in a controlled environment, but the AI models managed to escape containment, connected to the internet, and hack the library of computer code. A startup called Hugging Face. OpenAI is calling it an unprecedented cyber incident, and they're now reinforcing safeguards.
OpenAI says it expects this kind of incident to become more common, but the company says it is enhancing its internal security. They're fast, quiet, and affordable, but as e-bike sales have surged, so have injuries related to those vehicles.
One estimate puts the number of people hurt in e-bike accidents at 20,000 per year.
It's really disheartening.
Orthopedic trauma surgeon Hassan Mir sees it firsthand.
I'll spend a day operating on kids injured from e-bikes, and then on my way home from work, see more kids on e-bikes.
Riders aged 10 to 14 make up the largest percentage of e-bike injuries. When Dr. Mir sees those riders,
I wonder if that kid's going to be my next patient.
Jim Ryan, ABC News.
The Apollo Gallery at the Louvre in Paris is back open to the public for the first time since last year's crown jewels heist. That's when thieves took less than 8 minutes to force their way through a window into the gallery and steal crown jewels valued at over $100 million. Security since then has been enhanced. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
President Trump heads for Dover as the Pentagon asks for more money. Welcome to the Wednesday edition as President Trump attends the dignified transfer of soldiers killed in combat last weekend, while Congress considers a new price tag for the war and a supplemental budget request for billions more. We're going to hear from 3 key lawmakers on this issue. Our conversations with Senators Rand Paul, Mark Warner, and Rick Scott. With analysis today from our political panel, Republican Rick Davis, Democrat Lauren Fink are with us for the duration. And later, our conversation with the head of the Port of Long Beach, Dr. Noel Hasegaba, on the impact of tariffs and a new idea to put small nuclear reactors on ships. It's all after a look at Wall Street. We get to Charlie Pellet right now, World Headquarters in New York, and the big wind-up to Alphabet earnings. Charlie, how's it going?
You summed it up perfectly, Joe Matthew. Google, after the bell, Alphabet, also Tesla. Right now we're looking at Alphabet shares. They're up by about 0.1%. Tesla in the red, down by 0.2%. Also going to be watching out for IBM. It will report after the close of trading, down now by 0.3%. You'll recall last week it had that 25% swoon on Tuesday of last week. To the markets we go. We've got the S&P higher ahead of earnings, now up by about 14 points, up 0.2%. We have been swinging between small gains, small losses. Dow Industrials up 0.4% right now, while NASDAQ little changed, down 4 points right now, down under 0.1%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, it is advancing today, up by another 1.2%. We've got the VIX holding below 17, a 10-year 4.64%, the 2-year 4.29%, and the 30-year 5.13%. Gold up $81 the ounce. That is a gain now of 2%. We've got West Texas Intermediate crude oil. Major story today, WTI 86.03 a barrel, up by 2%. Barrel of Brent have been trading above 95. Brent crude right now 93.15 a barrel. It is up by about 2.4%. I did mention the big earnings coming up after the close of trading. We'll be hearing from both Alphabet and Tesla. Aaron Cannon is the CEO of Clear Harbor Asset Management, and on Surveillance this morning, he explained why Alphabet definitely matters for markets.
I think the market is very focused on not just the ad revenue, but as it pertains to AI, what does Google's cloud growth look like relative to estimates, relative to, sort of market share? What is the CapEx going to look like? It could be a read-through for all the other hyperscalers out there.
We'll give you all the answers when Alphabet reports after the close of trading. Aaron Cannon, by the way, CEO of Clear Harbor Asset Management. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow at 5 p.m. Eastern for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. We'll have it live from UN headquarters. Kicks off 5 o'clock Wall Street time right here on Bloomberg. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, looking forward to that. Boy, hey, how often do I get to watch TV at 5 o'clock in the afternoon? I'll be all over it. And, of course, here on Bloomberg Radio. Welcome to the Wednesday edition. We're only halfway through the week, and it's been a doozy already. What's going to happen over the next couple of days will add to that, both here in Washington with a very busy agenda on Capitol Hill before everybody leaves town again, and, of course, at the White House, where the president is doing his best to continue operations in Iran, and today making a beeline to Dover, which we'll be talking about a lot more. It's great to have you on the Wednesday edition, live on Bloomberg Radio and streaming live on YouTube. Dial us up right now by searching Bloomberg Business News Live. We'll always save a seat in the studio for you, and you're going to want to be dialed up here for what we have packed up for the next couple of moments here. We made tracks to Capitol Hill last evening. By the way, it's hard to get around town right now with, well, they're repaving all of Pennsylvania Avenue for the IndyCar race. Nobody's talking about this. There's like big gashes in the pavement. They're out there taking the median out of the way and moving cars, I guess, for when this whole thing goes down. It's going to be an event on Capitol Hill today, and this isn't exactly our lead story, but Jim Banks, the senator, Republican senator from Indiana, he's bringing IndyCar drivers, that's how that works, to the Senate Republican steering lunch to talk about the IndyCar race coming up next month in Washington. It's going to be big stuff. Iran leads our news, however, with the president taking to Truth Social as the U.S. widens the scope of its airstrikes on Iran, and lawmakers on Capitol Hill try to balance the idea of $1.5 trillion proposed Pentagon budget and now a supplemental budget request for more than $60 billion. We spent time last evening with 3 U.S. senators. They don't agree on this. And we'll start with Republican Rand Paul. The Republican from Kentucky chairs Senate Homeland Security, a budget hawk. Here's his take.
So we currently spend $1 trillion. He wants $1.5 trillion. That's $500 billion increase, plus another, paltry $37 billion on top of the $500 billion. No one in the history of the country has ever asked for this much money. This is more money that you can't even print it that fast. All right, so it threatens our country. The biggest threat we have right now is our debt. We are more in danger of devaluing our currency than we are of Iran invading the United States.
Well, the defense secretary testified that for national security, it is critical that they get the money that they are asking for. What would you say to someone that says the actual danger that the country is put in is if the Pentagon can't fund it?
I would say that he's mistaken the problem. The greatest threat to our national security is our debt. That's what Admiral Mullen said 10 years ago, and it's gotten 10 times worse. It is completely and utterly fiscally irresponsible to someone to ask for a 50% increase in the military, but they're not asking for the approval of Congress. We have a war that we have not voted upon, no congressional vote. Look, George Bush, at the very least, came to Congress. He asked for an authorization for the use of military force for Afghanistan and for Iraq without a vote, and yet then he wants us to give him a 50% increase. We're $2 trillion short this year. Increasing the military spending by 50% is absolutely irresponsible.
So where does that leave the war powers argument? I thought it was interesting that the president sent a letter to Congress announcing the resumption of the war. Doesn't that get a 60-day clock ticking again?
No, the only way it works for the Constitution is the initiation or declaration of war is Congress. The War Powers Act says you can go to war if you're attacked or if you're in imminent danger. The 60-day thing is misinterpreted that you get 60 days to fight the war. No, you're not supposed to fight any war unless you're under imminent attack or that there's a self-defense need to do it. 60 days isn't a gift every time a president says, I want 60 days to start the war. Oh, we stopped yesterday.
Yes.
Oh, we'll start tomorrow. Give us 60 more days. No, the initiation of war, the declaration of war, was given specifically to the legislature.
All right, now there is the take from Senator Rand Paul, who you knew already was not a fan of this war, and he doesn't want to see more spending without offsets. He's made that clear. Senator Mark Warner, the Democrat who serves as vice chair of the Intel Committee, also not a fan of this war, but for different reasons. And we asked him about the drive here, realizing the House votes today on reconciliation. They're going to start voting at 3:30 in the afternoon. And it's likely going to pass. That's the narrative, at least before it goes to the Senate. So senators like Mark Warner and Rand Paul, we'll hear later from Rick Scott, are trying to figure out how they're going to vote on this. If we can hear from the Democrat from Virginia, we spent some time with Mark Warner on this very question. Are you a yes or a no? Here's what he said.
At this point, Joe, I'm a no, because the Defense Department still has roughly $85 billion of unspent money. I agree that we have, taken down our stocks of munitions. They need to be replenished. Take it out of already appropriated money. This was a war of choice. And the irony is, to start a war of choice without a plan, or a plan that we were going to bomb Iran into submission, the 4 goals that the administration laid out: regime change, how's that going? The current crowd is worse. Enriched uranium, we haven't gotten it out. It would take 15,000 troops on the ground. Getting rid of their missiles and drones, obviously not the case. In Strait of Hormuz, seems to me, with gas now back to $4 and diesel above $5, that's not working out as well. This was a war of choice. The president never made the case to the American people. It's dreadfully unpopular. We want to replenish those troops, and I do. Take it from the funds that have already been appropriated that are sitting in basically the budget at DOD.
Indeed, gas is ever higher. $4.06, according to AAA. Mark Warner there speaking with us. I've got to tell you, the Balance of Power franchise, twice a day, the early program, feeding the late program, feeding the early program. I love these conversations. And I love nothing more than going up to Capitol Hill with Kayleigh Lyons to talk to lawmakers in person. It's different when you sit knee to knee and look at each other's eyes, which we did as well with Senator Rick Scott. Now, this is a Republican, of course, from Florida, who's going to make the case for the war. He supports the president's ambitions here and the money required to continue operations. He made the case as a member of the Senate Armed Services Committee and the Foreign Relations Committee. Here's Senator Rick Scott.
It's a trade-off, right? Nobody wants to go to war, but we don't want them to have a nuclear weapon to kill us. I've got kids and I've got grandkids, and I want them to kill a nuclear weapon, or I'm sure you're in the same position. You want your family killed by a nuclear weapon. So it's going to cost us money. It's going to cost to have a strong military to be able to stop this. And let's look at the world right now. The world's dangerous. The world's dangerous for, you can blame anybody you want to blame, but the government of Russia hates us. The government of China hates us. The government of Iran hates us. The government of North Korea hates us. So it's a dangerous place. And so if we don't build up a military that can defend our freedom, then we're going to lose it. And so, unfortunately, it costs money.
Yeah.
Well, should there not be answers as to how much ultimately this is going to cost? You feel that the Pentagon has been transparent enough with that information? The Defense Secretary only revealed that today, giving sworn testimony before the Appropriations Committee.
Well, I think it'd be easy if we knew how many more days it was going to take. We don't. I mean, we don't know how many more days it's going to take to get a new regime and to destroy them or bring them to the table. We just don't. And we actually, you never have enough information about how well your enemy is doing. So I look. Pete Hegseth has been always open and honest with me. If I call him or if I text him, I get an answer within hours. He's very transparent with me. He's been very transparent with the Armed Services Committee. But I don't think we know yet. I mean, I wish I knew. I wish it was tonight. I wish they would come to their senses, because I don't want more American lives lost, and I don't want to be at war. But I don't want them to have a nuclear weapon.
Well, so with all of that said, do you buy talk of a 10-day ceasefire that we've been hearing about recently, or is that a waste of time? How do you trust this party with a ceasefire?
I mean, we tried. I mean, we gave them the chance of diplomacy. Okay, they used it to rearm, basically. Yeah. And they were never serious. So they're a bunch of liars. They want to kill us. So,
if we want to get serious, do we bomb Pickaxe Mountain and do we seize Karg Island?
So, I mean, that's a decision the president gets to make.
Understood.
The way I look at it is that, look, we have to do everything. I mean, nothing should be off the table. Yeah, we don't want to be at war, and we don't want Americans killed. So whatever it's going to take, because they want to kill us. Whether we like it or not, we'd love to have diplomacy, we don't want to be at war, they want to kill us. So if somebody wants to kill you, I want to make sure they don't.
Stark analysis from the Republican senator from Florida, Rick Scott, in a conversation you will only hear on Bloomberg. And so after the 11th straight day of attacks on Iran, which again, by the way, fired at Kuwait, Bahrain, and Jordan, the president on Truth Social, from this point forward, he writes, anytime Iran shoots at a ship in the Strait of Hormuz, whether it's by missile, rocket, drone, or any other device or weapon, the U.S. will bomb and destroy one bridge or power plant, including those located next to or in the city of Tehran. He's in Dover for the dignified transfer right now. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are higher as investors await the latest numbers out of Alphabet, Tesla, and IBM. Oil is rallying. Right now, we do have West Texas Intermediate crude at $86.23 a barrel. WTI up by 2.2%. We did see Brent above 95, currently trading at 93.47. Barrel of Brent crude up by 2.7%. Bottom line, the Dow, the S&P, they are both higher. NASDAQ is lower. The S&P 500 index up 14 now. That is a gain of 0.2%. Dow Industrials up 0.4%. NASDAQ down by 8, drop there of under 0.1%. Meanwhile, the SOX, the Philadelphia Stock Exchange's semiconductor index, it is higher by 1.1%. 10-year at 4.56%. The 30-year 5.13%. Gold 41.54 the ounce. Spot gold up 1.9%. Crude, major story, surging 2.2% on WTI, currently trading at 86.21 a barrel. Super microcomputer shares are soaring 25% after the server maker issued preliminary results saying its backlog hit a record on new orders in the quarter of more than $60 billion. I mentioned oil higher, so are oil majors. ExxonMobil up 1.6%. Chevron now up 0.7%. ConocoPhillips up by 1%. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow at 5 p.m. Eastern for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. Recapping, S&P up 0.2, and that, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thank you. He'll be back in about 20 minutes with more on the markets as we work our way up to Alphabet earnings. I know I want to say Google, and you do too, but it's Alphabet that a lot of people think could, in fact, be the key to this earnings season, at least in figuring out how we feel about the AI spend, where we are, what inning we're in, and what's happening to the CapEx. That'll all be after the bell, of course, with much more to follow today on Balance of Power. I'm glad you joined us. It's the Wednesday edition, and we're live on Bloomberg Radio, on Satellite Radio Channel 121, and watching us always on YouTube. Search Bloomberg Business News Live. With our eyes on the markets and the price of a barrel of oil ever higher, up over 2% for WTI and Brent today. We're looking at 86 and 93 respectively. And as we were just discussing with the lawmakers, really fascinating series of interviews in the Senate last evening. By the way, we're going back up there tonight. Can we get Alyssa Slotkin on the line? We're going to keep doing this as often as we can as we figure out these votes. We've got the CR in the House today. We've also got reconciliation. And so when you factor in the supplemental budget request for Iran, things start to get pretty complicated. The price for a gallon of gasoline, where I was going here, $4.06. How about diesel? $5.18. They say the economy runs on diesel, right? And if you run the port of Long Beach, that's a pretty important part of the equation, because once the goods come in, they need diesel to go out. And this is going to be part of our conversation with the man who runs the port of Long Beach. Dr. Noel Hasegaba is with us in studio right now. And Doctor, it's great to see you. Welcome to Bloomberg TV and Radio.
Thanks for having me. Pleasure to join you, Joe.
I want to talk about a lot of things, including price pressures, including your port as a barometer of our economy, which is fascinating to talk to the likes of yourself, Regine Soroka. Frequently more accurate anecdotal evidence than we ever get out of a data set. But I want to start with something that you're introducing. This is a new idea, and the reason why you're in town here, I believe you just came from the Department of Transportation.
That's correct.
To talk about, as we look at the cost of diesel, jet fuel, the price that it costs to take goods from Asia to your port, there's a new idea as we look for alternatives, and it's nuclear. Small modular reactors on a boat? How close to reality is this?
Well, we took the first step today. This memorandum of cooperation with the Maritime Administration is really the first of its kind.
Yeah.
And what it does, Joe, is it establishes a framework for the proper agencies at the federal level to start having conversations with a port like ours, a major national asset, and our partners in the private sector to look at ways to introduce SMR technology in a safe and reliable fashion. Look, you described it very well. Everything that's going on in the energy market. The cost of fuel and the uncertainty surrounding that is strengthening the case for energy diversification. Now's the right time for us to explore nuclear energy.
We talk about these small reactors pretty frequently when it comes to data center, right? That's the future of AI, how you get them off the grid. You put a little reactor right there at the plant and everybody's happy. We've heard about the U.S. Navy for years, for generations, using nuclear in its aircraft carriers and submarines. Putting this on commercial vessels raises a lot of questions. Who's responsible for it? It's not a military operation any longer. What if a boat sinks? Could this be a target? How do you answer those questions?
These are all great questions, and they are questions that need to be asked and answered. And one of the reasons why we decided to join this memorandum of cooperation now is because there are a lot of questions that need to be answered. And safety is at the top of the list, right? When it comes to safety, there's no calendar. And so we thought it was important to start the conversation, bring in the agencies and the partners in the private sector to start thinking through some of these scenarios. The reality is, when you look at nuclear, it's a carbon-free energy source. It's already being used in different sectors, industries around the globe. What we're trying to answer through this MOC with MARAD is how do we introduce it in a safe, reliable fashion? And let's not forget, the Port of Long Beach is one of 18 commercial strategic seaports. So we're already an asset for the U.S. government in the event of any military activity. So it just makes perfect sense for us, a leading port, a major gateway, and a commercial strategic seaport to be the first port to enter into this type of cooperation.
Well, it's interesting that it's coming from you, the port, not a commercial shipping line, not a ship builder. This is a pretty entrepreneurial move for you, is it not?
Well, you know, the Port of Long Beach has been around for about 115 years, but in order for us to stay competitive, we have to think like a startup. That's exactly what we're doing. What got us here isn't going to get us there. And this is why in January I launched our new 2050 vision. And our plan, Joe, is very simple. We want to double our container throughput to 10 million to 20 million container units and build a port of the future in the process, a port that's going to be clean. And we're also leveraging partnerships. For example, Bluecore, which is a startup that just entered into a lease with the Port of Long Beach. They're the ones who are doing the R&D behind this technology, and they're the ones who are going to be working with the port, with MARAD, and the other federal agencies to make sure that we do this reliably and safely.
When you look around the world right now and consider what's happening in the Strait of Hormuz, what might be happening in the Red Sea, it raises so many questions about technology like this. Could you take a nuclear-powered ship through the Strait?
Well, it's a great question. I wouldn't do that right now. But when you consider the advantages of what this energy source offers, it's worth exploring. That's what this MOC is all about. It's asking those questions, bringing in the experts, bringing in the agencies, making sure that it's introduced in a safe and reliable fashion.
I want to hear where this goes. I think our audience will be fascinated to learn as well. There are massive economic implications here, just like the ones we're dealing with now. The reason we're having this conversation as we started out is because of the price pressures that we're feeling from overseas. And I'm wondering to what extent, if any, that is impacting business in terms of traffic at the port and just the conversations you're having with shippers right now who are enduring this.
Well, it's interesting. The impact is felt, and it's felt first at the pump, but it cascades across the transportation network because so much of the cost involved in transporting goods from port to port, and once it arrives at destination, from endpoint to endpoint, it requires that fuel. But surprisingly, Joe, the resilience of the American consumer, the resilience of the supply chain. Here we are in the middle of these soaring fuel costs, and yet at the Port of Long Beach, we're ahead of a record run last year. Through the first half of 2026, we're actually 2 percentage points ahead of last year. And last year was a record year for us.
Wow.
And a lot of it is because shippers are trying to hedge their bets. They're trying to mitigate the uncertainty of additional tariffs or additional soaring fuel costs, and they're advancing their shipments. And like you said a moment ago, traditionally ports like ours have been pretty good barometers of what's going to happen to the rest across the economy in the months ahead.
Well, that's encouraging, considering new tariffs are coming. And this is the time when the holiday season is set, right? What happens in July and August will pay off in November and December. What kind of a holiday season will we have based on the currents that you're seeing now?
We've already begun to see holiday gifts arrive into our port.
And that's something?
I mean, we're not going to miss the season.
Yeah.
In past years, there was concern of whether or not folks were going to have access to the hottest toys. They're already here.
Right.
And that's the remarkable thing about these, whether it's fuel costs or whether it's some of the uncertainty surrounding trade policy, enticed everyone to advance their shipments.
That's really encouraging, I think, for a lot of people who are listening right now. Talk to me about the other end of things. When you have trucks lining up and they're paying over $5 a gallon for diesel, does that impact business, or are these businesses swallowing that cost right now, or are they passing it on?
It's a mix. Most businesses absorb some of it, pass on to some of the consumers.
Look at the transportation like J.B. Hunt. I mean, these stocks are at all-time highs. They're printing money, it looks like.
Well, they are, but affordability continues to be a key issue, not just for policymakers, but for operators like us. And it's important for us to keep an eye on that, because at a certain point, that resilience muscle is not going to be able to stretch to that degree. So this is why, again, I say, what is happening right now in the energy market is strengthening the case for energy diversification. This is why this historic memorandum of cooperation with the Maritime Administration makes a ton of sense.
How's your labor force in terms of the port itself and drivers? This was a real concern coming out of COVID. How do we get enough drivers, even if the goods make it to port, to get them around the country?
Our workforce are the true heroes. They're the ones who move the containers. They're the ones who power our port. And right now we have a very healthy and robust workforce. They show up. During COVID, they masked up, and we never had to close a single shift. So it's a testament to the resilience of our workforce as well.
What's the timeline, getting back to where we started, on small nuclear reactors getting on ships? Do you have one, or is it impossible to tell right now? Is this 5 years, 10 years away?
You know, I can't tell you exactly when it's going to happen, but what I can tell you is this MOC sets the path forward for us to have those conversations that need to be had. We have willing partners in the private sector who are going through the R&D right now. We're bringing in the experts, and again, we're going to do this safely and reliably.
Is this administration the reason why this is happening now?
You know,
there seems to have been an embrace of nuclear that didn't exist before.
SMR has been around for the last 10 years. Nuclear power has been around, as you mentioned, the U.S. Navy.
Sure.
As a matter of fact, a fun fact, the very first warcraft vessel to use nuclear power was the USS Long Beach back in the 1960s.
Is that right?
Yes, it's been around for a while. But again, it's the application and the adoption. If we can introduce this technology in a safe and reliable fashion, I think there will be a lot of advantages.
Would this be like an aircraft carrier or a submarine where you'd have, in this case, Maersk would put a cargo vessel on the water and be out there for a year?
Well, right now, our partner Bluecore is looking at how we could leverage SMR to power commercial vessels. That's the beginning phase. Where it goes from there will depend largely on how we develop the safety protocols, the operational standards, and make sure that this technology is adopted and implemented safely and reliably.
Well, we'd love to stay in touch with you on this as you get closer. Next time you're in Washington, come and see us, Doctor. It's great to compare notes on a number of issues, from the economy to the future of nuclear on the open seas. Really fascinating conversation, as we promised, with the doctor. He's the Port of Long Beach CEO, Noel Hasegaba, with us here exclusively on Bloomberg TV and radio. Stay with us. We'll assemble our political panel next as we talk about what's taking place on Capitol Hill today. Some important votes that are just a few hours away on funding the government and the Pentagon, currently at war with Iran. We'll update what we're seeing from overseas as well, as the president makes his way to Dover for the dignified transfer. It's the Wednesday edition of Balance of Power, only here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P higher, NASDAQ, and the NASDAQ 100 index both declining. However, the SOX, the Philadelphia Stock Exchange Semiconductor Index, continues to advance, up now by just about 1%. But bottom line here, we've got stocks essentially in a holding pattern ahead of earnings after the bell today, coming up from Alphabet and also from Tesla. S&P right now up 14 to 75.23. That is a gain of 0.2%. Dow Industrials up by 0.4%. NASDAQ down 0.1%. The NASDAQ 100 index also down 0.1%. The SOX up by 1% with the VIX just below 17. A 10-year at 4.64%. The 2-year 4.29%, the 30-year 5.13%. Gold up 1.8% now, 41.49 the ounce. West Texas Intermediate crude up 2.5%, 86.45 for a barrel of WTI. Brent was trading above 95 a barrel, right now 93.54 a barrel of Brent today, however, advancing by 2.8%. Sources tell Bloomberg President Trump is poised to impose fresh levies on products from dozens of economies by Friday. Libby Cantrill is head of public policy at PIMCO.
He believes in tariffs. He thinks tariffs work. And importantly, from a revenue perspective, tariffs are a tax. They do raise revenue. And so what this administration is trying to do, I think to also maybe quell the bond market a little bit, is to reconstitute that tariff rate to get back to that sort of $170 billion amount that we were raising under tariffs under IEEPA and the other provisions.
PIMCO's Libby Cantrill interviewed on surveillance. Shares of wireless providers are higher. Case in point, AT&T up now by 3%. It did add more monthly wireless phone subscribers than analysts expected in the second quarter. Right now, Verizon shares, they're also up by 1.4%. Verizon reports Friday, reporting tomorrow. T-Mobile, and T-Mobile shares up now by about 0.1%. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow at 5 p.m. Eastern for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. We'll have that for you live here on Bloomberg from UN headquarters. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Okay, Charlie, looking forward to that. This is big stuff tomorrow, 5 o'clock. Even I get to watch TV and listen to the radio at 5 o'clock. Wow, it's a special occasion. I'm looking forward to seeing Romaine Bostick against the Green Marble at UNGA. That's going to be cool. Only here. Only Bloomberg would attempt such a project. Thanks for spending part of your Wednesday with us here on Bloomberg Radio. We're live on satellite radio channel 121 every day and streaming live on YouTube as we prepare to assemble our political panel. I'll tell you something. This story about the war in Iran, and more specifically, the dollar signs attached to it, as Pete Hegseth yesterday actually gave lawmakers an update in his hearing, $37.5 billion. That's the cost of the war up to now, or I guess, as he put it, through September 30. I'm not sure how we know about that because, well, the Pentagon's asking for a lot more. I think it's $67 billion in the supplemental. The president wants to have $1.5 trillion Pentagon budget. If you ever want to go viral online, go talk to Rand Paul for a while. This is something. I was just talking to producer James about this. You know, we at the beginning of the program, we played you part of our conversation with Rand Paul from last evening. Company posted it on Instagram. You know, it's on LinkedIn. It's on Twitter. The numbers are staggering. I could talk to Rand Paul about anything. I think it would. Right now, we're at, in the headline, increasing the military spending by 50% is absolutely irresponsible. 1,041,000 people have watched this already. My God. 55,000 likes. The comments, well, you know, I can't read half them on the air. But it proves the involvement that people have. If you don't think people are paying attention, this is an Instagram post that people are seeing on the scroll. They may not even be looking for it. And they react when they see it. With $4.06 for a gallon of gas, diesel over $5, as we were just discussing with the doctor, and now a president of the United States, back to Dover, which is never a good thing. The dignified transfer began at 11:42 a.m. I've got the pool note here from the reporters who went to Dover with the President of the United States. The transfer started with an Air Force officer's call of wheels rolling, indicating the families of the fallen were en route. The same officer called family in sight as their vehicles approached the flight line. Their vehicles were marshaled into position by an Air Force NCO with a procedure akin to that used for an airplane. They walked to stand next to the cargo ramp. Each rendered a salute to the call of President-at-Arms as the POTUS, Secretary of Defense, Chairman of the Joint Chiefs, arrived as well. They held the salute until order arms was called at 11:52. This was repeated for the second transfer case, the third, the fourth. A family member who the pool could not see was heard crying as the fourth case was loaded into the transfer vehicle. This is really tough stuff, and it brings this story beyond the economic impact to the human one. And the president was talking with reporters on the tarmac as he made his way to the transfer. Here's what he said.
Americans aren't against the war. A poll just came out. Americans don't want high gasoline prices, but they're not against the war. That just came out loud and clear in a poll. Nobody wants Iran to have a nuclear weapon.
Nobody wants Iran to have a nuclear weapon. And lawmakers are now balancing that idea with the cost of the war, both human and financial. And it's very difficult to find consensus in Washington. Let's try with our political panel right now. Bloomberg Politics contributor and Republican strategist Rick Davis is back with us today. Partner at Stone Court Capital. He's live in New York, along with Laura Fink, the founder and CEO of Rebel Communications, our Democratic strategist. It's great to see both of you. Rick, what are the economic, or I should say political implications of a day like this when Americans get home from work, or maybe when they're looking at their phone on their lunch break, they're going to see images of Donald Trump at Dover? It reminds us of how difficult this is, and Americans don't know when it's going to end or what it's going to cost. How does this all add up politically?
You know, Joe, first I want to thank you and the production team for devoting so much time to today's broadcast for the dignified transfer. These are America's greatest heroes, and they deserve the attention the American public can get. They don't get enough, but thank you for that. Look, I mean, the consumers are already in an angry mood. You need to look no further than Michigan Consumer Sentiment Index, which is still at the rock bottom of its levels of concern for the inflation, the cost of living. When the price of gas went down a little bit, it ticked up. I have no doubt that now that the price of gas is going up, it's going to tick back down. And this is defining the political dynamic that exists in America today, which is a pretty grumpy electorate, regardless of all the great news that we hear about stock markets and things like that. So the president's in a bind. He can talk through it and hope for the best. But unless the administration and Congress find some unifying message around economics, it's not good enough to say I'm going to continue fighting on until I get what I want. And 1 week it's opening the Strait of Hormuz. The other week is getting rid of the nuclear program, which may be much longer term than hopefully opening the Strait of Hormuz is. But they need to settle on an outcome, and they need to create that outcome. Otherwise, this limbo is not helping anybody with an R by their name.
Laura, you heard what the president said just now. Americans are not against the war, he said. They don't want to have gasoline prices, but they are not against the war. That's not backed up by public polling. What do you think?
It's simply not backed up by public polling, and I think it shows that the president is receiving slices of information but continuing to kind of fail to see the whole picture. I thought Rick said it well. There's an idea here about sacrifice, the ultimate sacrifice that we see at Dover today of the truly young people who have put their lives on the line for American freedom, and they are at the behest of the president and of the people in power. And we also have sacrifice being made by American families. I mean, it's estimated $500 already that Americans have put into the pump, and perhaps even more with all of the increased costs of goods and services. You're asking for American sacrifice at an already difficult economic time with inflation high, and there's no articulation what the goals are, as Rick said, but also of what the strategy is and of what is going to be required of the American people. And I think that thinking that you can't communicate on that level with people that you're asking for these things from, I think is a big mistake. And I think you see it in his polling numbers and in the way Americans feel about this conflict. They don't know enough, and they're unsatisfied with where things are.
The rhetoric is certainly intensifying, Rick. I'm curious what you make of the president's post today on Truth Social. From this point forward, he says, anytime Iran shoots at a ship in the Strait of Hormuz, the U.S. will bomb and destroy one bridge or power plant, including those located next to or in the capital city of Tehran. We're definitely getting to the point of escalation here, Rick. How should we read this?
Yeah, the president's always pursued a escalate to de-escalate strategy. It seems to fluctuate every week, depending upon the status of the negotiations. Sometimes they're on, sometimes they're off. In order to get them back on, I think he believes he has to escalate. And this would be a level of escalation we have not seen. The president's already bombed bridges. That's been happening in the course of this latest campaign. That hasn't seemed to elicit the response that he needs to enter into negotiations with Tehran. So turning the lights out in Tehran may be his next best option. It doesn't seem pegged to an ongoing campaign, though. I think what Congress said yesterday to the Secretary of Defense very loudly, both Republicans and Democrats, is you need a plan that is longer looking than just what is the next week going to give us. And I think that's the frustration Congress has. I think the American people sort of get the joke on that. They want to know what the plan's going to be to get out of this, not just to sort of continue to bomb away. And I think the president is loath to try and look over the horizon too much. He's waiting for that sort of flag of surrender, and so far he hasn't gotten it.
Yep. Well, you know, we're going to get some real numbers when the House votes on this later on today. We've got a 3:30 p.m. series of votes, Rick and Laura, that will include the annual defense policy bill, but more importantly, this budget resolution for reconciliation that includes the supplemental military funding. Laura, will it pass?
I think it's likely to pass. Republicans have shown their loath to stand up to Trump. I think you also have to look at what I think is disappointing and even cowardly positioning by the defense secretary, who came and said that you are the biggest threat if you don't give us this blank check and this additional funding that doesn't go through an appropriations process, that doesn't have any accountability. And I think that positioning the Congress as the biggest threat is really myopic, and also saying that the consequence of not doing so would be troops' lives and troops' livelihoods, saying that they would be forced to cut or freeze salaries. They're really centering and putting American troops really at the center here in a way that I would say is predatory. I think it's disappointing. I think you heard that the lack of transparency and some of this positioning frustration with senators like Senator Kennedy, Republican from Louisiana, saying you're just not being straight with us. And I think that it was a disappointing day to sort of see that once again the American people are being asked, and the senators that represent them are going to be asked to write a blank check to a war that whose horizon is not clear and whose goals continue to fluctuate.
He really does have a way with lawmakers. Blank check, the two most important words there. Rick, we're going to be talking shortly at the top of the next hour with Chip Roy. The Republican congressman from Texas has an allergy to debt spending, much as Rand Paul does. He's going to want to see offsets here, right? I don't know what he'll tell us yet, Rick, but could there be Republicans who make this difficult to pass because it's all deficit spending?
Yeah, where are the deficit hawks? I think one of the reasons Rand Paul's interview that you did got so much attention is because he made a very clear and salient point. And I hate saying I agree with Rand Paul because it drives me crazy. But the reality is every dollar we're printing to increase the defense spending is going straight into debt. We're not offsetting this in any way. And we're creating a situation where in future generations, and I'm talking the next one, they're not going to have options like this to increase defense spending because they're going to be spending more on interest on the national debt than they have available for defense spending. And so all we're doing is shortcutting the process today to take away options for the future. That is an assault on our national security.
Pretty well put from Rick Davis and Laura Fink. We've got a great panel today. Thank you both. They'll be back in our second hour with a lot more to talk about, including our conversation with Chip Roy. The Republican from Texas will join us. We'll get an update from Tyler at the White House. Kaylee will come along, and we'll also bring along our global television audience. We're just getting started here on the Wednesday edition of Balance of Power, so stay right where you are. Chip Roy, Tyler Kendall, our political panel, and later in the hour, our conversation with Congresswoman Brittany Peterson, the Democrat from Colorado, keeping us balanced here with the power, only on Bloomberg.
Washington, D.C. This is Balance of Power with Joe Matthew and Kaylee Lines.
The House votes on more money for the Pentagon as the president threatens escalation. Welcome to the Wednesday edition as President Trump attends the dignified transfer of soldiers killed last weekend in service to their country, while Congress considers a supplemental budget request that they're going to be voting on for billions more today. I'm Joe Matthew, alongside Kaylee Lyons here in Washington. Kaylee, the president on Truth Social, threatening to bomb a bridge or a power plant for every boat that Iran shoots at.
Yeah, even those close to or in the capital city of Tehran, to use the words of the president. So once again, threatening escalation at a time where, of course, the escalation we already have seen to this point has lost more American lives, with the death toll climbing, and the president just moments ago receiving the bodies of those fallen service members. All of that is what points to more political difficulty. The longer that this war continues to go on, the harder it may be for those here at home who have to stand for re-election in November. And that's why this vote on a budget blueprint that paves the way for a third reconciliation package that provides more funding for the Pentagon is so sensitive and is likely to be Republican only in terms of voting yes.
They're going to be getting to this, it looks like, a couple of hours from now, in the 3 o'clock hour voting, at least the process of voting on a number of issues will begin. But you're right, Kaylee, there are no offsets here. This is deficit spending, whether we're talking about the supplemental or the $1.5 trillion that'll be debated for the annual Pentagon expenditure. And we're going to be spending some time with a budget hawk, and very curious to hear what Congressman Chip Roy thinks. The Republican from Texas will be joining us. I think safe to say someone who supports this effort, but not the idea of spending without offsets.
He also supports the notion of a ban on members of Congress trading stocks. That is also one of the votes that will be happening this afternoon, although he might want this particular package that is on the floor today to go a bit farther, but we'll speak with him about that. And of course, as we consider those trading stocks, if it's not members of Congress, there's plenty of people on Wall Street doing it. And right now it's a bit of a mixed day in terms of where they're buying and selling. So for the latest, we turn to Charlie Pellet with a check on the markets from New York. Hey, Charlie.
Hi, thank you very much, Kaylee. Indeed, all about Alphabet, all about Tesla. They report after the closing bell, and of course, we're going to be all over those numbers as they cross the Bloomberg. Right now, as you mentioned, mixed market. We've got NASDAQ 100 index just turning positive, barely up by a point right now. NASDAQ Composite Index does remain lower, down by 10 points. That is a drop of under 0.1%. S&P keeping it all in context. Little changed, up by about 0.2% now. Higher by 15 points, just about the best level of the day on the S&P. The Dow up 170 now. That is a gain of 0.3%. And to be sure, both NASDAQ and the NASDAQ 100 index now lower and little changed. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up now by 1.2%. A 10-year at 4.64%. The 2-year, 4.29%. And the 30-year at 5.13%. Gold, meanwhile, up 1.7% to $41.45 the ounce, while West Texas Intermediate crude oil, $86.49 a barrel. WTI up 2.5%. Brent was trading above 95, currently at 93.56. Barrel of Brent crude up by about 2.8%. Oil prices jumping on the escalation of the U.S.-Iran war. After the closing bell, again, we will be hearing from Alphabet. Shares higher now by 0.2%. Tesla also after the bell down by 0.3%. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow at 5 p.m. Eastern for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. We'll have it for you live from UN headquarters, the UN Town Hall, 5 o'clock Wall Street time, right here on Bloomberg. I'm Charlie Pellet. Back we go to Washington. Once again, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, checking on the markets for us from New York. Thank you so much. President Trump, of course, is not here in Washington at the moment. He's actually en route now to Georgia. Well, he will be speaking at a high school later this afternoon, having attended earlier the dignified transfer of 3 fallen service members who died this past weekend in the Middle East amid the ongoing conflict with Iran at Dover Air Force Base in Delaware. Even as he was making his way there, of course, the president has been weighing in on the escalating nature of this conflict with Iran on True Social, threatening to essentially go tit for tat if Iran were to try to attack ships in the Strait of Hormuz. He says the U.S. will go after a bridge or a power plant, bomb or destroy them. Essentially saying that this war will go further. And the president suggested that the American people may not be against the war itself, even if they don't like the prices that they are seeing at the pump.
Americans aren't against the war. A poll just came out. Americans don't want high gasoline prices, but they're not against the war. That just came out loud and clear in a poll. Nobody wants Iran to have a nuclear weapon.
Let's get to Tyler Kendall, Bloomberg's Washington correspondent, ahead of our conversation with Congressman Chip Roy. She's on the north lawn of the White House right now as the president makes his way from Dover to Georgia. And Tyler, you heard, of course, Kayleigh reference the president's post on Truth Social. Will he be escalating, as they say, to de-escalate once again?
Well, Joe, at this point, despite efforts by mediators to try to avoid further escalation, the tensions appear pointed there as the U.S. expands the scopes of its targets. You had this post that you guys were talking about from President Trump saying that the U.S. will go after either a bridge or a power plant in exchange for every commercial vessel that Iran targets in the Strait of Hormuz, as we have gotten very little indication that Iran is willing to let up its leverage when it comes to disrupting global oil flows. In fact, President Trump, as you well know, yesterday said that Iran desperately wants to make a deal, but that the U.S. isn't even interested in coming to the negotiating table unless Iran does in what he called a meaningful way. But we heard from one of Iran's top negotiators earlier today, seeming to downplay reports that there was this meeting yesterday in Pakistan, instead saying that there are not negotiations, just messages being exchanged between the two sides. And Joe and Kayleigh, as you well know, the disruptions extend beyond the Strait of Hormuz, which is just adding to the urgency of the moment. We got new satellite imagery overnight appearing to show that at least 2 tankers loaded up with Saudi crude made U-turns as they headed toward the Red Sea, seeming to indicate that that threat from the Iranian-backed proxy group, the Houthis, to institute a maritime blockade is already working.
All right, Bloomberg's Tyler Kendall live on the North Lawn of the White House. Thank you so much. And for more on this, we go now to the other end of Pennsylvania Avenue, live on Capitol Hill, where we're joined by Republican Congressman Chip Roy of Texas, who is joining us live now on Bloomberg TV and radio. Congressman, welcome back. It's great to have you on Balance of Power. As we consider this ongoing war, and we want to get to other matters before you and your colleagues in the House today as well, but given the escalating nature, we are seeing the Defense Secretary having testified yesterday that it's already cost $37.5 billion, with the Pentagon obviously asking for billions more than that in this supplemental request that's going through the reconciliation process. For how long can Congress continue to authorize funding without offsets for this war to continue to be prosecuted?
Well, great to be on. Obviously, we're trying to move forward this week to get a reconciliation package done, frankly, because we have no real partners with our Democrat colleagues to figure out how to move things through. We had to do it to fund ICE and Border Patrol. Now we're trying to figure out how to make sure our military has the resources it needs, as well as ensuring we can get the SAVE Act through the Senate so we can protect our elections. But to your point, I am a fiscal hawk. I am concerned about spending, and I am concerned the extent to which this is not being paid for, and that we need to have a full-throated debate here in the halls of Congress about the war. I happen to be one who supports Israel, supports our national security interests, and wants to check Iran and make sure that we're stopping Iran from gaining, whether it's conventional or nuclear capabilities. But we need to make sure we have a full-throated support by Congress, or we shouldn't be doing it. And we haven't had that debate fully. And I think that's a part of the discussions today on the NDAA, the National Defense Authorization Act, as well as the reconciliation package. We're going to want to move forward this week to get that budget process step forward. I think that will pass, but we're going to have to continue to debate whether we're going to get a full SAVE Act and whether we're going to have anything that I'm demanding, which is in any future negotiations on a 4th reconciliation package, that we pay for the $90 billion of this that is unpaid for. We cannot keep racking up debt, and we need to have a conversation about the war.
Well, we hear you, Congressman. I'm just curious if you could act as our reporter here. The extent that you're hearing a vote count, will this budget resolution pass? Does the Speaker have the votes? We'll ask you about the CR as well, because obviously you've got $67 billion, I believe, here for the Pentagon, and what many say is badly needed on the other side of the river.
Yeah, for sure. I do believe the Pentagon needs additional funding, and I'm happy to try to provide that and support it. But I do want to make sure we're paying for it. All right, there ain't no free lunch, and too many people in this town think there is. I do think that the first step of the reconciliation process, the budget, will move forward this week. That's my bet. We'll see. We still have some votes that we're working on the floor. We need to move forward and try to get the SAVE Act done, and we do need to try to support our military while we're engaged. But I think the NDAA might be in trouble. And I think that's in part because we haven't had the full-throated conversation on the war that we need to have and have a unified approach to how we're going to make sure our military is strong as it needs to be, not just to deal with Iran, but to deal with China, a real threat on the horizon. We need to make sure that we have a transformation of our military for generations to come so that we are still the global superpower and we can defend our country and our interests. Right now, we got to get through this step this week. But my message has got to be clear. We got to pay for this stuff, and we need to have Congress in the conversation on war. That's what the Constitution contemplates. That's what it says, and we need to be a part of that.
Well, if there's no guarantee, Congressman, that there will be a fourth reconciliation package that may include pay-fors for this one, why vote for it without the pay-fors now, today?
Yeah, I'm not a fan, as you know, of voting for anything that's unpaid for. Right now, I am being a team player to move something through this week so that we can try to get the Save America Act passed through a recalcitrant Senate and against Democrats who refuse to work with us. But I am being very clear that we've got to pay for it in our future conversations. And by the way, we have multiple steps to go on this one. I need to know that the Save America Act is real. I need to know that we have a real plan on how we're dealing with the war. I need to know that we're going to be serious about paying for this $90 billion in the next phase. You're right. We may not get a fourth reconciliation, but I'm willing to roll the dice this week, as of right now, based on the information in front of me, to try to give us a shot to secure American elections and get the Save America passed and try to backfill our munitions that our military needs, because our men and women in uniform deserve to have the tools to carry out their job when they're being asked to do it. But Congress is going to have to work with the president to make sure we've got a real plan for our military going forward. This is all complicated stuff. The Constitution requires separation of powers. Congress has to have a voice. But our men and women in uniform deserve the tools to do their job. So I'm trying to balance those interests and send the messages that need to be sent both to the White House and to my Democratic colleagues that we need to have adults sit down and get this done the right way.
Well, I'm sure that you're sending that message to the Speaker. And Congressman, I appreciate the fact that we can acknowledge that this is complex stuff. There are a lot of nuances here that are difficult to put on a bumper sticker. I'd like to bring our audience to your Stock Trading Act, your Restore Trust in Congress Act. This is a big issue. The House plans to vote on the Stop Insider Trading Act, which does not require divestment. Yours does. Can both pass?
Well, thanks for the question. First of all, thanks for you all getting the facts right. I do a lot of interviews where people get it all confused. You laid it out beautifully. That's exactly right. 6 years ago, I worked on a bipartisan basis to try to move forward and say we should ban all congressional stock trading, including divestiture, like you said. We worked out a deal to get Republicans united, or at least close to united, behind a deal that's going to say you can't buy equities, but you can maintain the equities you come in with. But you'll have to have the kind of transparency that we require of the executives, the CEOs, and so forth of publicly traded companies under the SEC rules. So I think that's a giant step forward. If you think about it, to say that members of Congress cannot purchase any equities, that would be a big deal. So I'll support it, however. I always have a however. My problem is they added the SAVE Act, of which I'm the author and I support loudly, to the stock trading bill. Now, the purpose of that is to make it partisan. The purpose of that is to score political points. I don't like that way of doing things. Like, look, I'm happy we're in an election. You got to go win the election. But I want to have a straight up or down vote on stock trading. I want everybody to have to go in front of the American people on a one subject bill and tell them what they think is right. And if they want to amend it, offer an amendment. If they don't, then vote up or down. That's what I think we ought to do. But at least we're getting a vote today for the first time, to which I'm aware, on this issue. And I've been trying for 6 years to get it. So I'll take this as a step forward. Hopefully we will see it pass. But then we're going to need to get a straight up or down vote on it pretty soon if I can have anything to do with it.
Okay, so one step forward. Would another step forward for this to extend beyond the legislative branch? Should this reach the White House too? Why should the president or those working on his behalf be able to trade stocks?
Yeah, I agree. It should apply to the entirety of the federal government across all branches. Separation of powers also means that we should all kind of treat ourselves the same way in terms of both transparency and the rules by which we operate. So it should apply to the president on down in the executive branch, everybody in the legislative branch, and all judges, including the Supreme Court. This bill obviously is targeted to Congress. Again, baby steps in the sausage-making legislative process. If we get our house in order in Congress, then I think we can then point the finger at the courts and the executive branch and make them adhere to the same rules. That would be my goal and my preference, and I'm not going to stop fighting for it. Today is a giant step forward. Again, I think Congress is poised today to state that members of Congress should not be buying equities. That's a very powerful statement to say that and by the way, that's not insider trading. If you have insider trading, you can go get convicted of that right now. It's about trust. It's about believing that your members of Congress are actually making decisions in their committees and on the floor that are in their interest, the people's interest, not the interest of their financial interests, right? So if you're voting on health care, you're doing it for the people. You're not doing it because you own stock in an insurance company or a pharma company, right? If you're voting on defense, you're not doing it because you own Palantir or Lockheed. You're doing it for the people. That's what I think is important.
It's wild for people who are not in Washington circles to hear this conversation, Congressman, and why it took so long for this to be addressed. I don't know if this passes, if that'll be the end of the NANCE ETF. Maybe that's a separate issue. But I do wonder, from your view, why it's taken so long. Are there members you talk to in the cloakroom who say, hey, Chip, I'm sorry, I'm trading Intel this weekend. You don't have my vote. Who wants to keep trading?
Well, look, I don't want to talk about private conversations I have with people, but I'll tell you broadly, there are two forces at play. One, you've got people who they just want to trade because they want more money. I'm just going to be blunt. And number two, you've got people who believe they've got the right to do it, right? That as a member, as a citizen, they have the right to trade stocks, that we can't limit that. I disagree. It is a privilege to serve in the United States Congress. We limit salary. We limit what you can do in terms of being employed at the same time. And there's a lot of conflicts there. People own car dealerships. People own farms. I get it. But we need to start cabining that in so that people can trust Congress again to be here for their interests. By the way, especially when you don't have term limits, especially when people are here endlessly. You should come here for 2 or 3 or 4 terms, and if that's no longer good for you personally, then go home. But it's a sacrifice. It's supposed to be a sacrifice. So that's my message to my colleagues. Suck it up, Gus. You get to be a member of the United States Congress. Let's go do this so that people can believe in us again.
Well, and you are a member of the United States Congress. You are a member of the Budget Committee. So just finally on Reconciliation 4.0, which I know you want to include pay-fors for what is going through the process now, but what else would be on your wish list for an unprecedented 4th budget reconciliation package in one Congress?
Yeah, look, if we're able to get to a 4th reconciliation package, whether it's before Election Day or in a lame duck or next year, I think we need to make sure our military is transformed to beat China and to make sure we're the global superpower. I think we need to restore healthcare freedom for the American people with fully empowered health savings accounts that allow us to have the doctor-patient relationship restored so you're not dependent on insurance companies and bureaucrats and government bureaucrats telling you what to do. Thirdly, I think we need to have actual deficit reduction. Not made-up nonsense, not 10th year spending, not stuff you hope to get. Oh, trust me, we'll get the fraud stuff coming in. I want straight-up mathematical deficit reduction, a strong defense, healthcare freedom. We can do some other things in there, but those are my big 3. And it's got to be actual deficit reduction. $40 trillion in debt. We're spending more on interest every year than we do defending our country. Our kids and grandkids depend on us getting this done right. Reconciliation, we're having to use it for things like Border Patrol, ICE, and now trying to deal with the SAVE Act. I get it. It's a weird political climate, and we got to go win. But we need to do our job, reduce deficits, and that's really, at the end of the day, what reconciliation is for, is to deal with debt, deficits, and spending. So making sure we're reducing spending. So that's my goal.
I just sense freedom. I feel freedom when you're talking, Congressman, in your last months in Congress, and I hope that we can stay in touch for the rest of this one. Thank you for being with us for an honest conversation today about a wild day on Capitol Hill. Great to see you as well. Congressman Chip Roy, the Republican from Texas, as we now assemble our political panel for their take on everything we just heard. A revealing conversation you're not going to hear anywhere else. And we have Bloomberg Politics contributor, Republican strategist Rick Davis with us, partner at Stone Court Capital, joined by Laura Fink, Democratic strategist, founder, CEO of Rebel Communications. Rick, we heard a lot from Congressman Chip Roy there. Does this CR, based on what you heard, passed as reconciliation, maybe more importantly, passed with Pentagon money on board?
Yeah, I think it's really hard to reconcile that conversation because at one side he says, oh, I'm just all about reducing the debt and the deficits. And at the same time, I'm going to pass through this, just under $100 billion with no offsets. But we can get to it later sometime if there is an opportunity to get to it later. I mean, we've already added almost $4 trillion to the deficit since the president took office. And these guys keep making promises like Chip Roy does. I love everything he says. I just hate that they don't do any of it. And so I really think there's a reckoning coming, and people can't look in the mirror and make the argument that they're a deficit hawk when they say yes to all these big spending bills.
Well, he says he is willing to take the risk or roll the dice, he said, on this go around. And I guess we'll have to see what happens there and if he ultimately is going to get the pay force he wants, Laura. But he also clearly really wants to see some forward progress in Congress on banning the trading of individual stocks. We've been talking about this for years now. Is now actually the moment at which you think it happens?
No, I don't think so. And I want to say 100% I agree with him on this, and it should get done. And you heard him say he wanted a standalone bill. Like, that's the least likely way it's going to pass, if it passes at all. So I think this is, I understand why this is his pet project as he exits Congress, and that makes a lot of sense. But you also heard him say that he's dying on the hill of the Save America Act, the Bring Your Passport and Your Birth Certificate to Register to Vote Act. And I think that he's tying this $90 billion to that. So I'm just like, I'm roiling with the say one thing and do another. I mean, this is a congressman who voted for the big, beautiful bill, which added significant amounts of, I don't have the estimates right now, but I feel like we're like billions and billions, if not $1 trillion, to the deficit. So to me, it sort of rings hollow when, and to be fair to Chip Roy, this is endemic and it's just a problem with this Republican Congress, arguably the weakest Congress we have seen in generations in terms of standing up, checking the president, using the congressional power and oversight power to stand up for the beliefs that he was saying he held so firmly. So I'm really challenged with all of the things that he is wanting to do as he moves forward, because right now is the time, as you exit, is when you can take those risks because you're not on the ballot.
Indeed. There's a YOLO caucus in the House, too. It's not just in the Senate. Laura Fink and Rick Davis, our political panel today, will be sticking with us. We're going to have more ahead of them, from them in just a moment, as we're also going to head back to the Capitol Hill. We'll be joined by Democratic Congressman Brittany Peterson of Colorado. Will be joining us just ahead. First, though, we got to get a check on the markets and where we stand on this Wednesday trading day as we turn back to Charlie Pellet at the New York. Hey, Charlie.
Hi, thank you very much, Kayla. I'm going to call this a holding pattern. We are awaiting the latest numbers out of both Alphabet and also Tesla. We'll have those for you after the close of trading. Right now, little change. Perhaps the key takeaway is oil prices surge. S&P up 0.1%. Dow Industrials up 0.2%. Both NASDAQ and the NASDAQ 100 index, they're trading lower. Right now, NASDAQ down 0.2%. NASDAQ 100 index down 0.1%. 10-year 4.65%. Gold up 1.6%. 41.44 the ounce. A surge in West Texas Intermediate crude 3% higher, 86.86 a barrel. Brent up by 3.4%, back at 94.09 a barrel. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow, 5 o'clock Wall Street time, for special coverage of a UN town hall to hear candidates for the next UN Secretary General. We'll have it for you live on Bloomberg. Recapping S&P up 0.1%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much indeed. Checking on the markets as we continue to check on Capitol Hill and the progress that is being made today, which, by the way, could be the last day in session for the House of Representatives for 5 weeks, because they're supposed to leave for the August recess tomorrow. But if they get enough done this afternoon in a series of votes that we're going to see, rumor is the speaker could actually send them home a little early.
That would be impressive, because none of these votes have been coming easily, as I think we just animated with Chip Roy. We're talking about votes starting around 3:30, unless that's moved. Maybe you can tell me otherwise if you were in the newsroom more recently than I. We've got the NDAA on the table. We've got the budget resolution for reconciliation 3.0 that everyone's bringing their hands over. And we've got the stock trading ban in Congress that no one's been able to pass for years. So, well, this ought to go easily. And it's where we start our conversation with Brittany Peterson, the Democratic Congresswoman, Colorado's 7th District, a member of the House Financial Services Committee, on this day that the Clarity text is released. We've got a lot to talk about with the Congresswoman. Welcome to Bloomberg TV and Radio. It's great to have you after what we just heard from Congressman Chip Roy, who was pointing to Democrats as the reason why Republicans have to use reconciliation in this case to give the Pentagon more money, as Pete Hegseth, the Secretary of Defense, says is needed. Should I assume that it's, whether it's NDAA or reconciliation, that you're a no vote?
I'm absolutely a no vote. This is an illegal war, and it is, you were just talking about the increase in oil prices. This is hitting Americans at the grocery store, every basic essential, the costs are skyrocketing. So this is not a war that we voted for through Congress. This is a war that Donald Trump pulled us into, and I am absolutely a no vote.
Are you also a no vote on the continuing resolution to fund the government through December?
So I voted no because unfortunately there was a backdoor way that they were going to fund ICE's illegal operations. I believe that we need to have a functioning government, that we shouldn't be holding these critical services hostage. And unfortunately, it's a really cynical attempt. This is going to end in December. So after the election, hopefully we will have the House as Democrats and have some leverage in negotiating. But this is kicking the can down the road, and it's ultimately a budget cut because this is from the previous year funding levels.
What if that means a government shutdown lasting until the election? Is that a prospect that voters should prepare for?
I think that, I come from the state legislature where we always work together in a bipartisan way. None of us were 100% happy by the time our budgets came out. And ultimately, we would vote to move forward a package that is reflective of the people that we are representing in our priorities. I think what's so frustrating to see this time and time again, over and over, is just the chaos and dysfunction and unwillingness they never learned the lesson. By the way, Speaker Johnson, they were supposedly going to fix this backdoor loophole. Democrats were willing to come to the table on addressing this issue with the language that they had. They fundamentally didn't want us to come to the table because they didn't choose to address it. They moved forward as it is, so we'll see if the Senate actually gets it done. But this constant chaos, government shutdowns, this is not what our country deserves. We deserve so much better.
Well, we're also wondering if the Senate's going to get something else done before the recess, and that is passing potentially a Clarity Act that, of course, has been revised from the one that the House already passed to include now an ethics provision. And I'm not sure, Congresswoman, I know you sit on the Financial Services Committee. I don't know if you've had a chance to read through this more than 600-page Senate bill that was released earlier this afternoon. But in the ethics portion, a few key takeaways from my glance through it. This would cover all elected officials and spouses. They wouldn't be able to issue their own digital assets or sponsor digital assets, though the whole thing seems to sunset on Inauguration Day in 2029. And it's the DOJ that ultimately would be in charge with enforcing this. Would it be enough to get your vote in the House if it can get through the Senate?
Look, Donald Trump has been very clear with Republicans that this is going to go after the ways in which he is exploiting our country and our interests to enrich himself and his family, that he would veto this bill. So you can guarantee that this doesn't actually close the loopholes that exist right now. It's truly unprecedented when you think about a current president profiting over billions of dollars from his cryptocurrency and the stock trading that he continues to do while pretending to support stock trading bans. So, I think that I really appreciate the Republicans who have continued to try to work through this, but in private conversations, the president has been very clear that anything that gets in his way, he will not sign, which is, the American people should absolutely know.
So can this not pass the House?
So we'll see. I mean, I think that I know that issue is a top priority and something that we're trying to get done. The other pieces that are so important is making sure that we're regulating our digital assets and that we're providing a framework so we're not losing, the investments and the opportunities in this country, and that we're protecting consumers here. That means we have to do it in the right way. So to your point, I haven't read the 600-page piece of legislation that was just introduced, but we'll definitely be following this closely. We have a bipartisan coalition that's trying to work on threading the needle to protect people here in the United States and provide a pathway for businesses to thrive here.
Congresswoman, as we consider what ultimately will make things and businesses thrive, you mentioned earlier the costs that are around the war with Iran that have fueled energy costs and inflation here at home. Should we expect anything more bipartisan to be done in Congress to address the affordability challenge ahead of the midterms? Is there time for that, something like the bipartisan housing bill that was able to pass earlier this month, or have we seen all legislatively that we can expect to see?
We should be working on this every day. What the American people are facing because of these failed policies is absolutely unacceptable. People are in pain, and you're seeing this. This is why the Republicans, President Trump is trying to shove his Save America Act through the process to ensure that voters don't actually have their votes counted. They know that people are incredibly unhappy. They are feeling the pain from the healthcare crisis that they've created, the skyrocketing costs because of Trump's illegal war, and the tariffs that hit our small businesses on an average of $25,000 a month of unexpected costs. So when you think about the ramifications that this has, this is where we should be focused. And you brought up the housing bill. No thanks to the president, that became law. It doesn't make me feel hopeful. Anything that is not about something that is going to benefit Donald Trump, he doesn't care. As he said, he doesn't give a shit. So.
All right, that's quite a way to end it. I don't know that he ever did say that, but Congresswoman, thank you for being with us.
About housing.
Brittany Pedersen, Democrat from Colorado. All right, thank you. Can't talk like that on TV or radio here on Bloomberg.
Yeah. The Congressman from Colorado, thank you for joining us as we turn back now to our political panel. Rick Davis and Laura Fink are back with us, guys. No expletives, please. I think we've probably just hit our quota for the day. But Laura, I would love to get your take on what we were just hearing from the Congresswoman around the idea of affordability and what else is going to be able to be done in this Congress. If it doesn't even seem clear that we're going to be able to fund the government after the end of the fiscal year before the midterms, should we essentially assume that we're not going to get anything else much? The train is leaving the station.
Agenda, and it is no more and no less than that. And right now he is laser focused on the Save America Act, which would potentially disenfranchise 21 million Americans by requiring them to have a passport or a birth certificate in order to register to vote, and also make it really hard for women who might have changed their names, say by getting married. So this is the focus and not anything related to affordability. You heard the Congresswoman talking about him dragging his feet on housing, and so I don't really see that any of the leadership in the Senate or the House on the Republican side is going to go against the president by trying to bring something else into the conversation, much less contend with the increases in the lack of affordability. I mean, these ghost tariffs, these zombie tariffs that are coming back that the Supreme Court tried to strike down, Trump is so wedded to them, and we know that raises the costs for businesses that they pass on to the consumers, and that means it's going to cost more for just about everything you buy. I don't fundamentally understand why the president is so committed to raising prices for Americans between wars and tariffs, but it seems to be his sole agenda.
Rick, what do you think of what Democrats are getting into here, using defense spending and even the NDAA itself, an authorization bill as a proxy for the war in Iran? These votes, I presume, will be held against them in campaign ads in the midterms. Will they work?
Yeah, there's got to be a cost to taking a bill, the NDAA, for instance, that has historically been nonpartisan and for the public good and for our national security, and turning it into a political football. This is a really, really bad development. It shouldn't be able to last. And I think people who vote against it for, regardless of what reasons they have, they've had a chance to amend. It'll go through the legislative process. This is one of those things that is regular order, and the idea that we're going to make it into a political football strikes at the heart of our national security.
And yet a political football it seems to be, and we may get more evidence of that in the vote this afternoon.
Yeah, it's really something, Kaylee. They're going to be voting at 3:30 on, I guess it's going to be one vote for all of these, NDAA, reconciliation, CR. So we'll have some news on this. And thanks to our panel, Rick Davis, partner at Stone Court Capital, Bloomberg Politics contributor, and Laura Fink, founder CEO of Rebel Communications. Everybody's worked up in Washington today.
Yeah, well, and maybe in Europe too, as we just got some breaking news that just crossed the Bloomberg terminal. We were waiting for this, and it wasn't necessarily unexpected, but the EU, the European Commission, has just okayed Paramount's $110 billion acquisition of Warner Brothers Discovery. It has gotten the conditional nod. This was supposed to pave the way for the deal to close as soon as this week. Yet it will not, because, of course, here in the U.S., you had a lawsuit brought by a number of state attorneys general and a judge issuing a temporary stay, essentially. The deal can't close. There will be a hearing on August 3rd to decide the way forward. Got the nod from the EU. Here in the U.S., still an open question.
Paging Ram Banta out in California, along with several other attorneys general who put the brakes on this deal. We'll have much more on it as we move forward. This is Balance of Power, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story. European Union says yes, Paramount's $110 billion Warner Brothers Discovery deal does get EU conditional nod. That headline right now on the Bloomberg Professional Service. We do have shares of Paramount Skydance. They're rallying now by 2%. Warner Brothers Discovery up by just about 0.1%. This development comes after earlier in the week on Monday, a federal judge temporarily paused Paramount Skydance's takeover of Warner Brothers Discovery, saying it likely violates antitrust law. However, moments ago, Paramount's $110 billion Warner deal did get a conditional nod from the European Union. Stocks continue to hold on to gains. Little change, perhaps the key takeaway at this hour. Ahead of earnings after the bell coming up from both Tesla and Alphabet. Both companies to be closely watched for any indications about their capital expenditure plans. Alphabet shares right now up by 0.3%. Tesla in the red, down by 0.6%. S&P up 0.1%. We do have the Dow higher by 0.2. NASDAQ down 0.1%. And the SOX, the Philadelphia Stock Exchange Semiconductor Index, higher now by 1.2%. Your 10-year at 4.65%, the 2-year 4.29%, and the 30-year now at 5.14%. Gold 41.38 the ounce, up 1.5%. West Texas Intermediate crude up by 3%, 86.88 a barrel. Barrel of Brent crude was above 95, now at 94.14, still higher by 3.5%. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow at 5 o'clock Wall Street time for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. I'll have it for you live from UN headquarters. Recapping, S&P up now by 0.1%. I'm Charlie Pellett. Joe and Kaylee, that is a Bloomberg Business Flash.
Okay, Charlie, looking forward to that tomorrow at 5 p.m. Eastern as Bloomberg holds forth from UNGA. I'm Joe Matthew in Washington alongside Kaylee Lyons. We have news on Clarity. That might sound strange, but that is the name of the crypto bill that we have seen debate up and down for months, should I say years, Kaylee? And we actually have the text. We're about to wonk out with none other than Patrick McHenry, because John Thune says he's planning a vote for next week. The updated bill text, this is the important part, and this is what has been shaken loose here, would prevent federal officials and their spouses from issuing digital assets. This is the ethics language Democrats have been asking for with their eyes on the Trump family. Will it be enough? Patrick McHenry, the former Republican congressman, used to chair the House Financial Services Committee, which would be managing this. He also held the gavel for some time, as you remember, Speaker Pro Tem. He's all ours now, and it's great to see you. Mr. Chairman, welcome back. I don't know if you've had a chance to crank through the text. I know that you're a supporter of this bill and the need for a framework. Will this pass?
Eventually, yes. It's a question of timing. It's sort of when, not if. Though the debate right now on Capitol Hill is a lot of if. The Democratic Party, particularly the pro-crypto Democratic senators that are part of the coalition working on the bill, have raised real concern about so-called ethics language. And that pertains directly to the president and his family's financial holdings of crypto assets. What they fail to realize, and the debate right now on Capitol Hill fails to realize, is that we don't have any federal law dictating what is a digital asset, what is a means of exchange, and the legal parameters around those things. So there is currently no law on this. The best ethics language we have is actually passing the Clarity Act, so you have a clear definition, clear rules of the road, and consumer protections that come from that, as well as the ability to deploy capital here and have innovation. So the big thing here is to get the bill done. It's a question of whether or not the current politics will permit that to happen, or we have to wait longer for the Senate to come to terms with this.
Your point is well taken, Mr. Chairman, that you actually need the market structure portion of this to be able to define what it is that you want to restrict the president and his family from doing. But on the ethics provision, because it is obviously part of this 616-page bill, I think it would stop any elected official, president included, and their spouses from issuing a digital asset. It says nothing of other members of the family, like, say, children of a president. It would be enforced as well by the Attorney General, by the Department of Justice, and the whole thing sunsets on Inauguration Day in 2029. Does that really have teeth in your mind?
Well, it does, because ethics rules are still ethics rules. When you outsource this to another, who do we outsource our federal government to? Elections and the people. But in order to hold federal officials accountable, you have to have rules within that regime. What Democratic senators want to do is hand this over to Democratic state attorney generals, to states attorneys general, to sue the president and enforce this law. That is a recipe for disaster, and I think their own party should recognize what Republican states attorneys general would have done to a President Biden under those circumstances. This is a recipe for complete chaos. The question now is whether or not you can have enforceable ethics language and what would be sufficient to get pro-crypto senators on board. Right now, Senator Alsop-Brooks has said that under no circumstances is this enough, but we have to recognize that the president coming to even this language is a major concession for not just the president, the White House, and the executive branch generally.
Well, this is the part of the interview where you feel happy to not be in Congress anymore, Patrick McHenry. What's about to happen at 3:30? We're going to vote on the NDAA. Democrats don't want any part of it. A budget resolution for reconciliation that many folks, we talked to Chip Roy earlier this hour, even Republicans are concerned that it's not paid for in some cases. We've got a stock trading ban. Is all this going to pass?
Lions and tigers and bears, oh my. This is a real mashup before the House leaves for August recess. Look, I've wanted to say this for a while. Newt Gingrich always said the House is like riding a bicycle. The only way is to actually move forward. I would say it a little differently. In this environment, you have the Senate. In the nature of the Senate, you have old bulls sitting, chewing grass, and content to sit in the sunshine. That's what the Senate does on a sort of a daily basis. In the House is a lot like a border collie or a Labrador or some young pup. If they're fully exercised, they're fine to have inside your house. If they're not fully exercised, they can be quite destructive. And that's what's happened with the House Republican Conference right now. For the Speaker and the leadership, this is where coups and palace intrigue persist when there's no action in the House. And so they had to put together an aggressive agenda in order to get aggressively out of town to save the House Republican Conference. That's really what we're doing right now, is just running as fast. The House Republican leadership is running as fast as possible so they can get out the door and save themselves until we come back for September for more chaos with House Republicans.
Jeez.
And again, I say this as a friend of House Republicans, having spent my adult life working in and around it and loving these folks. But it is what it is.
And I raised a Labrador from puppyhood, and this analogy is really, it's working for me, Mr. Chairman. I understand what it is.
A lot of exercise. Well, the other way to say it.
That you're saying, yes, that is, it's very true.
House Republicans are also like Marines, in that if there's a mission and it's something critical, they're eye on the prize. But if they're on leave and it's a Saturday night, things can get rough.
Wow,
you got to email McHenry on that one.
Yeah, we'll have to take that conversation offline.
Not the dogs.
Okay, well, what about on the idea of something mission critical? I think a lot of people would argue that funding the government falls into that category. The Speaker decided that he would just try to make sure we don't shut down in September by punting until after the midterms, until early December. It's unclear what's going to happen in the Senate. The Senate Majority Leader is suggesting that if Democrats don't negotiate on a CR, he's just going to attach it to budget reconciliation. Mr. Chairman, is that effectively killing the filibuster?
That's one mechanism to kill part of the filibuster, which has been eroded over the years. But it's also more of a forcing mechanism to get Chuck Schumer to the table. Look, we went through the longest government shutdown in American history, and it was because Chuck Schumer and Senate Democrats wouldn't give the necessary votes to pass a continuing resolution. And so I think that's where we're headed September 30th this year, unless Leader Thune can entice Leader Schumer to pass a continuing resolution. That's really what the messaging is about. And this will come to the fore as September goes on, but not until then.
So is this how we do it now? And I guess every other year, if there's an election coming in November, you guys better get a CR before August recess, because this whole government's going to shut down. We simply can't function otherwise.
That's basically where we are. The budget resolution, the 1974 budget resolution, which was House and Senate Democrats' response to Nixon's impoundment, that's why we have this budget process, has been broken. It's been broken for 30 years. Congress has not passed all 12 appropriations bills by September 30th since the 1990s. So we have a broken legislative process that is further broken because we don't have great muscle memory from policymakers on how to do this basic piece of governance. And so that means that we're in for more chaos, not less, more needless, senseless political violence, not less.
Well, it's a sorry state of affairs, to be sure, Mr. Chairman. When we consider the notion of regular order being something difficult to come by these days, hence why we're talking about a third budget reconciliation package now, I wonder how realistic you think the prospect is for a fourth, because that's what your former colleague, Congressman Chip Roy, was talking to us about. He hopes he'll get his pay-fors. He's just going to wait to see those pay-fors until, in his mind, budget reconciliation 4.0. Is there a real chance of that?
Well, again, this is about the House staying in motion. And as long as you stay in motion, you can stave off palace intrigue and coups. And that is what this reconciliation 4.0, or whatever we're going to call it. But also, when you hear policymakers talk about a fourth iteration when they can't get the third iteration done, it makes me question what medicines they're on and whether or not these psychedelics are in fact now close to FDA approval, whether or not they're already in pre-drug trial here. It's absurd to talk about this, especially in an election year, this late in an election year. It's one of the more bizarre things I've heard out of a really bizarre political year we've had in Washington.
Wow. This is the best Patrick
So I'm saying there is
ever.
no chance of a reconciliation 4.0, not even the slimmest.
Understood.
All right, putting the psychedelics down. I thought of you when did you see this Gallup poll this morning? We can talk about the vote all day long, but we're getting right down to it here. Americans are the most likely to name politics as a threat to their safety, Mr. Chairman. The latest polling by Gallup identifies 1 in 10 Americans saying politics is the greatest source of risk to their personal safety. More than half of American adults believe the government does not care about them, a record high. Aren't we seeing a reflection of this?
We're seeing a reflection
in our House of Representatives?
We are. Yet these American people that have this feeling vote in these people. This tells me that populism is not some sort of President Trump phenomenon, that populism is going to continue to rise in American politics because of because of that very explanation you just gave. When you look at the elected officials and say they don't care about me and they're a source of my problem, not a part of my solution, you're going to see unrest. That'll be vividly displayed in not just the primaries that we have continued throughout this election year, but in the midterms, and then going into the nomination process for both parties, the presidential nomination process that will start next year.
Can't wait for that. Just to end the interview on a more optimistic note, perhaps, for yourself, Mr. Chairman. If market structure finally happens, if clarity can get through, ethics provisions included, what else does the crypto industry need in terms of legislation? They fought for the stablecoin legislation. They've long fought for market structure. What's next?
Tax provisions. We have to have clarity on our tax law on what these digital assets are. And what the holding periods are. We had to define these things for commodities and for securities, and likewise we'll have to do that for digital assets. In the nature of a stablecoin, for instance, it should be treated in a similar fashion you have for your bank deposits and interest derived from bank deposits as a tax measure. And so then we have to define what's the holding period for these digital assets and what a capital gain structure would look like. So there's a lot of work to do on that front. And then the regulatory process will be ongoing as a result of the Clarity Act as well for the next year or two.
All right, the former chair of the House Financial Services Committee and now, of course, Bloomberg Politics contributor Patrick McHenry. Thanks for joining us on this early edition of Balance of Power. And we'll be back for more in the late edition at 5 p.m. right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
All right, right, everybody, welcome to Bloomberg Business Week Daily. This is Carol Massar along with Tim Stanovic live at New York headquarters of Bloomberg, and a little bit of a big tech earnings churn when it comes to the markets today. We have some big earnings coming our way after the closing bell. We're talking about Tesla and Alphabet. So ahead of that, we've got a market that's kind of little changed.
Little changed, except if you're chip stocks. The chip makers are actually doing pretty well.
For a second day, right?
For a second day. NVIDIA climbing 3%. Software firms are getting hit again. We're going to have more from Charlie Pellet in just a minute. The real story, though, you mentioned, earnings after the bell and also geopolitics.
Yeah, absolutely. We're going to get into all of that. By the way, Alphabet right now is just down a hair. And if I pull up Tesla ahead of earnings after the closing bell, that stock down about 0.8%. So a little bit perspective. Speaking of perspective, the war that just doesn't seem to find an end or even to seemingly move closer to some kind of peace agreement. We say we have a peace agreement, but it's kind of not happening. So we're going to get into the bombs, the boats, the boots, President Trump's Iran dilemma, what it all means as we watch oil prices tick higher, moving stuff around, especially from that region. There's a cost to that. I'm thinking about global inflation, certainly ahead of the Fed meeting next week.
Yeah, Chris Kennedy going to be joining us in just a few minutes. Also joining us a little bit later, Rory Halaka, partner of the management consultant Oliver Wyman. We're going to talk about the automotive blind spot when it comes to AI.
Looking forward to that. And speaking of autos, the twists, the turns, the bumps of the global auto industry, there have been quite a few over the last few decades, actually go back to the 80s, if you will, from bailouts and buyouts, Elon and EVs, to China's coming of age. Bloomberg's Keith Naughton came to Bloomberg just after the great financial crisis, just as the auto bailout was certainly kicking into high gear of the big three, which are really no more. There has been so much that changed coming out of the GFC when it comes to the global auto industry, and the change continues. We're going to get into where it was when Keith came to Bloomberg and really when he kicked off his career writing about the auto. That was back in the mid-'80s.
Yeah, 41 years ago, to be specific. 1985 was the year he kicked it off. So we're looking forward to that. I mean, this guy could write several books.
Yeah, absolutely, and I hope he does. He's getting ready, though, to shift gears, so we're going to talk about all of that in just a moment. First up, though, let's get to the trade ahead of those big earnings after the close. Here is Charlie Pellet.
All right, I thank you very much, Carol and Tim. Happy Wednesday. We're looking at an S&P 500 index. Those gains fizzling, yes, higher, barely up now by half a point on the S&P 500 index. Flat ahead of earnings after the bell, coming up from both Alphabet and Tesla. Dow Industrials holding on to an 82-point gain, up by about 0.2%. Both NASDAQ and NASDAQ 100, both in the red, but as Tim mentioned, we got the stocks higher. Philadelphia Stock Exchange Semiconductor Index up now by 1%. On NASDAQ, looking at a loss now of 0.3%. NASDAQ 100 Index also down by 0.3%. S&P, there she goes, now trading lower, down under 0.1%. The SOX bears repeating, up by 0.9%. The 10-year, 4.65%. The 2-year, 4.29%. And the 30-year, now at 5.14%. Gold up $60 the ounce. An ounce of the precious metal now at $41.37, up 1.5%. Crude ripping higher. WTI, Middle East tensions. Right now, WTI at 86.76 a barrel, higher by 2.9%. Barrel of Brent, 94 even, up now by 3.3%. Recapping, S&P 500 index now lower, down 1 point, coming up after the bell. Alphabet and Tesla. Alphabet flat on the day right now. Tesla down by 0.8%. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow, 5 o'clock Wall Street time, for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. We'll have it live from UN headquarters. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
Hey, what makes you sure the S&P is a she? I just want to know that.
That's a very good question, which I had not given full thought to. I wasn't expecting to be asked, but let me flip it right back at you, Carol Massar.
What?
Why would she be anything else?
I don't know. Maybe she's the NASDAQ 100. I'm just going to put it out there. All right. All right, Charlie, we'll come back to you a little bit later on. All right, we got to get to the global picture, geopolitics. We've had 11 consecutive days of U.S. airstrikes. They have done little to change the direction of
of the Iran war. The result, a stalemated conflict where both sides are trapped in a cycle of strikes and counterstrikes. President Trump is likely at an inflection point, escalate the war to break the impasse or find a way out through diplomacy. So writes our team here at Bloomberg Economics.
In the meantime, we are seeing market effects of this, specifically when it comes to oil markets. Oil spiking above $95. It extends this month's price jump to around 30%. This as the U.S. and Iran playing down the prospect of peace talks and disruptions to global supplies. Those continued to mount. Carol, it couldn't come at a worse time for, summer travel.
Yeah.
But also politically for the president, who wants to make sure that he's selling that affordability message ahead of these midterms.
Exactly. It's not like, midterms are just a few months away. Hey, and there's also that next round of tariffs as the president is poised to impose fresh levies on products from dozens of economies. That's going to happen by Friday, according to people familiar with the matter. Let's get to it. Let's head to our D.C. News Bureau, Bloomberg Economic statecraft lead. He is Chris Kennedy. He's back with Tim and me. Hey, Chris, the U.S. strikes continue. We mentioned bombs, boats, boots, President Trump's Iran dilemma. It does feel like we're at an impasse. How do we see it? How do folks that you guys are all talking to see it about what happens next here in this conflict, this war?
Yeah, Carol. So like you said, there are no good choices for the president right now. And I think, oil traders are looking at some of the news that, for instance, there aren't direct negotiations happening, which suggests that we're going to be in this cycle at least for a little bit longer. The president is clearly very frustrated with the war. He is upset about the deaths of service members, and he's looking to, continue strikes for the time being. Of course, we don't know, whether we'll see additional escalation, but the longer this goes on, the larger the impacts on the global economy, especially through this continued strangling of oil exiting that region.
In terms of escalation, if we just play out one scenario, and that's a scenario that the president shared on True Social a little earlier today, and that was the idea of retaliation and bombing or striking a power plant or a bridge in Tehran, for example. Is that something that you think the U.S. would actually follow through with?
It's a good question. The
reason I ask this is because this threat has been made before.
Mm-hmm. Yes, of course. Yeah, and of course, these sorts of sites have traditionally been off the table for U.S. strikes. But the president and the U.S. have consistently said that a lot of these civilian infrastructure sites are actually used for military purposes as well. I think what we've seen is that the U.S. has been striking some of these dual-use sites recently, and we've seen retaliatory strikes from Iran on regional infrastructure that certainly goes beyond U.S. military assets. Nothing that's going to be, too disruptive, but that could change if U.S. strikes continue.
All right, so Chris, impasse, who knows, right? We could, I'm sure, go to Polymarket, and there's tons of bets or Kalshi about what's going to happen next in this war. Having said that, there's a cost, obviously, in lives. Let's not forget damage in various regions around the world, fiscal budgets because of money spent on defense, geopolitical relationships, which seem to be being remade, if you will, those higher energy prices, higher transportation costs as the world tries to move things through the Middle Eastern region. How are you and the team continuing to calculate the economic cost of this? And we think about it ahead of the Fed meeting next week when we will be focused on what Fed Chair and the FOMC has to say about monetary policy and the U.S. economy.
Certainly. Of course, there are the direct costs, and Secretary Hegseth, Defense Secretary Hegseth, was in front of Congress this week talking about those direct costs. But of course, the more relevant costs for the global economy are the impacts on global energy markets. And as you noted, crude oil prices continue to tick up a week ahead of the next Fed meeting. We're seeing that demand for fuel in the U.S. is pretty robust still. Inventories of crude continue to fall. We're seeing additional pressure on global energy markets from Ukraine's campaign against Russian energy infrastructure and vessels transporting Russian oil. So those costs are going to continue to grow so long as this conflict persists. And it's hard to know how quickly this will happen. Another big blind spot is what is China going to do over the next couple months? Are they going to resume energy purchases? That's been a real buffer for the global economy, since the war began.
I think a lot of consumers focus on the gas prices and above $4 a gallon, and that's a threshold. But one thing that I think a lot of people who are in the industry focus on is the price of diesel, and that being above $5 a gallon has some real repercussions. I mean, if you think about just produce, for example, let's say it comes from California. How does it get from California to another state? Oftentimes it's on a truck, and that truck runs on diesel, and this stuff adds up. How does that, in your view, play through and flow through to other parts of the economy? Diesel, by the way, up to about $5.18 a gallon right now, national average.
Yeah, certainly diesel is going to have a much deeper transmission into different elements of inflation than gasoline. Diesel is used to transport everything, as you mentioned. I would also say that diesel is where we're seeing this sort of multiple factors hit the global market. So Russia banned the export of diesel. Russia is traditionally the source of about 10% of the world's diesel exports. And I think we're going to see additional pressure on U.S. exports for diesel, which of course will transmit into domestic prices that affect everything from transportation to construction, everything, mining, et cetera. So certainly diesel is sort of the backbone of the real economy, so to speak.
Hey, just real quickly before we wrap up here, Chris, we've also got the president talking about another round, or at least according to people familiar, another round of fresh levies on products, new round of tariffs on economies. That's expected to come again at the end of the week. What do we know? And that could be what? More inflationary pressures here, just quickly.
Yeah, I mean, our base case is that the president is going to impose these Section 301 tariffs over forced labor. They will replace the Section 122 tariffs that he imposed after the Supreme Court lost back in February. The net effect is actually not that significant. It's a slight tick up. We'll be around 11% for the U.S. global average effective tariff rate. That's up maybe about 0.5%. I think we're going to have to see what comes next.
Right.
The president also made a couple decisions. I'm sorry. I know.
No, that's okay. Go ahead, quick. Yeah, you can wrap up.
I was going to say, we also got some countervailing moves. So earlier this week, the president decided to offer some relief to aluminum importers, and that's been a huge drag on manufacturers in the U.S. So I think the president is seeing that some of these tariffs are having a negative effect on the economy, and that might be a positive sign, moving later into the summer.
Well, here's another sign. The U.S. 30-year bond yield trading above 5% for the longest stretch since the dawn of the financial crisis, echoing some investor concerns about a growing debt pile and sticky inflation. So starting to see these signals that certainly keep us on our toes. Hey, Chris. Thank you. Chris Kennedy, Economic Statecraft Lead for our Bloomberg Economics team. Tim, he's there in our D.C.
Yeah, I mean, truly does it all. War to gas to tariffs to diesel to inflation. So, appreciate him keeping an eye on all this stuff for us.
All right, that is certainly the macro. Let's get to the micro. And Houston, we kind of have a problem. OpenAI said its advanced artificial intelligence models inadvertently hacked Hugging Face in an unprecedented incident that prompted fresh calls for curbs on the technology. Are you worried?
I am among those who might be a little worried.
A little perturbed?
Yeah,
a little worried?
Let's see if Ed Ludlow says we need to be worried. He's the host of Bloomberg Tech. He joins us from our San Francisco bureau. Ed, I got a text message just minutes ago from some friends. They sent this article to the group chat and said, be honest, how many years do we have left?
This is a big story, but it's not a scandal. And it's really important to understand what happened chronologically. Okay, so OpenAI was testing GPT 5.6 Sol, which is its most advanced publicly released model, and it was testing another more powerful but unreleased model for their advanced cyber capabilities. Okay, they were running an evaluation of them. And what they did was reduce the guardrails on those because it was in what's called a sandboxed environment, a closed environment which OpenAI had control over. And so that was the instruction to the models. We want to test your cyber capabilities, evaluate them. So the models were like, okay, in order to do this, to pass the evaluation, the models wanted more information. So they exposed what's called a zero-day flaw, basically a flaw in the code. It's called zero-day because the engineers, the human engineers, had literally 0 days to find and patch it. And in doing that, the models got access to the internet. So their next logical step was, okay, our instruction is to pass this evaluation. We could do that if we had more information, and Hugging Face seems like a really logical place to get that information because it's a platform that hosts models specialized in this area. So it breached Hugging Face systems to get the information to try and cheat the evaluation. So that part is a concern. But Hugging Face detected that this was happening. So this is a lab experiment, essentially, under closed parameters. And the way that the industry has reacted is there is some concern because the big takeaway is it shows what these frontier models are capable of.
Okay, I'm glad. That's where I wanted to go with this, because maybe it's fine in a lab if it's OpenAI and Hugging Face, but if this technology, let's say, gets out, and who's to say that the same guardrails will be in place with a model maybe 1 year, 2 years from now in China, for example, that may not have the same guardrails. I think that's what has people concerned.
Now we're getting to the story, the story behind all of this, which is these were two American companies. And OpenAI is neck and neck with Anthropic, but it's a leading frontier lab that was testing American-made models. Closed models. Hugging Face's defense was to rely on an open source model, but where the guardrails limited the ability of that model to defend it against a cyber attack, which in this case so happens to have been instigated by a US-made frontier model. I know that that's hard to track, but you're quite rightly pointing out the question that loads of people in industry have, which is, what if this wasn't OpenAI? What if this was a Chinese model where Hugging Face is the defender of what's going on, isn't able to properly protect itself? That is the debate that's been opened.
I guess my question is, Ed, if there are guardrails, which we'll assume will be in place, is that 100% or 99.9% guarantee that things will not go wrong or astray? Or we don't know?
Okay, so again, it's important to go back to OpenAI was testing two specific models with the guardrails intentionally reduced. And the way to think about it is when you have the guardrails on, you are testing how a model behaves on public roads. I know you guys are doing a car segment. So say on public roads, you want the guardrails there. In a sandbox environment, a closed environment you control, you pare back the guardrails because you want to see how it can perform at its greatest capabilities. Closed models, you can do that. You have control. The worrying part here is the Hugging Face part, that they relied on an open source model where the guardrails that are there for very good reasons also diminish that model's ability to defend it against a malicious action, whether it was a mistaken action or not.
Okay, so then, all right, this story has definitely caught our attention. Just got about 40, 50 seconds left. So anybody who's listening and somebody comes up and like, did you see this story? You would say, not a big deal, or?
Yeah, so the cybersecurity industry, the AI industry and their investors basically think this is a good thing because they want the leading labs, OpenAI in this case, to be testing what these models are capable of and then reporting back. So OpenAI and Hugging Face have got together, they have partnered, they've taken steps to make safe the situation and do a full investigation, and that report will come out. But that's being cheered as a good thing. The information from this whole experience will be valuable.
All right, that makes sense, and giving us the context and understanding.
So we're safe for now, Ed. Thank you.
For now.
For now.
Skynet, yeah.
To be continued, TBD. Ed Ludlow, thank you so much, host of Bloomberg Tech. He's going to be back later in the 4 p.m. hour. We got a lot of earnings to get through, including Alphabet and Tesla, so Ed's going to join us with that. And speaking of Tesla, we're going to talk to someone who's covered it, along with the big three and so much more. Our own Keith Naughton's going to be here. Stick around.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. A little change right now on the S&P 500 index, higher barely, up under 1 point. We've got the Dow advancing by 0.2%. NASDAQ, though, in the red, down 0.3%, with the NASDAQ 100 index down by 0.3% as well. All of this ahead of key earnings out of both Alphabet and Tesla. Right now, Alphabet shares down 0.1%. Tesla also lower by 0.8%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, pushing higher by 0.9%. 10-year 4.65%, the 2-year 4.29%, and a 30-year 5.14%. Spot gold up 1.5%, $41.36 the ounce. West Texas Intermediate crude just above 87 a barrel, up 3.2%. AMD has agreed to invest up to $5 billion in Anthropic. AMD up 1.6%. Meanwhile, OpenAI plans to spend tens of billions of dollars on a massive new data center near Savannah, Georgia. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow, 5 o'clock Eastern, for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate. That'll be live from UN headquarters. I'm Charlie Pellet. Carol and Tim, that's a Bloomberg Business Flash.
Thank you, Charlie. BMW pulling out of this year's Paris car show as its new CEO cut costs following a major profit warning. Also on the Bloomberg, Tesla's Cybertruck may be on its way to becoming viewed as the greatest automotive flop of all time, similar to the Ford Edsel, which was introduced back in 1957. There is always...
You don't see a lot of them on the road today. Let's just say
always a lot going on in the global auto industry, covering all the twists and turns, the tight curves of the global auto industry, from bailouts and buyouts, Elon and EVs, to China's coming of age. Bloomberg's Keith Naughton, who began his career back in 1985, coming to Bloomberg in 2009 amid the great financial crisis and the big three auto bailout. He's written about all of it and more. We are delighted to have him in New York. His home perch has been in the Detroit area, but he is getting ready to wrap up his valued and very respected career here at Bloomberg. We can't even believe we're not going to be like, call Keith. We want to talk to him about this.
I can't believe they're letting you retire.
Yeah. Well, it's time. It's time. Every good career has its moment, and leave out on a high note.
Well, we are really happy for you. It is sad for us, as Carol mentioned, and we do want to start at the beginning of your career, all the way back in 1985, 41 years ago. Take us back to that time. You were at the Indianapolis News, and it's where you began your career. And I think it's so notable because it's like, that was when so many U.S. automakers were concerned about Japanese cars.
Yeah, so that was the big story in that time. The way I got the auto beat is my business editor at the Indianapolis News, this guy named Ed Lawler. He said, so I grew up in Detroit. He said, so you're from Detroit, so then you'll cover the auto industry? And it's like, okay. But yeah, so, it was all about the Japanese coming to America in those days. Sounds like an echo, doesn't it?
Yeah.
And so one of the big stories I was covering at that time was Toyota was looking for the location of their first American factory. All the states were, vying for it, Indiana included. It ended up going to Georgetown, Kentucky. So I was there for the groundbreaking of that one and interviewing the governor at the time, Martha Lane Collins, and now here we are with when will the Chinese come to America, and where will they locate, and do the states want them, and it'll be very similar.
Do you remember what car you were driving?
Yeah, in those days I had a Renault Alliance.
Oh, wow.
Made by UAW hands in Kenosha, Wisconsin, when Chrysler and Renault had a joint venture.
Well, I'm so glad you mentioned Chrysler, because one of the, icons or iconic figures of the auto industry is Lee Iacocca. And we actually have a picture, 1989, of you with him, and we'll bring it up for everybody.
Yeah.
Tell us about this moment. For those on radio, it is Keith Naughton a few years ago, a couple decades ago.
A lot more hair.
No mustache, though.
Lee Iacocca was
He was iconic. Yeah, no. So that's obviously a scrum, and I'm clearly laughing too hard to try and impress the chairman. But no, he was something. I mean, I remember when he came back from Japan, And this is when the original George Bush had gotten sick on the lap of the Prime Minister of Japan. I don't know if you remember that moment in history. So Leto comes back and he gives a speech.
It seems so charming amid the geopolitical backdrop today, but go ahead.
He goes back and gives a speech to the Detroit Economic Club all about how we should essentially, and he used this kind of verbiage, go to war with the Japanese, which, given the whole World War II thing, was probably not the right way to put it. But that was Lee Iacocca. He pulled no punches.
And had to deal with his own crisis, though, right?
He did. Oh, absolutely. I mean, he saved, not more than kind of. He definitely saved Chrysler. They were in dire straits. And remember, he got fired by Henry Ford II, right? Hank the Deuce fired him. Iacocca's the father of the Mustang, and then he, rehabilitated himself by saving Chrysler. It was a great time to cover the industry because there were such swashbuckling characters in those days. Bob Lutz, all these guys that just said what was on their mind.
It wasn't all the auto industry for you, though. Some other highlights in your career, even before coming to Bloomberg. Senior correspondent at Business Week, you covered the auto industry. You were auto reporter at the Detroit News. Before Bloomberg, though, you were Detroit bureau chief for 10 years over at Newsweek. We covered the auto industry there, but also some other stories, including
Martha Stewart. And this little-known man put on the cover, he's president today.
Yeah, Donald Trump. Yeah, I spent a couple of days with the Donald and Melania. There's the cover. Yeah, that's the one I wrote.
For those on radio, it says, it's Donald Trump, back in his apprentice days, you're fired.
Right, so he was, the story on how that ended up on the cover was, this all sounds braggy, but I was talking to Jack Welch. I did this all in one day. I was talking to Jack Welch, former chairman of GE, and he told me it was his favorite show to watch. He and Susie would watch it every night.
On his network, right?
Yes, on his network. and so then we reached out to Trump, who in those days there were no PR people. You just called his secretary, and he gets on the phone, and he told me that in no uncertain terms we should put him on the cover. And I'm like, well, right now it's just a business story. We're going to do a business story in the business section. No, you should tell Rick Smith, who was, the publisher at the time, put me on the cover. And then when it went to the meeting that day, the editor said, okay, let's put him on the cover. I called him back, and he said, I'm glad you listened. So then we both flew to Mar-a-Lago and hung out for a couple days.
Well, what did you find about him on that trip to Mar-a-Lago? Obviously, no prediction that he would one day become president and serve out another term.
he was a Democrat then, and he had run as a Democrat. Sort of run is more of a marketing exercise in the Gore-Bush election, the election of 2000. So we talked a little bit about that, and he and Melania at that time were engaged. They got married a year later, and of course, Bill and Hillary were at the wedding. There's the famous picture of the four of them together,
Isn't
right?
it like changing times.
But yeah, he was the Donald. We watched The Apprentice together, and he would, turn down the sound when it was the contestant segments, and then when he was on, he would turn it up to a deafening volume so no one in the room could talk.
So fascinating, like the places that being a journalist takes you, right?
Yes.
And to certain people. All right, let's talk to your time at Bloomberg. 17 years, you came at what was a really difficult time for the world, for the U.S., for the financial industry, and for automakers. Who can forget, right, the automakers being hauled before Congress, the CEOs?
Right. The bailout. Yeah, no, it was amazing because it was right as I was leaving Newsweek and starting at Bloomberg. When I was here for my training in New York, Obama was being inaugurated for his first term. And George W. Bush had sort of handed the baton to him to save those companies. And famously, they were all asked, they'd got in trouble for, there we go. They got in trouble for flying in for the hearings, and they're told they should drive in for them, so that's what they did. They were all asked to give up their pay, and everybody except Alan Mulally at Ford said they would. Alan Mulally said, yeah, I'm fine. And they're the ones who didn't take the bailout.
I was just going to say, they didn't, did they?
No.
A lot has happened in the auto industry since then, and it kind of brings us to almost to today. The rise of EVs and the way that, even conversations that we had with you on our program in the last 6 years, at the beginning of that, and that's how long I've been doing this. That's why I went with the 6-year number. At the beginning of that, we talked to you about the huge investments that these U.S. companies were making in EVs, how difficult it was to get a Ford Mach-E and the wait list that a customer would have to wait on, and getting a Lightning pickup truck. And just a few years after that, we're learning that these investments are being pared back, and the customers just aren't there for these.
It was one of the biggest misses ever. And I think we sometimes, our view of it isn't long enough. We think, okay, so Trump got in office and he took away the EV incentives and that was killed the market. No, the market was withering before he got elected. Americans just, we live in a very big country. So range anxiety is real. It's easier in other places that are more compact and that have a better infrastructure for recharging vehicles. So particularly in the vast middle of the country where I live, people just aren't sold on EVs, particularly people who drive pickup trucks. The big bust of the whole American EV cycle was putting in pickup trucks first, because if you use an EV pickup truck to tow or haul, the battery is depleted in no time. So it's just not practical. So everybody has taken a step back. I actually think in some ways Trump does them a favor because it gives them time to regroup, as long as they keep those barriers to the Chinese, and hopefully they'll come up with a better solution.
We have another picture of you, I believe, with Alan Mulally, and this was in 2009, former Ford CEO. You said it, you reminded us he didn't take the bailout. Then where are you guys?
We were, he was, I think, in that picture being inducted into the Automotive Hall of Fame. And we're in Detroit, I think in...
was it 2009?
Yeah, it might be a little later than that.
A little bit later?
I think it's more at the end of his time. But it was in 2009 that he avoided the bailout. And, he saved Ford along with his boss, Bill Ford. Never forget, the Ford family runs Ford. So,
still.
But no, he was a rock star. And he was great to work with. And he also was one of those guys who pulled no punches and had things on his mind.
We were thinking about you. You're a lot of fun to talk to, and we just love covering this world with you. You've inspired a lot of us, and it seems like you've also inspired someone who's very near and dear to your daughter. We have another picture we want to pull up, and maybe you could tell us a little bit about this. That's you. For those on radio, it's Keith, obviously, and then there's your daughter?
Yeah, that's Nora behind me, and we're both scrumming Jim Farley, who is now Ford's CEO. I think that's at a New York Auto Show, maybe in 2019. So yeah, Nora has worked in different places. She was also at the Detroit News, like I was. She was at the Wall Street Journal, Business Insider. So she's great, and it's great to have your child in the biz with you. So she's wonderful. And that was a great moment. And that picture was taken by Ford's Chief Communications Officer, Mark Truby. He was monitoring the scrum, and he saw that shot and got our faces of skepticism. So.
Which you sometimes have to do when you're covering an industry. We've got to wrap up, but as you look forward to your world, and are you going to be keeping an eye on the auto industry?
Oh, I mean, I live in Detroit. It's hard not to.
Yeah.
you know?
Well, what's your thoughts? Like, we've only got 30 or 40 seconds. Like, there's a big lesson for the...
I think it's a really perilous time for the American auto industry. They really do need to reinvent themselves before the Chinese arrive. And as Bill Ford said last week, they are going to arrive. And if the American auto industry isn't ready, lower priced cars, electric vehicles, if they aren't ready, they won't survive.
Are you driving an EV?
I'm not. So, see, I'm a mossback.
Not even a hybrid?
No. My older brother has a hybrid, but yet I do not.
I keep waiting for what's
my
that car?
son has a hybrid.
There's another one. You're a gem. We wish you well.
Thank you.
Keith Naughton, Bloomberg News auto reporter. You will be missed. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are churning ahead of after the bell earnings coming up from both Alphabet and Tesla. Also, IBM will be reporting. Right now, we got Alphabet shares. We'll call that unchanged on the day. Tesla, meanwhile, down by 1%. We'll be all over those earnings as they break shortly after 4 o'clock Wall Street time right here on Bloomberg. S&P, as I mentioned, flat on the day with the industrials. Dow Industrials up 0.1%. NASDAQ and the NASDAQ 100 index both trading lower. They're down by about 0.3%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, pushing higher now by 0.9%. The 10-year 4.65%, the 2-year 4.29%, and the 30-year 5.14%. Spot gold at $41.34 the ounce. The precious metal up by 1.4%. Crude, big story today. WTI 87 even a barrel, up by 3.2%. Brent did see a couple of prints above 95, 94.25 now. Barrel of Brent crude up by 3.6%. Apple is readying an overhaul of its Mac line, seeking to capitalize on demand for powerful laptops and desktops fueled by the AI boom. Apple shares today down by 1.1%. Super microcomputer shares are soaring after the server maker issued preliminary results last night, saying its backlog hit a record on new orders in the quarter of more than 60 billion. Super microcomputer up now by 21%. For the first time in 10 years, the United Nations is set for a leadership change. Join us tomorrow, 5 o'clock Wall Street time, for special coverage of a UN town hall to hear candidates for the next UN Secretary General debate live from UN headquarters. Again, 5 o'clock Wall Street time, right here on Bloomberg. Recapping, S&P now down by 0.5 point. I'm Charlie Pellet. Carol and Tim. That's a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Hey, go back a couple of years, and our Bloomberg Intelligence team out publishing some research about connected vehicles, smart vehicles. And they said they were going to be those on the road to be a $742 billion market by 2030, spearheaded by Tesla, OpenAI, and NVIDIA.
Is your new car a smart car?
Yes.
Okay.
It's crazy.
Medium smart?
It's super
crazy smart. Okay.
Like, remembers how you pulled out of a spot.
That's
and then when
cool.
you come back later, it'll park it. And it's almost a little overwhelming. Like, I'm a little afraid it's going to take over for me. It's pretty amazing. So we are kind of thinking about this. And, fast forward to kind of where we are today, right, Tim? I mean, in a big way, so much is coming at us. And you layer on AI and how everything is moving so rapidly. You do think how it's transforming so much. And our next guest talks about how AI is quietly transforming some of the world's biggest industrial sectors. So we're talking about automotive, defense, aviation, and that many companies still risk being left behind here.
We've got with us Rory Hilaka, Oliver Wyman's partner in the firm's Transportation and Services and Digital Practices Group. Rory, good to have you with us this afternoon. You and the folks at Oliver Wyman have this big report out on the industrial AI divide, how AI is quietly transforming, as Carol mentioned, some of these big industrial sectors. What is happening, and who could get left behind?
That's a great question. And I think we're seeing a couple things happen right now, and it varies a bit sector by sector, where AI is rapidly becoming a focus area for automotive manufacturers and automotive companies, airlines, rail companies, industrial mining, you name it. And it's become something that is already starting to generate real revenue returns for companies that have embraced it early. If you think about leveraging AI for better price decision, better servicing of offers for consumer-facing transportation companies, you're starting to see those benefits. But at the same time, you're seeing, real differences in how companies are evolving when it comes to embracing AI for delivering, complex, very real-world transportation offerings. So think about a rail network, airlines and airspace, cars on the road. So there's a lot that's happening. We're seeing some real differences in kind of companies that have always been more focused on deploying AI as a real transformation of the business and their people, versus companies leaving it kind of more as this is something that the technology team has to go and figure out for how we embed it in our business. And so we're seeing real differences across the industries. It still feels like really early days in terms of the level of change and evolution that we're going to see, though.
You know, I'm looking at some various, statistics, in this report. Like here, 58% of aviation maintenance, repair, and overhaul professionals said that their value expectations from AI investments are being met or exceeded. That's up from 20% in 2024. How much, when we look at stuff moving around, whether it's, planes, trains, or automobiles, go where you want, is actually utilizing AI and it's making a difference? Are they all just at the beginning? Because it feels like, AI's been around for a long time, and I understand what's happened in the last 3 years is taking it to a whole other level. But give us an idea of how much is already happening.
It's a great question. I think if you think about certain things like manufacturing parts or cars or engines, AI and particularly machine learning have already helped companies realize substantial value. It allows you to much better model and predict behaviors of a closed system, allows you to design things, keep a factory up and running at a higher rate, which creates better economics. You're seeing it really in use and at scale in a number of those kinds of use cases. You mentioned airline maintenance, great example, where just having better visibility into the likelihood of a maintenance event and then being able to put the part in the right place, have the team ready to go, that drives real efficiency, and we've really seen that take off. When you think about using AI to do things like manage complex airspace and improve, what it's like on a Thursday in LaGuardia or going into Heathrow, we're starting to see that technology be put to the test, but you're dealing with a need to change a massive open system, use the interplay of the weather, aircraft networks, things on the ground, and that's a much harder problem to solve. So I think we're still in the early days of really figuring out how that's going to come together. And so I think there's a lot of change to come. And that will impact companies that touch all aspects of those operations and of that kind of value chain.
I think a lot of people are thinking about AI as a sort of layer of technology, the same way that we thought of the internet and just being online, maybe 25 years ago, and how that's sort of everything we do now is online. What areas, though, right now are missing not missing the opportunity, but have the most opportunity for disruption? Like, we don't see it yet because the technology's not quite there, but maybe we will in 2 or 3 years.
Yeah, it's a great question. I mean, I think the one sector we've probably seen play out really quickly over the last couple of years, given just the nature of what's happening in the world, is the defense sector. Certainly the role that AI plays in using drones in the battlefield. We've seen that, and we've seen the effects of disruption happening, new entrants into that sector, bring that technology to life. If I think about, in other areas like rail or aviation, I think the companies that are able to really rethink and transform how they manage their business, run their business, automate their business, change the role of people in the workforce, and do that quickly, they're going to find both economic efficiency and, frankly, improve the consumer and customer experience. And I think that's where you're going to see some real divides. And the challenge is, for a lot of these companies, you still need all of your technology infrastructure to come together and be able to support the use of AI. And that's one of the really big lifts. Modernizing systems, making the data available to inform, train, and support these kinds of models and tools, putting the physical infrastructure in place so you have computer vision. All those things are really the key.
Rory, just 30 seconds left here. U.S. versus China, U.S. versus Europe, in terms of industries embracing AI for the good, if you will. And just quickly, if you could.
Yeah, really quickly, I think all three are going to make great strides. I know that's a bit of a muted answer, but
if you have to pick one, who's ahead of the race here?
If I have to pick one, I think the innovation coming out of the U.S. is really remarkable.
Okay.
I think, and we're gonna see that play out in the next couple of years.
All right, really appreciate it. Good stuff, in-depth report, that's for sure. Rory Hayalaka, he is Oliver Wyman's partner in the firm's Transportation and Services and Digital Practices Group, joining us right here in New York City. When we come back, A check on trading ahead of some big earnings. We've got Alphabet and Tesla, IBM also, ServiceNow, a few others.
A few others. The S&P 500 pretty much flat. The NASDAQ composite down about 0.3%. This is Bloomberg.